Welcome back to Power Breakfast on CNBC TV 18. Now, Infosys, they reported their numbers yesterday, missed their estimates in Q4 FY26. Revenue contracted 1.3% sequentially. The company expects FY27 revenue growth somewhere between 1.5 to 3.5%. CEO Salil Parekh responded with no comments when asked about this as well, and his tenure, which expires in March next year. Will this, with all this also going in for Infosys, let's talk about other IT major companies as well. They missed estimates as well. To talk to us about more details on this front, Infosys and other IT companies, the scorecard there, let's go across to Rima to take us through all those details.
Well, as you rightly called out, slightly disappointing from Infosys. Revenues, margins lower than expectations. The company's revenues have declined by 1.3% quarter on quarter versus expectations of a 0.6% decline. Margins have gone up by only 20 basis points. The street was more hopeful given the currency depreciation. The Project Maximus that they're running, the margin expansion would be more. Even the deal wins for the company at $3.2 billion is lower than the average over the last 3 quarters, which was $4.5 billion. And I'm not sure if it's a sign of future pipeline, but the company's headcount has gone down by more than 8,000 in Q4 itself. The FY27 guidance, I must say, is in line with expectations, but it's not a positive surprise. And I think after the disappointing numbers and the guidance from HCLTech, the street here could have done with a little more optimism. Infosys is guiding for a 1.5 to 3.5% growth, revenue growth for FY27, as I said, in line with expectation. Margin guidance remains unchanged at 20 to 22%. Now when you take a look back at all the IT companies, because numbers are out, it's generally been a poor showing. In TCS, it was a margin disappointment. The street argued that, you got a revenue, you got a rupee depreciation benefit of 110 basis points, but only 10 basis points showed up in your margins. For HCLTech, it was a very weak organic revenue growth. Growth was only boosted by that Harman DTS acquisition. For HCLTech, that flagged off discretionary spending cuts at US telcos, SAP project cancellation, and now you've got Infosys also missing the mark. And when you look back at FY26, it's been a tough year. For TCS, it was a revenue decline of 2.4%, their first annual decline in revenue since inception. Wipro has been degrowing for the 3rd consecutive year. And for HCLTech and Infosys too, it was a modest growth of 3.9 and 3.1% respectively. And it's been 3 consecutive years of softness now for the Indian IT companies. And FY27, going by the guidance given by HCLTech or given the guidance by Infosys, doesn't look like it's going to be another significantly stronger year. Maybe more of the same, FY27. It's possible the companies are being conservative to begin the year with, but Infy's guidance of 1.5 to 3.5%, HCL's guidance of 1 to 4% is slightly on the muted side.
Okay, thank you so much for that, Rima. But let's also hear out what management of Infosys had to say in the post-earnings press conference.
So what we are seeing right now is financial services. We are seeing an acceleration of our growth next year. So we had growth in financial year 26. We're seeing more growth. In energy, utilities, services, resources, vertical, similar, good, more growth there. What we are seeing in terms of projects, we see that at the AI Investor Day, we shared that our AI services revenue was growing nicely. We see on the large deals, the net new is pretty large for the full year at 55%. So that gives us support for growth.
The last year, we had announced 20,000 for FY26, and we have hired more than 20,000 freshers from the market. This year also, we are expecting at least 20,000 freshers to be hired.
Okay, that's all about IT, but let's talk about Reliance Industries. They're set to report their Q4 FY26 numbers later today. Sonal is joining us now to take us through the key expectations. Sonal?
Well, despite the West Asia crisis and disruption in global energy markets, it is expected to be a steady quarter for Reliance Industries. The stock, which is down 14% in last 1 year, in line with the market disruption that we have seen. Overall, on a quarter-on-quarter basis, we are expecting the revenue to increase by 3%, but there will be an EBITDA fall to the tune of 3%, leading to a margin compression, which is expected to come in at around 16.3%. Profits, accordingly, will also see a decline on a quarter-on-quarter basis by 5%. We've been speaking about global energy disruption disruption, and that is something which will impact two segments, oil to chemicals segment, which is the biggest one, and oil and gas, which will see some disruption this time around. However, telecom and retail will continue to see strong YOY growth. So let's talk about those expectations. For Jio, it is expected to see a growth in EBITDA to the tune of 15%, led by 5% ARPU growth according to an estimate by Nomura. And if we talk about the retail business, that is expected to see an increase in EBITDA by 6%. The oil and gas business will continue to see a decline. That is because of lower KG-D6 volumes. There has been an interesting note from JP Morgan. They talk about how stock has given up recent outperformance on uncertainty related to near-term O2C margins because of disruption that we are seeing. However, they also add both refining and petchem margins should turn out higher than what the assumption is currently. Higher crude and weaker rupee should drive higher EBITDA for the oil to chemicals business in FY27. This is the trend in terms of EBITDA for the consolidated business. It has been increasing, but this time a quarter-on-quarter decline because of global disruption is expected. But overall, a steady quarter for Reliance Industries, and important to watch out for management commentary as well.
Okay. Thank you so much for that, Sonal. But, with that, we're absolutely out of time on this edition of Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, a Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis. designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's a Friday once again. And, between Fridays and Monday is when bulk of the price action nowadays happens. And we've spent many weeks now walking back what happens during these 3 days. So we'll see if this is a repeat once again or not. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Morning.
Hi, morning.
Hi, morning. Crude once again is higher, and we've got a lot of earnings to react to. But finally, guys, it's a Friday.
Well, that's right. But the global market's a little bit iffy, a bit of risk off. So let's see how it goes on Friday, and then we head into the weekend.
The weekend though is nowadays news-wise action-packed, you can look at it one way or the other, say that there's no price discovery. So you can just come back on Monday morning and just deal with whatever it is, right?
Sometimes you come back on a Sunday morning.
Sometimes you get back, and that's the problem. And that's the reason why, the weekend is not exactly the weekend. But take it from the beginning, right? So oil prices continue to climb, and just look at it where we were yesterday. Look at prices where we are now. So we're about $4-5 higher, and yesterday was high enough, 102. We're at 106 now, 106, 107. It's not good, absolutely. As I said, we are, of course, importing 5 million barrels of oil a day, and you're paying a lot more as compared to what you were paying earlier. By the way, the difference between, so what we track is paper prices, financial asset prices. But, there are reports that crude for delivery in Asia, physical prices are, north of $160. So it's starting to climb once again. And if you remember, beginning of the week, late last week, we were talking about how, even though the situation, lesser oil is going through the Strait of Hormuz with the US blockade now, physical oil prices had come off from highs of 140, 145 to 110, 120. And whether that was sustainable. I think it's moved back. It's moved right back across the board. And we'll talk more about this as we go on. In terms of news flow, there's not very much. US forces boarded vessels as, the Strait of Hormuz blockade continued. Trump ordered the US Navy to shoot and kill any boat placing mines in the strait. I guess this has already been done in that sense earlier. And of course, Trump also announcing Israel and Lebanon will extend their ceasefire by 3 weeks. But the main issue here is, of course, Iran. Trump also shot off a Truth Social post yesterday evening, essentially saying that, Iran is trying to figure out who the real leader is. So we need a figurehead to negotiate with who can prevail upon all the other parties in Iran. The fear, of course, is with the civilian government out of the picture now, hardliners are basically in full control. That is the IRGC. And this then becomes more complicated than before. Now, US equities, they closed lower, but off the intraday lows, they were down more. S&P down 0.4. The Nasdaq was down about 0.8, 0.9%. And technology stocks, both large, small, all kinds, basically sold off. Salesforce was down 9, IBM was down 8, Microsoft was down about 4% or so. And by the way, there were results from two companies, ServiceNow and IBM. And you look at the numbers per se, especially ServiceNow, numbers are not bad. Markets just, the guidance perhaps was a little bit of a miss compared to what the market expected. But generally, fears that some of the longer term fears coming to dominate the narrative right now, that, AI disruption, all of that stuff, it's almost deja vu. Look at the rest of the software names, right? And this is what Indian investors investing in Indian IT services also keep a close eye on. So Globant was down 9, EPAM was down 6.5, Accenture was down 6, Cognizant was down 6. Infosys, of course, reported numbers here in India yesterday evening. That was down 4%, and the Wipro ADR was down about 4% as well. So that's the situation. In terms of other news flow, Trump repeated his criticism of Powell, praised the incoming Fed chief, Kevin Warsh, and there's not very much new. And I'll just leave you with the levels here. Supports are 24,100, 23,900, and then 23,500. We broke 24,300 yesterday. We closed under it, but 24,100, very, very near term, 24,100 and then 23,900 are supports which markets will watch out for. As I said, today is a Friday. Go back and see what has happened the past many Fridays. You know, in the evening, you get some tweet, something from President Trump, and the markets jump, react one way or the other. Over the weekend, that reverses. And then the next week is basically spent walking back whatever happened Friday evening. So it's complicated. It's tricky, especially because it is Friday and then you're heading into a weekend when markets are shut. And the only way to react to any of it is Monday morning in that sense. We'll talk a little bit about the political stuff as well. Remember, polling in West Bengal, etc. Very high turnouts. What does that mean for chances for the BJP, which the market, of course, would like very much for it to come to power in Bengal? Is that, I mean, we can talk more about that. But 90 points higher on the GIFT Nifty is what the indicative opening is at. Well, Nigel is walked across to the wall, F&O positioning and the data. Nigel, over to you.
Well, the gap up could get sold into, I think, because the global cues are a little bit tricky, and then we'll take the path from there if in case we do start off 90 to around 100 points higher, because the geopolitical tensions continue to weigh. The dollar index, that's stronger overnight. Brent crude prices as well have spiked up to around $106 per barrel odd mark. So both those two, they are actually indicating a bit of a risk off. In terms of flows, the DI is bought, but they bought only around 1,000 crores approximately. The FI as well, they were sellers in yesterday's trading session. We did see that the FI as well, they sold close to around 3,300 crores or thereabouts. But looking at the Indian rupee then, yesterday we did see there was some kind of weakness out there. And after pulling back to around 92.5 odd, we are seeing some weakness on the Indian rupee. The Indian rupee, in fact, went to around that 94 odd mark. The FIs in the futures market, they've added shorts yet again. On the index, there were 5,000 contracts that were added on the short side. And on the stocks as well, there were close to 29,000 contracts that were added on the short side. And there was long unwinding both on the index as well as stock futures. The short point is, in a bit of a wobbly market, the shorts are piling back on. On the index, the FIs continue to remain net short with close to 79% of the positions on the short side. Moving to the positioning of the last few days, well, you can clearly see the FI short positions as the markets have come off from around the 24,500 odd mark. They've added close to around 16,000 contracts on the short side. While the clients, well, they had unwound some positions from a peak of around 170, 180,000 contracts on the long side. It had come down to around 1 lakh contracts, and gradually the last few days, they have in fact gone ahead and added some of those long positions as well. There appears there's a strategy in place because we have the monthly expiry that plays out on Tuesday, the 24,200 call as well as put. Both of them were fairly active, and there appears there's a short straddle at play. That is, you're writing both those two strikes and you're pocketing close to around 400 rupees. And if you're looking at that particular, strategy, then you have a broad range that comes up for you on the screen. So 400 points on either which way, 23,800 and 24,600 or thereabouts. The Nifty Bank, that's breached the 20 as well as the 50 DMA, on the Nifty Bank. But for the Nifty, these are the important levels. On the Nifty, the 20 DMA, that's the important reference point that you're looking at on the downside. While on the upside, the 24,320, which incidentally is the recent high as well. Yesterday as well, we almost went to that mark. That becomes a resistance mark. The Nifty Bank trading below the 50 as well as the 200 DMA. So that's the resistance zone out there. And Reliance Industries towards the end of trade, we'll keep an eye out on that because that could swing the Nifty since it runs into its numbers post-market as. So that big boy on your radar as well.
Thank you very much for that. But some concerning news. A lot of brokerages have started downgrading India. And the pace has picked up in the last couple of days. So today, it's JP Morgan downgraded India equities to neutral. It's Rajiv Batra who says they've downgraded Indian equities to neutral. The structural story of India is intact, but tactical headwinds warrant patience. He says the key drivers of the downgrade are 1. A valuation gap narrowing, but still stretched. 2. Earnings risk. 3. Dilution caps upside. 4. Limited next-gen tech exposure. And 5. The monsoon risk. Overall, he says they see better opportunities elsewhere in the emerging markets until the valuations derate further or earnings visibility improves. But back to the big story then about US and Iran. US President Donald Trump said that he is under no pressure to end his war with Iran, though the time is limited for Tehran. He wrote on social media, "I have all the time in the world, but Iran doesn't. The clock is ticking." However, speaking to reporters when asked how long he would wait for Iran's response to get a deal, this is what he had to say.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. Guys like you want to say, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. we're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you.
Okay, Mark Matthews of Bank Julius Baer & Co. joining in. Mark, thank you very much for joining in. Crude prices on the boil now 106, and it's hurting India, and brokerages are quickly downgrading India. It's not just JP Morgan. Yesterday, we spoke about HSBC. Prior, it was Nomura, it was Goldman Sachs, it was UBS, all sounding a bit cautious and saying the opportunities are better elsewhere in emerging markets. You've been a bull on India. Is that thesis changing?
I see the points that they're making, and they're valid, but I think you can come back with counter arguments. One very simple one is that the oil price will not stay at this high level if the Iranians and the Americans come to some agreement, and that is our base case. They're playing chicken with each other. Both can play a waiting game, but I think that Iran is the more vulnerable one because their budget is $56 billion a year. The American budget is $6 trillion a year, and Iran is losing about $400 million a day because of the blockade. So I think as much as Trump has the midterms to worry about and the high gasoline price in the United States, the Iranians have reason to come to the table, too. The major point of contention, of course, is nuclear power, and it's so deeply embedded in the Iranian psyche now that I don't know how they can get around that. But where there's a will, there's a way. So if the oil price does come down, and we do expect it to be back in the 60s by the end of this year, I would think intuitively the markets that have performed the worst since this war started would recover the most, and India is right at the top of that list. The other thing I would point out, just a technical thing, is the very strong rebound in the mid-caps. The Nifty mid-caps are just about 2% below where they were before this war started, and I think they're acting as a lead indicator for the Nifty itself, and so I believe that the mid-caps will make a new high, and then the Nifty will follow suit.
Mark, you would be an outlier in expecting crude prices to go back to where they were before the war started, back to levels of $60 per barrel by the end of the year. But markets are a game of probability. Assuming that oil prices settle higher, maybe around $80, $90, $95 per barrel, then how would India be placed?
Just to clarify, I didn't say $60 a barrel, I said in the 60s. So to be precise, our price is 67 by the end of the year. I think oil above 80 is a problem for India. So I think the economy can survive, but I think it's a price at which investors would just stay away because they would look at it as being, too high. I think India can manage economically up until 90, maybe even 95, because the infrastructure has improved so much and the machinery and the equipment in the country compared to, say, 20 years ago. But $80 a barrel would be broadly where I think the price point is, where people would, until we get below that, I think people will just stay clear of India.
Mark, we've got to talk about software as well, and we'll do that in just a bit. But just one more question, right? Do you believe that the so-called off-ramp... Look, markets are optimistic by nature, right? That things will get resolved. How can this go on? This is illogical because markets' collective wisdom is... they're based on logic and, the greater good and good stuff happening. But just look at last 12 hours or so. Do you believe some of these off-ramps are, in a way, fading, disappearing? All the statements, President Trump's posts, and the press conference by Hegseth and Kane. The one thing market's not ready for is re-escalation of actual, fighting, bombing or whatever, right? You think that is a risk at all, or no?
I think the oil price is partially factoring that in. It's, as you know, Brent is well above 100 again. All I can say is that it is in the interest of both sides to diffuse this confrontation. And of course, they're both putting up a lot of bluster. It's like when you're buying a carpet in a carpet store. Of course, the merchant is going to start with a very high price, and you start with a very low price, and you meet somewhere in the middle. But what I would also say, if you look back at the history of these oil price shocks related to geopolitical conflicts, there's been about a dozen over the last 30, 40 years. And the trajectory is always the same, that the oil price goes up quite steeply about a month or two, and then it comes back down. And that goes back really to the first Gulf War in 1990. It's always the same thing. I think in part because, apart from the fact that the political issue tends to get solved, also when oil is at the kind of prices it's at today, all kinds of marginal producers are profitable, from Canada to Brazil and shale in America, and they'll produce more. You have to go back to the 1970s, specifically 1973 and 1979, to see oil price shock that ends up lasting for years. And I don't think we're looking at one of those.
All right. Hi, Mark. Very quickly, I wanted to ask you about Google announcing the big capex plan, agentic platform overnight. They're talking about $170 to $180 billion. How worried are you about all these large capex that have been announced in the last few months, and overnight as well, the one that we heard?
Yeah, clearly the capex of the hyperscalers has been the reason why those shares have not outperformed over the last half year or so. Previously, the big tech stocks in America were these massive outperformers. And I would say that the forecast for the hyperscalers in general, not Google specifically, but the hyperscalers in general, is that their capex will peak in the second half of this year. And if that's the case and they start implementing AI in the workforce, unfortunately, that may come at the cost of a lot of people's jobs. You might have seen the report a couple of days ago from Meta that they're going to fire 10% of their workforce. Anyway, I think that what we will also see very soon is the direct impact of AI in these companies' P&L statements that will be very, very accretive and cause a return on investment. So I think the market is already starting to see that, and it's starting to come back to liking the technology sector again.
All right, Mark, thank you very much for joining us. Good speaking with you, and it's a pleasure having you here on CNBC TV8 as always. Let me just quickly run you through the interactions which are lined up in the program. 8:35, we've got the management of Aequs joining us in just a bit. So we talk about the company's business outlook, FY27 roadmap. 9 o'clock, Bhavin Shah of Sameeksha joins us on Infosys and other software companies. Gautam Shah of Goldilocks Research will be your market master of the day. 9:30, we have Aditya Birla of Aditya Birla Sunlife AMC to talk about the fourth quarter numbers. Management of Himadri Specialty Chemicals will be speaking with us at 9:40 on their earnings towards the end of the program. Lata discusses with PIMCO's representative on where oil prices are headed as the war drags on. Stay tuned.
Time to slip into a short break, but we've got a lot of stock-specific action to track for you. We'll get to that in just a bit. For the time being, I give you a sneak peek into the list. Tata Capital, Himadri Specialty, IKS Health, Bluestone Jewelry, Mahindra Logistics, all of them will be reacting to positive news flow. While on the flip side, Infosys, Cyient, GMR Airports, they'll be reacting to negative news flow. While you'll have, LTI Mindtree and United Breweries that could open up next.
Welcome back. You're watching Bazaar Morning Call. It's a Friday morning. It's time to talk about stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. Hi guys, good morning. But let me begin this one with Infosys, which reported their numbers. The ADR was down 4%. The stock, by the way, in the last 5 years has given no return now. In fact, in the last 5 years, stock is down nearly 7.5%. Missed the mark on revenues and margins. Revenues declined by 1.3%. EBIT margin expansion of 20 basis points was less than what the street was anticipating. And the deal wins cooled off compared to what we had seen in the last couple of quarters. FY27 guidance at 1.5 to 3.5% top line growth. Margins at 20 to 22%, in line with estimates, but no positive surprise. Jefferies says they've got a hold call. The dividend yield limits the downside, but weak growth caps the upside. Citi has a neutral call. They've cut EPS estimates by 1 to 2%, but they still expect the company to outperform peers. Nomura, though, has a buy call, and their target price stands at 1640. So disappointing numbers, but remember the stock has fallen 5.5% just in the last 2 days after HCLTech reported the numbers. So how much of this is already in the price?
All right, got that, Rima. Thanks a lot for that. So disappointing numbers, as Rima said, but the stock has seen some kind of pre-positioning as well. Hopping across to Ananya, though, she's here to tell us about Tata Capital's numbers. Morning, Ananya.
Tata Capital has ended FY26 on a strong note. Let us look at the AUM growth. So AUM grew 20% YOY and 6% quarter on quarter. Excluding motor finance, the core franchise looked even stronger with AUM growth of 28% YOY. Now profitability was very impressive. PAT rising 43% YOY. Excluding motor finance, PAT growth was even stronger at 51% YOY. Now asset quality trends were clearly encouraging. Credit costs improved to 0.9% from 1.2% in the previous quarter, while gross stage 3 improved to 2% from 2.2%, and net stage 3 improved to 0.9% from 1% in core book. Now, management highlighted that slippages are now at their lowest in the last 8 quarters. Now, on the business mix, retail and SMA continue to anchor the book with at around 86%, while unsecured retail stand at 10.3%, giving the room to the company to expand the segment more, which was also highlighted by the management. And most importantly, motor finance is now stabilizing, showing early signs of recovery, and management expects growth momentum to pick up by FY27. They expect ROA at 2% by FY28 for motor finance. Now, most importantly, management commentary remained quite constructive. They guided for 23 to 25% AUM growth in FY27, expects cost of funds to be lower than FY26, better margins with better product mix, and expect credit costs to normalize around 1%. So overall, this was a very strong quarter for Tata Capital. They are now focusing on growth, profitability, and AI-led initiatives.
Thank you very much for that, Ananya. LTI Mindtree also, it's an okay set of numbers. Again, no beat, maybe slight downside to consensus expectations. The company's top line growth 1.2%, EBIT margins at 15.1%, lower by 100 basis points on account of the partial wage hikes implemented 1st of January and productivity commitments in key accounts, partially offset by the forex benefit. But in the conference call, while the company didn't give out a specific guidance, they did say that they're aspiring for industry-leading growth in FY27, and they're looking at doubling their revenues in the next 5 years as a part of their Lakshya 31 strategy, and this includes inorganic. So Q4 numbers are okay-ish, maybe slightly soft, but the guidance by the management is fairly optimistic, looking to double their revenues in the next 5 years. But it's over now to Sudarshan for United Breweries.
So Heineken, the parent company of United Breweries, yesterday reported the earnings, and in that they have commented about the India business, which continues to be led by the premium segment. So led by Kingfisher Ultra Premium segment, volume has grown by mid-teens, while in India net revenue has grown by low single digit, and total volumes have come in only in mid-single digit. So because of mixed set of earnings, I'm going with yellow for United Breweries.
Thank you. And one more IT company that's signed, and here it's a disappointing set of numbers. Now, Sign's overall revenues have fallen by 7.2% on a year-on-year basis. Now, Sign's top line consists of largely the DET business, which is digital engineering and technology, but they also have a very small contribution coming in from semiconductors. So 7.2% is the overall decline. But in that, if you look at the DET business, that too has seen a decline quarter on quarter and on a year-on-year basis. And brokerages have cut the EPS estimates following a poor show. Broadly, by 2 to 4% are the EPS cuts seen for Sign, so a negative performance here. But moving on now to non-IT names, Bluestone Jewelry, Mahindra Logistics. Sudarshan, how did it look?
So like all the other jewelry companies, when Bluestone Jewelry has reported a very strong set of earnings, revenue has increased by almost 50%. Adjusted EBITDA has seen a surge of more than 240% year-on-year, and same-store sales growth too has seen an increase of more than 30%. It's 34% year-on-year. Next one, Mahindra Logistics, also a strong set of earnings for Q4 FY26, has reported a profit against loss in the same quarter last year. Profit at 20 crore versus loss of almost 7 crore. Revenue has increased by 14%. EBITDA too has seen a jump of 43%. All the major segments have seen an increase in the revenue in the range of 14 to 25%. Express business revenue up 25%, freight forwarding revenue up 14%, and mobility business revenue has seen a jump of 22%. So I'm going with green for both these names.
All right, thanks a lot for that, Sudarshan. Hopping across to Sonal, she's here to tell us about Himadri Specialty, whose numbers look pretty okay. Morning, Sonal.
Good morning, Nigel. With Q4 numbers were decent. Revenues are up 14% to come in at 1,288 crore rupees. EBITDA up 21% at 280 crore rupees. Margins were down 100 basis points, but profits were up 8% to come in at 208 crore rupees. However, if we look at FY26 numbers, revenues are flat. They came in at 4661 crore rupees. EBITDA was up 19%. Margins were also higher, but profits were up 36%. So yes, there was EBITDA growth, but revenues are flat. So we'll need to know whether that was because of lower realizations or lower volumes. They are a net cash company, but net cash reduced on a YOY basis to come in at 121 crore rupees. A lot of capex that they announced earlier has come on stream. So we'll have a conversation with the management today to understand what the outlook is going forward. But going with green on Himadri today.
Okay, all right. Cut that, Sonal. Going across to Vivek, though, there's a large trade, I think, in the offering. GMR Airports is the stock in focus, Vivek?
That's right. Good morning. So GMR Airports is in focus. A rejig as far as the promoter holding in the company is concerned. French company Group ADP, that held almost 30% stake in the company at the end of Q4, is going to sell up to 7.3% stake in the company, and this particular stake is going to be sold to the GMR promoter group only. Now, the first tranche of this particular deal is a 3.4% stake that will be sold at $256 million, indicating a little over 15% discount to the last closing. Other than this, they will sell an additional 3.9% stake before 30th April 2027. Again, this particular stake sale will be done at 3,100 crore or close to 285 million euros. Now, this is the equity portion of the deal. Along with that, GMR will also buy back the FCCBs with interest paid as well. Now, the key thing to watch out for is number one, source of funding as far as GMR promoters is concerned, whether there's going to be any pledge of shares or whether they are raising debt. That will be the first part. The reason why Group ADP is selling this particular stake is that they have mentioned that they will use the proceeds for debt reduction at their level and also for a special dividend that they intend to go ahead and give. So now what happens is GMR family stake increases in GMR Airports and Group ADP stake marginally reduces.
All right, Vivek, thank you very much for that. Keep an eye out on that stock as we open up this morning. IKS is the next one we want to address, and Vinny's got details here. Vinny, take it away.
Hi, good morning. So IKS Health has actually announced to acquire TrueBridge, which is a US-based company. So they will be acquiring this through their wholly owned subsidiary, IKS Inc. 100% stake is what they'll acquire. TrueBridge is a listed entity, so they will first delist the entity and then they'll merge it with the company as well. Do not forget the funding for this. How is that going to be happening? They're going to be approximately raising 600 million debt, which will be secured for a term of 5 years. The enterprise value right now for this acquisition is around 550-60 million. So watch out for that as well. The deal is expected to be completed by Q2 FY27. It's an EPS accretive and a profit accretive in FY27 deal is what they're saying. Margins. Now, when you look at IKS's numbers, 9-month time period for FY26, margins were at around 33% that you could say. TrueBridge, the adjusted margins for this period would be at around 20%. So overall, the pro forma EBITDA margins right now would come in maybe at 26%. So maybe the dilution we could see for some period of time. But IKS has that history, equity which they required. They managed to bring the margins in just 4 quarters to the company level margins. So that'll be interesting to see in terms of margin front. A lot of synergies that will come in for the company as well. Given this acquisition comes in, they serve some rural hospitals where IKS Health is not there. There will be cross-selling that will be beneficial for them as well. And outsourcing penetration for RCM will be key. Management has given a vision of 2030 as well. Net debt, they expect that to be at around 300 crores. While in terms of revenues, they expect that to reach 3,000 crores from currently around 1,000 crores.
Thank you, Vinny, for that. Here's a quick recap then of the top stocks. Stocks with positive news flow are Tata Capital, Himadri Specialty, IKS Health, Bluestone Jewelry, Mahindra Logistics. Stocks with negative news flow are Infosys Science and GMR Airports. We'll wait to see how LTI Mindtree and United Breweries. It's a mixed picture for them. But moving on from equities and stocks to commodities, Manisha joins in as always.
Thank you so much for that. I'll start with the crude oil prices, where we have seen the Brent climb above $106 a barrel right now. It has been a 4% of gain overnight, and this is one of the very strong weeks that the crude oil prices are putting across. 18% up for crude in this week, with the U.S.-Iran peace negotiations stalling, and it's also about Iran seizing a vessel in Strait of Hormuz, U.S. forces boarding a supertanker carrying Iran oil, and then the U.S. ordering the U.S. Navy to shoot and kill vessels laying mines in the strait. All of that is adding premium to the prices. Markets also reading into the fact that it has been about March and now April as well, 2 months that the Strait of Hormuz has been partially or mostly closed, and that impact also is coming into the crude oil prices. For the longest time now, we have seen the futures continue to trade lower than what the physical markets are doing. So the physical crude is trading $20 to $50 a barrel on the higher side versus the futures market. So it continues to be quite strong, with more and more banks and brokerages now putting out their forecasts on higher crude oil prices in the month of May and beyond. But it's not just crude. The Baltic Dry Index is at a 4-month high. You have Wind Energy Index at 2008 highs. Lithium carbonate prices have gained up by 50% in this year till time. The only thing that has seen a bit of a decline is the precious metal prices. So gold and silver headed for a weak week, but everything else in energy and metals on the positive side.
All right, Manisha, thank you very much. For that, we'll take a quick commercial break here. We'll connect with the management of Aequs to discuss the company's business outlook and F527 roadmap. Stay tuned, coming up. Okay, welcome back. We've got our first management on the program now. Aequs is in focus. This after news came out that global toy giant Hasbro is looking to stop placing purchase orders with Aequs. Just look at the stock price for the last 6 months. If you can have a price chart up, it's really picked up. Had a subdued kind of list, had a decent listing, and then didn't do anything for a while. And in the last 1 month, it's up almost, I think, 50%. Actually, bulk of the gains have come in the last 1 month. Almost a vertical spike. There's, I guess, been buying from some, funds in the defense space as well. I think HDFC defense fund has been buying this, some of the names, of course, publicly disclosed. For those of you who don't know, Aequs, of course, is into aerospace component manufacturing. Works with some of the largest plane companies in the world, actually both, that is Airbus and Boeing. And of course, it's also got a toys business. Most of it, of course, goes outside India, which is exported. Arvind Meligari is with us, Chairman and CEO at Aequs. Mr. Meligari, good morning. Great to have you with us here. Thank you very much for joining us. Prashant this side. So, the news around Hasbro, sir, if you can tell us what's happened and whether this is cancellation of an existing contract which was running, or this is the intent to stop purchasing in the future.
Yeah, thanks, Prashant. Good morning. Look, it's customers make their choices, and we are basically dealing with that decision what they made, and it came as it was not something which we are expecting at this point in time, but historically the customer has been up and down, and we have other customers who are more strategic. We are working with them, and we feel that end of the day, this decision came and we had to communicate, and we have communicated, and this should not have any impact in our growth overall as a business. As you know, overall, aerospace is 89% of our business as of today, and overall consumer is only about 11-12% of our business, and our consumer is majority of the consumer growth is driven by the consumer electronics as we go forward, and with the specific to this specific customer, we are working with them on a separation agreement and figuring it out. And as we get more information, we'll share. And hopefully by the time of our conference this quarter, we should be able to give more clarity. But overall, I can say in the big picture and long run, it should not have any impact on overall what we want to be as a company.
Okay, 89% is aerospace, and that is how's business there, sir? I mean, is that
grown 30+% last quarter, and we see a good visibility. We have $815 million order backlog. We see a multi-year, next 5-year growth path, very, very solid for us.
Has this war and so many, some of the largest airlines in the world, of course, cutting back, right, aggressively. Some of the biggest capex spenders have been airlines out of the Middle East in that sense. So it's like a butterfly effect, right? Airlines cut back, hits the plane makers, and then in turn it comes down to component providers like you. Has that ripple effect shown up in any way?
Not really, because if you really look at it, aircraft order cycle is 10+ years out, and currently our customers have, Airbus and Boeing both have like a 10-year order backlog. And if anybody wants to delay or cancel, there are plenty other people who are willing to pick up. And this industry has lived with oil prices going up and down all their life, and they know how to manage. All these are short-term bumps, and we being a supplier to the OEMs, we have no impact from that perspective. In fact, customers are making sure that we're able to ramp up, which Airbus is going towards 75 aircraft per month on an Airbus A320, and they're making sure that we can support that from current level of somewhere around 55 to 60 level. So that ramp continues to happen, and Boeing is ramping up. So we don't see that as an impact at all, because we don't really support aftermarket services. And aftermarket is where this impact will be seen, and that happens already happening in the market, and mostly in Western customers. We are seeing that impact because number of flight hours will be less. That means less maintenance will happen. So, but we are not exposed that much to the aftermarket side of the business, and OEM order book is solid, over next 10 years.
Mr. Meligari, morning. This is Rima here. Just getting back to the Hasbro issue and trying to understand the why behind the exit. Hasbro has been a partner for you since 2016. Any indication given by them for the reason for stopping new orders? Was it an account of pricing? Was it an account of quality issues? And you would have heard in the industry, right? Who would their partner be? Is it someone outside of India? Are they looking to tie up with someone in Vietnam, Mexico?
They've basically communicated their strategy has changed, and they want to, more focus on Indonesia. That's what they've told us. And we respect their decision, but there are obviously, certain things which we have to work through between us to make sure that it happens properly. And our teams are working together on that. So it's a global business. That's what we have to live with. And we are competitive. We have been competitive all along, and we have delivered value to them over the last 10 years. And we continue to deliver value to our other toy customers. And I don't think that has changed anything in our way of where we are doing the business.
But you just infused 14 crore into the toy subsidiary. Now, will this, with Hasbro orders not coming through, will there be a significant underutilization of your asset? And on account of this, in FY26, will there be a widening of losses purely for the toy subsidiary versus FY25?
No, it won't be, because our order book is still solid for the toys. We will continue to deliver current orders what we have for Hasbro also, and also Metal. As you know, Metal is another large customer to us. We have a large contract with them, and the investment has predominantly gone towards to support their requirements. And we don't see that as an impact. And we are whatever we had planned for the current year, we'll continue to execute that.
Okay.
Yeah, got that. You will continue to execute. Just F5, since we have you, Mr. Meliguri, F527 for the business, where will you end up at a net level, just broadly? We won't hold you down to the numbers. It's a volatile environment, but what's on your mind?
Well, look, I can't, we are literally at a period where we cannot communicate from that numbers perspective, but generally I can give guidance. We continue to grow aerospace at 35% level, what we see, growth level. And our consumer business is growing at 50% level, year on year. And we feel very solid position in there right now, And we have no reason to be concerned about our growth opportunity, and execution is where we are focused on right now. And as our consumer utilization improves, our margins will reflect that very, very, very quickly. And that's our focus right now.
Got that. Thank you very much. We wish you all the best of luck, Mr. Meliguri. Appreciate your time here, and thank you for joining us. So that's Aequs with perspective on the business. I mean, almost 90%, of course, is aerospace, 35% growth guidance there, and 50% on the consumer side is the... I mean, I think perhaps that is the reason why, even though that Hasbro news did come 2 days back, stock barely budged. I mean, sort of, in a way, shrugged that off. And yesterday it was down 2% along with the rest of the market. We'll take a quick break here. Siddharth Khemka of Motilal Oswal Financial Services with us on the other side.
Welcome back. Let's welcome Sid Khemka of Motilal Oswal Financial Services on the show. Hi, Sid. Good morning. Good to see you again. So we've got a lot of IT companies that have come out with their numbers, and leading the pack on the disappointments is Infosys. Though the sector itself has been a little bit under the weather all of this week, and Infosys is down 5.5–6% just in the last few trading sessions. Any of these disappointments in terms of numbers are presenting buying opportunities? Would you look to get into any of these tech names?
Nigel, glad to be on the show. So I think a lot of numbers, yes, but clearly the commentary shows that the near-term weakness would persist. And especially if you look at AI, what we see is that it's a two-edged sword. On one side, while AI-driven projects are being seeing some traction, the AI benefits that the companies are acquiring are being passed on to the customers. Hence, we are not seeing any accretion in terms of margins. Clearly, there is a miss from Infosys, and what we have done is we have cut our estimates by about 2 to 4%, while the deal wins remains healthy. But as I said, the AI productivity savings are being passed back to the clients, and hence not being visible in the numbers. The only part that I would say is that a lot of these negativities already in the price. Unlike an HCLTech where we saw a big disappointment, I think with Infosys, the disappointment is only to the extent of the softer guidance. So we may see some subduedness in the near term. But again, if you look at the balance sheet, the strong free cash flow that they are doing, dividend yield now climbing to about 5.4%, the downside for Infosys looks limited.
Downside for Infosys looks limited. You know, some interesting lines came out from the Infosys conference call yesterday. Salil Parekh said on AI rationality, on pricing, etc. He's like, we do see sometimes a particular sort of competitor doing pricing which seems unusual. Unusual was the word he used, but that's happened over the course of the last many years for different reasons. It now may be linked to clients' mind to AI productivity. So there are instances of unusual pricing. And then when they were asked on AI pricing, the CFO, Jayesh, said that AI projects come at better pricing and therefore reflects in better margins. But they also have a higher cost compared to the regular project because talent is a premium talent at this point of time. So they may be making more, but they also have to put their best talent on it. So the costs associated with these AI deals are also on the higher side. Siddharth, you're looking at Fortis Healthcare. Recently, Motilal Oswal initiated coverage and you believe the turnaround is complete now.
Yes. So, Rima, if you look at post the change in management, what we are seeing is that the ownership has moved to IHH Healthcare. That happened in FY19. The company transformed into a professionally managed platform which supported the balance sheet cleanup. The company exited from some of the non-core assets. Plus, we also saw the financial performance improving meaningfully from there. And hence, what we are also seeing is that the EBITDA grew at about 33% CAGR. There was capacity expansion and as well as efficiency gains. From here on also, now we believe that there is a strong rationale for looking at Fortis going ahead, given that the improving growth as well as margin trajectory would lead to further growth both in terms of EBITDA at about 18%, 17 to 18%, and net profit CAGR of about 22% going forward. So overall, what we see is that it's a strong story post the turnaround as well as the cleanup of balance sheet. There is a healthy brownfield-led expansion that is happening, plus the diagnostic recovery that aids incremental upside. The Agilus diagnostic is emerging from the transition, and now with utilization-led growth, improving realization as well as hospital integration, that is driving the gradual margin expansion. So overall, a strong earning compounding with the improving return profile. We believe that there is further scope for re-rating as the return ratios improve. Hence, we have rated the stock as a buy and with a target price of 1100.
Okay, you know, what we're going to do is, Sid, stay with us. we're going to look at some of the delivery stats yesterday. With regards to big moves, are they backed by delivery or not? Gives us a good indication of what's going on. Hormuz, as always, has got that list. Hormuz, take it away.
Morning, Prashant. And two sectors that stood out in yesterday's trading session. Let's start off with the positive one. Was first up. It was pharma, undoubtedly. And almost every other pharma company did very well in today's session, with be it Dr. Reddy's or stocks linked to Dr. Reddy's. Dr. Reddy's, OneSource did very well yesterday. Shaily Engineering, Piramal Pharma, all of them were up anywhere between 8 to 10% in yesterday's trading session, and all of them gained on very high volumes as well. Dr. Reddy's had more than 1.5 crore shares were traded. That is at least 6 times higher than its 20-day average. OneSource was 4x its 20-day average. Shaily was 3x, and Piramal Pharma had over 5 crore shares that were traded. The 20-day average is only 30 lakh shares. And even if you take a look at the delivery front as well, Dr. Reddy's had close over 20% of its shares marked for delivery. OneSource, Shaily Engineering, Piramal Pharma had 5x of its 20-day average marked for delivery. Over 50 lakh shares were marked for delivery. The 20-day average is less than 11 lakh shares. So a good day for pharma stocks backed by volumes and delivery as well. Now, Data Patterns was another stock that did very well in yesterday's trading session. It was the third straight day of gains, and in this 3-day period, the stock has gained almost 20%. And volumes are on the rise for 5 straight sessions now. And Thursday's volumes were double that of Wednesday. Close to 60 lakh shares were traded yesterday. 20-day average of 10 lakh shares, and 7.2 lakh shares marked for delivery. The 20-day average is 2 lakh shares on this front. The stock in the month of April has declined only thrice, up 37% so far this month, and had a 52-week high on Thursday, the most traded non-Nifty stock on the Nifty 500. And lastly, the segment that did not do well yesterday was the auto stocks, and Ashok Leyland, TVS Motors, Mahindra, the entire sector faced some selling pressure yesterday. And all of the put options on these stocks were very active, premiums going up anywhere between 50% to 80% in yesterday's trade. Now, if you take a look at the volumes as well, Ashok Leyland's volumes were in line with the 20-day average, but that is, of course, there was one day when it had some outsized volumes over the last 20 sessions. But look at TVS Motors, 3x its 20-day average, Mahindra and Mahindra 2 above its 20-day average. And on the volumes front as well, TVS Motors had 12 lakh shares marked for delivery. The 20-day average is 5 lakh shares, and for the other two, it was mostly in line or slightly above their 20-day average as well.
Okay, all right. Got that, Hormuz. Thanks a lot for that. Well, we'll slip into a short break. We come back, we get the pre-open rates. We'll also have Bhavin Shah of Samiksha Capital, who will be joining in to discuss Q4 numbers of Infosys. Stay tuned.
Welcome back. Siddharth Khemkar, Motilal Oswal Financial Services, is with us with what he'd want you to do with regards to specific trades and, of course, the broader market sentiment as well. CleanMax is a company, Sid, I don't know if you've looked at it, debuted recently. It's just 2 months old. I think this is the second month. 1,052, it's been a good month. Listed at about 960, it's at about 1,052, or listed at 960 and then fell to about 700 and is back at about 1,050. One of the larger players with regards to setting up renewable capacity, especially for the commercial and industrial side. Basically, they work with businesses on long-term power purchase agreements. Returns are, it's a high capex business, but I think returns, etc., are assured, kind of regulated, but assured for the life of the contract, which could be as long as 15, 20, 25 years. Any thoughts, Sid?
Prashant, unfortunately, they have not looked at this company, but what we believe is that this entire renewable energy business, especially given the current global energy crisis, should do well. We are positive right from the utilities, which are the renewable generation companies, to the distribution. And even yesterday, we came out with a report on Fujiyama Power Systems, which is an integrated play on the rooftop solar business. We believe that India's target of about 100 gigawatt rooftop solar target, which is a strong policy push from the government, plus the company, both backward integration is driving margins, plus capacity expansion, and its integrated product ecosystem, which is your solar, storage, as well as electronics. That benefits from a rising adoption, plus the bundled solutions that they are providing. And with a pan-India network of presence of 900 plus distributors, 6,000 dealers, and enable it to see a good deep retail penetrations, supporting the scalable growth and demand. So overall, we like this space, and some of our top picks, Acme Solar in the power generation, Fujiyama in the distribution segment.
All right. Sid, I wanted to ask you about the Vedanta stock. From the time the demerger is announced, the stock has come down to around 735 rupees. And there could be various reasons, right? Some of those that have the position in the F&O, they may not want to hold it because now they'll be left only with the holding company, at least for the next 1 month, since only Vedanta Limited will be listed initially. Besides that, from a fund manager perspective, sometimes there's a restriction on the number of stocks they can have. So from having one, they'll suddenly have 5. So that's why they'll be forced to knock off a name. And that could be the reason that we have seen a bit of a pullback. From 780, 790, stock has come down to 730. What's your view on the stock? I'll tell you where the upside comes in from. You have Hindustan Zinc that is listed, so you get bulk of the value from there. And the aluminium business, the street is still working with $3,000 a ton when the price is actually $3,500 per ton. Would you be interested, or do you believe Vedanta has run its course?
Yeah, Nigel, I think some of these corporations do lead to some of these non-fundamental technical factors. As you rightly said, some of the portfolios would not want the stock to see a loss in the between and wait for 1.5 months, 2 months for the new shares to get listed. Plus, I think a lot of run-up has happened in anticipation of this demerger, and some profit booking is taking place. But what we believe is that Vedanta is kind of a proxy play to the overall metals commodities sector cycle that is seeing sharp up move. So the global commodity up cycle is likely to continue, supported by the ongoing cost reduction initiatives that the company is doing, plus the capacity expansion towards the higher value-added products. Yes, some of the core businesses of the 5 that will eventually get listed, aluminium, iron ore, and then your oil and gas. I think these are the 3 commodities that will remain listed, and the aluminium business is something that would be bulk of the valuation that it will command. I think tactfully, if someone is willing or have the patience to wait out for the entire demerger process and the relisting, I think it's a good opportunity to add on dips before the record date and benefit, because once the new companies get listed, we'll again see a lot of fund managers, institutional interest towards the specific commodities which are getting listed separately. So I think, yes, it's a steady growth outlook, plus it's a good opportunity for investors who are willing to wait out the entire demerger process.
Okay, got it. All right, Sid, thanks a lot for joining in. In fact, we'll be deep diving into Vedanta on Editor's Roundtable later today. I'm going to explain the business, and then we're going to be putting some important questions to Sanjay Parekh as well. In the near term, there appears there is some profit taking that's taking place on the counter. Thanks, Sid. Have a good day ahead. Well, let's welcome Shrikant Chauhan as well as Sudeep Shah, who join us on the show. Hi, gentlemen. Good morning. Good to see you all in. Sudeep, you go first. What's your take on the Nifty? Last few days has been a little bit iffy. The problem is crude oil prices as well have spiked up by $4-5 a barrel overnight. Where does support come in on the Nifty? And with this 100-point gap up that the gift Nifty was suggesting, what would you do?
Good morning, Nigel. Nigel, see, if we see the trend of Nifty in the last 10-15 days, right from the lows of 22,200, there has been a steep rally now. Suppose that it's just a bit of consolidation that we have come under. And overall, from the lows of 2nd April, 22,182, and till the highs of 24,600, even if we see, say, somewhere around the 23% retracements also works out somewhere closer to 24,000. So what we feel is that this 23,950, 24,000 band will act as an important support on the downside. It is just that the last 3-4 days have seen some bit of profit taking and some bit of fatigue at higher levels. But I feel that 23,950 now will act as a stronger base. We might still continue to consolidate, but eventually higher levels of 24,500, 24,700 looks likely. So buy on dips would be my strategy, even if the markets are opening, say, a flat or a 30 to 50 point gap up or gap down as suggested by Gift Nifty. But overall 23,950, 24,000 will act as a stronger support.
Got that. Sudeep and Shrikant, good morning. Shrikant, what about you? How are you looking at things?
Good morning, Prashant. Good morning, Nigel and Rima. So when looking at the setup of the market and the way it retraced to the levels of 24,500 and 600, and now again the things are like turning little bit negative, like currency is above the levels of 94 and crude is around $105, $106. I think till the market is not crossing 24,600, we can expect some correction in the market. And the important thing is that it should not close below the mark of 24,000. In case if we see the market is closing below 24,000, then we can expect further more retracement in the market. Even if we go through with the sector-specific performance, then IT is not at all performing. In fact, it is not supporting to the entire performance of the market. So in that particular scenario, we need to be more and more stock-specific rather than focusing more on indices.
And what would those specific trades be then, Shrikant?
So in that, I think, see, like since last 4-5 days, as the ceasefire had started without any deadline, the flows have started moving towards defensives, especially FMCG and pharma companies. In that, we like pharma companies because there we are seeing some strength and gradual upward activity. Most of these stocks are very close to their important resistance level. In fact, Glenmark Pharma has crossed its important level. And from current levels, the stock is currently quoting at 2350, but we can expect 2500 or 2600 sort of level. So there we need to be a buyer, even at current levels, more on dips with a target of 2600. The other space on which we are bullish is power and power equipment related stocks. So in that NTPC, Power Grid, I think these are the stocks to buy for. But while looking at the sentiment of the market, if we have to create any short position, then Ashok Leyland looks weak. Currently, it is around 170, 171 levels, but the stock can fall to the levels of maybe 160, 162. So here we should look for creating some short positions with a stop loss close to 174.
Okay, all right. And Sudeep, what about you?
Nigel, two themes which have picked up interestingly in the last few sessions. One is the capital market theme and the second being the defense theme. So from the capital market space, CAMS is that stock which is on my radar. closed almost say around 770, 775 levels yesterday. Stock has crossed its 200-day moving average after 4 months. Last it had broken down was in late December 25. So we feel that this space is once again becoming more vibrant. Buying on dips is visible here. So CAMs can be bought at current levels and on dips with a stop loss at 748. On the upside, the targets would be 810, 835 in the coming 1 to 2 months. It's kind of a positional portfolio trade. The second stock which is there on our radar is from the defense space, and that is Bharat Dynamics Limited, BDL. Here also there has been a clean breakout yesterday backed by volumes, and we feel that lot of most of these defense names have given good traction in the last few days. So with BDL also, we feel that this can be bought at current levels and on dips to 1400. The stop loss would be 1380. The targets would be 1480 and 1510.
Thank you, gentlemen, for that. We'll come back to you in pre-open. Infosys is down nearly 2%. In fact, all the 4 IT companies have disappointed in Q4. In the case of TCS, it was the miss on the company's margins, even though the revenue performance was actually pretty okay. The company's revenues went up by 1.2%, but the street argued that you had 110 basis points improvement in your margins, but only 10 basis points got reflected. In the case of Wipro growth, they've been struggling on growth. In the current quarter, they got the M&A boost, the Harman DTS acquisition, but it didn't really show up in the company's top line. Organic revenue growth was significantly lower. HCLTech had flagged off discretionary spending cuts in telcos, project cancellations, SAP project cancellation. So there was a sharp drop-off in the company's revenues. Infosys too has missed the mark on the company's top line and margins. And now when we look back at FY26, it's been a third year of weakness for the company. For TCS, it's the first negative revenue growth since inception. They ended the year with a cut of 2.4% last year. For Wipro, revenue declined 1.5%, declining for the third year in a row. HCLTech ended the year with a 3.9% growth, but they also missed their own guidance, which they had given in January, 3 months back. Infosys, 3.1% growth for the full year, but again, it's at the lower end of their own guided band of 3 to 3.5%. And the FY27 guidance isn't suggesting an acceleration compared to FY26, which is what the street was hoping for. For HCLTech, the revenue growth stands at 1.1 to 4%, while for Infosys, it stands at 1.5 to 3.5%. The takeaway is that FY27, no acceleration in growth compared to last year. Bhavan Shah, founder, CIO, CEO, Samiksha Capital, and he's been a close watcher of IT now for so many decades. He looks at the market, individual stocks as well, but he's got a keen eye on IT and the mood, the pulse, and the investor view towards IT. Bhavan, your first take on the IT numbers so far, and what does it tell us for FY27? What should shareholders, investors do?
Yes, I think it is certainly disappointing, although not unexpected outlook for the sector. If you compare it to say a year back, what people were looking for FY26 is clearly a step down in expectations and growth outlook for FY27. So obviously because of the confluence of factors, with the whole the AI-led improvement being the new and very significant factor at play. And so I think for the investors, there is not much to play with. Definitely not in the large cap IT. In a small mid cap, there might be some very, very select opportunities where there might be a company specific growth story playing out even amidst all this, because for a smaller company it is easier to still grab some new business and still deliver growth. But even there, if you would have noticed, the companies that were growing at say 20% are now people are happy to if they are saying 10 double-digit growth. So yeah, it is a tough space to be an investor, and it's in a portfolio. I would suggest very low allocation, if any.
Low allocation to IT, if any at all. So for this kind of growth, say a 2, 3, 4% kind of a top line growth and a little better on the EPS front, what is the appropriate valuation for large cap IT companies to your mind?
I mean, the way I look at it is, I like to say that to invest in a large cap IT, one would, these are liquid names, at least still some fair bit of stability in their cash flows. So let's say you are okay with 11-12% return. And then if the underlying growth is, let's call it maybe 3-4%, including some currency benefit, as you said, then you have to get down to low teens or 10, 12 kind of P multiples for them to be attractive investments.
Even taking into account the dividend yield, you're saying the appropriate valuation multiple should be low teens? Because there is significant derating from here on. Already, IT companies are at, say, 16, 17 times. But you're arguing for lower valuations.
Absolutely.
Okay. What about companies like a Persistent, Coforge, which are growing well? But as you pointed out, these were companies growing 20% plus and now perhaps will grow at 15%. Are these companies also trading at expensive valuations to your mind?
Absolutely. The whole sector needs one more valuation reset. We had one valuation reset. We saw a bit of a rally, but I think that rally is not going to find support. If you just notice overnight, the major tech companies in US, Meta, Microsoft, they all announced large job cuts. And we know that Indian IT services companies are essentially, they have been growing through the growth in headcount primarily over a long period of time. So when the whole industry is shrinking in terms of number of people required, then obviously it's not a great place to be.
Yeah. No, absolutely. Bhavin, morning. Prashant here. Good to see you. There is, and that's the point. I mean, high tech is, of course, getting impacted first, as someone said. Well, right. But everything else also perhaps gets impacted. But at the same pace or not is the question. From you've named names like Sonata in the past. I'm not sure if you still have that in the portfolio. I've heard names like First Source as some of the smaller companies, perhaps more agile, more AI first in their approach. Is there a way to look at any of these names as opportunities, maybe on the product side, and not just pure services? What's your sense, Bhavin?
Well, yeah, product, for example, we have some of these listed companies in the banking software space. They might have some bit of defensive position, especially in that space. But again, one has to look at individual opportunity. We don't have any investment there, but it's something one can think of.
Do we have him?
Then there is the, if you talk about, pure IT services companies, again, it is case specific. We don't own Sonata, we do own Mastech. It has corrected a lot. I think company has shown a very strong growth in order book. And so we are continuing to hold it, but, we won't go aggressive there either.
So you're not buying the dip on Mastech as well, a stock that you like and you believe in the long-term story?
He owns it. But
yeah.
Yes, we do own it, and we are, we have confidence in the management to deliver reasonable growth, especially considering the valuation.
Any other stock that you own in IT or you're looking to add?
We own stocks in IT related areas, healthcare IT, for example, companies like IKS, for example, or even Sagility. Again, we won't build more aggressive positions there or increase our positions there, but we think that these companies do have the ability to take advantage of AI. But they also face disruption. The shrinkage in how much customer would be willing to pay for the same work, and so on and so forth. So that pressure also will be there. But overall, we think that if they adopt AI well, then they can still grow because their end market is fairly large and still have room for growth.
All right, Bhavin, appreciate you joining in. I believe we had a late night cricket game, but made it in the morning for the interview. So appreciate you joining in and giving us that quick analysis. Have a good day ahead, and we chat up soon. Well, the markets, I think, are set to open up in the backdrop that actually the global cues are a little bit iffy because crude oil prices have spiked up, the yields hardened a little bit, and the dollar index as well was strong. I'm not sure what the rupee had opened up, but I think maybe we could get that as well up for you on the screen because the last few days it slipped from sub that 93 odd mark to around that 94.1 odd mark. So the rupee will be in focus as well since the FIs have turned smile sellers over the last few days, Prashant.
Absolutely. I think we got market open right in queue. What do we have? 24,130. So if you're able to get away with just that, I mean, outstanding. 24,160, actually in the green now, 24,190. The Nifty Bank is up about 0.25%, and the mid-cap index is up about 0.29. The small-cap index will come up on your screen as well with a quick sort of check. 1,200 up and about 420 lower. That's the advanced decline ratio. Almost 3:1 right out of the gates. And of course, that number will move around. But to begin with, this is, great. Yesterday, the two indices which were under maximum pressure were the Bank Nifty, which was down 1.5%, and the small cap index, which was down 1.5% as well. Nifty was down less than 1, mid cap index was down less than 1. So, that we'll see if private banks and public banks in the small cap space, how that fares at this point in time. It's a broad bid, I think, in the broader markets because both indices are up and about so far. What do we have in terms of the Nifty heat map? More up than down. Max Health, Grasim, Bajaj Auto and Indigo are some of the movers on the upside. And Infosys, HCLTech and Dr. Reddy's are stocks which are on the downside at this point in time. A little more pressure emerging. We're down about 46, 47, 50 points now. So 24,120. Rima.
Well, the culprit today is IT. The Nifty IT index is open with a cut of 1.5%, followed by the pharmaceutical index. Pharma index is down nearly 0.6%. So if you look at the losers right now, it's Cipla right on top, 2.5%. It had rallied yesterday. Dr. Reddy's was up 10%. It's given up a fourth of those gains, 2.5% down at open for Dr. Reddy's. Sun Pharma is weak in trade. The headline today in one of the pink papers is Sun Pharma looks to outshine rival bids with a $13 billion offer for Arginan. Excuse my pronunciation. Then you've got all IT names weak in trade. HCLTech continues to flounder, 13% lower this week. Infosys has opened in the red. The cut is not deep, but 1.5% lower in Infosys, reacting to numbers with a downtick. This week, Infosys is down 7%. And for the month itself, remember IT stocks had rallied nearly 10% going into the numbers. And now Infosys and HCLTech are actually down for the month of April. So they've given up more than what they had gained. Once that relief rally was taking place on the back of the rupee depreciation. ITC, ICICI Bank, Power Grid are a couple of the other names which have opened in the red. On the way up, you've got consumer names continuing to climb higher. So Nestle is on top. Coal India is seeing buying. ONGC benefiting with crude at 106. M&M, Max Healthcare up and about, Bajaj Auto, L&T, Eicher Motors are some of the other stocks. So it's slightly negative for the benchmark indices, but it's on account of IT and it's on account of Dr. Reddy's. And some news coming through on Dr. Reddy's. We'll wait that. I think Newsbreak confirmed about the semaglutide in Canada. But we'll wait for that flash to come through.
Well, that's right. A few stocks, Rima, that are looking quite good this morning. Rolex Rings, I think they have gone ahead and they've announced a buyback overnight. So that explains why that stock had popped up close on 2%. But otherwise, in terms of earnings reactions, well, there are quite a few actually. You have Himadri. That stock is up and about in today's trading session. Solid move is what we're seeing post its numbers. We'll hear from the management in just a bit. Bluestone, that's the other positive earnings reaction. So that stock as well has gapped up, and we'll hear from that management at around 10:30 a.m. CIE Automotive, that came out with its set of numbers as well, and that as well is fairly impressive. IEX, well, that stock has taken a pounding, but that's opened up actually in the green, up close to around 1.5%. IKS, they announced that they're going to be buying TrueBridge for around 550 million EV via debt, and they'll merge the company as well. The street's taken that positively, so that one as well opened up in the green. Some of these solar plays, though, have come in for profit-taking. Vari Energies is down, and Prima Energies as well. Both of them are down between 2 to around 4% because of the news flow overnight with regard to restriction into the United States. The ADD on solar imports that's been announced in the United States explains why both those two names are down. So though the headline index is still down 50 points, There are some positive earnings reactions that you're seeing. The breadth of the market is still positive, and the mid-cap index has moved into the green. So a flattish start on the headline index, but plenty of stocks doing a thing of their own from the broader markets.
Okay, well, I think, it's not a bad start at all, given, the combination of higher oil and the software sell-off last night, and markets are holding. I wonder, just at the margin, how much of this is, optimism around, the elections which are going on in West Bengal, the 90% turnout, voter turnout, which is unprecedented. And so I don't know, but, we'll know post, I think the last phase is 29th. Post the 29th of this month, we will know, which is basically next week. Let's welcome in Gautam Shah, founder of Goldilocks Global Research. Gautam, good morning. Great to have you with us here. Thanks for joining in. Gautam, you are in... Are you in Calcutta?
Morning, Prashant. No, I'm in Dubai right now.
You're in Dubai right now. Okay, I'll ask you a political question before charts, Gautam. So how are things looking here now in terms of the indices? Let's start with the Nifty Bank, etc. Fundamentally, Gautam, it's that kind of a market where 1,000 points lower, there are India upgrades which come. These are strategy reports. And the market rally goes up 1,000, 1,500 points, there are downgrades. We've literally seen that, at least three of them. And that kind of tells you about the state we are in. What's your sense, Gautam?
Well, I think the markets have been reacting to all the geopolitical news flow that we've got in the last 1 month, and all that's happened at the markets is because of that. I believe that the worst of the geopolitical news flow in some sense, because market believes that the peak intensity is out of the way. That could already be in the price. And I also believe that the good news from the geopolitical situation of a possible resolution to this war or a ceasefire is also in the price, because it's not just India. World over, we've had a massive rally in these last 3 weeks. While the Nifty is up about 11%, on an average, world markets are up about 15%. And if you look at the US market indices with what the S&P and the NASDAQ have done, it's clearly almost as if the market is beyond the geopolitical news flow right now. So as you might have been noticing in the last 4 or 5 days, despite all the news flow around it, the markets worldwide have not reacted much. I think with this recovery, the market has done its bit for now. I think 24,600 was an important resistance. We've seen a bit of a correction from that particular number. I think now we'll go back to normal business. And I don't think people should start extrapolating that just because we've had such a good last 3 weeks, it doesn't mean that all is well once again and we keep going up and start making new lifetime highs. I don't think that's going to happen, because we go back to normal business. We go back to looking at earnings, fundamentals, consumption, AI disruption, and all of these factors are still impacting Indian markets, and the fact that FI selling continues. So I think we will yo-yo in a sort of a range, 23,500 on the downside, 24,600 on the upside, and we need to go through a consolidation patch. So I am not excited at all for the Nifty or the top 100. I think they will just be very boring in a sort of a range. But the real opportunity, as I've said multiple times, is micro caps, small caps, and mid caps. The micro cap index is up 22% from the recent low of 90,000, and I think the outperformance is here to stay for the rest of the year. So staying in the right pockets is important. And with two major heavyweights of the Nifty, which is IT and Reliance, not delivering, it's very difficult for the markets to continue to rally, because there is just too much responsibility on the banks, and I don't think that they are at a point where they can move up significantly.
Well, it's a narrow range, Gautam, that you're anticipating that we will oscillate in just about 1,000 odd points on the Nifty. So clearly, large caps no go. They won't see, even if there is volatility, perhaps you won't see some big moves. Tell us some ideas in this micro cap, small cap space. What are the themes one should look at?
See, let's not forget, we were at the depths of pessimism close to levels of 22,000, which I always thought was a long-term support. And I'm happy that the markets have recovered from there. Obviously, it's been a very large rally in these last 2.5 weeks. A lot of stocks have done well. Now, I think we go back to the broader markets. And within the broader markets, I think energy-related stocks, power-related stocks, metal stocks, PSU stocks, I think these are the big opportunities. I mean, I've said this multiple times in the past as well. I'm sticking to this basket because I feel there is new leadership that has really emerged in this space. I mean, look at the metals index is at a lifetime high. Look at the comeback in capital goods. Look at also a comeback in real estate. And, PSU, according to me, is probably your best bet for the rest of the year. I mean, they've handled the market weakness really well. They're very steady, nothing to do with foreign policy, excellent dividend yield, under ownership, and they've done all the right things on the charts in the last 10 days. So metals, PSU, and energy, I think are three baskets that we are really liking. In the broader markets, you could actually buy the entire basket of small cap 100, which has just tested the 18,000 resistance number yesterday. So there could be a bit of a breather, but basket buying for the long term, I think makes a lot of sense at today's prices.
Okay, all right. You want to give us levels on any of these indices that you're talking about, Gautam?
So I think, as I said, if you look at the broader market indices, microcap index was at 19,000. Today, I think we are close to 23,000. That's a 4,000-point move in a matter of 3 weeks. And I'm tempted to believe that it will do another 5-7% up on the upside, which is towards 24,500. And the small cap index can do about 19,500. But the point I'm trying to make here is the juice of the possible resolution to the geopolitical situation is already in the price. So I don't think if there is good news on that front, markets will continue to rally higher. They will stay in a range. We are still in a large consolidation pack. I don't think the Indian markets are running away. One should have realistic expectations from these levels and stay in the right pockets. I think that's really the key for the rest of the year.
Point taken. So what about politics, Gautam? Will that excite markets from here as a trigger?
Well, it always has, but I'm not sure whether the current political situation can really excite markets enough. This domestic liquidity has been so stubborn. I mean, happily stubborn in this last 1 year. We've had so much in the recent past, but despite that, domestic liquidity continues to be a mega revolution. And that's probably the reason we are at levels above 24,000 today. So I think come what may, the market will stay protected is what I'm tempted to believe. Obviously, if you're referring to what's happening in the region in terms of politics, I think that's a fierce battle. I don't want to get in there, but I mean, we'll all wait as to how that pans out.
How are things in Dubai, Gautam? I mean, generally, day to day, things are normalized?
Yes, it's quite normalized. Schools opened up a couple of days back. People are back to regular life. It's just that the city is missing tourists. Probably that's the only miss, but otherwise it's quite normal.
That's good to know. When you described all that, what's happening with micro caps, and it's all, I was thinking about it, it's almost as if, I mean, maybe not, it's not thought through in that way, but you're kind of steering away from things where FIIs are invested in to a place where there are no FIIs, unaffected by all the selling and everything else. Do your own thing. A kind of thing. Is that perhaps a theme one should? It's not a theme. I don't know how you kind of build a portfolio out of that, but perhaps makes sense to look a little deeper into that. Non-FII stocks, basically.
Well, you hit the nail on the head. That's exactly my view, and that's exactly what we are putting out in our reports, that be in stocks and sectors where FII selling is limited and DII ownership is limited. And that's probably the reason I'm really looking at that basket where the market cap of stocks is anywhere between 1,000 crore to 30,000 crore. I know it might be a large range, but that's the basket I'm looking at because, you've seen a lot of these stocks do very well in the last couple of weeks. But, it's quite interesting. I saw the 2003, 2008 bull market, and we always said, be where the FIIs are. So that was a very different kind of a bull market. Right now, we are looking at be where the DIIs are.
Yeah. No, that's be where the DIIs are, be where the local money is. So you don't run the risk of sudden FII selling, and that's been relentless in more ways than one as well. Just run us through your reading of the charts on these power names, if you will, Gautam. I'm talking about all the utilities. Some of them have made all-time highs. Adani Power, for example. Hitachi and GE are another universe. The transformer companies. I mean, what's your reading?
I think it's a market where the older themes are taking a bit of a rest. I see a lot of people trying to buy the older themes thinking that they will participate, but they are not participating. And look at the way the NSE Energy Index or the BSE Power Index has come back in the last 2 weeks. I think it's a mega trend and it's here to stay for the rest of the year. There is obviously a lot of fundamental talk around it. There is genuine fundamental tailwind to it. I think the government realizes its task is cut out in the energy space with what has happened in the recent past with energy security. And the way stocks have behaved, whether it could be the Adani group stocks or many other stocks in the market, I think this entire basket will deliver upwards of 30% over the next 6 to 12 months in an environment where the Nifty might not even deliver double digit. So I think it's a great space. The entire basket, I think, will be a beneficiary. You can pick and choose. And, in today's market, if you get the theme right, it's very rewarding to pick any stock.
Got a view on crude and gold on the charts? Crude cooled off and then bounced back very swiftly. And gold actually, when the markets got a little brittle, people started taking money off gold. And on an asset like gold, it fell more than 20% in a matter of, I think, a few weeks. Your view on both these two?
Well, I think crude will stay elevated. I don't think we have a resolution to what's happening in the Middle East and the US verdict and feeling about the rest of the world. So I think crude will stay elevated and India will have to deal with it. There is no doubt about it. And that's probably the reason every time we start to move up, we will find selling pressure because our fundamentals will come into play and will not allow the markets to rally beyond a point. When I say market, I'm referring to Nifty and the top 100. So I think crude will stay elevated. 80 will be a sort of a base. 110, 115 will be a sort of a ceiling. So what was 65.70 earlier now becomes 85.90, which is quite an elevation on an overall basis. And if you ask an economist, I'm sure he'll put out numbers there. Gold and silver remains a mega trend. It was a little overdone, went through a bit of a correction. I think it seems to have stabilized. I think it's formed a bottom at the recent low, and gold will probably gradually go back to 50 to 5,300. Silver will probably gradually go back to $100. So gold and silver, for your viewers, please stay invested. I think best is yet to come.
Best is yet to come. That's what we'd like to hear. Gautam, thank you very much. Good speaking with you. Appreciate you joining us and stay safe. And we'll see you back when you're here in India. Well, I think just a quick word on the market before we go any further. 115 points lower, and we're about 24,055 at this point in time. Market breadth is now flipped. It's more reflective of course, morning when we started, one of the top gainers, at least on the upside, was Indigo. Didn't make any sense, and it kind of flipped a little bit. But 1,700, 1,800 stocks are lower, and about 900 stocks are higher. So this is 2:1 on the downside in terms of what is down to up as far as stocks are concerned. This is the broader universe. We'll take a quick commercial break here. Okay, I'm sorry, we won't take a break. We will, Rima, we have a guest in the studio.
Well, indeed, we've got Aditya Birla Sunlife AMC in focus on the back of the Q4 numbers. Revenues declined 4%. The company also saw an 8% drop in the operating profit. Bala Subramaniam, Bala as we call him, Managing Director, CIO at Aditya Birla Sunlife AMC, is now here with us on the show. Thank you very much, sir, for joining in. Now, as per SEBI's new BER framework, you've guided for a 3 to 4 basis points pressure on the equity AUM. Does that already include the GST offset? What would the net revenue impact look like in FY27?
So I think the way we have gone about assuming is on the basis of multiple round of discussion, right from the first circular when it came and then subsequent engagement with the SEBI, the modification that came, I think we came to the conclusion that it'll have a very least impact both on the revenue as well as the profitability from a broader perspective, given the fact it now narrowed down to about 1 or 2 basis points. Second, as far as the GST is concerned, now there are 2 set of numbers have come. We always used to calling as only one number TER. Now it became BER and TER. Correct. Which is BER is something including management fees and other things. Whereas the TER is actually add to the BER, add your GST and security transaction taxes. That has to be disclosed separately. That sets over and above that. So there are some reductions that will come mostly on the brokerage expenses. It used to be somewhere around about 8 to 10 basis points. Now it dropped about 6 basis points plus GST, ultimately remain the same. It's about 8.5 basis points remain the same. So on the overall basis, I would assume about 2-3 basis points already included in the overall expectation that you have set. Broadly from the way we have guided to everyone is the whole system, it'll have to be optimized in such a manner. It has the least impact as far as the AMC's concerns. Also, it's got the least impact as far as the distribution partners concerns.
Okay. So the impact will be about 2 to 3 basis points net.
On the overall basis.
On an overall basis.
On overall basis.
You look to optimize.
Yeah, that's right. That's right.
Bala, hi, morning, and thanks for dropping by. I hope this is the first of many interactions. It's a new one on quarterly numbers. We talked about what's happening in bond markets and markets in general, but earnings, of course. And AMCs as a business is, many would agree, is one of the few businesses where, the flows are still steady.
Right.
And at Aditya Birla, of course, performance has also become much better. Over the last 6 months, 8 months, it's picked up across the board, across funds.
Right.
And the proof of the eating is in the pudding, right? You will get a larger share of flows as performance picks up. Are you starting to see that?
I think I would say the last year was a good year. I've been saying the last year has been a good year for us for 2-3 reasons. One, as you rightly put it, we invested on people, we invested on process, we invested on improving the performance across all our schemes, especially in the equity. And I'm happy to say that as of March, almost 85% of the funds have delivered Q1, Q2 performance with the competitions. And not only beaten the benchmark, it's also, of course, beaten the peer average, which I call it. So that's something is good news. That's, of course, getting converted into some improved flows coming in some of our core funds we already identified, such as Flexi Cap Fund, Multi-Asset Gain Fund, Mid Cap Fund. In fact, we have gone about giving a call this year, irrespective of market volatility, we've gone about giving a call this year. Earnings for the Indian markets have become more better. And equity, as a result of that, as time progresses, when things does settle down, in the current uncertain world, I will probably see flows to reverse from overseas investors in India. Therefore, mid and small cap could outperform. Therefore, we have gone about giving call on smaller mid cap also is worth investing, along with Flexi Cap and Multi-Asset Gain Fund. So we are seeing kind of flows coming in. And second is we are also building our alternate business, which has been one of the increased contribution will come from alternate business. Especially on the offering performing credit fund as well as the real estate fund. And we also now opened our Gift City as a 100% subsidiary company of Gift City. It gives actually to open the gate for us to get retail participation coming in the offshore funds, both for inwarding, outward remittance as well as inward remittance. In both the cases, the limit used to be about $120,000. With the 100% subsidy now being set up, and we can start accepting money from retail investors. I think we are looking at a holistic basis. As you rightly put it, asset management business has been one of the fast-growing business in the current world in the capital market. And given the fact that this huge underpenetration still remains, and one of the things that we keep saying that SIP is the one which has to be continuously promoted. But as a fund house, we have gone about building a SIP for life. And don't look at SIP actually for 1 or 2 year or 3 year. Look at SIP for life. And her girl has to have an SIP. These kind of promotions, I'm sure, will only make more and more people to participate.
In terms of share of flows which are coming in, like for example, industry flows into, I'm just using an example, into the mid-cap category. Do you have targets in mind? One is of course performing and then is going out and telling the story that the performance is improved and getting more money in. So just like across categories, large, mid, small, etc. And is there a target of what should Birla get as a share of these flows? Where are you at and where would you like to be?
Yeah. No, we generally say, I think earlier we used to have a theme called we should get our deserving market share. Given the fact that Aditya Birla Sunlife Mutual Fund is a 30-year-old organization, and we have been working towards building the mutual fund business to where they are today. So having been a large player, an old player, large player, established huge track record, a long-term track record that we have, investing on people and processes and so on and so forth, we have a long way to go. So we call it as a deserving market share. What do you mean by deserving market share? It can actually number can vary from say 7% to say 10%. And given of course the competitive landscape, there are almost about 50 players out there. And the earlier regime when we used to have about 15 players, we used to say we should have about 10% market share. At this point of time, we are saying roughly about 7.5% it should be our deserving market share, given the fact that we are a large, established Indian conglomerate, most trusted names. And that's something we keep saying it internally.
7% is the existing share.
Currently, we have a total market share about 6.25%.
Of the total?
Of the total assets under management in the industry. And equity is roughly about 4.5%. And in terms of net...
This is the stock or the flow?
I'm talking about overall market share. Overall market. In the industry AEM.
Okay.
In terms of flows, we generally get about 5.5 to 6% on a gross basis. And roughly about 4% on the net sales basis. So we generally say that what we set expectation may not be necessarily happening today, but in ideal scenario that we call it a deserving market share, but for which of course we have to earn it by way of giving consistent investment performance and so on and so forth. That we have established it. That's anyway an ongoing process as every manager go through their own tough time.
Yeah.
And we also gone through our share of pie. We had good time, we had bad time. And I would probably say the last 2 years have been pretty good for us by way of people change that we've made, process change we've made, focusing on consistent delivery on investment performance, and look at market across the market cap rather than focusing only on large cap. Now we have built capability within the team to build the next level of phase of growth. In fact, we also added our more and more team to the investment side to focus on new product like SIF. We need to have a capability before offering the product to the external world. These are some of the investments we are making. I'm sure these investments that we have made, the renewed focus that we are bringing in, which all I think I probably say reposing confidence on the brand that you have built over a period of time. And that's something that I think is something we are working on it.
All right. Hi, Bala. Good to see you in the studio. A couple of quick questions then. You spoke about deserving market share. So just to clarify on that point, on the mutual fund market share, you're saying 7.5% in the near term. That's in the next 12 to 18 months. Would that be fair? And equity market share, you'll head to around 5.5%. Should that be the near-term goal?
That's a goal. Of course, I can't say that, next 18 months. I can't give a forward commitment at this point of time. I think whatever the steps that they are taking, the steps they are taking, the way I think things are panning out.
So 50 to 100 basis points?
Our aim would be to grow at line of the market.
All right.
And that's always the aim that we have.
And gain market share around 50 to 50 basis points just in the near term, 50 to 100 basis points.
15 to 20 basis points. That is still pretty large amount.
15 to 20 basis points. Got that.
I think we'll work towards it.
Yes.
But ultimately, we have to continue to keep our head low and focus on the hard work that we have been doing all these years.
15 to 20 basis points in the near term in terms of market share. Got that. Tell us what is the overall AUM target, growth target, if you could help us out with that. And as you mentioned, alternates on a very small base, I think that tripled in the past year.
Yes.
How big will that grow to, and what is the growth trajectory on alternates?
See, we have gone about building this business the last 3-4 years. One, we have invested on people to offer AIF performing credit funds. We did about 750 crores last year.
Yeah.
And I think here also we are aiming close to about $1 billion kind of size we should gun for the next 1.5-2 years.
Okay.
The same way real estate performing credit fund. Real estate fund again focused on credit. We already have about 950 crores kind of size. We've given a very good performance for the last 10 years. So the way we are building is first to showcase our capability, way of delivering good performance, irrespective of whatever the size is. On the basis which I think go and offer a product to the growing HNI family offices invest in the country. That's something we are keeping. The last, of course, is the passive side. Again, we have invested on people. Last year, passive side was the highest growth we have seen.
Okay.
And that's something, again, we are actually bringing in renewed focus on building passive. And passive not necessarily has to be only a low profit margin kind of product. We can even run product which gives a reasonably good margin. So that's something the third area of focus we are bringing in.
Okay.
And last but not the least is building the equity to the next level of growth. Currently, we have size about 4,46,000 crores in terms of assets and management. 2,20,000 crores roughly is in equity.
Yes.
And that's something, given the fact that we can continue to grow this business, I think internally we keep looking at the growth has to be in line with the industry. So far, our growth has been a little lower than industry.
That is picking up.
That's picking
hopefully,
up.
that'll be the case. Bala, thank you very much for joining us. More questions, but we're on the earnings treadmill, as you know. So thank you for dropping by. As I said at the beginning, I hope we do this every quarter. Thank you.
Yeah, we'll do that. Thank you.
Thank you.
All right, we'll take a quick commercial break here. We're going to come back with the management of Himadri Specialty Chemicals on the other side. Stay tuned.
Welcome back. Himadri Specialty, that's the stock in focus. The street likes those numbers because with the markets at the low point of the day, that stock actually is at the day's high. For the past quarter, the revenues grew by close to 14% sequentially. The company also reported record EBITDA and profits in FY26. To discuss this and more, we're joined by Anurag Chaudhary, the CMD of Himadri Specialty Chemicals on the show. Hi Anurag, good to see you win and congratulations on a good showing in the past quarter and the year as well. Let's get a few details out of the way. I'm looking at the trajectory that you've laid out on your presentation. You're talking about higher amount of value-added products. So if you could give us a simple number as a percentage of the revenue mix, what is it? And where is that number headed, given that you've commissioned some capacities?
If you look at our numbers, there has been a stable growth in top line over the last 2-3 years, basically because we were focusing more on value-added products. And when you go for value-added products, what actually happens that the raw material becomes the finished product and you go for more value to the same product. That's the reason the bottom line was growing and the top line was growing in a lower percentage compared to bottom line. And today, if you look at our Q4 numbers on a consolidated basis, we have reported a growth of 14% in terms of top line growth also. So in terms of percentage, the value-added products are growing from, it was around 25-30% to 50% around.
All right. So currently it's around 25-30%. You're saying it goes to around the 50% odd mark. Is that correct?
Right.
All right. Now I want to ask you about this anode capacity because the street gets very excited about these, these sort of businesses. And I think you've commissioned the 200 MT anode capacity. Could you tell us what is the revenue potential? How do you see this ramping up? And ultimately, where do you want to take this anode capacity to?
So anode has been something we have been talking about for last more than 10 years. Lithium chemistry, we have been focusing for last 14 odd years and have invested a lot of money in terms of research and development in this product profile. And the unique thing, what we have been able to achieve now is a culmination of years of dedicated research and development and innovation mindset. As you know, research and development don't yield result in a year or two, but we kept working on it. And the unique proposition which Himadri brings to the table is a complete integration. So from raw material to finished product. So what we did, we made special quality, highly technical coal tar pitch converted into coke and this coke into anode material. This unique value proposition no one has. So that is something on which the company has worked. And now with this commencement of production of anode material, it's the new beginning of a new era of growth for the company.
Okay, but this 200 MT can give you what kind of revenue, sir?
See, this 200 MT is just the beginning. Okay. The idea is to set up a huge capacity. This is the first step in the direction.
The targeted capacity on the anode side would be, say, in the next 2-3 years from here?
So we are planning on that, and I'll come up with full details on full planned capacity over the next 4-5 years, and the capex is paid on that.
All right. You've added some capacity then on the other part of your business. So what utilization levels are you targeting on the new capacity addition for the specialty carbon black business?
So for the current year, we are targeting around 85 to 90% capacity utilization.
On the incremental capacity, right?
Incremental capacity, that's right.
So, all right. So if I look at it, in the last year, that is FY25, you did around 550 crores of profitability. And I recall you mentioning in your past con call as well that you want to see that double by FY28. So, currently it looks very expensive. Market cap 28,000 crores, and you're currently doing around 750 crores of profitability. However, the street is willing to look ahead. So by FY28, do you stick to that guidance that the net profit number actually will be more than 1,100 crores?
Definitely. And if you go by our track record, you can see we gave the same guidance for FY24 to FY27. And we achieved nearly that in 2 years.
Oh, that's encouraging.
Yes, I am very much optimistic and confident of achieving what we have guided.
All right. Okay. That's encouraging then to hear. What about Birla Tyres? How do you see that business scale up? And also profitability, when does that come about in Birla Tyres? What is the targeted number?
So if you look at the year FY26, this is a transitional year for Himadri and a landmark year also, where in the entire year, if you see, we debottled our core capacity from 500,000 to 600,000 tons, which result you will see in the current year. We expanded our specialty from 60,000 to 130,000. We introduced naphthalene ball. We commenced production of Birla tire, and that's ramping up on a monthly basis. And looking forward, you will see huge revenue coming in from Birla tires in terms of sales of OTR, OHT, and BS tires.
Okay. Since it's ramping up, sir, you want to give us a number? What is it doing currently in terms of a revenue or a utilization level at Birla Tires? And where do you see that number headed to?
Last year, we did a top line of 187 crore from Birla, from tire business. In next 3 to 4 years' time, I expect this to cross 3,000 crores.
Wow. 3,000 crores. All right. Final question, sir. You know, there's ongoing capex across carbon black, battery materials, downstream integration as well. The point is, currently our ROC is sitting above 30%. Over the next few years, with you scaling these businesses, do you think the ROC can continue to be maintained above this 30-35% odd mark?
See, I feel we are, for myself, the most important thing, dynamics, which I look when we invest in any business is ROC. And so we have a benchmark, internal benchmark of ROC, and we have to stay above it. And I'm fully confident that we'll be staying above 30% in next 2 to 3 years.
Okay, all right. It's a pleasure talking to you, sir. For the time being, the street likes what you have had to say. We're going to hold you to these numbers. FY28, you're going to be hitting around 1,100 crores of net profit. The ROC continues to hold about the 30% odd mark. And you're very bullish on a couple of these businesses, like the tire business and the anode capacity as well, will be hiked. Thanks a lot for joining in. Wishing you a good day ahead and a good financial year ahead as well. Okay, time for another earnings conversation then. Union Bank of India reported a 6.6% rise in profit, driven by lower operating expenses as well as provisions, while margins moderated by around 12 basis points and slippages rose. My colleague Ritu spoke to the management and started off by asking them about the NIM compression outlook and the sustainable margin level. Let's listen in to a slice of that conversation.
If we see, the circumstances which were prevailing at that point of time, and the MPC as of now has continued with the stance. And going forward, keeping in the same scenario, we are very sure that this is almost like a bottomed out sort of, and we expect improvement in the NIM because we are already working on the various efficiency parameters. So going forward, we are very sure that we will be in a position to, defend it and improve it from this position.
Any particular level, sir, a NIM target that you've had?
NIM, actually, we are thinking around 2.7 up above that levels.
Okay. So let's also talk about that 700 crore standard asset provisioning that you made as a one-time measure in the fourth quarter. Now, last quarter, I recall you had told us that the ECL shortfall was about 4,200, 4,300 crore rupees. So if the ECL guidelines come through, this 700 crore will barely move the needle. So I wanted to understand the requirement for making this kind of a buffer. I mean, if you have to meet ECL requirements, do we expect provisions to remain high for the next few quarters? Or is this a cushion against any potential stress you're seeing building up in the system?
See, that is very clear then, when the counter-cyclical buffer also from the regulatory guidelines when it came. So general, the perception and the prudence is that whenever you are doing good, your asset quality is good, your efficiency is improving, your growth is also there. It is always better to keep aside something. So on that basis, if you see, we are dividend paying and dividend is increased, the profit is increased. If we come to SMA level, we are at the lowest levels. That is 3,833 crore. If we take more than 5 crores, SMA 0, 1 and 2, all the figures, all the 3 figures. Now, keeping that in view, our slippages are less. I think almost from around 4,500 crore, our recoveries are more than the slippages. The slippages from last year to this year is much less. That is around 4,000 crores. So keeping in view all those things, and if you see the quality, asset quality, 95% our corporate book is more than 25 crores, not only corporate, but more than 25 crores is above triple B and above. And if we take the retail, 680 and more than 680 is considered as prime, but we have taken internally 700, and if we take 700 and above, 99.8% is above this quality.
So, to summarize, you're saying that there is no potential stress build-up you're seeing because of which you've made this additional provision. The only reason is to build a buffer for the later ECL requirements. But again, back to the question, the ECL requirement is far higher. 4,300 crores, the shortage you've spoken about. So do we expect, say, for the next 6-7 quarters, we will see a similarly high provision number from Union Bank?
No, it is not like that, because this time, if you see, this provision which we have made is not impacting the net profit or the capital. So actually we were comfortable on all the 3-4 counts and other efficiency parameters and business parameters. That is why it is just an initiation, it is a start to build up the buffer, and so that we can keep it. And any stakeholder, whether it is a regulatory or the government of India or any investor, and even the staff members. So strengthening the balance sheet is, I think, is resilience, and it is a prudence for any management and for any bank. So we have just kept it, and then there are guidelines. If suppose we talk about ECL, then certainly regulator, as per the draft and other things, it is already there, it can be spread out, and also we will see that point of time. But at the same time, when we are discussing, West Asia crisis or this ECL and all, so just, it is for sure that this 700 is kept aside. So I think rather it can be looked that the bank has kept as a proactive prudential measure, as a forward-looking measure, that and amount is also good. So 700.
Got that, sir.
But at the same time, it has not impacted dividend. It has not impacted profitability. It has not impacted ROA. It has not impacted ROE. So in all the parameters, we are better. And then this is kept aside, I think, only as a forward-looking measure, forward-looking prudence, and strengthening the balance sheet and resilience, and giving a comfort to all the stakeholders that yes, we are there with
Got
this,
that,
and
sir.
we are ready
Got that.
for anything which is going to come forward.
Sir, let's talk about your asset quality briefly. It's risen sequentially from about 1660 crores to more than 2,000 crores. I also see your SMA1 book has nearly doubled. So what led to the increase in slippages in this particular quarter? Where did that come from? And, when it comes to the West Asia affected sectors, your export-linked exposure, MSMEs, etc., are you expecting any kind of deterioration there? And if you could give us a guidance of what the credit cost for FY27 could look like from these low levels of 0.23% that you've been able to get to.
We have continued, if you see, we have continued with a very contained credit cost and slippages ratio. And we have tried to recover more. The recovery is much more than the slippages. And the asset quality on the book, whether on the SMA side. So your first question, that SMA 01, actually, we are in discussion very rigorously with all the people who are in the SMA 01 and 2. So basically, it is a movement from 2 to 1. So that is clearly one thing that is the reason you see SMA 1. If you see the last quarter, SMA 2, it was just, the swapping of the figures from SMA 2 to SMA 1. So there is again not an issue on that. Now, when you said that, there is a slightly increase, so there is a slight increase, but it is not anyway related to West Asia crisis or anything. Our exposure, to the, I should say, the institutional or a corporate is around 3,000 crore only. We are monitoring very rigorously on the inward remittances, on the import remittances, and we are also seeing whether it is same is hedged or not. We have also talked to the SMEs, and when we see there is an elongation of the goods that are coming, through the alternative routes. So these were the thing, and certainly the energy backed up sectors like which are in ceramics, Morbi, cement and all, which are not a very big players, have seen certainly some sort of a stressed, working capital cycle. But then the regulator as well as the government of India has come forward, and if we see, we have received around 380 applications, and in this around 200 is already sanctioned, and we are moving ahead in that. If we take the trade relief measures from RBI, so there also, we have received application, we have all attended to, but then the many people are not coming. This also gives an indication that they are managing within themselves anyhow right now, but they're not resorting to. So as of now, this has come recently, but then we are in touch with all, and we have not as such seen any disruptive situation in this. So this year, this quarter also, in the earlier quarters, the slippages are just normal as usual it used to happen. But total, if you see, we are around 8,000 odd crores, and it is much less than the earlier year slippages of 12,000 odd crores.
So, sir, in just one word, credit cost guidance for FY27?
So generally, we are right now in the range of 0.22 and 25 levels and all.
Yeah.
But then, safer side, we say we will be below 1%.
Okay, all right. The management of Union Bank in conversation with Ritu after numbers and some outlook as well. Well, I think the other big story, of course, is politics, right? West Bengal and Tamil Nadu both have recorded their highest ever voter turnout. Tamil Nadu saw polling at 85%, while West Bengal touched a record 92.5% in the first phase of assembly elections. Sanjeev Srivastava, senior journalist and political analyst, is with us now. Sanjeev, I believe you're in Bengal?
Yes, last 6 days we have been here now.
Okay.
So we have traveled through the region where voting was yesterday.
Okay.
Now,
92%.
right now I'm in Kolkata.
I mean, that is mind-blowing.
Well, the number itself is mind-blowing, but if you try and put it in perspective, Prashant, it was 82% last time. And considering the fact that SIR has resulted in deletion of about 28 lakh votes in all, so the base becomes lower. So from a lower denominator, it is not, if you see it from that angle, that less number of voters are there, and the voting percentage is higher. So approximately, especially in Tamil Nadu, the numbers remain approximately the same as last time around, but the percentage has shot up. And I think the same story has played out in Bengal. And of course, those who have remained in the electoral list also seem to have come out in large numbers to ensure that they exercise their vote, and since they've retained their voting rights.
Yeah. So, what is...
To read much into the voting percentage, maybe missing out the true picture of what is happening on ground.
So, what is your assessment? You're a seasoned election analyst, and we've done this long enough, Sanjeev. So,
you again are making me stick my neck out, and it has its own hazards,
Yeah.
And not always one is right also. But what I think is the sense on the ground where voting was yesterday in West Bengal. So North Bengal has around 54 seats, and the BJP had its nose ahead even in 2021. So I think the BJP may gain a few more seats in North Bengal. In Central Bengal, which is Murshidabad, Malda, and those areas which are heavily Muslim populated and minority-dominated districts, that's where the largest number of deletions have also happened. But despite the deletions, the number of Muslim voters remain very large. So I think the battle there is also the communists and the Congress has come into play with the TMC. I think in Central Bengal, the result will be more or less the same, maybe little more seats for BJP. And in the Greater Kolkata or Calcutta presidency, where there are 100 plus seats, 110 odd seats, where voting will be on 29 together with some tribal areas. That's where the TMC scored disproportionately well, if you may, last time, when they got 215 out of 294. I think the story remains more competitive here. It has become more competitive. But I don't think it would mean a very big gain for BJP in terms of seats. So likely that the TMC may still be coming down in numbers, but it's likely to have its nose ahead in the final outcome. Now, this is a very difficult election to call because the BJP has pulled out all stops. The TMC is totally rattled, fighting for its survival. But I don't get the sense on the ground that a large number of electorate is willing to swing towards BJP this time. They are doing their best in every sense. But whether they will be able to cross the ropes or win the election, I personally have doubts. It will be a close one, but TMC ahead.
294 total. अभी तो एक phase ही हुआ है, but 150 done, right? Approximately.
150 done, yes.
Total, how much? Stick your, as you said, stick your neck out. What's the tally?
I think the TMC should get 150 plus easily. So it will be a large downward swing for them vis-a-vis 215 of last time.
Okay.
But, it's, in 6 days you can cover maybe 20 constituencies. I'll be foolhardy to say that I understand it all or my friends understand it all who are traveling with me. Yeah. But that's the overall sense one is getting, that people may still come back to TMC because they don't want to see, except for a selected some sections, the BJP coming to power. There is huge misgovernance by TMC. People are genuinely unhappy. If the left was a real option, left and Congress were a combination and they had worked for a year or so, it would have been even a more interesting election. But as things stand, that's what my takeaway is.
Yeah. Yeah. Well, just quickly, there's Bengal. What about Tamil Nadu? Any thoughts?
Tamil Nadu, I think it's like the conventional wisdom and thinking in political circles it much will depend on actor Vijay and how many votes in terms of percentage votes he is able to get for his party and from where he takes those votes, from AIDMK or DMK. Having said that, it still looks that the ruling party may return to power. The DMK again has its chances. Their chances are much better.
Better. Got that. Sanjeev, we'll have you back. And I won't hold you to the numbers, numbers, but...
I dread it. I dread coming back this time.
No, I mean, whenever we... it is what it is, and it'll be what it'll be, and we'll, of course, track it with you when the results come. Thank you very much, Sanjeev.
Thank you for having me. Thank you.
We'll take a break. Manisha will be joining us with the focus on commodities on the other side. Stay tuned. Welcome back. Let's shift focus to the commodity space. Manisha is here with what she's tracking. Manisha, morning.
Morning, and thank you for that, Prashant. Well, I'm looking at the crude oil prices. It continues to be very, very volatile onto this one. We started before the West Asia conflict at $70. We've seen 120 on the higher side, a correction all the way up to 92, and we're back above $106 a barrel currently. So when you look at the overnight markets therein, we've gained up by 4%. This current week, the prices have gained up by an 18%. And for the year, that now adds up to nearly 74% of gains for the Brent crude oil prices as we see it. Well, there are a lot of headline statements coming in from the US and Iran, where US 1 has ordered the US Navy to spot and kill, shoot and kill vessels laying mines in the strait. There also have been various reports suggesting that the US forces boarded a supertanker carrying Iran oil in the Indian Ocean. There also is a truce between Israel and Lebanon that the markets are looking at that perhaps is going to be for the next 3 weeks there. In the meanwhile, Iran has also seized a vessel around Strait of Hormuz. So all of these statements, all of these events continue to support the crude oil prices therein. The U.S. military also has released a statement suggesting that the U.S. forces have redirected nearly 33 vessels till time since the blockade began therein. But take a look at the various statements that have been coming in from agencies, banks and brokerages as well. Vitol, for one, says that nearly 4 million barrels per day since the start of war is a loss that we are looking at in sense of demand, and supply loss stands at around 12 million barrels per day. Most of that, of course, coming in from Middle East. So that's the number that we are working with right now. And then there are various reports suggesting that 178 refineries, which account for, by the way, nearly 40% of world refining capacity, are affected because of Strait of Hormuz there. Also, 80 oil facilities have been damaged within West Asia. So all of that premium is what you are seeing into the prices right now. But even more important is the demand destruction. Various austerity measures is what we've seen from Asian governments come in. But this data comes in from EIA, which says that nearly 0.6 million barrels per day of a demand destruction is what they are working with. S&P Global Platts, pardon me, has put out a number at around 0.4 million barrels per day of demand destruction therein. This is a near-term price forecast really coming in from various banks, and this is only for second quarter. A long-term vision is something that most banks have continued to revise in. So Goldman Sachs talks about $90 a barrel of an average for the current quarter. You have EIA talking about an average of $95 a barrel. StoneX says that their base case scenario is anywhere between $88 to $110 a barrel. Depending on what they see in sense of news flow, the prices can move higher or lower. Morgan Stanley has put a forecast of $110 a barrel as an average for this current quarter. You have JP Morgan talking about $150 a barrel if this, what we are looking at, continues into the second half of 2026 as well. And that's exactly what Bank of America also says, that their near-term targets stand as it is, but $130 a barrel is what they're also not ruling out if there is a prolonged West Asia conflict coming into the markets, which could lead to further decline in supplies. And while it could damage demand as well, but at this point in time, supplies clearly is the headline.
All right, Manisha, thank you very much for that. Supplies is a supply shock more than anything else showing up in prices. Well, 180 points lower. What is incredible is the open, right? I mean, absolutely strange open with the market on the Nifty. I think the open was higher today. The open was 24,100. I think, yeah, okay. So it was kind of flattish, and then the market started to dip. But lots of stocks, etc., started up, and they've all completely reversed as we've gone on. We'll take a quick commercial break here. We'll come back with our special segment. It's the economy. Latha in discussion with PIMCO's Greg Shernow, on where crude prices are headed as the war drags on. Stay tuned.
Welcome to It's the Economy. As the closure of the Strait of Hormuz enters its 55th day, Brent crude remains over $105 a barrel, and the International Energy Agency says the world is facing its biggest energy threat in history. Where is crude headed if the straits remain closed, all the way up until May? How many months before prices begin to normalize? I have with me PIMCO's Greg Sher, now an undisputed master of the energy ecosystem. He leads the commodity portfolio management group at PIMCO, and before that, he was trading energy at Hest Energy Trading, Goldman Sachs, and D. Shaw. Greg, thank you very much indeed for your time. Welcome. Well, assuming the straits don't open by early May, how long do you think we will have to suffer triple-digit crude prices?
Well, I think it actually can stay in the three-digit mark for a considerable amount of time, because we have many complications with opening up the Strait of Hormuz. For the first is we have to decide what is the mechanism for transit through the strait. Who is determining that? It's going to take a while, I believe, to sort through those details. You could easily have a situation where only a narrow channel is operating, and you could have a greatly reduced amount of flow relative to what normal would be. In addition to that, we have a lot of tankers that are trapped in the Strait of Hormuz today. Normally, those tankers would be running in and out on a consistent basis. So it acts almost like a pipeline effect where, you always have the oil moving. We've now had a point where the virtual pipeline, the ship pipeline, has been closed. So when you open it, you have 25 days to many destinations for sailing, assuming you can get out in a relatively quick order. And then those ships have to come back. So it's going to be quite a while before the whole production chain would normalize, assuming no structural damages. And that's also assuming no challenges with restarting the existing infrastructure. We were actually looking at inventories for crude oil outside of China and outside of the Middle East yesterday and today. With current information, we're already at the lows of the last 10 years, with full expectations that we only continue to draw more over the next 4 to 6 weeks, irrespective of when the Strait of Hormuz opens. So I think there's going to be considerable pressure in the supply chain that will keep prices elevated for quite a considerable amount of time.
Now, take your point. Let's talk scenarios. If the blockade ends in early May, how does the crude price trajectory look until June and in the second half? And if it ends end May, how much does crude go till June and second half?
I could easily see if we do have a situation where we have a normalization of flows. So I think it's very important. We talk about like full normalization. If we are restricted at 20% of normal, to 80% of normal, so 20% is not flowing, that is, 3 to 4 million barrels per day of oil still impacted. That is, call it 3 to 4% of global oil demand. That's a massive number. If you needed to take that demand, you needed to reduce that demand to match that supply, like you're going to need much higher prices. So the conditions we are ascribing to the resumption of flows are really important to be like very, very specific on. So if we have a situation where by the end of May, we have full resumption and we have visibility, I can easily see Brent prices returning to the 80s. I think there's going to be a massive amount of demand that needs to come back in to refill the supply pipeline, to rebuild inventories. I think it's very hard to see going back into the 60s unless we have a real economic slowdown. Conversely, if we're not resuming at a full level of that nature, you could easily see prices remaining here or higher. And if you look at refined products, they're trading at meaningful historic premiums to crude oil. And that's what we ultimately care about. And when we start talking about the supply of refined products, we know a lot of refiners have been damaged, both in Kuwait and Bahrain. Ukraine has kept up a steady pace of attacks on Russian refinery assets. It's going to be very hard to correct the refined product balances to bring the jet prices down, to bring the diesel prices down, that have been such an acute pain, particularly throughout Asia, which has felt the intensity of the shock the quickest.
Okay. Okay. Now, well, I can hardly speak about a demand destruction now. Even without the war, we have actually had factors like AI pushing up power demand, a general increase in defense production in many countries. All of these need commodities, actually. So how do you see the commodity cycle pan out?
Well, I think you stated some of the key pillars of that thesis very well. You know, AI is very commodity intensive, very energy intensive as well. If you look at the energy transition, as we try to build an alternate supply chain that requires less hydrocarbons, it's very hydrocarbon intensive to create the windmills, to create the solar, to create the transmission wires. There's a tremendous input pressure that is coming from those two alone. Once you add the military industrial complex and the onshoring or supply side resiliency, the CapEx pipeline looks fairly robust for commodity intensive sectors. That said, probably the biggest bullish underpinning for the secular horizon has to do with the fact that the amount of CapEx going into creating supply of a lot of these materials is very low. And the reason for that is, and it's someone who has spent 30 years visiting the oil patch, I never would have expected to say capital discipline is the modus operandi, but it is. And I would have bet against this for my whole career and would have been smart to do so. But the C-suites have really changed their approach to how they think about their balance sheets, how they prioritize investors. You know, after being poor stewards of capital for 20 plus years, there's been a pretty big change. You know, in oil specifically, particularly in the United States, we've seen a massive amount of basically conversion of plots of land and drilling facilities into stronger hands of large multinational and large E&P companies, much less in the smaller ones and the PE-backed firms that would have been more price responsive. In metals, we've seen some of the CapEx reinvestment rates relative to free cash flow at like 40-year lows. And I think this is what is the biggest driver of the supply, of the price pressures on the secular horizon, is the fact that we're just not reinvesting in the upstream of the material space like we would have historically.
Okay. Well, let me come back to crude oil in a bit. First, let me ask about the gas ecosystem. You know, Qatar's gas fields have suffered a very big damage, probably 20%. How may gas supplies and their prices pan out, and what's the impact on downstream?
So I think one of the biggest challenges in knowing where we'll settle is what do we see as a rebound in Southeast Asian and Chinese LNG imports? Because one of the biggest levers the market has been able to rely on has been a major drop. Now, if this event happened in January, global LNG prices would have been, meaningfully higher than what we've realized already, because you would have had an inability to ramp down demand because you need it for winter heating. The fact that this happened in March and weather conditions were accommodating lower demand because it was just already warmer than normal throughout many of the major consuming economies was a saving grace. But when you start thinking about countries like China, for example, and they're going to want to rebuild their inventories heading into winter. So I think there's some backside demand pressures that will ultimately help support. And if you look at Europe, inventories are extremely low and uncomfortably so, and on path to remain, pretty much towards the 5-year lows heading into next winter, which again, if we have a resumption of more LNG flows, there's going to be a lot of demand to rebuild the inventory buffers. The biggest shock though for Qatar is that the expansion is likely to be delayed at a time where we've now lost 2 trains. So the global surplus narrative in the LNG chain is certainly being pushed back yet again by these developments. So if we get to a point where demand does normalize, I think you'll see prices stabilize around here and supply normalize. But if supply doesn't normalize, I think we have real risk that prices can continue to go higher to ensure we create enough buffer heading into the next winter heating season for our needs.
Okay. Okay. Well, let's again come to scenarios. Assuming the Straits open in May, what's a likely crude price average for the full year? Is $90 the right average?
I think that's a pretty reasonable guesstimate for an average for the year. But each week and month we pass, that average is going to be harder to achieve, and you're going to have price pressures above that. So I don't find that a comfortable scenario, to be honest. It's going to be one that we're really running very tight on inventories and supply all the way through summer. If we even just try to get things normalized, it's going to take months to do so. So there's going to be meaningful pressures in the system that will sustain itself for way beyond the point where we say flows have can start to normalize.
Okay. Okay. And finally, how many more months before crude oil goes back to the 70s, the $70 per barrel mark? Does it take a year?
I mean, the $70 mark seems very hopeful at this point. Time will increase the odds of that because you have more recovery. I don't expect that we're going to see a meaningful uptick in supplies outside of OPEC in this period of time. Like, I don't think you're going to see a meaningful increase in U.S., which is the shortest cycle drilling. So it really comes down to that normalization where I have the least amount of comfort in saying that's imminent. And then I think that process of restarting is going to be potentially messy. So $70 does feel like it's a year plus more away. I would love to be surprised and said, hey, we're back at it. The world has found a peaceful solution that, everyone can live within, and we have safety again. And as a result, some of the supply side pressures can be ameliorated. But that is definitely your optimistic, scenario right now. And it doesn't have the likelihood of that right now does not seem terribly high. So while we hope for 70 in the next, in 12 or 18 months, I don't know if that's definitely not the baseline at this point.
Oh, yes, sir. 18 months. That's really looking a very long time even to get to $70, 105 as we speak. Thank you very much, Greg Chernow, for joining us with all those details. Most helpful, most informative. We have to wrap up on Bazaar. On that note, Chartbusters up next.
Stocks start weak as tensions continue to rise in West Asia. The Nifty slips below 24,000 as all sectors correct, led by IT pack. The broader end of the market is slightly better off.
Infosys and LTIMindtree report weak numbers, keeping in line with the sectorial trend this quarter. Both stocks are among the top losers on the Nifty, dragged the entire sector down over 4%.
Himadri Specialty Chemicals surges as EBITDA and net profit hit a record high in FY26. The management also tells CNBC TV18 that they are sticking to the guidance of 1,100 crores profit by FY28.
Bluestone stock rallies, revenue rise nearly 50%, while the same-store sales growth nearly 35% in the fourth quarter. The management joins in shortly to discuss the quarter gone by.
Stock starts weak as tensions continue in West Asia, but we have Aequs Health that is in focus after it acquires US-based healthcare operator TrueBridge for $557 million to strengthen its presence in rural community and healthcare. The deal is expected to be profit accretive by FY27. The stock is up 4%.
Well, hello and welcome to Chartbusters. You're tuned to CNBC TV 18. We're coming to you live from the Motilal Oswal studio. I'm Nigel, and today is Vinny who joins us. Hi, Vinny. Good to have you on the show. Well, the market's a little bit under the weather on a Friday. Let's see whether or not there is some recovery. I think the 23,800 mark is an important support level. But the tech index, after seeing that rally from around the 29,000 mark to 31,500, has given all of it off in a matter of a few sessions.
Absolutely. And in those few sessions, we've seen most of those big IT companies come out with their numbers. Nothing exciting that has come in from any of them, right? So today, Nifty IT obviously is down more than 3% in the trading session as well. Apart from that, all the sectors today are trading in the red. There's nothing. Pharma, metals, all of them just in the decline. And in terms of the broader end of the market, slightly better than the benchmark indices. But nonetheless, we have a lot of earning movers that have come in as well, right? We're seeing Himadri Specialty Chemicals that's managing to hold on to some bit of a gain. We have Bluestone that's trending in this trading session as well. And obviously, we'll talk about all of this later on in the show as well. Let's move on and talk about Reliance Industries because they are set to report their numbers today. First up, let's go across to Sonal Bhutra, who's joining us to take us through the key expectations from Reliance.
Well, despite the West Asia crisis and disruption in global energy markets, it is expected to be a steady quarter for Reliance Industries. The stock, which is down 14% in last 1 year, in line with the market disruption that we have seen. Overall, on a quarter-on-quarter basis, we are expecting the revenue to increase by 3%, but there will be an EBITDA fall to the tune of 3%, leading to a margin compression, which is expected to come in at around 16.3%. Profits, accordingly, will also see a decline on a quarter-on-quarter basis by 5%. We've been speaking about global energy disruption, and that is something which will impact two segments, oil to chemical segment, which is the biggest one, and oil and gas, which will see some disruption this time around. However, telecom and retail will continue to see strong YOY growth. So let's talk about those expectations. For Jio, it is expected to see a growth in EBITDA to the tune of 15%, led by 5% ARPU growth, according to an estimate by Nomura. And if we talk about the retail business, that is expected to see an increase in EBITDA by 6%. The oil and gas business will continue to see a decline. That is because of lower KG-D6 volumes. There has been an interesting note from JP Morgan. They talk about how stock has given up recent outperformance on uncertainty related to near-term O2C margins because of disruption that we are seeing. However, they also add both refining and petchem margins should turn out higher than what the assumption is currently. Higher crude and weaker rupee should drive higher EBITDA for the oil to chemicals business in FY27. This is the trend in terms of EBITDA for the consolidated business. It has been increasing, but this time a quarter-on-quarter decline because of global disruption is expected. But overall, a steady quarter for Reliance Industries, and important to watch out for management commentary as well.
Okay, Shirley, thanks so much for that, Sonal. But on that note, the management of Bluestone will join us after the break to discuss their Q4 numbers. So stay tuned for that. Welcome back to Chartbusters on CNBC TV 18. Now let's move on and bring on board Gaurav Singh, who's the founder and CEO at Bluestone, joining us right now to discuss the numbers of the company that have gone by, the quarter gone by. What is the outlook of the company going forward as well? Gaurav, good morning. Thank you so much for joining us on the show. When you talk about and look at the numbers for Q4 FY26, let's start by talking about the SSSG, right? For the quarter, 34%, much better than what the street was anticipating as well. One, is this sustainable? Out of this, how much was actually in terms for volume-related growth? What is the gold price rise? Because of that, what is the growth coming in? If you could start by talking about all of this.
Sure. So good morning, Cecilia. So on the first part, which is the sustainability of 34%. So I think in general, if you look at our past data also for past 2 to 3 years, our growth rate, our same-store sale growth have generally been in the ballpark of 30% and so. So delivering 34% is kind of for us to getting back to normal. I think last 2 quarters were severely impacted by gold price rise, which had kind of created some certain challenges in the business. But I think 30% or so is something that we have delivered many times in the past also.
Okay, all right, 30% revenue growth, right, Gaurav?
SSSG, I'm saying.
SSSG growth, all right. And what would that mean in terms of revenue growth?
We went public in Q2 of last year. And before that, if you look at our data, which is there in the DRHP and many public forums for the 2 years prior to that also, I think SSSG, same-store sale growth, were more or less in the ballpark of 30s for a very, very long time.
All right. Could you tell us what was the inventory gain for the past quarter and what is your hedging strategy? I think it was around 50%, right?
Hedging strategy remains same. It's not something that we change basis anything or that we change very frequently. And the hedging strategy remains same at 50-50 to protect the balance sheet. And that has been the hedging strategy since for the last 1 year or so.
And inventory gain for the past quarter?
For this quarter, the inventory gain is close to 50 crore.
Okay, close to 50 crore. Gaurav, this is Vinny this side. What also about silver? How is that moving in terms of the demand? That had been a growth driver in the past as well. So what is the current contribution in terms of revenue from this?
Yes. Did you say silver?
Yeah.
We don't deal in silver.
Oh, y'all are not. Oh, okay. Sorry.
Okay. So I'll just tell you our proposition typically has always been design-led jewelry. So I think India predominantly is a very it's a jewelry market, but a good part of that is also kind of very commoditized in nature. So we have never dealt in that. We've always focused on. So we believe in the long-term secular trend of people moving away from heavy jewelry to lightweight, daily wear kind of jewelry, and there we believe designs have a huge role to play, and hence we use our omni-channel play to kind of capture on that aspiration. And we use internet very, very heavily. We use internet as first touch point to take our designs to the customers and to consumers and in their homes, make them fall in love with our designs, then walk into our stores and then convert. So design has always been our forte. Design has always been our wedge with which we entered this category. So,
all right, difficult one, right? If you take your wife to a store and she falls in love with something like that, it's going to be a little bit costly for you, but I get your point. You're running a business.
I'm already, my wife actually let's just not start on that. I'm always already.
Yeah, we want to have a pleasant Friday evening and then a better weekend as well. Let's get back to business. Operating cash flows actually were negative, I think, for the past year. What's the plan to get that into the positive trend? And also tell us about the store addition. How many more stores do you look to add in FY27?
Sure. So I believe operating cash flow for this quarter were positive. I can consult my CFO, come back on that. But in terms of store openings, this last year we opened around 65 stores. And our plan generally is to grow our distribution by close to 20% per year. So this year we closed, this year the closing number is around 340. And I think year over year we'll grow our distribution by 20%.
For the year, actually, the cash flow was negative. You're saying for the quarter, I think it was positive. So from year on, it stays positive, right? The operating cash flow?
From here on it will.
Okay.
All right.
Yeah.
Also, what about your store expansion plans over there as well, given that, you have competition coming in the affordable side of the segment as well? So one, store expansion plan, and in terms of competition, any concerns that you've seen in Q4 itself?
Yeah, so on the affordable segment, I would say the number of players are still very, very few. If you look at all the jewelry players, all the legacy players, etc., I think they've generally been focused a lot on heavy jewelry, wedding jewelry, and so on. So affordable segment, which is I think around 30-40% of the overall jewelry segment, is still not still does not have enough players. So I wouldn't worry much about competition. I think if we just keep on solving for the end customer, and if we keep on solving our operational, if we kind of keep on strengthening our operations, I think the opportunity is huge. I wouldn't worry much about competition.
Okay, all right, Gaurav. Thanks a lot for joining in. Cecilia was the one that fixed this interview. She's our guest coordinator. And Vinny and myself had a good chat with you. Wishing you all the best for the coming fiscal. And we look forward to chat with you soon.
All right, thank you.
All right, well, time to slip into a short break. On the other side, we'll focus on industrial metals. We'll tell you what to expect from the ferrous and the non-ferrous space for the coming quarter, as well as the quarter gone by. Axis Securities' Aditya Birla is waiting for us on the other side. Welcome back. You're tuned into Chartbusters here on CNBC TV 18. And as we speak, the markets are under pressure. Let's tell you about the metals pack, though. During Q4 FY26, the metal companies across ferrous, non-ferrous and mining companies, they'll see a good recovery in profitability. Let's start off with steel companies first. They will improve in profitability, and the profitability per ton will improve by more than 2,000 rupees per ton. This, as the realizations are up by around 3 to around 4,000 rupees, operating leverage will play out, and volumes as well will be up by close to 2 to around 10% on a sequential basis. This will be partially offset, though, by higher coking coal costs and marginally higher iron ore cost, which will hit the non-integrated players. The highest EBITDA per ton increase will be seen for SAIL on a low base, while Jindal Steel EBITDA per ton will also jump up by close to around 50% on a sequential basis. They will get partly impacted because of the one-time commissioning cost of their new capacities. Tata Steel's India business as well will see an increase on the EBITDA per ton by around 2,000 rupees per ton. It will get partially offset, though, because of the lower price automotive contracts could weigh on. And though Europe continues to remain in a loss, the EBITDA losses will actually reduce. On the non-ferrous side of things, the rise in commodity prices will drive growth. Zinc is marginally high on a sequential basis. Aluminium prices have been rock solid as various capacities in the Middle East have got shut down. While silver, yes, it's corrected from the top, but on a sequential basis is actually sharply higher. Moving in the company-wise expectations, Hindalco's India EBITDA per ton, including the Utkal Alumina business, that will jump up by close to 9% on a sequential basis. Hindalco's India business will be led by higher aluminium prices, while Novelis' core EBITDA, without adjusting for Oswego fire, that impact, we'll see an improvement of around 20% on a sequential basis. That will be driven by higher volumes by around 5% and improved scrap spread as well as lower tariff impact. Hindustan Zinc's EBITDA, by the way, will jump up by close to 20% on a sequential basis, which will be driven by lower cost of production, higher commodity prices, and Vedanta's EBITDA will rise by close to 20% on a sequential basis as well. It obviously has the tailwind of LME prices. Moving to the miners, NMDC will report a 15% growth in the EBITDA on a year-on-year basis. That's going to be led by higher sales volume on a low base, but it's partially going to be offset because realizations were a little bit softish. Coal India's EBITDA that'll increase primarily due to the lower cost of production, though volumes have come in lower, while the blended realizations will improve on a sequential basis. Finally, let's wind it down with a snapshot on the valuations front. Stocks are not cheap, but metals, remember, it moves with momentum. So the past quarter will actually reflect a good improved performance for the sector on the whole, ferrous, non-ferrous, as well as the miners. Let's welcome Aditya Birla from Axis Securities, who joins us on the show. Hi, Aditya. Thanks a lot for joining in. Aditya, what's the preference now between ferrous as well as non-ferrous names? In the past quarter, the non-ferrous guys actually have outperformed. Where would your preference lie?
Good. Nijal, I think both the ferrous and non-ferrous, they will continue to do well, at least for one more quarter. But the preference will be structurally towards non-ferrous side because aluminium, we see that the kind of disruption which has happened because of this war, almost 2.5 million tons of smelting capacity has been hit. And that may translate up to a deficit of 2 million ton in this calendar year. And the new capacities which are expected to come in Indonesia, that will happen over a period of time, but that will happen maybe in calendar year 27 and 28 because they have their own challenges of sourcing power. So this window of higher aluminium prices have opened up and it may persist for the rest of the calendar year and maybe up to a few months of the next calendar year. So aluminium players from the price tailwinds perspective, the top line perspective looks strong. Steel, we will have to see going into the monsoon, we may see some correction in steel prices because the prices have rallied substantially. Okay. And as the off season starts, we may see some correction. So that will move with the spreads.
All right, let me take that point on aluminium then, Aditya, because currently aluminium prices are holding about $3,500 per ton. And in getting into this calendar year, which is 2026, as is the street was saying that the demand will remain strong and supplies are limited, and China is almost at peak capacity. Given that sort of a backdrop, and now with the Middle East capacities getting hit, what's the range you're working with in terms of aluminium prices? Because it appears the street is underappreciating the strength in aluminium prices, which is at more than $3,500 per ton.
That's true, Nijal. I think if the new smelting capacity elsewhere, ex-Middle East, if that doesn't come up within the stipulated times, especially in Indonesia,
And the smelters which have got hit in Middle East, they may take 12 months to fully operate, because remember that these smelting, the pot lines, they took time to prime up. So we are in a phase where this deficit will persist. And if the new ex Middle East smelters don't come up, or if the demand destruction doesn't happen because of other macroeconomic parameters, then the aluminium prices could exceed the current levels, and the downside from these levels looks definitely limited, and upside risk persist.
Okay, Aditya, while you said ferrous, non-ferrous, both are expected to do well during this quarter, given the run-up that we've seen YTD for the metal index as well, where are your top picks that you pick up, whether it's ferrous or non-ferrous? What is the preference there? And what are the names?
See, as far as the valuations are concerned, the valuations have run up, and the earnings are largely reflected in the current valuations. So the next leg of rally will be dependent on the next phase of expansion. So if you recall that most of these names, especially steel names and even aluminium names, they have huge expansion plans lined up. So in case of Hindalco, a couple of smelters and alumina refinery expansion. In case of Nalco, alumina refinery expansion. In steel names, the steel capacities are going to exceed in future. So from a very long-term perspective, I think we have a couple of drivers. One is the volume driver, which will drive the top line of these companies. Then the cost drivers will be variable, means that will be dependent on the coking coal prices and other raw material prices. So that will keep on fluctuating quarter on quarter. But remember, the cyclicality of these companies get reduced because we are in a structural volume growth phase for these metals. And there is some run-up for some of the names like JSW Steel. It is increasing from 35 to 50 million tons. So keeping that in mind, the long-term, as a long-term investor, one can stay invested in the stock. From a short-term basis, we may see seasonal variations based on the monsoon and all. So that is the view which we can give. If we want to give a top pick preference, we will first prefer non-ferrous, followed by ferrous, and within non-ferrous, maybe Vedanta, Hindalco, and Nalco in that aspect. And then in the ferrous pack, JSW Steel, JSPL, Tata Steel, and SAIL.
Got it. Thanks a lot for joining in, Aditya. I believe you had a busy evening and a busy morning as well, but appreciate you taking some time off and giving us your take. Non-ferrous is the way to go, structural in nature, and Vedanta is one of the top picks from the aluminium basket. Well, on that note, we'll wrap up on this edition of Chartbusters. That's it from Vinny, myself, and the entire team that put the show together. You stay with us, though. The team of Trading Up comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me from the Bangalore studios, as always, is Ritu Singh. Ritu, good morning. It's not been a very good morning for the markets, though. It's not been a very good week for the markets either. A 250-point cut on the index and dragged lower by the familiar suspects. Higher oil prices, IT stocks, and most of the other earnings reactions have also been on the negative side, Ritu.
Yes, not looking very good, and it looks at this point of time almost certainly that we may end the week on a negative note. Below 24,000 on the Nifty, 23,917, down more than 1%. It's a 250-point cut as we speak on the frontline index. The Sensex is also below 77,000. It's now trading at about 76,767, down almost 900 points. And, the market breadth tells you about the kind of buying that's selling that is pressure that the markets are seeing. There are about 2,340 odd stocks that are declining on the NSE as opposed to about 600 odd stocks that are advancing. So almost 4 stocks declining for every 1 stock that is advancing. The IT pack that you mentioned continues to be under pressure. The earnings so far haven't really given the street much hope with a weaker guidance. The banking pack also seeing pressure, although falling lesser than what we're seeing on the IT pack, down about 350 points, below the 56,000 mark again for the banking stocks. IT, metal, media, PSU banks, pharma, sectorally, these are the biggest losers. Realty, FMCG, banking, they're doing relatively better, but it's pretty much red across the board. But Hormuz has walked over to the wall to put a spotlight on the key movers and shakers in trade today. Hormuz.
We can't not talk about the IT names, and since you mentioned that is certain to end the week lower, well, 24,353 is that level we need to close above for a weekly gain. We are a fair distance away now from that level, but never say never in a market like this. But IT is the big talking point in today's session, as has been the case all through the week as well. And Infosys is down around 5% after its results, extending its losses now. We're talking about LTM, the LTI Mindtree, not the stock that is highlighted here, and Coforge too is down another 5.5% in today's trading session. You take a look at the volumes here. Over 1.5 crore shares have been traded already on Infosys. That's 4x. It's a 20-day average for LTM too. Now that's around 3x. It's a 20-day average, and for Coforge, 15 lakh shares have been traded, 20-day average of 10 lakh shares. So all of them falling on higher volumes compared to their daily averages. Now the other stock movers today, the newsmakers of the day, Himadri Specialty is a positive earnings reaction, 8% higher on the stock. Gujarat Themis announced an acquisition earlier this morning. The stock is up 10% as well. And Atul Auto, after the big order that it received earlier in the day, 7.5% higher here as well. And look at the volumes. They're gaining too on substantially higher volumes. These smaller names. Himadri Specialty has had 4 crore shares traded. The 20-day average is only 18 lakh shares. Gujarat Themis is not a very much traded stock. There are 3.2 lakh shares traded, but 32,000 is the average here. And Atul Auto, 57 lakh shares traded. The 20-day average is only 4 lakh shares. So all of these broader market names also advancing on very high volumes based on news flow. And lastly, some negative earnings reactions as well. 2 names come to light. UTI AMC is one of them. That's down around 6%, and Mahindra Logistics too is seeing a negative earnings reaction. Both of them now down 6.5% each. You take a look at the volumes. UTI AMC has had more than 4 lakh shares that have been traded. The 20-day average is only 60,000 shares. Same is the case for Mahindra Logistics. 15 lakh shares have been traded. The 20-day average volume is less than 80 lakh shares, Ritu.
Well, Hormuz, thanks very much for that. Giving us a picture of the market breadth right there. It's pretty much negative, isn't it? But stay there, Hormuz. We're going to come back to you in just a bit. Don't sit down just yet. Let's quickly shift the focus back on the IT sector we've been talking about. Sectorally, it is the top loser today. Infosys is the top Nifty 50 loser. It's down almost 5%, multi-year lows because of the weak guidance and the kind of performance it's reported for the 4th quarter. It's been a disappointing quarter overall, and which is why you're seeing the kind of reaction you're seeing on the stocks. Reema Tendulkar joins us with a detailed roundup of the IT sector performance in the 4th quarter. Reema.
Well, it's been a disappointing quarter for Indian IT companies. Now that we look back, all 4 IT companies, majors, have disappointed this quarter. In the case of TCS, revenues were fine, but margins street questioned that you had 110 basis points benefit because of the currency, but only 10 basis points margin improvement was reflected. In the case of Wipro, despite the benefit coming in from the Harman DTS acquisition, your revenues continue to struggle. HCLTech had flagged off discretionary spending cuts at US telcos, 2 SAP projects getting cancelled, and Infosys, as we know, was a miss on revenues and margins. Now for FY26, it's been another tough year. For Infosys, it was a revenue degrowth of 2.4%, the first annual revenue decline for the company since inception. For Wipro, this is the 3rd consecutive year of a revenue drop. In the year gone by, despite the acquisitions, revenues were down 1.6%. HCLTech at 3.9% missed its own guidance of 4.5% that they had given in January, and Infosys at 3.1% was at the lower end of their own guidance. Also, look at the employee change in FY26. TCS went through the restructuring, as a result of which the employee headcount went down by 23,000. But for the others, these were companies which used to hire in large numbers. And now in FY26, the addition has been 3,000, 5,000, 8,000. The FY27 guidance basically is implying that there is no incremental, the growth is not accelerating. Growth will be what it was in FY26 as things stand today. HCLTech is at 1 to 4% growth, Infosys at 1.5 to 3.5%. And just one final word, I was listening to the Infosys conference call, and there were 2 key things that stood out for me. One, Salil Parekh talking about, every now and then he sees competitors, where they're quoting unusual pricing. The word was unusual. He's saying it's happened in the past as well. This time it seems to be linked to AI. So the question is that, are some competitors promising more on AI more than they can deliver? Somehow the math of the deal doesn't seem to add up. And on AI pricing, the CFO said that AI projects come at better pricing, therefore better margins, but it also has a higher cost compared to the regular project because premium talent is being assigned to it. So the question is, what is the net revenue margin benefit for IT companies? And HCLTech, particularly because, it was a very disappointing quarter. There were many company-specific issues, as I said, discretionary spends at telcos, SAP project cancellation, a revenue AI deflation of 2 to 3%. So I think that sort of spooked the street, and HCLTech was a rank underperformer for this quarter.
An underperformer this quarter indeed. Reema, thanks very much for that. The IT pack, it's facing steep cuts deep in the red. Infi, like we said, is the top sectoral loser. HCLTech, Tech Mahindra, TCS, these are some of the names that are actually, some of the top losers in trade today in the Nifty 50 pack. For now, market's still down about 240 points, 23,930 odd levels is what we're seeing right now. But let's go back to Hormaz, who's still standing by at the wall. Hormaz, we've got a downgrade, yet another one from JP Morgan this time, downgrading India to neutral from overweight. And they've also cut the Nifty target. What are they saying, Hormaz? What brings the fresh bad news?
The downgrades are just not stopping for the Indian equities, and this one comes just a day after HSBC also made its second downgrade of India in less than a month. But talking of JP Morgan, they have downgraded the rating to neutral from their rating of overweight earlier. And as per all scenarios, the Nifty targets have been cut as well. The base case target that was earlier 30,000 has now been cut to 27. The base case target has now become the bull case target at 30,000, which was earlier used to be 33,000, and the bear case target from 24,000 has been slashed to 2,500. JP Morgan has cited multiple factors as the rationale behind the downgrade. The valuation gap is the first one. They're saying that yes, it is narrowing, but it is still stretched, and that Korea, Brazil, China, the other peers are offering cheaper entry points for growth that is similar or maybe even better compared to India. They're highlighting this valuation differential as well. The India premium to the MSCI EM index, which at its peak used to be 109%, has come down to 65, but it is still at stretched levels. The other big factor is the earnings risk. Now, JP Morgan sector analysts have cut their FY27 estimates by 2 to 10% across sectors, and as a result, it has cut its MSCI India EPS growth forecast for calendar year 2026 and 2027 by 2 percentage points and 1 percentage point each for these 2 years. The other major one is the flows picture. Now, FIIs since the start of 2025 have sold a whopping $37 billion. That has been offset by more than $120 billion worth of inflows that have come in from the domestic investors. But there is a big dilution risk that is still lined up in the form of IPOs, QIPs of $64 billion is the figure that JP Morgan is highlighting here. And it is this large dilution that continues to cap any potential upside that Indian markets could see. And this is in stark contrast to the US, where the buybacks that the companies do continues to persistently retire equity, is what JP Morgan said in its note. The other disadvantage that JP Morgan has highlighted is the lack of exposure to AI, where they say that the large cap index in India has minimal exposure that represents AI, data centers and semiconductors. And that is in stark contrast to countries like the US, Korea, China and Taiwan that have far larger representations going forward. And the upcoming risk to the market is the subpar monsoon forecast that the IMD has said. They are pegging the LPA at 92%, and this subpar monsoon could threaten rural incomes and food inflation as well. And therefore, based on all of this, JP Morgan says that they continue to see opportunities elsewhere until valuations derate further and earnings visibility in India improves. So another downgrade coming in, another target cut for the Nifty. There are multiple risks that lie ahead as per what JP Morgan is saying.
Thanks, Hormaz. And what a steep cut. Bear case is 20,500, bull case 30,000. Let's hope we're closer to that higher figure. But let's slip into a break for now. Up next, we're going to focus on the bond market, where Manisha Gupta is going to be speaking with Umesh Salvi of Catalyst Trusteeship after this short break.
Hello and welcome to Bond Street. Joining us on the show today is Umesh Salvi. He's MD Catalyst Trusteeship Limited. Umesh, hi, thank you so much for joining us. Well, Catalyst has been a debenture trustee since 1997 and has been the first non-banking private sector company to get SEBI's debenture trustee license as well. How has the role of a trustee evolved over nearly 3 decades that you've been around?
So Catalyst started in 97. It's been 29 years. So 20 years back, the role of debenture trustee was more of an administrative role. So trustees used to execute documents, trustees used to follow the instruction given by debenture holder, and it was more of a back office role. But last 20 years, the overall bond market has evolved. The role of trustee is evolved. Regulator has played a very important role. today, trustee is not merely a back office function. Trustee's role is more of a monitoring role. Trustee does the due diligence. Today, whenever any issuance is to happen, debenture holder is to do their own due diligence. But now, trustee does their own due diligence before the issuance. Trustee monitor the quarterly asset cover, whether sufficient security is there or not. From compliance point of view, trustee ensure whether regulatory framework is followed in each and every transactions, and definitely enforcement process trustees plays a very important role. So earlier from a back office function to today, I can say the role of a trustee is more of a frontline risk management role. So there's a big change has happened in last 20-25 years.
Oh, absolutely. But there also is a perception that debenture trustees only act after something goes wrong. How do you change that narrative and make trusteeship more visible, proactive?
So this narrative has to be verified with the facts. So today, the outstanding debentures are around 50 lakh crores. So, and the default rate in this 50 lakh crores is less than 1%. Vis-a-vis you compare with the banking industry, the NPA levels are 3 to 4%.
Sure.
And it's not merely accidental. So there's a lot of work done by trustees as well as SEBI as a regulator. So trustee is monitoring asset cover regularly. Trustee, each and every debenture transaction has a specific covenants. So it can be financial covenant, non-financial covenant. So financial covenants like different ratios, non-financial covenant like shareholding pattern, management change, multiple different covenants. So trustee monitors each and every covenant. If there is a breach in covenant, trustees send notice to the issuer company on the same day or within next T+1 day. Within T+3 days, trustees conduct debenture holders meeting.
Okay.
And these debenture holders are spread across India. So now through virtual meetings, we conduct the meetings, but it's not easy to conduct those meetings. And our observation is whenever these meetings happens, there is never quorum achieved in the first meetings. So, and meanwhile, the value of assets is eroding. So trustees are doing whatever best possible things are there, regulations are there. But, and if you see the numbers, the default percentage is very less.
Okay.
So whenever default has happened, people have lost the money. So definitely there will be anger, but trustees trying to do the best things. We have managed multiple default situations. We have recovered good amount of money. There were cases where 1,50,000 crore default has happened, and we have participated in that process. So definitely we need to, whatever the perception is there, we need to verify with the facts and figures. Yeah.
Point taken. Also the bond market has seen explosive growth. Trades settled on exchanges grew by 138% in FY26 alone. As a trustee, does it mean more volume or more complexity?
So you're absolutely right. So FY25 closed at around 9.9 lakh crore. And projection for FY26 around 11 lakh crore. So 9.9 lakh is the highest ever in a year. So it's numbers are increasing, but complexity is not directly proportional to the volume. So overall, I see debenture industry has evolved. So there are complex products, irrespective of the volume. Now, from a conventional debentures, we are seeing the green bonds. We are seeing infrastructure trust bonds. We are seeing municipal corporation coming out with the bonds. We see different structures where there's a waterfall arrangement is there. So it's a structured products are coming up. So volume is increasing, but at the same time, this market is evolving. Debenture holders or investors are showing more interest in a complex product. So complexity as a structure wise, however, at the same time, we see a lot of reissuance happening. So as there's a restriction on number of ISNs, so we see a lot of reissuance happening in the same ISN. So it is increasing volume. So operational complexity is increasing, but at the same time, structural complexities are also increasing, but nothing to do with volume. Market is evolving, because of which complex structures are well accepted in the industry.
Absolutely. You work across NBFCs, corporates, AIF, securitization trusts, a very wide canvas really. Where is the most activity right now, and which segment is growing the fastest?
So I can proudly say all these segments, the growth is significant.
Okay.
The securitization market is growing. You see the number of AIFs which are coming up, significant growth in AIFs. So today, active AIFs are more than around 2,000 AIFs are active. The participation of AIF in the private credit market is significant. Securitization trust, again, a very new product to the industry. Earlier, it used to happen only with the NBFCs, but now we are seeing corporates coming out with the PTC transactions. So last year, we did the largest pass-through certificate issuances, which are of 25,000 crore. So a significant volume. So debt market is evolving, and touchwood, PTC, securitization trust, AIF, and bond market. All three markets, we are seeing a significant growth happening. At the same time, NBFC and financial institutions are the main borrowers, main issuers in all these segments.
Welcome back. Still a 250-point cut on the index, and the broader markets are selling off equally sharply, if not more. UTI Asset Management is now down 8%, as we just highlighted one of them as their negative earnings reaction. The other negative earnings reaction is Cyient. That too is down 6% now, heading towards the lows of the day. And the buyback, which has come in at a 20% premium to yesterday's close, has not been of any help either to allay any potential investor concerns. Now, what is also not doing well, Coforge is selling off along with all of the others. The yet to report numbers are 5% lower on Coforge, 5% lower on LTM, and 5% lower on Infosys as well. And a lot of the others, the stocks that are doing well too have come off the highs. Himadri Specialty too at one point was up almost 11-12%. That has now cooled off and is still trading with gains of around 7.5%. Good time to get a quick chart check from Dharmesh Shah of ICICI Securities along with some trading ideas as well. Dharmesh, good morning. Thank you for joining in. We've given up a lot of those gains that we had in the month of April, but where do you see support now for the Nifty? Is there further down at 23,800 odd, or do you see some support at 23,900 as well? Your call on the index and your stock recommendations for the morning as well.
So good morning. Yes, absolutely. I think so. The market, if you look for the last 15 days, we have seen a sharp rise of almost 2,500 points. That makes the market to more of a overbought condition, and that is what exactly panning out for the market right now. I think so it's more of a technical in nature. Looks like, I think so, the way the market has seen a profit booking in last few trading sessions, we expect Nifty to see the strong support in this range of 23,500 remains to be the very strong support for the Nifty. On the higher side, we believe, I think so, 24,400 to 500 will act as an immediate resistance. So it looks like more of a consolidation after a sharp move which has seen in last 15 days. So not so much negative for the market, but we expect, I think so, Nifty to see a strong support in this range of 23,500 to 600, and eventually should make a higher bottom formation and should see the next leg of upside where below Nifty should look for a target of 24,800 in the month of May. So it's something like, I think so, maybe in a couple of weeks we can see some bit of a profit booking which makes the market more healthy in this current context.
Okay, would you want to call out any stocks, Dharmesh?
Absolutely, the way the market has been, it looks like more of a stock space action likely to continue going forward, where power as a space remains to be the positive in the current context, where if you look, the index itself has witnessed a breakout of the last 10 months of consolidation. So inside the power space, we remain to be positive for power grade. Again, the stock has witnessed a falling trend line breakout, and a breakout seems to be shaping a flag breakout. It looks like the way the stock formation forming on the weekly and the daily time frame, clearly in terms of relative outperformance, we believe power grade can be looked for a target of around 352, keeping a stop loss of 289. So power grade remains to be a top pick at the current market price.
All right, Power Grid is your top pick. Dharmesh, thanks very much for joining in with that. Appreciate your time. Let's move on to the big numbers that are expected today from Reliance Industries later this evening. It is expected to be a steady quarter. Let's start with Reliance Retail. That is expected to report a strong performance in the March quarter. Manglam Malu has done, a poll of what is to be expected, and he joins in with the key expectations. Manglam.
Well, the updates that have come in the fourth quarter so far from all the other retail players tell you that consumer sentiment is improving, at least on the demand front. And that's exactly what's expected from Reliance Retail as well this time around. Our poll of analysts expects a range of 6 to 9% growth on the top line, with 7.5 to 8% on the EBITDA margin front as well. Remember, this time around will be the first full quarter impact of the demerger of their FMCG business. The third quarter saw just a 1 month impact. And that's why, if you look at the absolute numbers, that will be a lot better in terms of picture for the retail business as against year-on-year numbers. So 84,500 crores is what our poll of analysts is expecting on the top line, with a 6,600 crore EBITDA and margins at 7.8%, right between 7.5 to 8%, the expected range. Like I said, again, year-on-year, the numbers will not be comparable due to the FMCG business demerger. We'll have to await company details on those comparable numbers. What is it that will lead growth this time around? 7% growth in the core retail business is what is expected, higher penetration of fast-growing quick commerce business, and complete recalibration of their store network, which will aid their operating performance in the retail business. And that's exactly the commentary that we'll be watching out for too. Scale up of quick commerce, how that is performing, pace of retail store additions. The Smart Bazaar vertical has actually crossed 1,000 stores as well, and commentary around the consumer business, consumer sentiment, and the numbers that it has clocked as well.
Mangalam, thank you for that. All eyes on the big boy Reliance Industries this evening. That was retail, but how's the core business going to do? Both O2C, oil and gas. Sonal is here with a lowdown of that. Sonal.
Well, auto chemicals and oil and gas business will be the most impacted because of West Asia crisis. But let's talk about the refining front first. Singapore gross refining margins, they're up 12% on a sequential basis to come in at $8.3 per barrel. Across most products, cracks have risen, and how? For gas oil, it's up 162%, gasoline up 21%, jet fuel cracks are up 144%, and there's been a lot of action in this segment. However, petchem spreads continue to be under pressure because of the supply disruption that we've been talking about in the Strait of Hormuz. Some of the prices, they have declined anywhere between 1 to 10%, and that disruption continues even now. And that is the reason why Jefferies estimates EBITDA to decline 8% on a sequential basis, but it will be up 1% on a YOY basis. Let's look at the EBITDA trend. It has been continuously improving, but this time around, because of West Asia war, there could be some disruption. Let's talk about the oil and gas business now, because lower KG D6 basin volumes will impact profitability for the company this time in this segment, and Jefferies expects the EBITDA to decline 12% on a YOY basis and 7% sequentially because of lower volumes. Again, let's get the trend, because it has been declining largely because of volume issues and some realizations as well. But this is what the street will be watching out for, the commentary in terms of volumes and realizations in the oil and gas business.
Thanks, Sonal. Those numbers later today. Let's slip into a short break. Up next, we're going to discuss market fundamentals with Mukul Kochar from Investor Capital Service, so stay tuned.
Welcome back. Looking to have some bit of recovery from lower levels is the market. So we are at 23,950 as of now. Still a 225 point cut is where we currently stand at. So Mukul Kochar from Investec Capital Services is now joining in. Mukul, good morning. Thank you for taking time out. Well, you've had most of the large cap IT companies now report results, and most of them have disappointed on a fairly large level. HCLTech, Infosys leading that disappointment in terms of the guidance and the earnings miss as well. Do you believe that FY27 might bring some better days because of the commentary that these companies have given, or do you believe that this pain is likely to persist, but it is in the price?
Hi, good morning. It's a good question, very pertinent. But let's look at why the correction has happened in the first place. Yeah, the first reason why the correction, I believe, has happened is because these stocks were expensive to start with for the level of growth that they were promising. So, multiples had touched on a forward basis 20 times, and, which had happened post-COVID, but the correction really never took place. So the first level is the numbers, the multiples have corrected to what I believe now are a little more sustainable, more sort of reflective of the businesses. The second overhang, of course, which is a bigger overhang, is the impact of AI. Yeah, and which is where I think now the second order impact is taking place, where market belief is that these businesses will slowly lose relevance. Yeah. While we were on the trade of multiple correction, we thought these stocks were overvalued, and in most of our model portfolio, we were maintaining an underweight on the IT services sector. Now I think the multiples have become normal, and the call is on the AI trade. Now, on the AI trade, though, I think the market is over-assessing the impact at this point. Even if you look at the guidance that these companies are giving, the guidance is calling for growth. And the guidance that these companies give is, based on near-term visibility, right? Near-term visibility, as in they know that that number is very achievable. They don't want to miss their guidance. So with that, we see the sector large caps growing at roughly 4%, overall sector growth of 5%, 5 to 6%. So we believe that the AI threat is overplayed. The sector is, at least on a multiple basis, fairly valued. We are becoming, we are now picking stocks, for example, some of the large caps we are constructive on. And we believe as time goes on, the AI fears will be proven to be overblown.
So would you use this opportunity to accumulate? You are turning slightly constructive, but what do you tell an investor? Does he be brave?
All right. So let's take some of the large cap stocks. So COVID was a moment when all these stocks became, we believe, overvalued, and that's what we maintained for the last 3-4 years. So pre-COVID, some of these stocks used to bottom out at roughly 13, 14 times forward earnings. They're roughly there, maybe 10%, 5-10% off, which is a point at which you start, picking up some of these guys. So yes, while I cannot talk about specific stocks on a public show, I can tell you a few of the large caps we are becoming constructive on. We're asking people to accumulate in this decline.
But Mukul, hi, this is Ritu. Are there other sectors where you think investors can extend this bravery, where valuations look attractive from here on, where you'd look to accumulate?
Yeah. Tech is certainly a brave trade at this point, looking at how these stocks react on a daily basis. But India, we believe is not. On a fundamental basis. Let's just talk about broad Nifty. Nifty growth for FY27 is 16%. Even with downgrades that will come because of the war, maybe it will settle at 11-12%. If I look at the multiple on a trailing basis, it's important because the moment you talk about forward multiples, people say, what is your visibility on earnings? So on a trailing basis, the multiple is roughly 20 times. Historic sort of last 10-year low, the price band for Nifty multiple has been 20 to 24. The only time these multiples have been lower is during COVID or during demon. So Nifty broadly is, I believe, not a brave trade at all. It is a good time to sort of be constructive. We've been saying this all through March. And we maintain this now. Sentiment on India is negative, which is reflecting on market performance, but we believe in the second half that sentiment will also turn. And there are triggers for that, which we can talk about.
But, Mukul, we've been seeing this spate of downgrades. JP Morgan is the latest one that is cut, to neutral now from overweight. Their bear case is Nifty at 20,500. Little overdone, you think? Of course, the bull case, they say, is 30,000.
Yeah. No. So honestly speaking, I'll tell you where a lot of the FII concern is coming through, which is what is reflecting in some of these downgrades. At no point should you say, these concerns are totally invalid. Of course, there is substance to it, but you have to sort of, unpack them a bit. Yeah. So the first concern is, how is India relating to, let's say South Korea or Taiwan, which are considered to be AI positive trades. Yeah. So that's the first thing that comes out. But if you unpack that, South Korea and Taiwan are a very narrow market. Yeah. So South Korea, 2 stocks comprise more than 50%. Taiwan is just 1 stock, which is TSMC. And these companies are having a massive upcycle. Yeah. But if you sort of look underneath that, SK Hynix next year will be sort of doing a return on capital of roughly 100%, which is if they put up a new capacity, the payback period is 1 year. Yeah. So and these stocks are high fixed cost, low variable cost, or these companies are high fixed cost, low variable cost. So small thing I'm saying is that this kind of profitability will attract new investment, which means profitability will go down there at peak profitability, on which multiples are now getting close to India. Taiwan is actually at the same multiple as India. So I think some of this downgrade is rear view, yeah, because a lot of these markets which were trading at a discount to India have already caught up. I think earnings are probably close to peak. So at peak pessimism of India, I won't be downgrading the country. Yeah.
Mukul, running out of time, but
sure.
Thank you for sparing time and joining us today, and with your views on the markets as well. Take a short break, get you more on the other side. Stay tuned.
Welcome back. Markets still under pressure. 23,926 on the frontline index. Continuing to be in the red. But let's focus on some other earnings that have come in. And, this is a better number than what the street was expecting. Tips Music. The stock is up almost 15% in the last 2 days, up almost 5% today. They've delivered a good quarter. Let's bring in Kumar Taurani, who's the MD of Tips Music, to give us more color on the numbers. Kumar, thanks very much for joining us here. Blockbuster quarter, that you've delivered. Revenue growth of 32%, EBITDA has doubled. But didn't, the 50%, 55% fall in the content cost do most of the heavy lifting on margins? And can you sustain this into FY27 as well, this kind of a performance?
Thank you. Yes, we will sustain this. We given this year's, our projection was to achieve 20% top line, 20% bottom line. Touch wood, we have achieved that. Bottom line, I think we have done 31%. So for next year also, we are now telling 20%, our target is 20% top line and 20% same as bottom line. So we are quite hopeful we will achieve that. As far as content cost is concerned, see, we are very selective when we select our content. We want whatever money we invest, at least that all money should come back to us in next 4 or 5 years. But whenever we see there's no fun in whatever content we are acquiring is not going to return good returns, so we just don't take anything, and we focus more on our repertoire catalog, whatever we have done for so many years. And touch wood, our catalog is doing really well.
Your 90s repertoire catalog, you're saying, is giving a disproportionate share of growth. Good for the nostalgia seekers like some of us. But when does the newer content start pulling its weight?
No, actually, it's a myth. We are only a 90s company. We started in 88. Till 2002, we have a 65 or 70% market share. After that, because of quality was not coming and there was a change in the business from physical to non-physical changes happened. So we have focused on a very selective content, around 30-40 songs every year. And from that also, we have a 90% successful ratio. So we were never out of the business. If you see from 88 till now, we maybe sometime we are taking few songs and sometime we are taking more songs that we follow, but we are there all throughout.
Mr. Taurani, the purpose of asking that question was the fact that the share of the 90s music as part of your growth has been a lot more compared to new content, if we are reading that correctly. But what we intend to ask you is that when does this new slate of content pipeline start to pull its weight and contribute equally, if not more, to what the 90s music is currently doing?
See, please understand, music business is all for catalog, repertoire. Always 85% business comes from, I'm talking about all over, all companies worldwide. 85% money comes from a catalog and balance 15-20% comes from a repertoire. If your new releases are good, if your new releases are not good, then only 5-7% will come from new releases. And 90-95% becomes a catalog. So catalog repertoire is very, very necessary for all the music labels, wherever it is. So let me tell you, this year, actually, last year we had one film of our own company, Hai Jawani To Ishq Hona Hai, that was supposed to release in January, and the film was supposed to release in March, but it got postponed, and now film is releasing in May, and so we have released music in April. So that big money from last quarter, last quarter coming in this quarter. So that's why you are seeing that difference.
Right. So, Mr. Taurani, this time around, there was a significant fall in your content cost, down by more than half, and that contributed to the margin picture as well. How much of that do you attribute it to structural efficiency, and do these costs remain at the current levels, or do you expect a slight bit of mean reversion as well to come in this year?
Actually, I don't think it's become half. I think we have just spent, compared to last year, 10 crores less. And there was a movie which will be costing us 20 crore plus. It was not accounted for. That's why this difference you are seeing. But still, I feel this year we will have a full proper slate content, And this year, our target is to achieve 85 crores to spend on content, around 22-23%. I think this year we'll achieve that.
Mr. Taurani, thank you for sparing time and joining us. Short but effective conversation. Wish you good luck for the rest of the year as well. Just before we take the break, here's also a word from Vodafone Idea CEO Abhijit Kishore on the assessment of the company's AGR dues.
AGR is still, the reassessment is going on. We'll come back, once the reassessment is over, and we'll let you know.
Okay, so that is the Vodafone Idea CEO saying they expect reassessment of AGR dues to be completed very soon. That's the next cue that the street will be awaiting as far as Vodafone Idea is concerned. Let's slip into a short break on that note. Up next, we'll get you more on the markets in just a bit.
Welcome back. There's a sharp knock on SBI Life from the highs of the day. The stock is now down around 2.5% as we speak. And that's because of some lines coming in from the finance minister who was speaking at an event in Pune. And she mentioned the fact that a government-appointed banking committee will look into the open architecture for banks selling insurance products. And this open architecture means that the banks can tie up with more than one company to sell insurance and other products. Because currently, it is SBI Life has an exclusive tie-up with SBI for their insurance products. And this open architecture means that the banks can look at other companies as well. Now, that's the word coming in from the finance minister, that the government-appointed committee will look into this open architecture. And that has resulted in this knock that SBI Life has taken from the highs of the day. 2.5% lower now as we speak. But time for macro signal then. Ritu, what is the macro signal indicating today?
Well, West Bengal, Tamil Nadu, Kerala, before that Assam, Puducherry, the clear trend that we've been seeing across the 2026 state elections, that's what we're talking about, a sharp expansion in cash transfers and subsidy-led welfare schemes. And, it's not really incremental anymore. The scale has moved pretty meaningfully. So unconditional cash transfers for women, for instance, have gone from just 0.01% of the GDP in FY21 to nearly 0.5% in FY26. Look at the state budgets as well. These schemes are taking up a sizable share of spending. Jharkhand, more than 12% of revenue expenditure. Karnataka, about 9%. West Bengal, close to 9%. Tamil Nadu, almost 4%. And at the same time, the committed expenditure is already very high, which means there is limited fiscal flexibility with these states. So in Tamil Nadu and Kerala, 75 to 77% of the revenue receipt is already committed to be spent. West Bengal's Lakshmi Vandar, a loan scheme, it costs about 26,700 crores per annum. So a large part of the state revenues are already pre-committed even before any new schemes are now going to be added. Now, step back and look at the broader composition of the spending. Total state expenditure was pegged at 64 lakh crores for FY26. Now, revenue expenditure dominates at about 14.6% of the GDP. The largest component of that is the social sector spends at 8.2%, which alone makes up for 46% of total state expenditures. Capital outlay in comparison is just 3% of the GDP. So for every 1 rupee that is being spent on asset creation by states, nearly 5 rupees is going into recurring expenditure, which is not asset creating. Now, here is the macro risk. The state's gross fiscal deficit is already pretty high at 3.3% of the GDP. It's back above that 3% level after 3 years of consolidation. The debt stock is rising. That's almost 29% of the GDP. Market borrowings are funding 76% of this consolidated deficit. And that supply pressure is also blunting RBI's own rate cuts. RBI has also flagged this risk very clearly. It said, welfare spending, sure, it may be essential, but it risks crowding out productive investment. So the takeaway is simple. Welfare spending is rising very fast, but the fiscal space is quite limited. And that means any further expansion is going to come at the cost of either higher borrowing, that's not good, or cuts elsewhere. So that trade-off is what the markets are going to be watching very closely in this election cycle.
Indeed, that's the most important thing that the markets will be watching out for. Ritu, thank you for summarizing that for us in our macro signal. But take your leave on this edition of Trading Hour. We leave you with the markets at the lows of the day. Infosys is down 6%, the biggest contributor to the Nifty downside. From Ritu and me, thank you for watching. Halftime report on the other side.
and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a day where we are seeing pressure which continues for the markets at this point in time. So as you can see, we have the Nifty which is down around 1%. We have the mid-cap index which is down around 1.2%. And we have the Bank Nifty, which is seeing aggravated pressure or continued selling from yesterday. So down around 0.5% currently for the Bank Nifty. If you have to talk about how exactly we fared on a week-to-date basis, it is the Nifty and the Sensex which have been under pressure. So the Nifty is lost around 1.8% with the Sensex, which is down over 2% and the mid-cap index, which is down around 1%. In terms of sectors, what does stand out is the Nifty IT space, which is seeing relentless selling in today's trading session as well, courtesy the disappointment that Infosys has reported. So the Nifty IT index is down around 4.7%, and on a year-to-date basis, it's now showing a cut of over 20-odd%. So back to that underperformance after that brief outperformance that we had seen for the IT index. But nonetheless, this is what's taking place in the markets right now. Advanced decline ratio, nothing to write home about.
Absolutely nothing to write home about, Ekta. Good afternoon to you as well. But obviously all the sectors continue to trade in the red today. Look at that advanced decline line, right? The gap is just increasing through the day. It's a very wide gap now, just 500 stocks almost on the advanced side. So yes, nothing exciting that's happening in the market. What we're seeing is few individual names that are buzzing around from the broader end of the market or managing to hold on to gains either on numbers, some news flow that's coming. But apart from that today, everything continues to trade in the red. 52-week high, we have Himadri Specialty Chemicals that's holding on to good gains. We have Aditya Birla Sunlife AMC that's also holding on to a 52-week high as of now, holding on to gains of more than 1% as well. While obviously IT continues to be under pressure, pharma continues to be under pressure, and for the week also IT is the top sectoral loser. FMCG is something that manages to hold on to gains. But let's move on and talk about those individual stock names, right, which are moving around in the trading session. And for that, we have Vivek joining us to take us through all of that. Good afternoon, Vivek.
Good afternoon. What a session. Very sharp fall that we're seeing. A broader end of the market seeing significant advance decline pressure and declines far outpacing the advances, especially at the current hour. In terms of individual names, a couple of names that are hitting the green or seeing a little bit of buying. Policy Bazaar cooled off a little bit, but this particular stock has been an outperformer, post the very sharp sell-off that it saw from recent peaks. PNB Housing amongst the top F&O gainers. Stock continues to see upgrades after a very strong Q4. The other stock, of course, Himadri Specialty, like I said, a fresh 52-week high today, steady Q4, and on the back of that, a strong guidance too, that the management has given 6.5% higher. Hoodco, this particular stock in the broader end of the market's up on very strong volumes today, and JSW Infra, the top mid-cap gainer in the session today. On the other hand, can't look beyond the IT pack for the kind of weakness that we've seen, especially for 3 to 4 continuous trading sessions. Infosys, very weak guidance for FY27, stock down 6%, Coforge, LTM, Infosys, all of the stocks down anywhere between 5 to 7%. Cipla is the other stock that stands out in terms of weakness today. The company's key manufacturing partner has received an import alert. On the back of that, analysts are expecting a significant delay as far as relaunch of Lanreotide is concerned. And along with that, the other pharma names too under significant pressure. Sun Pharma down almost 3.5%. News flow surrounding the Organon acquisition is something that's keeping this particular stock under quite a bit of selling pressure. Lupin competition coming in for a key drug. Dr. Reddy's and Laurus Labs too under a bit of pressure. Union Bank, this particular stock, remember yesterday fell almost 7%. Today follow-on selling scene, muted Q4. Wari Energies, important news flow coming in. There has been an ADD, an anti-dumping duty that has been initiated by the US market. This is over and above the CVD, the countervailing duty that was earlier imposed. So Wari Energy almost 3.5% lower. And overall, when you look at even names like names from the insurance pack, a lot of selling pressure across the market today.
Okay, all right, Vivek. Thanks very much for that. So that's the news coming in on buzzing stocks. And as you can see, SBI Life is under pressure as well. So just watch out for that particular counter. We'll try and get you more perspective on that. But the big boy Reliance is due to report a steady set of Q4 numbers today. Later today, Sonal Bhutra joins in with the key expectations. Sonal, over to you.
Well, despite the West Asia crisis and disruption in global energy markets, it is expected to be a steady quarter for Reliance Industries. The stock, which is down 14% in last 1 year, in line with the market disruption that we have seen. Overall, on a quarter-on-quarter basis, we are expecting the revenue to increase by 3%, but there will be an EBITDA fall to the tune of 3%, leading to a margin compression, which is expected to come in at around 16.3%. Profits, accordingly, will also see a decline on a quarter-on-quarter basis by 5%. We've been speaking about global energy disruption, and that is something which will impact two segments: oil to chemical segment, which is the biggest one, and oil and gas, which will see some disruption this time around. However, telecom and retail will continue to see strong YOY growth. So let's talk about those expectations. For Jio, it is expected to see a growth in EBITDA to the tune of 15%, led by 5% ARPU growth, according to an estimate by Nomura. And if we talk about the retail business, that is expected to see an increase in EBITDA by 6%. The oil and gas business will continue to see a decline. That is because of lower KG-D6 volumes. There has been an interesting note from JP Morgan. They talk about how stock has given up recent outperformance on uncertainty related to near-term O2C margins because of disruption that we are seeing. However, they also add both refining and petchem margins should turn out higher than what the assumption is currently. Higher crude and a weaker rupee should drive higher EBITDA for the oil to chemicals business in FY27. This is the trend in terms of EBITDA for the consolidated business. It has been increasing, but this time a quarter-on-quarter decline because of global disruption is expected. But overall, a steady quarter for Reliance Industries, and important to watch out for management commentary as well.
Okay, thank you so much for that, Sonal. But now Rima is joining us with a comprehensive breakdown on what to expect from Reliance Jio in Q4 FY26. Rima, over to you.
Expect a steady quarter from Reliance Jio in Q4 FY26 with a revenue growth of about 3%, with the top line, according to Nomura estimates, coming in at 33,660. Margins likely to remain flat at 54%. Honestly, it was quite an uneventful quarter. There were no tariff hikes. In fact, this quarter compared to the prior quarter, we had too few working days, and therefore the growth is going to be on the slower side, not just for Jio, but for the entire industry. So Nomura estimates the EBITDA growth for Reliance Jio coming through at 3% on a quarter-on-quarter basis and 15% on a year-on-year basis. The other two metrics that we track, average revenue per user and subscriber, will modestly inch up. ARPU is moving up to 216, a 1% quarter-on-quarter increase. Subscriber growth at about 2%. Jio Air Fiber, which is basically Wi-Fi, that's doing pretty well for the company. It continues to see very strong traction, and even the home subscriber base is likely to cross 25 million. But all attention is honestly on Reliance Jio IPO. There are reports which suggest that the IPO size could be as large as 50,000 crore rupees, and it's imminent anytime soon in terms of a DRHP filing. If you go back in time, Mukesh Ambani in the 2019 AGM had first spoken about a Jio IPO with a 5-year timeline, and then he reiterated in the last AGM, and he said it should happen in the first half of this year. So all attention is going to be on the Jio IPO, and secondly on tariff increases, because a tariff increase directly flows through to the bottom line of telecom companies, and it just increases the value proposition, especially ahead of an IPO.
Okay, all right. Rima, thanks very much for that. We need to take a short break now, but Ashish Kyal of Wave Strategy will be joining in with some calls. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. 23,900, just around that mark is what the Nifty is trading at, right? And today seems like we were expecting to start on the positive note. Nifty indicated a positive start, but then we just seen a decline, right? Almost near the day's lowest point is what the Nifty trades at, 240 points down approximately for the Nifty 50. Broader end of the market also seeing a bit of a pressure coming in. So yes, today seems like a day of red on the screens for the markets. In the last 15 odd minutes that we've seen in terms of the fall that has come in, IDBI Bank, that's seen a downtick as well in the last 15 odd minutes. Apart from that, we have Indegene, that's also seen a fall coming in, so watch out for those as well. Vivek had also mentioned we have Vari Energies that is also in focus today because of the anti-dumping duty that has come in as well, and that's a stock that's under pressure. They have significant exposure versus other solar companies and solar module cell manufacturers in India. So that will have more pressure on this one. Premier Energies is not seeing a downtick today because they have zero exports. So that's the one that we should keep an eye out on as well.
Okay, all right. So that's Vari Energies down around over 3% But shifting focus, our colleague Ashmit spoke to Vodafone Idea CEO Abhijit Kishore on AGR reassessment and tariff hikes. Listen in.
No, I think first of all, I think we are very thankful to the Honorable Supreme Court and the Government of India for taking the holistic view about and a conclusive long-term view about the AGR reassessment. As we speak, the AGR reassessment is on, and I think once that is concluded, then we'll come back to you. The work is in full swing. We can't really comment anything beyond that as we speak.
Any indication from the government as to how long the process will take, how much longer?
Work is on. I think it's on a very fast pace. Let's wait and see when the results come out.
Some of the latest TRAI numbers have shown a bit of a turnaround in terms of subscriber addition. Just a word on that in terms of seeing subscribers trust the Vodafone network once again.
You know, we have always said that, look at us on 6 to 7 parameters, which are the right business parameters to see. One of the parameters was the subscriber addition, which for the longest period of time we were in the negative area. Very, very heartening to see. And we always believed that, we have all the right ingredients. In Feb and March that you see, which is a reported number, gives us a lot of confidence on the investments that we have been making over the last few quarters. Since we are in the silent period, really can't comment anything beyond that, but a couple of weeks and once the results are out, then, definitely we'll kind of come back to you and share a little more detail.
More recently, we've seen some tariff hikes. Is that something that we're beginning to see broadly as a trend? More consolidation in terms of an upward trajectory?
I'd say that, we keep doing a little bit of a correction here and there. These are not really the structural tariff hikes that you see. And that's where it is right now.
That's about Vodafone Idea, but let's move on and also bring on board Ashish Gyal of Wave Strategy Advisors, joining us right now to take us through the trading strategies as well as in terms of market levels. Ashish, today we're below the 24,000 mark again, right? And there is no such support, I feel, that is coming in, at least on the geopolitical news. Uncertainty still continues, but technically levels that you are keeping an eye out on for the Nifty as well as the Bank Nifty now.
Hi, Vinny. Afternoon to you and all the viewers. See, if you look at the overall undertone, we have seen a very sharp move already from the lows on Nifty when it was formed at around 22,000 level. And from there, Nifty has shown the rise of nearly to 2,400 points, which was 10%. And this kind of correction is actually healthy, I would say, because after such a sharp rise, we are bound to see some kind of profit booking from the higher levels. And at the same time, we are seeing that there is no such positive outlook that is coming in with rupee depreciating again, crude going above $100 again. So there is some kind of a pressure. But I think that's going to be temporary. The levels that I'm looking at on Nifty, on the downside, there is a very important support which comes to around 23,680, 23,690 levels, which is also 38.2% retracement of the rise. And on Bank Nifty, the support is around 55,000. So I think there can be some consolidation after a sharp rise. We are seeing some correction and that will result into consolidation or base formation before we start moving higher again. So having said that, on the downside, if you get any kind of dip on Nifty towards 23,800, use that as opportunity to buy, and then we can expect it to again move towards 24,200, 24,300 levels.
Okay, all right. Ashish, what are the stocks that you would be recommending? And if we could just add in how you would be approaching a couple of these IT names today as well?
See, if you look at the stocks that I'm looking for from buying perspective is something like a Cochin Shipyard, which is showing a good, strong momentum on the upside. Managed to break above its prior swing high also. So we can expect it to move towards the level of around 1800 on the upside. And downsides, the support or stop loss can be placed at 1620 levels. And the next stock on the buy side, we can clearly look at Oil India giving a very strong breakout after a lot of consolidation, and we can expect a target of around 506 in Oil India, and one can maintain a stop loss of around 468 levels here. So Oil India looks to be positive, some profit booking from higher levels, but eventually the stock should move higher. And with respect to the IT names, I would suggest that it's best to avoid, because what is happening, whether you look at TCS, Infosys, Wipro, or HCLTech for that matter, which was down by 10% just a few days back, the pressure is across the IT. And one bad result from one of the IT major comes and all the stock participates on the downside. Like Infosys is down by more than 5.5%, broken below its prior swing low, which was at 1214 levels. And there is no clear sign of reversal. So suggestion would be to avoid IT names now. Even TCS has broken below the swing low of 2468, trading bearish. We can expect it to also move lower towards 2350 levels. There is no sign of positive reversal. Anyone who is stuck in IT over the past many months are still stuck in IT. They are not able to get out because the stock has across the board has been falling down.
Absolutely, across the board that's been falling down. Ashish, thank you so much for joining us on the show, taking us through the levels for the markets, individual stock names as well. And talking about IT, I was just looking at Oracle Financial Services. That's the only one, whether you look at it today, mild gain, week to date, month to date, as well as YTD. That's the one that's done well or performing better than other IT companies. So that's interesting to watch out for. But on that note, we're going to slip into a very short break. And after the break, we'll come back with more stock-specific action. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back on Crypto Corner. Today we are joined by Catherine Gu. She's Head of Product Digital Assets at Solana Foundation. Catherine, hi, thank you so much for joining in. And I want to start talking about stable coins first of all, because that has continued to see higher growth and volumes in 2026 as well. What is the kind of number, portfolios, volumes and participation that you are anticipating in stable coins in this year?
Absolutely. I think the stablecoin trend, as you know, has really started since 2025, but it's going to take a while for the actual growth to take place, because I think around right now it's around $300 billion of market cap, but I do fully think that this market is really growing to the $1 trillion. So I think in the next few years, fully expect that the entire market capitalization around stablecoins is going to continue to grow. And the real good news is that, the usage of stablecoins is no longer just in sort of crypto trading in itself, but it's really spilling over into a lot of the real world economic use cases, whether that's in payments, whether that's in sort of investment type of things, which is why you're seeing that there's a lot more sort of flavors of stablecoin as well, if you will, because if I were to categorize the very beginning of stablecoins as more like a vanilla version, which is $1 backed, you're probably going to see stablecoins that's backed by other currencies, just like we expect G7, G20 different currencies that's being traded in the FX market. I fully expect in the future there's going to be more flavors of stablecoin, and it's going to be stablecoins that's pegged to other type of assets other than just fiat currencies. It could be commodities, it could be money market funds, it could be credit structure. So I think it's going to be really interesting going forward as we see the entire space of stablecoin.
The other thing, Catherine, is that the Solana Foundation has recently secured MasterCard, Western Union, WorldPay on developer platform. How are you looking at this one, and what more brands can we look at on the platform itself?
Yeah, that's a great question, because I think we are very invested in growing the entire Solana ecosystem. And the bottom line is we really think about Solana as the underlying financial market infrastructure. That was how Solana was designed from day one. So our goal is to really have all the institutional growth and adoption to be happening directly on chain. And toolings that we have built, such as Solana Developer Platform, is aimed to attract financial institutions to let them start building things directly on chain as easy as possible. Because part of the value proposition, if you will, within, say, the Solana Developer Platform is that everything is going to be entirely API based. So as a Web2 company coming onto chain to build, you don't actually need to acquire any new knowledge or skill set. In fact, you can just use APIs as you do today to start building things, whether that's, say, let me create a tokenization engine to say issue a stablecoin, to issue a tokenized deposit, or to issue, say, a tokenized commodities. And once I issue something, let me figure out how do I do the on-ramping and off-ramping in relation to the payments. All of the underlying, I would say, building blocks that is in the form of APIs are all provisioned to these customers through the Solana Developer Platform. So our goal is, as I said, to become the underlying financial market infrastructure that powers the future of finance, the future of capital markets down the road. And through toolings like SDP, we can really help to make that entire journey as smooth and as quickly as possible.
You talked about the cross-border payments here, Catherine. How are you looking at the growth of that? And would you say that clearly is going to be about the future of money, which is more cost-efficient and without a time lag?
Yeah, I think Solana is already handling a ton of traffic when it comes to stablecoin payments, and cross-border is one of the big use cases. I think as we're looking at cross-border payments right now, there's still a lot of friction points, right? Especially if you're looking at the larger B2B type of payments. There's a lots of inefficiencies in terms of the leverage of the money itself. And what I mean by that is, money might be parked or pre-funded for a few days before they even get used. And if you look at things like account receivables or account payables, we're looking at 30 days, 40 days lag time for which money actually get paid. So none of those things should actually be true down the road. And this is where blockchain really comes in to power that new kind of financial rail, new payment rail as you're building cross-border payments, and stablecoin is that instrument essentially to be conducted on that. So I would fully expect that there's going to be a lot more traffic in terms of stablecoin usage for cross-border payments, and Solana being cheap, fast, and very resilient is a perfect rail to facilitate a lot of these use cases. It's also borderless, right? In the sense that money can travel anywhere as you want, and blockchain powers that capability. So, one of the early use cases, as we're seeing the usage of stablecoins, is actually the usage outside of the United States. Why? Because there's a lot of demand for stablecoins, and the friction points in cross-border payments is in the rest of the world. So as we see the growth of blockchain, growth of stablecoin together to grow, continue down the road, I would very much think that we're going to see a lot of growth, especially in around emerging economies, as we're looking at the usage of stablecoin for cross-border payments.
That point is well taken, Catherine. Thank you so much for joining in. So absolutely, emerging economies quietly in the core there when it comes to cross-border payments, especially via stable coins on the blockchain. Is this something that continues to grow therein? But with that, we'll go for a short break, come back with more market specifics and stocks after this break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back to Halftime Report on CNBC TV 18. Like you see, the Nifty is now below 23,900. 23,880 is what the Nifty is trading at. Day's lowest point for the Nifty 50. We've seen a bit more of a slide in the last 15-20 odd minutes as well. So let's watch out for that. You know, obviously IT continues to be under pressure, and today in the top drags also coming in. We have Sun Pharma also that's making the list. But a lot of news flow that's coming on the pharma pack as well, Ekta, right? So what the update there? What's happening to which company now?
Well, yes, you know, I'll start with Dr. Reddy's, which was in focus in yesterday's trading session. Remember that 10% move that we saw on Dr. Reddy's. Now, they did come out with a clarification where they said that they have not yet received approval for semaglutide injection from Health Canada. This is something that we had reported yesterday. However, the company has received a drug identification number from Health Canada. DIN is a part of the regulatory process. It was approved or received on the 22nd of April by the company. And analysts say that a DIN number being received means approval likely to be within the timeline that Dr. Reddy's has said, which is by the end of May. Remember that a DIN basically means that it is one step closer to the final approval. So now what they would be waiting for is the NOC, the No Objection Certificate from Health Canada. That's when the DIN will get activated, start being reflected on the website, and that's when basically they will also get that final approval. Now, that's the reason why Dr. Reddy's is in focus. As you can see, the stock is recovered from the day's low. Cipla, US FDA has issued an import alert for Pharmathen's Rhodope unit in Greece. Remember that they are the manufacturing supply partner for lanreotide to Cipla, which is basically a tumor drug. Lanreotide is actually one of Cipla's top 3 US products. They have 22% market share. They've made $90 million at peak, and it was estimated that they would make around $70 million this year, which is now at risk. Cipla, remember, had indicated they could expect supply disruptions to continue into the first half of FY27. So all of that now becomes a risk factor, considering that they do have an import alert on that particular facility. The management had also cut their guidance on margins, and this was one of the factors. Sun Pharma, ET report, company looks to outbid the rival bids with around a $13 billion offer for Organon. The likes of EQT, a German drug maker, all of them are in the fray for it. Sun's final cash offer is being financed by 3 global banks at this point in time. If in case this goes through, it will possibly look to merge the NYSE-listed Organon with Sun Pharma. So as you can see, all of these stocks are in focus. Vishal Manchanda joins in to discuss this quickly with us, Systematics Group, from Systematics Group. Vishal, thanks very much for taking the time out. Well, you tell us which stock do you want to start with, Cipla, Dr. Reddy's or Sun Pharma? Which one do you think is possibly, the one where clients are probably asking the most questions at this point?
I think Dr. Reddy's is what's most being talked about. If I look at what's kind of buzzing on the street, while Sun on the news on the Sun has been there for quite a while, and there's a lot of discussion that has happened there. But on Dr. Reddy's, this announcement around the drug identification number seems positive, and I think an approval should be there sometime next month, probably. But I think what's important here is we need to understand how many other players also get into the market at the same time. Maybe not the first month, but maybe in the next 6 months, we'll have other players also launching the drug. While it can be initially exciting and create a strong earnings momentum for Dr. Reddy's after Revlimid loss, but then it's going to be probably short-lived because we have 7 filers in the fray, and even the others would also slowly come into the market.
Vishal, so, obviously others would slowly come, but once this DIN comes, it means that they will get it, right? It's in the right path, they're moving in the right direction, right? Or are there any concerns that could come in and they may not get it also?
Yeah, I think that's how you can look at it. They are on the right track, and probably there are a few steps still there for getting a notice of compliance on the drug, means a formal approval on the drug.
But is there anything that could go wrong, is what I could say? That maybe, is there a possibility that they do not get an NOC also?
Can't really say that because we haven't seen such instances in the past on Canada. So in the sense, we really don't understand this process very well in terms of what it takes to kind of go from a DIN number to a final approval. But the guidance document says if you have a DIN number, all the regulatory scrutiny is done. All what needs to be scrutinized is done, and the DIN number is granted post that.
Okay. All right. Vishal, just tell us about Cipla, because now Lanreotide, people were estimating that, the disruptions would last only in the first half of FY27. But now it seems as though it's possibly going to continue with this import alert.
Yes, I think typically an import alert takes quite long to be resolved, and probably we'll see a permanent loss, or maybe Cipla can do a site transfer for this drug to some other facility. But even site transfers can take quite long, and it's a complex drug. So I would kind of knock this off from my numbers for now. But since the Cipla stock has not corrected because it's one stock that has not done well this year, it's probably an underperformer. I don't think there is further scope for correction here. And we also had a good news yesterday on a new approval, Ventolin. So I think probably Ventolin was not in Street's forecast, and if that should replace whatever Cipla would lose from Lanreotide. So I think numbers may not change for FY27. The Street numbers may remain the same.
Okay, got it. The other, stock in focus has obviously been Sun Pharma, and there's a possibility that they're going very aggressive on the Organon bet. What is your sense in terms of if in case that does come through, do you think that the stock would possibly underperform because of the debt and integration issues?
Yeah, I think it's a very large deal, and probably integration could be a challenge here. I think what people would actually, I would say that this would be an overhang on the stock until people see some synergies or positive momentum happening out of the deal in terms of the growth prospects getting stronger over time through either company delivering synergies, which or possibly surprise in terms of the cost synergies that they can deliver from the transaction, or probably they can do some licensing transactions because of a stronger platform that they would emerge with post transaction. But until we see guidance on synergies and or maybe positive news flow happening on transaction front post deal in terms of licensing opportunities that they can strike, I'll probably see the stock being kind of stuck in a range.
Okay, Vishal, thank you so much for joining us this afternoon on the show, speaking to us about the pharma companies. Different news flows coming in there today as well. Thanks so much for joining in. But on that note, we're going to slip into a very short break. We'll come back and we'll connect with the management of LTM to decode their Q4 numbers. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty 23,900 around that mark again is what it's trading at. IT continues to be under pressure. Obviously, top tracks coming in from these big IT names as well. And that is what we'll be putting the spotlight on now as well. LTM. That delivered a steady quarter in Q4 FY26. Constant currency revenue growth came in at 1.2%, opposed to what we were expecting was 1.4%. Margins, however, remained under pressure, 100 basis point sequential fall on the back of the wage hikes and productivity. My colleague Rima actually caught up with the managing director and CEO of the company, Venu Lambu, who discussed quarter gone by and the road ahead as well. Listen in.
We had about 6% on the reported currency and 5.3% on the constant currency. And, the Lakshya, 31 is not just about the revenue dimension. It's about how do we pivot ourselves into an AI-centric organization. Our industry and tech industry as a whole is going through, one of the generational shift in terms of the business model and the innovation cycles. So, it's a very comprehensive strategy in terms of how do we pivot our talent base, how do we engage with our clients where we have a deeper relationship, how do we build contextual domain capabilities, how do we reposition ourselves in the marketplace with the tech domain convergence, and most importantly, how do we stay ahead of the curve in terms of the skill set access that our workforce globally can have. So it's a very comprehensive strategy and how this gets played out over the next 5 years. And all this will lead to opportunities that we can go after it, and those opportunities we need to look at it through the new lens. If I look at through the traditional lens, absolutely, we are talking about looking at the core services where probably the volume might increase, but the unit price will anyway get shrinked as we go along. So if I look at that lens, then you have a different view on how the revenue might look like 5 years. But if you look at through a new lens in terms of the opportunity that exists, especially in reimagining the business process in the agentic enterprise era, that's the aspirational goal that we have set ourselves, as a team. And we have taken an extended challenge, to exit at the end of 5 years to double the revenue. Of course, it has an inorganic component built into it. And, we will go through that journey. So that's how we have sort of planned it. If you don't have an audacious goal, especially during this, times where there is a once in a lifetime shift happening, I think we'll be sort of looking at it in a very myopic way, right? So for me, the intent of having a mindset change to look at accelerated growth and still navigating the short-term headwinds is fundamental to the culture of the organization and the determination of making that shift happen in this journey. So that's how I put it, Rima. It's less about maths. It's about having an aspiration and going after towards that.
But Venu, you called it an extended challenge, audacious goal. So just some idea on how you're going to get to this endpoint. And also, as I said, right, if you are growing at 5.5%, you're asking for 15%, there is a good gap of 1,000 basis points, 10 percentage point. Yeah. Where is that acceleration going to come from? And again, to get back to that point about the inorganic component, how large will the inorganic component be as a part of this goal?
Look, inorganic component has been, modeled into a certain degree, maybe, it depends on the kind of opportunity that comes our way, right? I mean, I can, assume 15 or 20% of that revenue coming from inorganic, but, it's not about having a wishful thinking. It's about finding the right fitment, right portfolio that fits into that. As I said, when we looked at how we delivered in FY26, 4 out of 5 verticals in Q4 for the corresponding time period from year to year basis, we delivered double-digit growth. 3 out of 5 businesses for the entire full year of FY26, delivered double-digit growth, right? And while we have navigated, whether it's a macroeconomic headwinds or we navigated the productivity headwinds that we engage with our customers, in most of the cases, it was a proactive headwind. So, I do believe that we are on the right track to continue the momentum. And as the AI adoption increases, I mean, you should look at the big bets that's happening in the AI space, right? Whether it's about reimagining the business process, the agentic investment, the AI infrastructure investment that's happening over there. The addressable market we're talking about is not the generic IT services addressable market that we had looked at in a traditional lens. There is a bigger addressable market that's out there. So if I look at it in the new lens of a extended addressable market, then there is a potential how we grow. But it all depends on how strongly we execute the pivot. In my view, that's what is going to differentiate, from winners and those who also ran the process of shift. So that's how we are looking at it. So if we don't look at that in a new addressable market spend, which runs into multi-trillion dollars, then we are sort of getting struck in the old, way of looking at what's the addressable market. So the whole aspect of having an aspiration to double our revenue as part of the Lakshya 31 plan is to look at the new addressable market and start building the capabilities, reimagining our existing core services, and start making that shift over the next few years.
But why did you then modify your commentary? When we last spoke 3 months back, you were talking about near double-digit or double-digit growth as you exited Q4 and even for FY27. Now you're talking about industry-leading growth. Have you effectively lowered the bar?
Okay, firstly, let me clarify. When we said the near double-digit growth, and if you look at our performance in Q4, we spoke about exiting at near double-digit growth for the run rate for Q4, and we landed at 8.1%. Yes, 9% was more nearer to the double-digit, but we landed at 8.1%, right? If it was not for the decision of taking more productivity gains that we passed on to the customer in Q4, especially in the BFS space, probably we would have been 1% higher than what we were. But look, 8.1% in my view is still a great performance amidst some of the challenges that we had in the BFS sector, especially the one client. So my comment was more on saying that, look, are we exiting at the near double digit? Yes, we are exiting at 8.1%. And moving on to the FY27, it is more about the traditional practice where we haven't given the guidance in a specific number. So that's what I said. We'll be confident of continuing the momentum. If, the growth momentum that we have, which is 6% on reported currency for the full year, 8.1%, year on year for Q4, these are the two parameters that we have, which we can take into FY27.
Okay, so that is the management of LTM. That stock is down around 5.7%. But surprise, surprise, Dr. Reddy's has now moved into the green. So it's a complete U-turn in terms of sentiment which has taken place. That is because there is more clarity that the DIN or the drug identification number means that it is one step or almost very close to getting that approval in Canada for semaglutide injection. We need to take a short break. More on the markets once we're back. Stay tuned. Welcome back. Well, for the markets, it's under pressure. Just want to reiterate that there have been a couple of downgrades which have come through for India. So JPM, remember, has downgraded India to neutral from overweight. HSBC just yesterday downgraded India to underweight from neutral. Remember that they cut their neutral stance from overweight in March. So that means that this is the second downgrade by HSBC just in the past 2 months. Goldman has also, remember, just about a month back, downgraded India to market weight from overweight in March. They cut the Nifty target to 25,900 from 29,300. And UBS too has downgraded India to neutral from attractive in March. So there's been a slew of downgrades which have taken place for the Indian equities. Remember that a couple of reasons include that JPM said Korea, Brazil, China offer cheaper entry points. HSBC says inflationary pressures are have led by crude going to weigh on earnings going forward. So these are a couple of reasons why you're seeing these kind of downgrades come through. But on that note, we need to wrap up on the show. Halftime report is closing up, but Business Lunch will take all of the action forward.
Stocks slip to the lows of the day. Nifty gives up 24,900 after Donald Trump says he's in no rush to end the conflict with Iran and aims to keep the Hormuz Strait blocked. IT, industrials and utilities are the big drags.
Infosys posts a sharper than estimated drop in constant currency revenue and sees lower growth in FY27. LTM2 fails to grow at the expected pace, even as IT charts an ambitious target to double revenues in 5 years.
Even as reports suggest Sun Pharma is in the fray for a $13 billion acquisition, Inventors Knowledge Solutions is buying rural health tech TrueBridge for $427 million, and small cap Gujarat Themis will be paying 158 million euros for 13 drugs to Sanofi.
Reliance Industries is expected to post a steady quarter, with Jio and Retail expected to show good growth, even as O2C and oil and gas are likely to see some impact of the US-Iran war. Any update on Jio IPO is keenly awaited.
Good afternoon, you're with us here on Business Lunch on what is the final trading day of the week. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormaz Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi, good afternoon, Hormaz. I mean, it's red on the screen again, right? The broad Sensex and Nifty falling a lot more. Nifty Bank providing some respite there, falling less than the blue chips, right? But nothing working in favor of the markets right now.
Absolutely not. And once the banks threw in the towel, there was no way that there was any recovery, especially considering the fact that the IT index has been on a bit of a selling spree over the last 3 trading sessions after one poor result after another, first by HCLTech, then by Infosys. And for those who were of the belief that the weakness in Infosys was priced in, well, that's not the case. HCLTech is now down 6%, and as the lows of the day, it's down almost 15% now for the week. Infosys is down another 6% as well. So it is IT that is leading the sell-off on this 300-point cut that you're seeing on the Nifty. 23,900 is the level that the bulls are now trying to defend, because 24,000 has now been taken out very convincingly. And for the week, well, we are ending the week lower for sure. And of course, the other earnings reactions that have taken place mostly on the negative side, and those have been on the extreme as well.
Absolutely. And, you know, even if you look at the sectors, right? Take a look at the top 4 Nifty losers. It's Infosys, HCLTech, TCS, Tech Mahindra. So no respite there. All of these IT names getting battered in trade, all of them down between 5 and 6%. So that's how it's looking for these IT names. But defense names also down in trade. We've got BEL, HAL down over 2%. But it is worth mentioning that Cochin Shipyard is one of those few stocks doing well in this market. It's up nearly 6% on that big Indian Navy order. We've got realty names also back in the red. Prestige, Lodha, Phoenix Mills, all of them down nearly 2% in trade. Almost all of the indices are in the red, Hormaz.
Indeed, and IT, of course, continues to be on top of mind. It has been a disappointing quarter for all of these large cap companies that have reported results, and all of them have taken a beating as a result as well. Now, Rima is here with a detailed roundup of all the IT names.
Well, it's been a disappointing quarter for Indian IT companies. Now that we look back, all 4 IT companies, majors, have disappointed this quarter. In the case of TCS, revenues were fine, but margins street questioned that you had 110 basis points benefit because of the currency, but only 10 basis points margin improvement was reflected. In the case of Wipro, despite the benefit coming in from the Harman DTS acquisition, your revenues continue to struggle. HCLTech had flagged off discretionary spending cuts at US telcos, 2 SAP projects getting cancelled, and Infosys, as we know, was a miss on revenues and margins. Now for FY26, it's been another tough year. For Infosys, it was a revenue degrowth of 2.4%, the first annual revenue decline for the company since inception. For Wipro, this is the 3rd consecutive year of a revenue drop. In the year gone by, despite the acquisitions, revenues were down 1.6%. HCLTech at 3.9% missed its own guidance of 4.5% that they had given in January, and Infosys at 3.1% was at the lower end of their own guidance. Also, look at the employee change in FY26. TCS went through the restructuring, as a result of which the employee headcount went down by 23,000. But for the others, you know, these were companies which used to hire in large numbers. And now in FY26, the addition has been, 3,000, 5,000, 8,000. The FY27 guidance basically is implying that there is no incremental, the growth is not accelerating. Growth will be what it was in FY26 as things stand today. HCLTech is at 1 to 4% growth, Infosys at 1.5 to 3.5%. And just one final word, I was listening to the Infosys conference call, and there were 2 key things that stood out for me. One, Salil Parekh talking about, every now and then he sees competitors, where they're quoting unusual pricing. The word was unusual. He's saying it's happened in the past as well. This time it seems to be linked to AI. So the question is that at, are some competitors promising more on AI more than they can deliver? Somehow the math of the deal doesn't seem to add up. And on AI pricing, the CFO said that AI projects come at better pricing, therefore better margins, but it also has a higher cost compared to the regular project because premium talent is being assigned to it. So the question is, what is the net revenue margin benefit for IT companies? And HCLTech, particularly because, it was a very disappointing quarter. There were many company-specific issues, as I said, discretionary spends at telcos, SAP project cancellation, a revenue AI deflation of 2 to 3%. So I think that sort of spooked the straight, and HCLTech was a rank underperformer for this quarter.
All right, Rima, many thanks for taking us through those details. Now, big boy Reliance is due to report a steady set of Q4 numbers later today. Sonal Bhutra joins us now with all of the key expectations. Sonal?
Well, despite the West Asia crisis and disruption in global energy markets, it is expected to be a steady quarter for Reliance Industries. The stock, which is down 14% in last 1 year, in line with the market disruption that we have seen. Overall, on a quarter-on-quarter basis, we are expecting the revenue to increase by 3%, but there will be an EBITDA fall to the tune of 3%, leading to a margin compression, which is expected to come in at around 16.3%. Profits, accordingly, will also see a decline on a quarter-on-quarter basis by 5%. We've been speaking about global energy disruption, and that is something which will impact two segments: oil to chemical segment, which is the biggest one, and oil and gas, which will see some disruption this time around. However, telecom and retail will continue to see strong YOY growth. So let's talk about those expectations. For Jio, it is expected to see a growth in EBITDA to the tune of 15%, led by 5% ARPU growth, according to an estimate by Nomura. And if we talk about the retail business, that is expected to see an increase in EBITDA by 6%. The oil and gas business will continue to see a decline. That is because of lower KG-D6 volumes. There has been an interesting note from JP Morgan. They talk about how stock has given up recent outperformance on uncertainty related to near-term O2C margins because of disruption that we are seeing. However, they also add both refining and petchem margins should turn out higher than what the assumption is currently. Higher crude and a weaker rupee should drive higher EBITDA for the oil to chemicals business in FY27. This is the trend in terms of EBITDA for the consolidated business. It has been increasing, but this time a quarter-on-quarter decline because of global disruption is expected. But overall, a steady quarter for Reliance Industries, and important to watch out for management commentary as well.
Sonal, thank you for that update there. Nearing the lows of the day is Reliance ahead of its numbers, a percent lower as we speak. The other stock that had taken a big knock just a few minutes ago from the highs of the day was SBI Life, and this is after Finance Minister Nirmala Sitharaman said that a panel may consider open architecture for insurance distribution, raising competition concerns. Let's go across to Yash to understand what the Finance Minister said and the implications of the same.
Today, the Finance Minister, who attended State Bank of India's branch inauguration program here in Pune, said that a government-appointed committee is looking into the proposal of open architecture for distribution of insurance products and other financial products. Finance Minister also spoke about how that government-appointed committee will look at advantages and disadvantages of this open architecture mechanism for distribution of insurance and other financial products before making any final regulation. Simply put, what is an open architecture? It's a mechanism under which banks have to tie up with more than just one insurance company or more than just one financial services company to distribute their insurance products or any other financial services products. This is particularly negative for SBI Life Insurance. That's because out of the large banks, State Bank of India is the only bank which has an exclusive tie-up for distribution of insurance products on the life side with SBI Life and on the general insurance side with SBI General. The numbers are large. For SBI Life, it receives 50% of its new business premium, 56% of its individual new business premium, 60% of its annualized premium equivalent, and 56% of its new policy issuance from State Bank of India. And if at all, this consideration of proposal by the government-appointed banking committee leads to a situation where open architecture is permitted and made mandatory, then that counter share between SBI Life and State Bank of India could get negatively impacted.
Right, Yash. Many thanks for those details. Let's also hear out what the Finance Minister had to say on the issue of open architecture for the distribution of financial products.
These are things which the committee will be sitting and working under the IBA chairman, which is being
formed, which is part of IBA, that there's no new committee. Don't ask me, oh, what's happened to that committee? There's no new committee. The IBA chairman with the IBA will be talking to banks to understand how best to go about it. What are the vulnerabilities? By keeping one, by keeping several, by having different vendors but not having some. So all these are going to be worked out.
Now, India's top public sector bankers met Finance Minister Nirmala Sitharaman yesterday to discuss cybersecurity in the light of new threats posed by artificial intelligence products like Mythos. Now, the minister also briefed the press on the developments in yesterday's meeting. Listen in.
See, it's always been that the banks in India, because of the greater digitization that has been happening over the decades, that we are adequately prepared for meeting any challenges which come because of technology-related, risks. But now, because of the new challenge which is coming in the name of Mythos, about which not much is known, not very many people have tested or tried, MeitY is an active engagement. The Ministry of Electronics and Telecommunications is an active engagement with various authorities, governments across the globe, and also with technology companies to understand how this is going to play out and what is the kind of preparedness we need in India. So yesterday's meeting was in that context. We need something new and something far more versatile to be able to counter the newer threats which are likely to come. In the coming weeks, there will be a lot of interaction within the banks, understanding where more investments will have to be made, what kind of technologies can come in, how AI itself can be used for countering this AI-born challenge.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. On to the latest updates from West Asia. U.S. President Donald Trump has announced a 3-week extension in the ceasefire between Israel and Lebanon. In a post on Truth Social, he added that he hoped to host Israeli and Lebanese leaders in the near future. The ceasefire was due to expire on Sunday. The president also said he is under no pressure to end this war with Iran, though time is limited for Tehran. Trump wrote on social media, "I have all the time in the world, but Iran doesn't. The clock is ticking." Meanwhile, Tehran is rejecting the rhetoric from the United States' president that there is a division inside Iran and among Iranian officials and the government.
President Trump extending this Israel-Lebanon ceasefire by 3 weeks after Israeli and Lebanese representatives met at the White House overnight. Remember, the original truce was set to expire after 10 days, so this is being viewed as broadly positive in the region. But of course, the Lebanon extension matters beyond Beirut because Iran has pushed to make an end to Israel's offensive in Lebanon a precondition of any deal with the United States. That is despite Washington saying that these two tracks are separate. The US president has blamed a lack of clear leadership in Tehran for holding up peace talks, and now we know why that leadership vacuum exists. The New York Times is reporting that Iran's Supreme Leader Mojtaba Khamenei is alive, but he has life-altering injuries, including to his leg and extensive burns to his face and lips. According to the New York Times, he's been isolated in a bunker of sorts and struggling to give direct sign-offs on ceasefire terms, ultimately leaving civilian leaders in Tehran without a clear mandate to negotiate. And of course, that's not just a diplomatic problem, it's a structural problem as well. Of course, it helps to explain, if the reporting is true, why we have seen these talks fail to launch before they even started earlier this week. And of course, inside the Strait of Hormuz, we're still monitoring developments here. The maritime standoff appears to be intensifying. US military officials now developing new plans to target Iran's capabilities in the strait if the ceasefire falls apart. And President Trump, of course, also overnight ordering the US Navy to shoot and kill, he says, any Iranian boats placing mines in the waterway. So the conflict remains hot, no diplomatic off-ramp emerging, even though we have seen this fragile truce being extended inside Lebanon. It's back over to you.
Dan Murphy, thank you for that update there. Numbers from Chennai Petro at the bottom of your screen. The stock has taken a bit of a knock from the highs. The margins have expanded by just under 300 basis points from the previous quarter. Profits are up 42%, crossing the mark of 1,400 crore. And of course, revenues have grown by 7% from last year. EBITDA has seen a growth of around 38% on a year-on-year basis. Mind you, the stock is up over 25% so far this year. So it's done fairly well, but now has taken a bit of a nosedive after that initial spike that you saw after the results. The numbers don't appear to be bad prima facie, but we'll get more details from Sonal once more details emerge. So 4.5% lower on Chennai Petro after the results announcement, make that 5% now, extending its losses. Now, President Trump has also said that he has decimated Iran without using nuclear weapons. Speaking to the reporters, he also said that the United States will open the Strait of Hormuz when a deal is made. Listen in.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. You know, guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. We're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you. I also took a little break. I gave them a break. And remember this, I want to make the best deal. I could make a deal right now. Do you know that if I left right now, we had a tremendous success. It would take them 20 years to rebuild, but I don't want to do that. I want to have it everlasting. I don't want to put that kind of a timetable on it, but it'll go pretty quickly. And we'll have the strait opened up. Now, right now, we have it closed. We have total control of the strait. And the fact that it's closed, you know, they would have opened it up 3 days ago. They came to us and they said, we will agree to open the strait. And all my people were happy. Everybody was happy except me. I said, wait a minute, if we open the strait, that means they're going to make $500 million a day. I don't want them to make $500 million a day until they settle this thing. So I'm the one that kept it closed. We have total control of it. and it'll open when they make a deal or something else happens that's very positive.
And meanwhile, crude prices climbed above $105 a barrel as stalled U.S.-Iran peace negotiations and the continued closure of the Strait of Hormuz fuel supply concerns. So right now, Brent at $106 a barrel. Speaking about the ongoing tensions in West Asia and the closure of the Strait of Hormuz, Fatih Birol, the executive director of International Energy Agency, told CNBC that the world is facing its biggest energy security threat in history. Take a look.
Are facing the biggest energy security threat in the history. We had crises in the past, three energy crises basically, 1973, 1979, two oil crises, and then after the Russia-Ukraine conflict in Europe. And as of today, we lost 13 million barrels per day of oil in this the crisis we are having now. In terms of gas, in the 4 years ago, Russia-Ukraine conflict, we lost about 75 BCM, and as of now, we lost 100 BCM.
He's made this reiteration multiple times, has Fatih Birol, about the biggest energy crisis that the world currently is facing. But moving on, where exactly is India not doing enough to work with America? That's the question asked by BJP leader Ram Madhav. Now, addressing the strain in the India-US trade ties at the Hudson Institute's New India conference, he argued that India has consistently expanded cooperation with the United States across strategic, economic and security domains. Listen in.
We agreed to stop buying oil from Iran. We agreed to stop buying oil from Russia. Facing so much criticism from our Indian opposition, we agreed for 50% tariffs. Agreed means we did not say anything. We maintained our patience. 50% tariffs we agreed. Today, in the new trade deal also, we agreed for 18% tariffs, higher than what it used to be. I mean, average tariff. So where is India lagging behind in that? What are those issues that where India is not doing enough?
On that note, it is time for us to head into another short break, but more news and updates on the other side. Stay tuned.
23,851, the new low for the index for the day. And that is the kind of pressure that we are seeing on the markets now, 300 points lower on the Nifty. Now over to the states of Tamil Nadu and West Bengal now, where a historic turnout of voters is being observed with over 85% in Tamil Nadu and 92% in Bengal in the first phase. Remember, close to 90 lakh names had been struck off the electoral rolls in the state after the Election Commission's special intensive revision. The second phase of voting in Bengal is due on the 29th, while the remaining 142 of the 294 constituencies will be contested by a cumulative 1448 candidates. Now, the key showdown will be between reigning TMC Supremo Mamata Banerjee, who will face the leader of opposition, and BJP in the West Bengal, Shuvendu Adhikari, for the Bhawanipur constituency. The final count for all the votes in the assembly elections nationwide across the 5 states is on the 4th of May.
And with that, it is a wrap on this edition of Business Lunch. The markets are still in the red, and we hand you over to Midcap Radar that's coming up next. Good afternoon. Welcome to Midcap Radar. We are coming to you live from the Motilal Oswal CNBC TV 18 studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. A down day for the markets. Last day of the weekend. Not ending on a positive note. At least not a good news for the bulls for now. 300 points lower on the Nifty. We are below the 23,900 mark. Midcap's taking a beating too. And in a market like this, where Bank Nifty has been underperforming so far in the week, is slightly outperforming. But yes, of course, it's still down in trade today.
That's right, a relative outperformance like you rightly mentioned. But clearly what's driving the markets lower today is the IT as well as pharma. Two of the heavyweights, especially when it comes to weightage on the index, both of them down sharply. But a lot lined up on the show, an important corporate conversation as well. Let's start off with the top headlines. Stocks extend losses sharply into the third straight session. Pressure accentuated across large and mid caps. Sharp sell-off in IT stocks, Coforge, Infosys, Persistent and HCLTech among the top mid-cap drags.
French airport operator ADP announces two-stage stake sale in GMR Airports. ADP has already sold 3.4% stake in the company. The remaining 3.9% to be offloaded on April 30th for 285 million euros.
Vodafone Idea chief Abhijit Kishore thanks the Apex Court and Centre for an honourable reassessment of AGR dues. Remember, the telecom operator reported a sharp surge in subscribers at over 1 lakh in March versus 22,000 in February.
Himadri Specialty reports strong Q4 results. Company closes the year with record EBITDA and profits. Margins for the year skyrocket 200 basis points. Management says they are confident they retain the 1,100 crore profit guidance for FY28.
The US Commerce Department levies a 123% anti-dumping duty on Indian solar imports. Lofty export exposure of 28%, dense sentiment on Vari Energies.
All right, those are the top headlines that we are tracking, but markets continue to trend lower. We do have the IT and the pharma pack, which are the reason for the fall in the markets. At the day's low for the Nifty as we speak, mid caps, small caps across the board, it is a big cut that is coming by for some of these names. So let's talk about that space itself. This is our special segment, Mid Cap Movers. Ria is here to take us through the mid caps that are moving around in trade. Ria.
Well, yes, a lot of stocks moving around in trade today. Let's start off with the gainers first. Himadri Specialty Chemicals is seeing strong traction today, reacting to strong results along with fresh capex announcements. The stock is up over 6% today on the back of strong volumes too. Over 6 crore shares have been traded today versus a 30-day average of just about 30 lakh shares. And the stock also sitting at its 52-week high today. Cochin Shipyard also continues its stellar run. The stock is now up nearly 40% since the 30th of March. And today's move is also backed by strong volumes for this one, nearly 5 times the 30-day average volumes. Apart from this, OneSource Specialty Pharma is also extending yesterday's momentum. The stock has rallied sharply, up around 40% over the past 1 month. Hudco also seeing steady buying interest today, gaining about 25% over the last 1 month, while Vardhman Textiles has also delivered strong performance this year, up roughly 30% on a year-to-date basis. On the losing side, then, we have UTI AMC, which is under pressure after a weak Q4 performance. The company reported a net loss for the quarter, largely led by mark-to-market losses. It's a weak day for IT stocks as well. Names like Coforge, Infosys, Persistent Systems, KPI Technologies, all trading lower today following weak results from the IT heavyweights. And apart from this, Vari Energies and Mahindra Logistics also taking a big hit in today's trading session.
Well, thank you so much, Ria, for joining us, giving us a neat gist of all of the top movers as far as the broader end of the markets are concerned. Well, it's a good time to welcome Hemen Kapadia, Technical Associate from DR Choksey FinServ, for a quick technical check on the market. Good afternoon, Hemen. Thank you so much for joining us once again. Well, after a while, we are seeing broad-based selling pressure, especially amongst the pharma and IT pack. What's your view on the market from here on?
A very good afternoon to you, Vivek. Thank you for having me on the show. It's always a pleasure. Last week's interaction, I had mentioned, Vivek, that time to be cautious because we're sitting on top of a 2,400 point rise. We needed a reality check. That's what happened. VIX has gone up a bit, not too much, but yeah. And 24,400 and 24,600 was strong resistance levels. Vivek, and after such a mind-boggling rise, I mean, you don't expect them to get taken out on the first attempt. So we peaked at 24,601. There was a gap also, Vivek, at around 23,900. The other one is 23,555. So this gap has been covered as of now. So frankly speaking, a welcome correction, much needed correction, Vivek. And I believe there could be some more downside left. It's a retracement of the rise. We need to digest it. So basically, that's what has happened. And I believe there is some more downside left the way things are going on, Vivek.
Right. Hemen, quick, what are your top picks for the day?
Okay, quickly, Angel 1 is a sell at around 310, stop loss of 320, target of 290. Overbought, small rounding top, negative divergence on the intraday, crossover sell by oscillators. Second one is a contra buy call on Dr. Reddy's. It's been consolidating for quite a long time. I believe it's setting the stage for a bigger breakout. So there's not a very shorter term call. It's a 4-6 month sort of a call. Buy Dr. Reddy at around 1320. Stop loss of 1270. Target of 1420. Vivek, looks good for an all-time high.
Well, thank you so much once again for joining us. Really appreciate your views on the markets as well as your individual trading calls. But now shifting focus, our colleague Ashmit spoke to Vodafone Idea CEO Abhijit Kishore on AGR reassessment and tariff hikes. Let's listen in.
No, I think first of all, I think we are very thankful to the Honourable Supreme Court and the Government of India for taking the holistic view about and a conclusive long-term view about the AGR reassessment. As we speak, the AGR reassessment is on, and I think once that is concluded, then we'll come back to you. The work is in full swing. We can't really comment anything beyond that as we speak.
Any indication from the government as to how long the process will take, how much longer?
The work is on. I think it's on a very fast pace. Let's wait and see when the results come out.
Some of the latest TRAI numbers have shown a bit of a turnaround in terms of subscriber addition. Just a word on that in terms of seeing subscribers trust the Vodafone network once again.
You know, we have always said that, look at us on 6 to 7 parameters, which are the right business parameters to see. One of the parameters was the subscriber addition, which for the longest period of time we were in the negative area. Very, very heartening to see. And we always believed that, we have all the right ingredients. In Feb and March that you see, which is a reported number, gives us a lot of confidence on the investments that we have been making over the last few quarters. Since we are in the silent period, really can't comment anything beyond that, but a couple of weeks and once the results are out, then, definitely we'll kind of come back to you and share a little more detail.
More recently, we've seen some tariff hikes. Is that something that we're beginning to see broadly as a trend? More consolidation in terms of an upward trajectory?
I'd say that, we keep doing a little bit of a correction here and there. These are not really the structural tariff hikes that you see. And that's where it is right now.
Okay, all right, that's the word coming in from Vodafone Idea. With that, we'll slip into a short break. When we come back, we'll get to IKS Health on the other side on their acquisition. Stay tuned.
Welcome back to Mid-Cap Radar. Well, earnings coming in thick and fast and sharp reactions. This is our special segment, Mid-Cap Spotlight. We put spotlight on UTI AMC that's fallen over 10% in the session today. The company reported a weak set of Q4 numbers. Our colleague Devyani brings us the fine print.
It's not just red on the ticker today for UTI AMC, it's also the bottom line. The company reported a net loss of 51 crores against a net profit of 138 crores in Q3. Now, this was majorly as a result of a 175 crore mark-to-market loss that wiped out the bottom line for the company. Operationally, the revenue slipped 5% to 375 crores, while operating profit fell sharper 18% to 147 crores. Now, this contraction was driven by a double whammy, lower revenue yields as well as elevated expenses. Now, together, these crushed the operating margins by roughly around 630 basis points, down to 39%. Now, the market share bleed also continues for the company. The overall share is down to 4.76%, while the equity share slipped to 2.72%. Crucially, their largest AUM bucket, the ETFs and the index funds, that's plunged 76 basis points. Now, looking ahead, the management expects to have 1 to 2 basis points of further yield compression as a result of the AUM shift towards passives and fixed income going forward, but they do plan to pass on the total expense ratio impact to its intermediaries. Now, the only silver lining though, the March SIP inflows hit a multi-month high of 852 crores this time around.
All right, Devyani, that explains the move that we are seeing on UTI AMC, the stock down in a weak market otherwise as well. We'll step into a short break now. When we come back, we'll talk about markets, get you some stock-specific action as well. Stay tuned for that. Welcome back. Let's get to the corporate conversation that we promised. IKS Health has announced that its subsidiary IKS Inc. will acquire TrueBridge for an enterprise value of $557 million in a deal structured through debt financing. The company has secured $600 million of debt with a 5-year tenure to fund the transaction. Let's welcome Sachin K. Gupta, founder and global CEO of IKS Health, for more details. Mr. Gupta, good afternoon. Thank you so much for joining in. If you can talk to us about the synergies from this acquisition, how will the growth look like for TrueAlt? The numbers that are given to us, his revenue CAGR of 6% from 2020 to 2025. What kind of revenues will this acquisition add to your P&L? Also, in the margins, will it lead to margin dilution and hence EPS dilution because TrueAlt's margins are lower than your current margins?
Hi, so thank you for the time today. Happy to talk to you all. Yes, so I guess the way to think about this opportunity is that their calendar 2025 margins, which is their fiscal year also, their revenue is about $347 million and an adjusted EBITDA of $68 million on that. And I think the way we have looked at this opportunity is that traditionally this business is over the last 5 years is growing at about a 6% CAGR in revenue and about a 10% CAGR in margins. Based on the way we have understood the business from the outside in, keep in mind the deal hasn't yet closed, although we've signed it, what we anticipate is through the superimposition of the IKS execution model on the TrueBridge customer base and bringing IKS's care enablement platform and tightly integrating it into the TrueBridge EHR, we should be able to cross-sell parts of our system of action that IKS has in our care enablement platform into the TrueBridge customer base. And if you look at the TrueBridge customer base, they have about 700 hospitals, rural hospitals in the US, of which there's about 200 that currently use their revenue cycle system of action. And when we change their system of action to our integrated system of action with their system of record, we think there's about a $500 million opportunity in their balance 500 hospitals to be able to install our system of action there. And so that provides the first vector of growth, is to cross-sell our joint revenue cycle system of action into the TrueBridge EHR customer base. Also, TrueBridge over the last several years has tried to use the right combination of technology and offshore delivery effectively to improve their margins. They've had some challenges doing that. As you imagine, IKS has a fairly optimized model to do that. And as we manifest our model into the current execution that they have, that will lead to margin improvement. IKS has a track record of acquiring such assets in the past where initially the pro forma margins declined. When we acquired Acuity 2.5 years ago, the pro forma margins had declined to 24%. We had said within 3 years, we'll bring them back to the early to mid 30s. As you know, last quarter, we had an EBITDA margin of 35%. So we feel confident about bringing the margins through our model in their current execution back to that sort of early to mid 30s, which will drop to about 26% pro forma at the close of this deal, just like we did in Acuity. Having said that, your other question was, is the deal EPS accretive from day one? Absolutely. From the date of close, the deal is EPS accretive after factoring in the $69 million of adjusted EBITDA and taking the expense of about $36 million of interest cost on that and other intangibles that will fall in the amortization. So EPS accretive from day one, great line of sight. First vector of growth will be the cross-sell of the RCM system of action into their EHR install base, and the margin improvement vectors that we're very confident of, which will get us back to the pro forma margins into the early to mid 30s, just like we did on Acuity. Those margin levers.
By when will those margins come back to those 30s level, Mr. Gupta? I just wanted a timeline. EPS accretive from day one, but what about margins?
You know, I think assuming the deal closes in the first 3 to 4 months, I would say perhaps 18 to 24 months is a fair estimate. And that's also one of the reasons why we gave more of a bit of a true north target to ourselves that I've revealed in the investor call earlier today, where if you look at our trailing 12-month EBITDA for 2025, as of December 31st, 2025, we had about 1,000 crore EBITDA standalone IKS. And I've given a true north aspiration to our investors, saying that for FY30 we should be able to get to an EBITDA of about 3,000 crores.
Right. Mr. Gupta, what is the debt you're raising for this particular deal? So what's the current debt post the deal, and how do you expect to pay down the debt? What is the timeline you've set for yourself?
So our debt is, as of December 31st, was a little under $35 million. We've been paring down our debt over the last 2 years, which was up to north of $200 million. It's already down to $35 million. It'll be even lower as of this March quarter, whose results are not yet declared. And we're taking on $557 million of additional debt to fund this deal. And so net, broadly, it'll be about $600 million of gross debt, maybe a little bit lower, depending on when the deal closes. And what we have said is that we'll bring that $600 million of debt, call it about 5,500 crores of debt, back down to this sort of 300 crore number that we were in as of December 2025 by FY30, by the end of FY30. So we've given ourselves a true north goal of 3,000 crores of EBITDA and back to 300 crores of net debt from the 5,400 odd gross debt we will have at the close of this deal.
At the close of this deal. Is it mostly dollar-denominated debt, Mr. Gupta? So in that case, the rupee depreciation, how is it impacting your interest payments?
Yeah, so it is absolutely dollar-denominated debt, and we've modeled, but also keep in mind that our revenues are in dollars as well, right? So our margins improve as the rupee depreciates, and so some of that will offset some of the increase in debt. And yeah, definitely there will be, depending on the rupee depreciation, some inflation in debt. But as you can imagine, because our revenue is in dollars, the rupee depreciation helps us on the margin side as well.
Well, thank you so much, sir, for joining us, giving us a sense of the deal. Congratulations on this particular deal, and we'll get you once again on the channel post the results as well. But Sonal, you've been looking at the numbers of Chennai Petro. How do the numbers look like? What's the calculated GRM?
The quarter gone by will look very strong because of the West Asia crisis. Refining margins went through the roof, and that is something which were positive for most of the standalone refiners. There was a point in time when we did see diesel cracks at a record high, $41, $42 per barrel. But that, of course, has come off now. But first, let me take you through the numbers. On a quarter-on-quarter basis, of course, it's a very strong performance. Revenues up 7.2%. EBITDA is up 36% for the company. Margins have expanded by almost 300 basis points, and profits are up 42% as well. The crude throughput for the company also increased on a quarter-on-quarter basis. It has come in at 2.93 MMT versus 2.786. However, things changed by the time these numbers were done as well, because now oil marketing companies have put a cap on the refining margins as per the refining transfer pricing notification as well. So they have capped it, and beyond that price, these products cannot be sold to OMCs to be ultimately sold to customers as well. So that is something which will keep their margins under pressure. Now, do remember this time around, their calculated GRMs have come in at $14.1 per barrel, which was, of course, an increase on a quarter-on-quarter basis. But this compares with Singapore GRMs at $8.3 per barrel. So it has done better than the benchmark as well. But the stock rallied ahead of the numbers. It has done well this year. So far, it is up 20%. This week, it did well as well. So it is some profit booking that we are seeing. And additionally, because the energy space is one that is impacted the most because of West Asia crisis, these stocks have been quite volatile in last couple of trading sessions.
Well, thank you so much, Sonal, for taking us through the numbers of Chennai Petro. Strong cracks, strong GRMs as well. But, moving on, earlier today, we spoke to Gautam Shah, who's the founder of Goldilocks Global Research, to get his outlook on the market and his preferred themes to invest in. Let's listen in.
I think with this recovery, the market has done its bit for now. I think 24,600 was an important resistance. We've seen a bit of a correction from that particular number. I think now we'll go back to normal business. And I don't think people should start extrapolating that just because we've had such a good last 3 weeks, it doesn't mean that all is well once again and we keep going up and start making new lifetime highs. I don't think that's going to happen, because we go back to normal business. We go back to looking at earnings, fundamentals, consumption, AI disruption, and all of these factors are still impacting Indian markets, and the fact that FI selling continues. So I think we will yo-yo in a sort of a range, 23,500 on the downside, 24,600 on the upside, and we need to go through a consolidation patch. Within the broader markets, I think energy-related stocks, power-related stocks, metal stocks, PSU stocks, I think these are the big opportunities. I mean, I've said this multiple times in the past as well. I'm sticking to this basket because I feel there is new leadership that has really emerged in this space. I mean, look at the metals index is at a lifetime high. Look at the comeback in capital goods. Look at also a comeback in real estate. And, PSU, according to me, is probably your best bet for the rest of the year. I mean, they've handled the market weakness really well. They're very steady, nothing to do with foreign policy, excellent dividend yield, under ownership, and they've done all the right things on the charts in the last 10 days. So metals, PSU, and energy, I think are three baskets that we are really liking. This domestic liquidity has been so stubborn, I mean, happily stubborn in this last 1 year. We've had so much in the recent past, but despite that, domestic liquidity continues to be a mega revolution. And that's probably the reason we are at levels above 24,000 today. Be in stocks and sectors where FI selling is limited and DI ownership is limited. And that's probably the reason I'm really looking at that basket where the market cap of stocks is anywhere between 1,000 crore to 30,000 crore.
All right, that's the market opinion coming in. The selling pressure, though, has intensified. The Bank Nifty is the one which is seeing lower lows, 0.9% lower on that one. And that has led to the Nifty sliding even more at the day's low for now. Nifty Bank, look at that, 0.9% gone. It's a 500-point cut. The Nifty also is down around 320 points. We have the metals index, which is taking a slide. And Nifty IT continues to be the biggest loser as far as the sectoral moves are concerned. Some recovery in metals, however, that is not enough to keep Nifty losses in check. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks comes up next.
Hello, good afternoon. Welcome to your stocks on CNBC TV 18. We're coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, very good afternoon to you, but not a good afternoon coming in, not a good end to the week, at least coming in as of now. Bulls are not going to be too happy about the situation. 23,840 around that mark is what the Nifty is trading at right now. So, clearly near the day's lowest point. Yeah. Nifty down 325 points, more than 1% over there. So pressure is coming in on the markets. Broader end of the markets too is performing in tandem with the benchmark indices. So pressure coming in there as well. And IT, the decline just seems to have continued. Arundhati at 12 and 1, we were still 3-4%. Now it's 5.5%. So
Absolutely.
Nifty IT also, that fall continues.
Absolutely. As you see those earnings trickle in for those IT names, right? They're just getting battered in trade. The Nifty Bank has also fallen further now, almost 1% lower. That's also putting pressure on the markets. All of the indices at this current point trading in the red. So no respite that we're seeing, right? But let's move on to our guests. Joining us today are Nirav Chedda, AVP Derivatives and Technical Analyst at Nirmal Bang Securities, and Shaina Mukadam, Independent Market Expert, to answer all of your stock queries. Thank you so much for joining us on the show today, but let's go across to our first query. We've got Umesh Jain writing to us from Lucknow. He holds 100 shares of Bharat Forge at 700 rupees, and he wants to know whether he can add more shares at current levels, or he just wants to know that, and he is currently making a profit. So Shaina, let me come to you. What's the fundamental view on the stock? Do you expect the stock to continue to do better, and should he add more shares or should he book his profits?
I would suggest that he continues to hold. First, good afternoon to everybody. So I would suggest that he continues to hold, not to add as of now, to review it, post the numbers, because, there are a couple of issues that may impact their, overall margins. Raw material prices have gone up. Secondly, in terms of they are exposed to US, wherein the truck sales, which were likely to, which we were expecting to pick up in the fourth quarter, may not really happen in this short-term period. So that needs to be reviewed as to how it is doing on that front. The positive for Bharat Forge, because of which I say continue to hold at present, is the defense. Defense for them is doing pretty well. If you see, last year it contributed just about less than 10% of their revenues. But within a year, the percentage to revenue contribution is going to jump up, I would believe, at least to 20% over the next 1 year time frame. And the margins are also much higher. So I would say that because of that factor and the huge order book that they have got compared to the actual execution, they are expecting to, I would say, execute almost 3,000 crore worth of defense orders in FY27, which would give them that percentage of overall revenue, 20%. So I would say continue to hold, but do not average as of now, review post numbers.
Okay, Shali, point taken there, but let's move on and talk about the technicals for this one then. And Nirav, what's your view for Bharat Forge? They bought it at 700. What should they do now?
Yeah, hi, good afternoon, Vinny, Arundhati, and thank you for having me as well. Bharat Forge, very importantly, from 2024, it had made a high of around 1750 odd, and it had come down. Now that high has been broken after a 2-year period. So there is a breakout on the technical charts. And I believe this breakout, the target is around 2400 for this stock. So I would suggest to hold on and even average at current levels, and on certain declines up to 1750 odd levels, you can keep a stop loss of 1650 for your longs and just hold on. There is a good chance this stock will go up towards the 2350, 2400 levels.
Okay. Shali will watch out for the levels over there. Let's move on then to the next query for today. We have this coming in from Inder Kumar, who's writing to us from New Delhi, holding 100 shares of Ashok Leyland. Price is 150 rupees per share, making some bit of a profit on this one. Wants to know if he should add some more to this one. Shaina, what is your view for Ashok Leyland? Is adding a good option right now for Ashok Leyland, or maybe look at some other names in the auto and ancillary side?
Well, I would not suggest that he adds as of now. My major concern, I would prefer to wait for, quarter numbers and a couple of months to add. My major concern is on the balance sheet. The debt is high. Interest costs are rising, have already risen. Secondly, there is pledge on the promoters holding, which is an additional cause of, little bit of concern if you're holding it for the medium term. They also raw material prices, it is possible that it could affect their fourth quarter numbers. And so overall, I think for a couple of months, despite I think volumes remaining stable, because volumes are dependent on OEMs and OEMs are doing pretty well. Also, the replacement market is doing pretty well. So the longer term is stable, but I would believe that do not average as of now. You can hold.
All right, do not average and you can hold. That's the word coming in from you. But Nirav, if I can come to you, he has shares of Ashok Leyland, which he bought at 150, and he wants to know if he should buy more. What's your view? Any levels that he needs to watch out for?
Yep, so I would like to concur with Shaina. I think there has been a huge rally which has come in this stock. Even when the market was going down, this was one stock which was continuing to move up. Now there is a top kind of a formation in this stock around 200, 210 levels, and there is a good chance that this stock will witness a good consolidation for the next 3 to 6 months, in which it can probably come down towards the 125, 130 levels as well. So I would suggest to book profits and exit the counter at this point of time. There's no point holding on at this point where we cannot see much upside, technically.
All right, don't see too much upside technically. All right, lots of queries coming in from the auto ancillary space today. But SK Swami writes to us from Bhopal, and he holds 10 shares of MRF at 4,200 rupees. He has been holding the stock for the last 20 years is making a profit on it. He wants to know the future prospects of the stock. Shaina, what's the fundamental outlook for the stock? Do you see more of an upside going ahead?
Well, this MRF suffers similar to Apollo Tyres in terms of raw material costs going up. But I would believe here the difference is the management strength and balance sheet strength. Balance sheet is extremely strong. So to that extent, I would continue to hold and maybe add at any dips. I would prefer MRF of course over Ashok Leyland at current levels. And if you see in terms of market share also, it is the largest manufacturer. It is going to benefit from OEMs doing better. Here also even defense, their product portfolio is across various segments of tire. And I think going forward, increase prices also. They have increased about 2% of their average prices in the last couple of months. I think that could also support some bit of margins. So overall, I would believe you can continue to hold MRF at current levels. And maybe if you want to added dips, but otherwise hold it.
Okay, added dips, but otherwise hold it. Surely this is that long-term investment story, right? Bought it at 4,200. I almost was shocked looking at the price, Nirav. But on the technical front, what is your thought on this one? Continue holding? Should you add more? And if add more, at what levels?
Yeah, see, he's been holding for, I think you said 20 years. So, that is very ultra long term, and, 10,000 price movement, either direction should not be a big problem actually. I don't see, much downside in this stock now because there has been a consolidation which has come in the last 2 years or so. Yes, there are chances that this stock can probably, come down towards 1,20,000 looking at the current chart, but that is not very far, and from a long-term perspective, that should not really matter. So I would suggest if it does come towards 1,20,000 levels, that is when you add positions, because from there is a very good chance this stock goes past 2 lakh kind of a level in the next year or so. So at this point of time, wait for some downside and then add some positions.
Okay, point taken there, Nirav, and the levels also maybe in a couple of years or next year, maybe we'll watch out for 2 lakh then. But let's move on and talk about, actually now switching gears, finally we're done with the auto side, seems like it. We have a query that's coming from Udit, who is writing to us from Jaipur, and this is about Shakti Pumps. They're holding 40 shares of Shakti Pumps and they bought it at 1,200 rupees. So they're making a loss on this one. Outlook for Shakti Pumps, how is that looking like? These solar water pumps, Shaina? Is this a sector maybe you're looking at, and is this the best bet here? Or maybe it's time to book out profits and look at something else in the sector?
Yeah, I personally hold the stock. I've been holding it for some time, and I believe the sector is pretty strong. If you look at the overall order book also, they have got good order book also, 2,000 crores worth of order book. Having said that, I think the last 6 months have been very disappointing. In terms of the performance in both top line as well as EBITDA margins, they don't seem to have executed, the order books well for whatever reason. Having said that, I would continue to hold. In fact, I would say that partly you can start averaging if at all you've got it at a higher price, which I believe the investor has. He's got it at the peak. So start averaging now, and over the next couple of months, you could take SIP type of averaging and then hold it for the longer term. Because I believe that even going forward, they have got good projects on hand. They are setting up a new plant to manufacture solar cells or photovoltaic cells also. So I think that should start contributing over the next 2-3 years in addition to their existing product portfolio. So I would say you could start averaging and hold it for the long term.
All right, start averaging, hold it for the long term. That's your view on what Udit should do. Nirav, coming to you, 40 shares of Shakti Pumps, 1,200, making a loss at this point. Seems to be a long-term investor. So what's your view? Any levels that he needs to watch out for? Should he start averaging at current levels?
I think yes, even I concur. One should average at current levels. Why? Because see, 2 years of consolidation is done for this stock, and there is a small breakout which has come in also at around 540 odd. No doubt it is near about the same levels right now, but there is likely to be a good close on a weekly basis. So I believe this stock can come up toward the 800 levels in the medium term perspective. This would be a good level to average your stock at current levels, and once that 800 comes in, book some profits. I believe if you've averaged here, your price will come down below the 700, 750 odd levels, and once it goes above the 800 levels, that is where you book your profits.
All right, once it goes above 800 is where you book your profits, but average up until then. All right, on that note, it is time for us to take a quick break, but we'll answer more stock queries on the other side, so stay tuned. Welcome back to Your Stocks on CNBC TV 18. We still have with us Nirav Chedda of Nirmal Bang Securities and Shaina Mukaddam, the independent market expert, to answer all of your stock queries. The next query is coming in from Kaberi, who writes to us from Kolkata. She holds 100 shares of Exide Industries at 500 rupees and 50 shares of Birla Soft at 500 80 rupees right now. She is a long-term investor and she wants to know if she should add more shares or sell both the stocks. She is making a loss on both of them. So currently wants to know on Exide and Birlasoft if she should continue to hold or sell both of them. Shaina, let me come to you first on the fundamental view.
Unfortunately, she's making quite a bit of loss on both the stocks, but I would not suggest adding even now. And basically, if you see Exide, and both the numbers are going to come out next week, so it is better to review at that point in time whether you need to sell or average or whatever. But in my view, it's better to not do that now. Coming to Exide, basically, they are going to face raw material increase in cost, and so I would believe that that would affect the margins. But I think the most important thing in these numbers would be to watch for the management commentary that will come out for the new project that they have set up for their lithium ion, which actually is going to expected to go on stream soon. And what will be the impact of that on the overall revenues as well as turnover and their margins? So I think that should be something we will closely watch to decide whether to exit or to hold. And Birlasoft, of course, it is suffering like the rest of the IT stocks. There also, I think you need to watch for the numbers and see what are the prospects going forward for a year, and then decide whether you want to actually exit or continue to hold. But as of now, I would suggest avoid doing anything for both as of in the immediate future.
Sure. Neena, what's your view coming in for both these names, Exide as well as Birlasoft? Should they look to average at these levels?
See, technically, I feel one should average. Why? Because almost a 3-year consolidation has happened. Downward leg for both these stocks. They've halved from where they were. 2.5 years back. So yes, for Birlasoft as well, you can look to buy. I see buying accumulation going on in this stock from a near to medium term perspective. This stock can come up to us 550 odd levels in the next 3 odd months or so. So one can look to add positions here. You can keep a strict stop loss of around 330. If that is closed below, then just exit it. Even for Exide, I see a breakout which has come in Exide, and it is very likely from a near-term point of view, this stock can go up towards the 450 odd levels. So yes, you can look to average Exide as well at current level. You can keep a stop loss of 300. And 440, 450, once it comes to, that is when you look to book profits. Both these stocks, at least from a near-term point of view, chart looks like they are headed upwards.
Okay, surely point taken there. We have Hindalco that's reported its numbers right now. And when you look at it, net profits, yes, on a year-on-year basis, it's seen a growth. Revenue has seen a growth on a year-on-year basis. But when you compare it with the poll, seems like, at least on the margin front, there was a miss that one has seen coming in, right? The EBITDA margins over here seem like it came in at 56%. Expectation was somewhere around 59%. So there's a miss coming in on that front as well. And overall, year-on-year basis, there's an expansion in terms of margins. But expectation, I think, it seems like it's below the expectation of what we were seeing. Net profits also is above. So net profit is above expectations. Margin seems to be below expectations. Revenue is above expectations. Let's keep an eye out on more details coming in from this one as well. So we'll wait out for further more details in terms of maybe the guidance, future dividend payout, realizations. That is the key from here on as well. So watch out for that. But as of now, the stock has taken a bit of a fall and a beating from where it started off. So a decline that's coming in for the stock in today's trading session. A sharp downtick as of now for Hindalco. So let's watch out for more details. But let's move on then to the next query. We have Richard, who's writing to us from Udupi. And he's holding 10,500 shares of Vedanta. Price is 270 rupees per share. Wants to know, for the long term, should they continue to hold the stock? Shaina, obviously, the demerger, the final approvals, all of that has come in as well. How do you see this story playing out?
Yeah, so Hindalco will be part, of course, of the Vedanta, and the rest of the businesses verticals will be moved out. And here, I believe one should, of course, in the near term, continue to hold, because by this month end, the demerger is going to happen. And I think one of the demerged stocks, like in the aluminium vertical, we should do pretty well, post demerger. So I think that would be an interesting stock. You could continue to hold and then review it post the demerger, maybe a couple of months down the line. Which are the stocks in the demerger that you would like to exit and which you continue to hold? Because I think some of them like steel, some of them like oil and gas, you could review and exit post the relisting. But as of now, you continue to hold Vedanta in my view.
All right, continue to hold Vedanta. Nirav, coming to you, what's your view on the stock? Any levels to watch? The big demerger coming as well next week?
I think one should exit. See, this stock has moved up from 400 odd levels up to 800 odd, and then some selling has come in. Looks like a top formation for now. It can probably come down towards 650, 620 odd levels. That is when probably it can again witness buying. But as of now, it would be better to book profits if you've bought this stock at lower levels.
All right, moving on to the next query that's coming in from Mohammad Aslam, who's writing to us from Noida. He says he's been holding a few shares of Pidilite since the last 2 years and wants to know the outlook on the stock. So we don't know what the quantity is. Pidilite is currently trading at 1,395. Shaina, what's the fundamental view on the stock?
Well, it's positive for the long term. They had a bonus in December, this recent last 3-4 months back. So that was a one-to-one bonus. So if he is looking to book some profits, I think the original shares pre-bonus, he could sell some of that, but continue to hold the bonus shares, for the longer term. They are doing pretty well in terms of their core business, which is actually including all, the brands like you have Fevicol, Fevikwik, all those brands, and which accounts for more than 50% of their revenues, is doing pretty well. That construction business, tile adhesives, those are doing quite well, ROF, etc. The issue over here is the results are going to be 15 days down the line, and they may see some impact on raw material cost increases, impacting the overall margins. So I would say that you continue to hold for the long term. Some small quantity of the pre-bonus stock, if you want the money, you could sell.
Okay. And on the technical front, Nirav, what should they be doing with Pidilite?
See, on the technical front, I don't see, a very big upside coming in here. But yes, from a near-term point of view, 1550, 1570 is where I see this stock coming up to. Yes, if you're looking for a short-term period, you can look to add position with a stop loss of 1350. 1550, once it comes, book profits and exit the counter. I don't see a very long-term upside in this stock. So it will be better if you, trade this on the near-term perspective.
All right, Nirav and Shaina, thank you so much for taking time out and answering all of our viewers' stock queries. But let's take a check on where the markets are at. We've got the Nifty at around 23,872 at the same levels at which we started the show off. We've got Nifty Bank about 0.7% lower, and the top losers are the IT pack. We've got Infosys, HCLTech, TCS, Tech Mahindra. Those are the top losers on the Nifty, and very few stocks in the green. We've got Trent, Coal India, and Nestle India that are some of the top gainers on the Nifty. If you take a look at the advanced decline ratio, it's clearly in favor of the declines. We've got 606 stocks advancing for 2,480 stocks that are declining. So right now, it's all red for the markets.
Absolutely all red for the markets. There's no respite coming in here. And Hindustan Zinc continues to see a fall as well after its numbers. Atul Limited also reported their numbers. They also continue to see a fall. But with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can always email us your queries or even send us a WhatsApp on that message on the number that will be on the screens for you all shortly. But thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trading.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index, that's managing to hold on to gains, right? Every day you look at it, Taiwan index is managing to hold on to gains.
We were in Vietnam like for 18 years. We were in Iraq for many, many years.
You know, yesterday was high enough, 102. We're at 106 now. 24,160, actually in the green now, 24,190.
I think the markets have been reacting to all the geopolitical news flow that we've got in the last 1 month.
It'll have a very least impact both on the revenue as well as the profitability.
We're back above $106 a barrel currently.
Overall, on a quarter-on-quarter basis, we're expecting the revenue to increase by 3%.
Same-store sale growth were more or less in the ballpark of 30s for a very, very long time.
Zinc is marginally high on a sequential basis.
Not been a very good morning for the markets, though. It's not been a very good week for the markets either.
All four IT companies, majors, have disappointed this quarter.
The tech industry as a whole is going through, one of the generational shift.
This whole new committee, the IBA chairman, with the IBA, will be talking to banks.
A down day for the markets, last day of the weekend.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and in a short while from now, Prashant as well will be joining in. It's a Friday, but the bears are on top actually, because we have not seen any sustainable recovery from the word go. Volumes are relatively lower actually if you compare it, and select stocks are falling on not very, very high volumes. So that's the word of solace out there. But lack of buying seems to be the reason that we're down close to around 300 points. The number of stocks declining are way more than the number of stocks advancing. And the problem is that Brent crude prices refuse to cool off. So when we started the day, we were holding at around $105.5 per barrel. And the last I checked, we were still sitting above the $106 per barrel mark. Remember, this is the traded crude. Spot rates or delivery, or the physical crude is at much higher and elevated levels. Keep your eye out on Mr. Trump. I don't know whether it's his time is yet here to tweet, put out something on social media. For the time being, no sign of that, at least as of yet. But let's tell you what we have on the show. Well, the Friday factor plays out once again. Risk off across the market as US President Donald Trump says he is in no hurry to end the war with Iran. Crude prices surge above the $106 per barrel mark as the Hormuz blockade continues. CDMO players, OneSource Specialty and Shiley Engineering, they see strong gains in a weak market. They've outperformed significantly. What's hitting the move? Ekta will be joining us to tell us in just a bit. And the IT index itself is down close to around 5%, led by heavyweights like Infosys, which is slumping after the fourth quarter numbers disappoint the street. And SBI Life is under pressure once again, as the finance minister says that the IBA-led committee will deliberate on having an open architecture system for the distribution of financial products. Yash will join us to tell us what does this mean for the stock. Well, before we get into all those neat pieces on pharma, tech, as well as the insurance space, let's welcome Nagraj Sethi, Senior Technical Research Analyst at HDFC Securities, who joins in. Hi, Nagraj. Good afternoon. Good to see you in a bit of a down day. Would you term it as down but not out? Or would you say that this market's actually now showing signs of weakness and maybe a deeper correction is in the works?
Hi, good afternoon, Nigel. Yes, after a massive rally of 2,400 points from low to high, market witnessed a sharp resistance around 24,500 levels, and now the downward correction is getting some steeper in the sense. I think more weakness is likely, market is likely to come down further. 23,500, 23,300 is going to be the next important support, where I'm expecting Nifty to bounce back from the lower levels.
Okay, got it. You're expecting Nifty to bounce back. And what is the level? Missed that support level?
Yeah, support is around 23,500 to 23,300 level, where the gap support and the previous swing lows are also intact. And I'm expecting market to bounce back from the lower levels after coming down further.
Okay, all right. So you're expecting it to bounce back if it can defend these crucial levels. And I think what you're talking about is the 20 DMA, if I plot the Nifty as well as the 20 DMA. Got that. Nagraj, what about individual stocks? What are you looking at?
I have two stocks. One is from a short side and one is from a long side. First, let's discuss a short side that candidate from an IT sector. It has been underperforming last two sessions. The stock price is KPIT Tech. Chartically, the KPIT Tech, after a massive decline in few months back, has showed some reasonable upside bounce. And 750 level, it has turned around from the lower highs, and currently witnessed a breakout of downside breakout of the smaller consolidation. The overall chart pattern is looking negative, and I'm expecting more weakness in the near term. Currently trading around 705, one can look to sell at this point of time. Immediate target would be around 670. One can place a stop loss at 725. Second one is from a long side, PPL Pharma, Piramal Pharma. The worst period for the Piramal Pharma seems to be over. Witnessed a sharp upside breakout from the lower levels, expanded volumes indicating the emerging of buying during this weak broader markets. The overall chart pattern is looking positive. Currently trading around 165.90, 166. One can look to buy at current market. Immediate target would be around 176. One can place a stop loss at 160.
Okay, all right. Thanks very much for that, Nagaraj. We'll see how these pan out, and we'll come back to you with more. 23,900. So we're now at the second level of the support. 24,300, 24,100, and now 23,900. So let's see if the market hangs on around these levels by close or not. What, of course, makes the entire thing a little more trickier, of course, is the fact that it's a Friday, and Fridays are known to be a whipsaw kind of sessions, especially post 5 in the evening or something. I mean, something or the other, at least for the last many Fridays, has come, which then throws things into a tizzy, at least for the first, at least for the next Monday, or if not for a couple of days. Well, the top-down picture as we go on, we'll keep talking about it, but let's talk about some specific stocks as well. The U.S. Commerce Department is set to levy a 123% anti-dumping duty on solar imports from India. But as we understand it, this may be more bark than bite. Indian manufacturers do believe so, as both Vikram Solar and Vari say that the U.S. business remains largely insulated from this. I mean, how does this work? Vinny is here with the details. Vinny, take it away.
Hi Prashant, so good afternoon. First up, in terms of details, the US Commerce Department solar cell and panels is what that import duties come in for India. They've also applied these duties on Indonesia and Laos. The duty rate is coming for anti-dumping duty rate is at 123%. Furthermore, there's some other update also that is coming that by July around, they'll be taking some decisions on solar cell for India as well. So we're waiting for some clarity here. But if you remember, in Feb 2026, they had announced a countervailing duty that increase in rate, right, for India, Indonesia and Laos, and for India that rate for countervailing duty was also increased to 126%. So now that countervailing duty is there, plus this duty that comes in, and anti-dumping duty also comes in. What is the exposure that Indian companies have? Premier Energies, they do not have exports. Vari Energies, they have around a 28% export that is there. Vikram Solar, they have around a 16% exposure. So last time when we spoke to them on 25th of Feb 2026, when this countervailing duty announcement that had come in, that time these companies had clarified that this duty that actually comes in for this is mainly on where that solar cell is manufactured, not on that whole module, and they were not impacted by the CVD. So as of now also what we understand is that this is come in as a duty. Maybe they may not see much of an impact. Obviously for Vikram Solar, much less in terms of impact for the revenue front. Vari Energies will see more of an impact given the exposure is still 28% for the company. So there will be impacts that will come in, plus some decisions will come in July also. So that will be key to watch out for.
All right. Got that, Vinny. Thanks a lot for that. Gurmeet Chadha joins us on the show. Hi, Gurmeet. Good afternoon. Good to see you, Ben. What do you make of this perceived negative news flow on these solar companies? They've seen a good bounce from the recent low. But any view on Vari and Premier?
So, Nigel, we've been actually adding Vari from February lows. I think obviously this news probably needs a little more clarity, but this is nothing new. And I think the management has indicated, which Vinny was also pointing out, on the fuel cell thing. And plus, Vari has done a very good job in terms of, backward integration as well. So we intend to use any opportunity in this, in terms of any dips there to add. Also, we are overall very constructive on this energy value chain and ecosystem. whether those are solar rooftop panels, changing energy mix. We are also now looking at some of the city gas distributors also. There have been reports of Gujarat Gas trying to do something for Morbi and replacing propane with natural gas. We've seen a big surge in, PNG connections as well, almost 3,000-4,000 now connections on a daily basis. And also looking at some of the refiners. So I think we are actually going very overweight on energy, including power equipment, including renewable energy, and looking at more options. So we intend to maybe take up the energy weightage to 20-25%.
Okay, so very bullish on energy and companies which kind of sort of enable the energy to flow. So all kinds there. Gurmeet, afternoon, just coming to you. Just one more sort of space, not a sector, a subsector, it's a niche space, which is, these GLP-1, fill finish companies and the guys who make the equipment for it. So one source specialty is the fill finish, and Shaily Engineering does the injectors, etc. Both are up sharply. Ekta is here with just like a snapshot view of what's happening and why is the street excited. Ekta, take it away.
Well, yes, one source is in focus because it just provides the fill and finish for semaglutide injections. It supplies the product to the factory gate and is agnostic to basically pricing and geography. Now, remember that OneSource is the sole supplier to Dr. Reddy's for semaglutide injections. In Q3, their numbers were impacted because of this deferred delay in Canada. Q3 revenue was down 26%, EBITDA was down 88%, and they recorded a loss as well. Now, why is this important that Dr. Reddy's could be on the cusp of approval there is because Canada is the second largest market for GLP drugs in the US after the US. Dr. Reddy's is expected to have around 6 to 9 months limited competition in Canada. Now, on April 21st, the company also announced that they have a tie-up with a different company, which is Orbular Tech, which has received tentative nod for Ozempic generic. So now what this actually means is that, OneSource does not only supply to Dr. Reddy's, it also supplies to other companies in terms of the semaglutide fill and finish. But the big opportunity is going to emerge from Canada for them, because they will be providing the fill and finish to Dr. Reddy's. Dr. Reddy's could possibly make $80 to $100 million in the first year. And because of that, the OneSource opportunity would be intact and would possibly benefit them going into the FY27 numbers. They have a tie-up with Orbular Tech. They also have a tie-up with Hikma, where they are exclusive partners, or they are partners for them in the Middle East and North Africa. So it's not just Dr. Reddy's that they have tie-ups with. They have tie-ups with various other companies where they manufacture the semaglutide for them, and then they can sell it in whichever market they want. Now, OneSource is also sticking to the FY28 guidance of $400 million and EBITDA of $160 million. Shaily Engineering, on the other hand, that stock has performed very well in the past 5 years. It's up over 400%. It supplies the drug delivery devices, injector pens, and auto injectors. 9 months, the healthcare revenue was up 158% year on year. Multiple companies are expected to have contracts with Shaily. They've mentioned that 75% of their first filers in Canada have tie-ups with Shaily. First filers for semaglutide, they have tie-ups with Shaily. So the company already began supplying pens in Q2 for commercial launches and is planning to expand its pen injector capacity to 150 million units from the current 80 million units. It's also setting up a new manufacturing facility in Abu Dhabi for 150 odd crores. In Feb, the company also signed an over 400 crore contract with a large pharma company for pen injectors. So both these companies are at the back end. They provide the pen injector, or they provide the fill and finish, the end product to the companies. The companies pick it up from the gate, and then they can sell it in whichever market they want. Similar case for Shaily, which provides the pens to all of these companies, and then they utilize it in whichever way they like.
Ekta, do we know if any other, like the Lupins or the Zydus or the Torrents, etc., right, in India, are there any plans afoot for them to make these things, devices, injectors, these pre-filled pens, etc., themselves, or no?
Well, some of the companies would obviously be looking at backward integration. But like, for example, what a OneSource does is that they get the pens from the company, they get the medicine from the company, they put it together, and then they give it back to the company. They basically process the entire drug for them and then give it back to them in their hands. So they do basically get the parts from different places and have to then eventually give it to a OneSource, which is a CDMO, which then assembles it. So companies do have back ends many of the times to actually manufacture these products.
Sure. Okay. And just since you're there, Ekta, I don't know if you have any thoughts on this, the Alchem CEO stepping down. I think it was being reported, talked about. Anything?
Well, yes, there was a lot of buzz that one of the ex-CEOs of a company which was, involved with an M&A recently would possibly be the next in line to take over Alchem. But my conversations have indicated that maybe that might not be something which is on the cards. Alchem, yes, the feedback that I've got is that the CEO was somebody who really helped in terms of building the company at this point. But let's see who they get on board next. This is probably the second CEO change which has taken place in the past decade or for Alchem.
Thanks very much. So stocks down sharply. And 5,300, 5,320 or so is where Alchem is trading at. Gurmeet, the OneSource and Shaily, I mean, do you own any of them? Any thoughts?
Prashant, we missed actually Shaily. We at some point of time we were evaluating, but now at about 70 times and after the run up looks difficult. But we are evaluating the CDMO opportunities in this. So we've been trying to reach out to a lot of the Indian CDMO players. And there's a lot of scale up happening with not just with the GLP, but also a lot of formulations for patented drugs. And a lot of scale up happening in the innovative synthesis. Also, somebody like Laurus developing a lot of capability in peptides, ADC. They're expanding the biologics and crop science. And this one space has done very well for us. Laurus has been almost like a 5-bagger for us. And we expect more opportunities. And once at some point of time, if Biosecure Act sees the light at the end of the tunnel in US, the pharma outsourcing movement could quite be big because the act actually specifically names 4 or 5 Chinese companies. And some of those companies are $5, $6, $7 billion top line. One of our largest, like Divi's, it would be 600-700 million. So the size of the opportunity is pretty big, but you need to have good compliance track record, good relationship with the innovator pharma companies, and that's something we are very closely tracking.
Okay, all right, Gurmeet, stay with us. Let's talk about the tech space. Continues to be the top losers list. Tech has seen actually a very, very disappointing quarter. The stocks have taken a beating. Rima joins us with the detailed analysis of all the numbers that have come in there. Rima.
Well, it's been a disappointing quarter for Indian IT companies. Now that we look back, all 4 IT companies, majors, have disappointed this quarter. In the case of TCS, revenues were fine, but margins street questioned that you had 110 basis points benefit because of the currency, but only 10 basis points margin improvement was reflected. In the case of Wipro, despite the benefit coming in from the Harman DTS acquisition, your revenues continued to struggle. HCLTech had flagged off discretionary spending cuts at US telcos, 2 SAP projects getting cancelled, and Infosys, as we know, was a miss on revenues and margins. Now for FY26, it's been another tough year. For Infosys, it was a revenue degrowth of 2.4%, the first annual revenue decline for the company since inception. For Wipro, this is the 3rd consecutive year of a revenue drop. In the year gone by, despite the acquisitions, revenues were down 1.6%. HCLTech at 3.9% missed its own guidance of 4.5% that they had given in January, and Infosys at 3.1% was at the lower end of their own guidance. Also, look at the employee change in FY26. TCS went through the restructuring, as a result of which the employee headcount went down by 23,000. But for the others, these were companies which used to hire in large numbers. And now in FY26, the addition has been 3,000, 5,000, 8,000. The FY27 guidance basically is implying that there is no incremental, the growth is not accelerating. Growth will be what it was in FY26 as things stand today. HCLTech is at 1 to 4% growth, Infosys at 1.5 to 3.5%. And just one final word, I was listening to the Infosys conference call, and there were 2 key things that stood out for me. One, Salil Parekh talking about, every now and then he sees competitors, where they're quoting unusual pricing. The word was unusual. He's saying it's happened in the past as well. This time it seems to be linked to AI. So the question is that, are some competitors promising more on AI more than they can deliver? Somehow the math of the deal doesn't seem to add up. And on AI pricing, the CFO said that AI projects come at better pricing, therefore better margins, but it also has a higher cost compared to the regular project because premium talent is being assigned to it. So the question is, what is the net revenue margin benefit for IT companies? And HCLTech, particularly because, it was a very disappointing quarter. There were many company-specific issues, as I said, discretionary spends at telcos, SAP project cancellation, a revenue AI deflation of 2 to 3%. So I think that sort of spooked the street, and HCLTech was a rank underperformer for this quarter.
All right, Rima, thanks a lot for that. Busy week for Rima. Lot of earnings coming in there. But Gurmeet, it must be busier for y'all. What are you all doing with tech?
So, fortunately, Nigel, very, very underweight, hardly, I think 3% weight, of which one is KPIT and one is HCLTech. HCL, obviously, a very disappointing quarter. I think my bigger disappointment, Nigel, has been the commentary. I think it's been 4 or 5 years, especially with Infosys and TCS. Literally no wealth creation. Same 1, 2, 3% kind of guidance. And nothing really done with cash pile. No pivot announced. I think what the street is also seeing is less intent also. And I think market is always forward looking. With the kind of reserves they have. I know this AI threat is not new. And the same concerns that discretionary spending will be up or there. In fact, if you just play up, and sorry, I'm being a little rude here. If you play up last 2 quarters commentary, you will not find any change in terms of outlook, in terms of, so I think that intent is missing. And that's where probably some of the mid-cap IT names may be able to pivot. So I'm not saying you have to acquire something on AI, but at least you need to announce some plans, show something on a war footing. And I think street, and this is globally, this is happening with other IT services companies as well. So I think disappointing, and probably, something needs to be done more from a thought process perspective. Otherwise, the numbers are unlikely to improve going, forward as well.
The other broader takeaway, Gurmeet, if IT, the forecast, etc., is so poor and dull, right? I don't think India earnings will grow more than 10%, 9-10%. So that's the other kind of thing. I think in the afternoon, Gautam of Motilal, Gautam Chachori was highlighting that, and I think Nikhil Bernstein had highlighted this earlier, I think he was with us yesterday or day before, that Infosys is now trading at 18 times trailing earnings, and NTPC and Power Grid are trading at about 20 times all trailing. Yeah. So, yeah, should this go up or that go down?
So even with some of the top 2 banks, if growth is single digit, we haven't seen RIL do much, and then you have IT not doing well. So that's like 30% index, delivering, single digit earning growth. So I think that's what's happening. The market is looking outside Nifty for opportunities. And even if, it's 15, 18 times is fine, but if you're again going to give 1 or 2% CC growth guidance, even 18 times is, relatively not cheap. And that's why probably pharma is getting some allocation more as a defensive bet than IT was. And this is quite owned by domestic institutions, hoping for a turnaround in valuation. So I think a little needs to be done with the kind of cash they have, and more intent needs to come rather than pointing the same thing on uncertainty. In fact, some of the IT transformation projects, Prashant, if you see, which are the ERP ones and all, that also apparently haven't yielded the exact results and this is the feedback we get. And then there is competition from GCC in terms of center setting up. So they need to pivot, in my view. And unless the pivot happens, I think probably you will see more an extended time correction, if not price correction.
Got that. Thanks very much, Gurmeet. We'll leave it there. Appreciate you joining us, and get ready for Friday evening fireworks later with tweets and truths and whatnot. But for now, it's down 250 points, and we are holding around the 23,900 level. We'll take a break. We're back. On the other side, we have SBI Fund Management's Dinesh Balachandran joining us in just a bit. Stay tuned. Welcome back. So markets, of course, are down. IT is the biggest pressure point. I mean, just wondering how many times this year have we seen the IT, actually not just this year, but I mean, it started late last year, that the IT index on a daily basis has swung, between 3 and 5%. It's got to be, quite a bit, mostly on the downside, of course, but sometimes you get that counter kind of move as well. Dinesh Balachandran is head of investments at SBI Funds Management. Dinesh, good afternoon. Great to have you with us here on the program. Prashant this side. Dinesh, of course, runs a fairly large amount of portfolio, including the Flexi Cap fund at SBI AMC. Dinesh, you've been fairly cautious on at least over the last 1 year on valuations, etc. I think post this correction, and now, we got a correction, we got a rebound, and now perhaps we're going down once again. So kind of tough to place where we are at. But how are things looking, Dinesh, to your mind, broadly? Valuations-wise, would you want to be constructive here, or are you still cautious?
Yeah. First of all, good afternoon, Prashant, and thanks for having me over. Now, when we think about markets, we have a framework that helps us think about asset allocation, and that helps us think about overall market outlook. On that framework, if you go back 18 months, we had this very sort of peculiar problem where you had a combination of the valuations, sentiment, and earnings outlook, all sort of throwing out red flags. Valuations, we were at 90 percentile plus, depending on the exact measure that you use. On the sentiment part, let's assume if you have an index that ranges from -1 to +1, we were at 0.79 or 0.8, close to the higher end of the range. And even from a near-term earnings outlook perspective, it felt like there was more scope for downgrades rather than upgrades. So that inherently made us quite cautious about markets. Now, if I then take it forward 18 months and then think about where markets are right now, the good news is definitely a lot of the valuation froth has gone away from the market, right? So if let's assume valuations were at 90 percentile plus back then, now it is somewhere in the 50 percentile range, depending again on the exact framework that you use. Even on the sentiment side, if we were at the very high end of the range, right now it looks like you're in the middle part of the range. So on a -1 to +1 scale, you're somewhere close to 0, right? So these are good things. But the question really is, are we at the lower end of the range? I've seen people make these comparisons with the COVID environment and talk about how this is a similar opportunity. At least for us, that's not the case. It definitely has become better, and we definitely are more constructive than we were. But are there sort of mouth-watering opportunities where you're getting really excited? Maybe at an individual stock level, but by and large, it's not so attractive yet. That is our objective assessment at this point.
Got that. Dinesh, I was looking at the Flexi fund, and I think you also run the Contra fund, right? At the AMC. So just talk to us a little bit about where are the opportunities. You're overweight financial services. You like, the portfolio shows oil and gas, and energy as a space is something you. These are, I guess, the top two, areas where you have holdings. So just talk to us about opportunities. Which pockets here in these two?
Yeah. So when you think about it, the oil and gas space is kind of interesting because when you think about it from a top-down perspective, there are certain themes that we are at this point inherently attracted towards. One, we actually think about it as bookends of the spectrum because they really reside at opposite ends of the spectrum. On one side, we really like the new age platform companies because these are companies that inherently are disrupting a lot of the existing businesses or creating new markets. And here, when you think about it, these kind of businesses or these kind of spaces, inherently the winner takes it all kind of aspect comes into play, right? So those kind of companies are inherently attracted to us. So that's essentially one end of the spectrum. At the opposite end of the spectrum, we like companies that have good hard assets. So when you think about a lot of the companies in the oil and gas space, when you think about, in general, the commodity companies, these are companies that are, in some sense, diagonally opposite to the new age companies. But they're also equally interesting because, again, when you think about it from a competitive intensity perspective, these are areas where it's very difficult for a new company to make an entry. The gestation period involved in creating these kind of hard assets is quite high, right? So that means that inherent pricing power is going to be there for these companies. So that is another reason why we like companies in the oil and gas space. Yes, the Middle East turmoil has created both headwinds and tailwinds, depending on which oil and gas company you're talking about. But if you think of them as a basket inherently, these are definitely sort of interesting companies to us from an investing perspective.
Do you, just to sort of close that loop, even oil, upstream companies like ONGC, etc., Dinesh?
Yes, we obviously do not talk about specific companies, but yeah, when you think about both upstream as well as the gas-related companies, these are definitely companies of interest to us.
You know, you don't manage that fund, Dinesh, but you have there's a SBI energy-focused fund as well. Would it make sense for viewers who are watching this to kind of sort of take a look at that, more thematic if you want specific exposure at this point in time?
Yeah, as long as people realize that thematic funds inherently carry a higher risk profile, and so people have to be prepared for that. But assuming they understand the risks associated with thematic investing, this is an area that definitely looks interesting, at least from my perspective.
All right, Dinesh, hi, good afternoon, good to see you, Ben. Interesting times with regard to hard assets. The ignored old economy, no one was interested in metals, and suddenly lot changed in the globe. Supply side constraints came in, and the hope is that demand destruction will not be that great. That's one of the contra ideas, right? Metals and mining. Throw some color on that. And what do you like within the space? Is it the ferrous, non-ferrous, or is it the miners?
Yeah, I think when you think about it, like you actually try to think about different decades in terms of what themes have dominated. When I think about last decade, there was one overriding factor that essentially governed almost all the assets, which was essentially disinflation or lack of inflation, right? That was the reason why you saw interest rates eventually go down to almost negative levels. That was the reason why like certain sectors did really well. But guess what? In macro, the way it works is the pendulum, it swings to one end of the spectrum and then it starts swinging to the other side of the spectrum. So if hard assets were completely ignored last decade, because no one thought that inflation is of any concern, and no one wanted to have anything to do with these old economy sort of sectors. Now, because of that, these guys have pricing power. So now, at the merest sort of mention of any supply disruption, you immediately start seeing prices go up. Why? Because any new project in the mining space, it is going to take a long time. And so there is actually inherent supply tightness in a lot of these areas. And so when you think about many of the mining companies, they inherently have good pricing power at this point. So that's definitely a positive thing, right? And the nice part, again, as I said, is these cycles tend to sort of go on for years. You don't measure these cycles in months and quarters. It definitely is a much longer cycle. And that is why we inherently like this space. Now, within that, be it a miner, be it a ferrous company or non-ferrous company, some of it boils down to valuation versus growth. What I would like to say is that across that entire space, there are interesting companies. We want to own companies across the entire space. So be it a miner, be it a converter, they are all of interest to us.
Yeah, in the Contra fund, the name says you've got to be Contra. So obviously you won't be Contra for the sake of being Contra. You have exposure to IT services. I think the fact sheet that I have shows IT services is about 7.5%, right, of the AUM. So just talk to us about this. I mean, this is clearly one area where the debate rages on, but stocks have taken a fair bit of beating now.
Yeah. So in the Contra fund, a significant part of our IT holdings are actually overseas IT services stocks, where those companies are actually trading at a much more attractive valuation than the Indian IT peers. And that was the reason why we wanted to go down that particular path. Now, when I think about the IT space, it's funny, like almost every day we have internal deliberations on this topic. On one hand, you can essentially talk about the fact that these are good cash flow generating machines, where when you look at the quality profile, it's quite high. And then when you also look at them on a relative valuation basis, they definitely stand out. So these are definitely positive attributes in favor of these companies, right? But on the other hand, the problem with something like AI is it's very hard to put, it's very hard to get a proper grip on it. you can essentially easily imagine a scenario where it is going to disrupt these companies big time. But then when you take that kind of argument and think about the logical extension of that, then why stop at IT services? Why not go down to the second order effect? Talk about what this means for consumption. Talk about what this means for companies in other sectors as well, right? What is funny is it feels like most of the argument right now is centered around IT services. But if you really want to talk about AI-based disruption, then we really have to have a much more comprehensive argument. And then a lot more companies essentially become part of the vulnerable list, right? So then that is a different type of argument. So for me, the way I think about it, did we or do we want to be significantly overweight IT? The answer was no back then. The answer is no even now. But when I think about it from a relative perspective, particularly when I look at the overseas companies that we have, they are essentially trading at no growth multiples.
You have Cognizant, you have EPAM, right? Yeah. These are some of the names. But they've all also been taken, okay, you're saying they're still cheaper compared to...
cheaper. I mean, like they're trading literally at no growth multiples. So there, for us, it feels like that is a bet I would always like to take, essentially.
Okay, and the other thing, of course, is, this argument about IT, why not extend it and why not take it further, one step further. Maybe we'll, come back on the show, Dinesh, and we can try and run that thought experiment with where this shows up in a bigger way. With, I guess what you're talking about is, it still employs, it's still relatively better paying jobs, and if all of that were to change, where does this show up in terms of consumption, etc.? So we'll do that. Thank you very much for now. Appreciate your time here on CNBC TV 18, and good speaking to you. Shriram Finance numbers are flashing, and they seem like very strong numbers. Although these are year-on-year numbers, we should look at what the poll said. 21% growth in net interest income, and the profit number was also flashing, and that will be up there as well. There's a 6 rupee per share dividend. Stock's gone south, and that's the reason why I'm saying we should look at what the expectation was, because on a actual basis, the numbers seem 20-40% growth, absolutely strong at this stage. Well, what are the trends in the F&O space? Nigel has been looking that up. Nigel, take it away.
Well, just one quick word on Shriram Finance. It appears the market itself has dipped a little bit, and there is lack of buying. So I think it's could be a market-related problem as well, because we bounced a little bit, but from the top, actually, we sold off very quickly, 60-70 points on the Nifty itself. Moving to the Nifty, the reason we are under pressure today is because the IT index, that's been, the one that's dragging the markets on the whole, and that's underperformed, 5.5%. Remember, it made a very swift move from around 29,000 to around 31,500, and from there, slam dunk. Now, looking at the Nifty, I'm looking at the options data, and the PCR has come down to around 0.77. A few sessions ago, it was at around 1.2. It's come down drastically because the call writers, they believe they're in the game. So the 24,000 call, the premium is down to 140 rupees from around 280 rupees. The 24,100 call as well, the premium is down to around 100 rupees from around 221 rupees. While, there is some signs of writing even at the 23,900 put, because the premium now has spiked to more than 150 rupees. So mix of activity is what we're seeing out there, which tells you, in the near term, the Nifty wants to defend the lower levels. So that 23,500 mark is extremely important. And the 23,300, which is incidentally when the 20 DMA comes in, to around 23,500 is very important on the Nifty itself. Moving to individual stocks, NNBC and SAIL, both of them are seeing a good amount of fresh buying in today's trading session. So keep an eye on both those two names. They're moving with good strength in a market that's wobbly. Some mild shorts getting into Reliance Industries, but I think that's going to be the stock of the morning on Monday. That's seen a good amount of selling, and in today's trading session, there are actually shorts that are creeping in there, so I'll keep an eye on that one. While Piramal Pharma, the stock that very often has shown signs that it wants to move up, but this time as well, it's corrected big time from the top. For the time being, appears there's a bit of a short covering bounce playing out on Piramal Pharma. And as we do that F&O check, just take a look at what happened to Shriram Finance. Very quickly, a 25-point uptake is what we're seeing on Shriram Finance. The intraday chart will tell you the picture. The market sentiment is a little bit weakish. The stock sold off. It was down close to 2.5%, and a sharp spike is what you're seeing. Asset quality more or less maintained. NII growth of more than 20%. The gross NPA is no change out there, 4.5%. And as we know, trades at a bit of a discount in comparison to some of its peers. So for the time being, that stock has seen a good bounce. Low of the day, 980 rupees a few minutes ago. That's now at around 1,011 rupees. But that said, let's go across to our favorite segment, D-Street Chatter. Nimesh joins us to tell us what is he picking up. Nimesh.
Hi, Nigel. So down day for the markets, largely dragged by IT, but also there are fresh concerns now with regards to the macro, macro indicators as well. So crude is back to 107 rupees, above 94.3. So those are also adding to the sentiment in terms of negative sentiment. Also to add to it, it's a weekend as well, so there is a bit of weekend pressure as well. All put together, the IT index is down 5%. That's been the big drag. But even in the broader markets, you've seen a bit of profit booking in today's market. In fact, at least on the Nifty and in the F&O names, there is a bit of a recovery as well in many of those names led by Adani Group stocks. But in the broader markets, you've seen some bit of profit booking today. From a flow perspective, I still feel, again, today would be a sell day. The FIs are net sellers in the cash market, and to some extent, the large part of the selling is in the IT names as well. So clearly, IT is under pressure on back of aggressive selling as well from large institutions. I've been pointing out for the last couple of days, even when the markets were trading higher, that on the upside, 24,300, 400 is a level to watch. That's a big resistance zones. So, and that's played out, right? From there, we've seen a good 600, 700 points correction. So on the upside, that will be the level to watch because that's a big resistance. But again, the sense is that today's fall is a bit of selling as well from larger FIs, largely into the IT names.
Gather Nimish, what's on your list of stocks?
So again, Prashant, power as a theme plays out even in today's market. Two stocks that stands out today, Adani Power and Suzlon. Both are going to see very aggressive delivery-based buying from the larger FI. So that interest towards the power themes continue from larger institutions. So that's the first couple of set of stocks. Second name is Infosys. Infosys stands out for me today because that is the only name where there is aggressive selling from the FIs in today's markets. So expect very high delivery volumes on the sell side. And to me, it looks like some larger institutions, both FIs and DIs, have dumped the stock in today's market. So that's the reason why it's down 6%. The third name is Urban Company. Well, the stock has been consolidating in a narrow range of late, but at least from a flow perspective, I understand some large HNI investors are accumulating Urban Company at current level. So that's the buzz there. And the last name is Persistent. Again, part of the IT name, part of the IT pack is under pressure. But for Persistent, watch out for a large block as well, which can come very soon. The sense is that maybe one of the large domestic fund who has a large holder there, they might sell a large block in Persistent. So apart from overall selling in IT, Persistent is down also because of that overhang of a large block coming very soon.
All right, thanks a lot for that. Namesh, the stock of the last few minutes has to be Shriram Finance, now up close to around 1%. 0.5% actually in a wobbly market, but from the lows of the day, it's up close to around 4%. So sharp uptick is what we're seeing out there. From the frontline names, from the stocks in the broader markets, Delta Corp actually has come in for a fresh bout of selling. That stock is now down close to around 7%. So keep an eye out on that one as well. Slip into a short break, come back, we'll get you some technical trades. Stay tuned.
Welcome back. Well, let's welcome Nagaraj Shetty back on the show. Nagaraj, the markets are still a little bit down, but as you said, we have firm support at lower levels. Individual trades, if you could help us out with, and also we're having a very volatile move on Shriram Finance. Any levels on that stock?
Yeah, nothing has changed in the Nifty over the last half an hour. Market attempted to bounce back, failed to sustain at the high levels, again coming down. For the stocks, I have two stocks which continue to come down. Actually, in fact, KPIT from the IT front, which is the underperforming sector. And after a minor bounce, the stock has broken down below the consolidation and slightly bounced back from the lower level, but looking very good for the candidate for shorting opportunity. I think I'm expecting continue with a short opportunity idea for this for the lower target of around 660 levels. And on the long side, PPL Pharma has showed some resilience during this week. Broader markets, worst seems to be over and placed at the higher levels. And next one, what you discussed about the stocks, which one the stocks you discussed about? Nigel?
Shriram Finance, sir. Shriram Finance had a very, very volatile move because of its results. Just wanted to ask you if you have any levels that you're tracking out there. The low of today is around 980 bucks, currently at 1,020. Please go ahead.
Yes, it has bounced back very well from the lower levels after showing a range-bound action. The strength remains intact for the Shriram Finance. I'm not expecting any bigger decline from here onwards. Today's false downside breakout indicating there is a possibility of a bounce from the lower levels. It has taken from the lower levels. And 1,060 to 1,065 is going to be the next hurdles to be watched in the next, at least by 1 week.
I mean, I think we'll see if this is the final move after all that confusion, down, then up, and then down again. And now, of course, it's up about 1%. Nagaraj, thanks very much for that. So those are some specific trading ideas and thoughts on the market indices. 14 minutes to go for close. Ensar tech numbers are flashing. Revenues are up 1.5% on a quarter-on-quarter basis. And I think we had a profit number coming up as well at this point. Well, we've had, JP Morgan trimming their view on India equities at a strategy level from, I think they're back down to, from overweight. They've cut that position now. Hormuz is here with essentially reasoning. Hormuz, take it away.
The downgrades are just not stopping for the Indian equities, and this one comes just a day after HSBC also made its second downgrade of India in less than a month. But talking of JP Morgan, they have downgraded the rating to neutral from their rating of overweight earlier. And as per all scenarios, the Nifty targets have been cut as well. The base case target that was earlier 30,000 has now been cut to 27. The base case target has now become the bull case target at 30,000, which was earlier used to be 33,000, and the bear case target from 24,000 has been slashed to 2,500. JP Morgan has cited multiple factors as the rationale behind the downgrade. The valuation gap is the first one. They're saying that yes, it is narrowing, but it is still stretched, and that Korea, Brazil, China, the other peers are offering cheaper entry points for growth that is similar or maybe even better compared to India. They're highlighting this valuation differential as well. The India premium to the MSCI EM index, which at its peak used to be 109%, has come down to 65, but it is still at stretched levels. The other big factor is the earnings risk. Now, JP Morgan sector analysts have cut their FY27 estimates by 2 to 10% across sectors, and as a result, it has cut its MSCI India EPS growth forecast for calendar year 2026 and 2027 by 2 percentage points and 1 percentage point each for these 2 years. The other major one is the flows picture. Now, FIIs since the start of 2025 have sold a whopping $37 billion. That has been offset by more than $120 billion worth of inflows that have come in from the domestic investors. But there is a big dilution risk that is still lined up in the form of IPOs, QIPs of $64 billion is the figure that JP Morgan is highlighting here. And it is this large dilution that continues to cap any potential upside that Indian markets could see. And this is in stark contrast to the US, where the buybacks that the companies do continues to persistently retire equity, is what JP Morgan said in its note. The other disadvantage that JP Morgan has highlighted is the lack of exposure to AI, where they say that the large cap index in India has minimal exposure that represents AI, data centers and semiconductors, and that is in stark contrast to countries like the US, Korea, China and Taiwan that have far larger representations going forward. And the upcoming risk to the market is the subpar monsoon forecast that the IMD has said. They are pegging the LPA at 92%, and this subpar monsoon could threaten rural incomes and food inflation as well. And therefore, based on all of this, JP Morgan says that they continue to see opportunities elsewhere until valuations derate further and earnings visibility in India improves. So another downgrade coming in, another target cut for the Nifty. There are multiple risks that lie ahead as per what JP Morgan is saying.
All right, thanks a lot for that, Harmaz. Anant Tandon joins us on the show. Hi, Anant. Good to see you, Ben. How are you feeling about the Indian markets? We had a good relief rally, and these downgrades don't stop, but sometimes may not be such a bad omen, right? As per what history suggests. You had turned relatively more positive, I think, in the last few days in comparison to what you were a few months ago. Your take right now?
Yeah, well, like I told you in the last week, I think the problem is that the market has moved up so quickly upwards that it has pretty much exhausted whatever steam there was. And given the fact that the earnings continue to overshadow in terms of, the analysts have yet to cut, but I think the market realizes there will be earnings cut this year as well. So if you look at any of the sectors that are doing well globally, essentially there are only four plays in the market. It's AI, it's defense, it is commodities, and it is energy. And we have nothing among those four in a meaningful way.
That's going hard at it, Anand, this afternoon. Huh? It's a Friday. Take it easy.
Well, we have defense, where we use screwdrivers because we don't make engines, we don't make any of the complex electronics. Maybe in missiles we are able to fire a few, but otherwise there isn't much to talk about, especially in things which can move on their own other than missiles. AI, we just simply don't exist. And in AI, everything else, whether it is power, which is then driving commodities, we have nothing to show for it. So, you want to play commodities, buy Brazil. You want to play semiconductors, buy Taiwan or Korea. What are you looking at India for? Maybe, the fact that we will have a census which will be looking at cost.
That's pretty depressing, Anand. थोड़ा तो time की बात होती है. So, it's a fad. It's passing fad. It'll pass. And, you'll... It's just one of those times. Although I must say, on defense, there is, there's a fair bit of indigenization, etc. happening. So it's not as if nothing is happening across the board. All three, in aerospace, a fair bit of indigenization is happening. We had a company called Aequs this morning here. They are some of the largest suppliers to both Airbus and Boeing on the civilian side. Defense side, sure, no engine making, but very few countries in the world make aircraft engines.
Prashant, it's not only engines. It is pretty much so, you have 200 companies which claim to make drones. Show me one which is able to drop a 1 ton payload anywhere or a half a ton payload anywhere. We are looking at drones which can carry one camera, which can carry 10 kgs of stuff. These are not serious drones. Nothing much is going to happen there with this kind of stuff. You are still looking to import or manufacture from overseas. We simply do not have deep technology across the board. We have one company which is trying to make, for example, technology for reusable rockets. It takes them 6 months to get time from ISRO to be able to test the damn engine. And as a consequence, they make their own engine testing thing, which is a lab scale project. If you're serious about trying to make, for example, reusable engines, you should have at least top 10 institutions in this country which should be having that funded by the government. It doesn't take more than 2-3 crores to build one of those test sites, instead of which we have one in ISRO and one in a private company. You think they're serious about this?
Fair enough. It takes all kinds of views to make the market. I'm just thinking, with the stock market gets blamed nowadays quite regularly, saying, everyone is, there's too much financialization, everybody's focused on making a quick buck and this and that, so there's no real attention on R&D innovation. Maybe look at it the other way. With so much lamenting and complaining and hand-wringing and anxiety, maybe this will help focus the mind that we don't have, as you said, right? 3 industries, maybe we're lagging. So, you know, this is going to push attention to, it works both ways, right? It's a feedback loop.
Yes, but you know, you need to have some vision to be able to invest. Frankly, if you look at what Infosys has, you know, as somebody's put out on a tweet, you know, Vishal Sikka must be laughing somewhere that we are now talking about integrating with OpenAI to make some kind of a, app which will work for consumers so that they can get their IVR sorted out. Then you could be owning a large chunk of that company, but you decided, no, that was too risky, despite the fact that you...
No, I have to correct you, Anand. That is not true. It's a commonly held, widely held. I also thought so, but it's not true. It was a donation. There was a donation which was made in a non-for-profit kind of capacity, and I think that donation was made. So it was not, they would not have ended up owning a large part of OpenAI, as the narrative goes. I mean, so it becomes a kind of an easy punching bag, but that is not true. I can tell you that. Yeah.
Okay, I haven't tested it out in detail because at that time, OpenAI was, for example, an NGO, right? For example, for all it was a not-for-profit. And the fact that at the same time, Microsoft had been putting in money and so had others, which continue to hold some kind of stake now. So I don't know the complications of how that worked. I'm just saying that you had an opportunity to be partnering with some of these companies then, and you just didn't have the vision to do it.
All right,
and even
just
today,
very
we
quickly,
offer an apology saying that we'll wait for prices to come down. And the only thing that we have developed internally after 1,000 crores of government spend is a translating company which can translate into 10 languages.
All right, just hold on to that thought, Anand. We need to take a break. Just want to pull up one stock, IRM Energy. I'm not sure what's gone on there, but the stock was down 3-4%. It's now up close to 3%. There's a big swing that's taken place on that particular name. I think we should pull that up. And Chennai Petro as well, the stock was down sharply. It's cut some of its losses. It's still down close to 100%, as is the case with MRPL. CPCL came out with its numbers and slam dunk we saw sell on news, but that's bounced up a little bit. Take a short break, come back, we'll wind down the markets.
Okay, well, I think we are just sort of wrapping up things here. Anand is still with us. Anand, thank you very much for joining us. Good speaking with you. And Anand is in a up and up mood, up for a debate discussion. I wish we could have sort of gone on, but out of time. Anand, come back and we'll continue. Thank you very much. 23,900 on the Nifty. I think we're down about 1.8% for the week. The Bank Nifty is down a little bit. The mid-cap index is down about 1%. The small-cap index is the one which I think is held out. It's down, but down barely so. I think about 0.05%, 0.1% or so on the Nifty small-cap index. That is Friday to Friday. And of course, I mean, I think the start of the week was pretty good. And towards the end, that is Wednesday, Thursday and Friday. But Thursday and Friday, more specifically, we started to lose steam quite rapidly. I think the Nifty IT index, is the pain point in that sense once again. 5% lower, just today. And I think for the week, perhaps down even more. Infi, was the top loser out there, but HCLTech and TCS and Coforge and Persistent and Tech Mahindra, LTM, so many IT services companies coming in for some selling pressure. That's a big story. I mean, actually, we came in this Friday morning with a double whammy. Oil, which was $4 higher than where it was 24 hours back, so about $106 odd. And number two, of course, was a sell-off in software companies overnight in Wall Street. So it was not going to be a good session. There was an initial bit of positivity in the first 1 hour of trade, but I think that quickly gave through to some selling, which came through, and the market finally ending around 23,900, which I think is where some supports come in as well. So almost exactly at 23,900 is where the final close this Friday is at. It's a wrap on this edition of Closing Bell. Thank you very much for staying with us. Editors Roundtable will pick up on the action in just a bit.
The Wall Street gives up last week's gain. Both the Nifty and the Sensex fall around 2% each. 4 of the top 5 Nifty losers are IT names. The IT index stumbled 10% this week after weak Q4 numbers across the board. Broader markets, however, hold up a tad bit better than the blue chips. So in this week's edition of Editor's Roundtable, we'll take stock of the fall in IT names. We spotlight the pharmaceutical sector and we decode the Vedanta demerger. I'm Reema Tendulkar. With me are Nimesh, Nigel and Ekta. And here with us in the studio is Sanjay Parekh, founder CIO of Soham Asset Managers. Hi guys, a bloodbath for the IT names, a weak week, 2% down for the benchmark indices, and 2 key reasons, right? The rise in crude prices and then the software sell-off.
But you know, Rima, this 2% fall this week need to put in the context that we rallied from the lows almost 2,200 points on the Nifty and we've given up 800 points. So in that context, I guess it's par for the course. It was expected. And you know, again, the macros are turning a bit challenging, right? The crude is back to 107, rupees at 94.4, almost 94.5. So there can't be a runway rally for sure. And actually, even the earnings have been a bit disappointing. And I'm sure you're going to highlight on IT. But in general, you know, that's a big challenge that the macros have turned a bit negative, and we've rallied hard. So it's just like far for the course. But yeah, it's going to be challenging. I don't think it's an easy runway for this market. And the earnings also are going to be quite important. And next week is going to be very heavy in terms of earnings. So yeah, I mean, we'll have to see how it goes. But I guess this week's the only good part is, even in this silver lining for me would be, while the Nifty is down 2%, the broader markets have actually outperformed and have done really well. A lot of the stocks have actually recovered 30-40% from the recent lows. So in that sense, while you know, Nifty is down 2%, there was enough momentum in the broader markets, is my sense.
Do you want to, Sanjay, talk to us about the markets? Crude now at 107.
Yeah, so crude, we are very sensitive on macro to crude. And I think you know, markets are behaving inversely. I mean, crude shoots up every dollar for 5 million barrel impacts us. So we certainly don't have great news ahead. Quarterly, fourth quarter is going to be okayish, like 8-9% as the estimates for the Nifty companies. And also now the first quarter also will get dampened because all the cost inflation issues will come in the first quarter. So news flow is not in our favor. Crude certainly is not in our favor. Balance of payment is getting weak. So I think markets, you know, will take time before, you know, it gets to a attractive zone. And I think it will consolidate and it could even fall. So if it's our client, we are telling our clients that slowly buy. But surely, you know, at the lows that we saw, it really gets attractive. And that is what at least we believe should be the case.
You know, Sanjay, I wanted to ask you, actually, when Nimesh said next week is going to be a busy week, but there is some silver lining. I thought he was going to talk about the holiday. It's a truncated week. So we have a long weekend next week. But
next week is a long weekend.
A nice long weekend.
Oh, yeah. Right.
But let's
Friday's holiday.
Wow. All right. So, Sanjay, you know, the headline index, we were all talking about that correction, right, from 26,000 all the way to around 22,000. The problem is that in the broader market, stocks didn't fall 10%, 15, 20%. Stocks fell 30, 40, 50% as well. And now in the last, you know, 45 days or so, you're seeing a lot of interest in the broader markets. On days when the Nifty is down, actually, you have the broader markets, the advanced decline ratio is more or less in line. And I'll give you one more data point that after 5 months, for the month of April, the number of stocks advancing on the NSE are more than the number of stocks declining. Do you expect that the broader markets will outperform from here on?
Yeah, it's going to be case specific. So in our portfolios also, you know, one of the company, when the markets were going down, it shot of 50-60%. You know, even one of the housing finance companies.
You want to help us out with that company that went down?
Yeah, so we used to own Atlanta Electricals, which is a transformer company.
Okay.
And, you know, we booked profits. So, and after that, it shot up 10%. But some of them have shot up. Even we own India Shelter, which is a housing finance company. From the lows, it's up 30%. Or even Interarch.
I was
So each of them have 20-30% they have increased. So you're right, broader market has done well. But I think from here, we need to be case specific, whether there is valuation, it's at a deep value to larger caps. Right. That is more important from our point of view.
Correct. Sanjay, I know one stock which is a bit of a pain for you, And I guess nobody better than Rima to explain that. Rima, IT, bad week for IT and numbers as well?
Well, it's a 10% fall for the Nifty IT index. This is the worst weekly fall since March of 2020, which means you need to go back to the COVID fall when the index had fallen close to about 13.5%. And the Nifty, the IT stocks, the large caps, gave up nearly 3 lakh crore in market capitalization. Now, the problem is that FY27 is going to be the 4th year when IT companies see very low growth. FY24, 25, FY26 were all low growth years for the company, and the street sort of gives you the benefit of the doubt. Well, you've had 1 bad year, 2 bad years, 3 bad years, and FY27, like 6 months back, the street was anticipating a significant acceleration in growth in FY27. They're saying the worst is now behind. You've grown at 2-3%. The base is favorable. Next year, you're going to grow at 5, 6, 7% for the large cap IT company. Now you come and look at the guidance shared by the companies. HCLTech is at 1 to 4%. Infosys is at 1.5 to 3.5%. And you look at the organic numbers, it's basically telling you that FY27, there's no growth acceleration versus FY26. And this would be the 4th year, right? The benefit of the doubt which you give, you sort of start questioning it. And the couple of factors what have led to this weakness is, one is AI deflation. That is real. Maybe it's accelerating, which means that macro headwind doesn't go away. The second factor that has been hurting is, a lot of the enterprise tech budgets are now diverted away from application. They're diverted towards infrastructure, monetization, etc., cloud. Again, that headwind perhaps is not going away in the near term. And the third one is increasingly the frequency of client-specific issues, whether it's on account of tariff, whether it's on account of the trade war, something or the other. But the number of companies impacted, that it's just sort of become a norm, right? How we say for the markets, it's uncertainty and volatility has become the new norm. Every day you're hit by the headline. These companies, quarter after quarter, are getting impacted. And I think in April, when the markets rallied, IT stocks, the hope was that rupee depreciation will boost at least the EPS and the margin. So fine, your top line is growing at low, mid-single digits, but your EPS growth can be 10, 15, 20, 17, 20% for some. But this quarter, what it's basically showed you is that the margin benefit because of rupee was not so much. TCS said they got 110 basis points benefit because of currency, but the translation was only 10 basis points. And then companies like Persistent told us specifically, right, this is the time to build capability. If you don't build capability now, your growth will suffer. And growth is harder to come by. So the time now is not to focus on margins, but it's to focus on capability building and for margins. So it's just a confluence of so many factors. And I think, some people may have just thrown in the towel, right? Who is to say that we've seen the valuations come down from 20, 22 times to 17 times. Today, Bhavin Shah came and said, well, I expect another round of derating in IT names. So yeah, it's a very, very tough week,
You covered it absolutely well. I don't know how much value I can add. But I think absolutely bang on. The problem is outlook on growth because of the headwinds that she said in terms of the spend getting diverted or select clients, large clients issues of rundown and GCCs taking more share and there could be impact later on. And then you also, the Middle East, there was comment yesterday that even Middle East-led crisis is having some delay in decision making.
But Sanjay, normally in such markets, market price isn't right. I mean, Infosys on trailing basis are almost at 15 times now.
Right.
It's a profitable company. Dividend yield as well. 4-5% will be the dividend yield going forward, right?
Yeah,
for many of these companies.
5.3% dividend yield.
As a fund manager, you've been tracking this for so many years now in decades.
Yes.
How is the investor behavior like? I mean, is there time to buy or to throw in the towel?
No, I think, market loves growth. Yeah. And growth is missing very clearly. You see the last 3 years' growth. Yeah. It's not great.
Sure.
And market follows volume growth. Dollar revenue growth, which is led by volumes. Rupee depreciation-led advantages, market doesn't give them benefit. Right. So that past 3 years has been missing. Next 1 year outlook, they are telling you.
They are telling, yeah.
So I think and then Accenture is at 9 times globally. Here, so you can globally, investors don't have to come here.
Right.
So I think this could go on for a while. At least we don't want to do a bottom fishing for now.
Okay, but if you have holdings in any large cap, stay invested because it's fallen so much. I mean, what could be the downside?
Yeah, we own Infosys.
So
we've taken the brand and we're underweight. We were underweight for 4 years. But at this price, I would not want to sell Infosys.
Okay, all right. Let's turn our attention then from tech to pharma. Ekta's had a very busy week as well. Ekta, run us through all the news flow that we've got.
And no earnings. This is all non-earnings news.
No. In fact, I'm just going to talk about Sun Pharma, and the big bets that, Mr. Sanghvi has made in the past couple of years. And just to put it into context in terms of how big this Organon deal could be for Sun Pharma, if in case they do consider that. So I'll start with Taro, which is, a 17-year battle which went on for Sun Pharma. They injected $60 million in Taro in 2007. Then there was a lot of pull and push which took place. Eventually, they acquired that remaining stake in Taro for around $348 million in Jan 2024. Ranbaxy was that big deal, $4 billion. Ranbaxy, however, came with a lot of issues for Sun Pharma. It came with 4 sideline plants by the US FDA. Eventually, Sun had to settle an antitrust litigation for around $485 million. Eventually, in FY18, they did see that synergies come through, which were worth around $300 million. And if you look at Sun's acquisitions, they've been more focused and streamlined. So, for example, DUSA in 2012, for $230 million, they got a key drug from that, which was Levolin. Another key drug is what they acquired from Novartis, which is called Odomzo for cancer in FY17 for $175 million. Again, Ocular Tech, they acquired a key drug called Sequoia from there, and that was worth around $40 million, but it's gone on to become one of their most successful drugs within their specialty portfolio. Then they eventually acquired Concert Pharma in 2023 for $576 million, and they got a key drug for alopecia, which is Lexelvi, and then Checkpoint Therapeutics for $355 million, where they got another key drug. So what they're looking to do is basically build their specialty portfolio by making these acquisitions. And as you can see, the specialty portfolio, in fact, was up 20%. It's their key driver in terms of numbers. But Sun Pharma now looking at a $13 billion acquisition. That's what reports are indicating at this point. And, it might be something that could be too much that they're biting off. What do you think? Do you think that the stock could underperform on account of that?
Yeah, I mean, large acquisitions, at least global acquisitions by Indian players, we don't have a very good, track record. However, we respect Mr. Sanghvi a lot. His capital allocation decisions, some of it took time like Ranbaxy, but his vision, his execution, his capital allocation historically over a period of time has been great. But this one, at least we would also want to understand more, let the integration happen. Let us understand what is their rationale and then maybe look into it.
But in general, are you underweight, overweight or neutral on pharma names?
Yeah, so we own Emcure and Aurobindo. We are neutral, but we own both of them.
But I just want to also touch upon this whole CDMO opportunity which is playing out. So, while we've been talking about Dr. Reddy's and semaglutide, one source is up 20% this month. We have Shelley Engineering, which has rallied almost, over 400% in the past 5 years.
Yes.
These are the guys who just supply the product and they're like, you can do whatever you want with it.
Yes.
We've done our job. Is that a space to look at?
Yeah, I mean, we're looking at some of them, but they don't come cheap. Like, we really like Laurus. But, we always felt that at 60 times, where do we make our money? And we are GARP investors. So, absolutely amazing model. We think there'll be surprise on the upside in terms of earnings, and they could meaningfully surprise. But then, ultimately, even at those earnings at 60 times, we are uncomfortable.
Sanjay, in the power space, I know you spoke about Atlanta as one company which has done well. But as you said, you look for valuations and good deep value. In the power space, anything which looks attractive to you?
Yeah, I think overall as a segment we like. Okay. So we like JSW Energy, we own it. We have GMR Power, which we own it. And then we have Power Finance now that we recently bought. I think that will be a big beneficiary of all the lendings that they do.
Again, there is a special situation, right?
Yes.
I mean, the merger with REC and also.
Yeah, it's an amazing, actually, when you see the merged entity, it's 330 crore shares outstanding, will go to 430 broadly based on the swap ratio. And it would have 35,000 crore of consol profit. The net NPAs are at rural all-time low. They've done a very good job. And at the time we bought, it was 1,70,000 crore market cap. So, on 560 rupees of consol book value on 28, you're getting at 0.7, 0.8 times. So it's pretty reasonable.
Okay, all right. I'll tell you what, since you spoke about special situations, Sanjay, there's the big one that's going to play out in the coming week. So I'll tell you what, we'll slip into a short break and we'll focus full throttle on Vedanta. The question is, Will it unlock value or post its recent run is bulk of the value in the price? Stay tuned. Sanjay and myself are going to break that down for you. Welcome back. You're tuned into Editors Roundtable. And as promised, we are going to dissect Vedanta, the company, as well as, is there value still emerging? Or post the recent run, is bulk in the price? And the reason that we're talking about is, a few years ago when they announced this demerger, the stock was much lower. In the interim, they've given a big dividend. The market price as well is much higher. And now you'll not have one listed company. In the next 2 months or so, you'll have close to around 5 listed companies of Vedanta. And the record date is May 1st. To help us out whether or not there is value, well, Sanjay, you tell us, for the last couple of years, I've had you on the show numerous times, and you have been saying you're bullish on the company.
Yes.
However, once they announced the demerger date, we have seen some profit taking. From close to 800 rupees, the stock has come down to 720 rupees.
Right.
What will you attribute this to? Is it some technical reason? Is it routine profit taking? And do you believe in that sort of a backdrop? Is there still value left in the company?
Yeah, so rightly, some of it could be technical because a lot of funds may not be able to have all the 5 holdings eventually.
Okay.
There could be even passive selling from representation to BSE 100 if there is some funds backing if they want to sell off. So that may be there. Most important, I think, what I understand is the F&O, everything, all the outstanding will get closed.
Unwinding of long positions.
Which is around 4.5 crores. So it could be a technical reason.
Okay.
For this reaction, and at least we believe that it's a good opportunity to buy into it, and we would have obviously acted on it.
Okay, all right. So you'll be having in a short while from now, in the next couple of months, you'll have 1 listed company as well as 4 more will be joining it. Yeah. Next up, since you're saying that there is still some value and you will be looking at actioning it, and things could be a little bit, volatile in the near term. Let's break down in all the businesses and see where the value is. So I think we'll just pull up the breakdown of Nuvama. They have given value to Vedanta, which will be holding Hindustan Zinc, and the aluminium business as well. Let's focus on Vedanta, because that's the one that's going to be listing first. As per Nuvama's note, they are giving it a value of around 290 rupees approximately. Bulk of this value comes in from the 60% holding in Hindustan Zinc.
Right.
So tell us, when this one lists, we'll only be having Vedanta from 30th of April onwards. What kind of price do you expect it to list at, going by the value that it has in Hindustan Zinc?
Yeah, so, broadly, our assessment is, if you take even the quarter of HZL that has come just now, it's around 28,000 crore of EBITDA annualized. And here they have hedged silver at much lower price.
Correct.
And we're taking silver at more like $65 or so, zinc at $3,000. And yet, we think the attributable EBITDA for the 60% should be around 17,500, 18,000 crores. And then you have Zinc International, which will have another 2,000 crores. So on that, while HZL is listed at 11 times, you list this at 8 times. And there'll be some cash in the company. The net attributable value, according to us, is more like 380 rupees. For the standalone HZL, which will continue to get listed.
And you're valuing both HZL and international business on FY28 numbers?
Yes.
All right. So you're saying that when we have that company that's listed, in the coming week, it should list at approximately 350 to 380 rupees as per your estimates?
Yes.
All right. So we've got one of those elements out of the way. And the other way of doing it is, attribute the value and give a holding company discount. But as you're saying, 350 rupees for that.
Right.
Now, the other point we're looking at is the aluminium business, which is the real juicy part of the business. And if you look at it, as a percentage of the target prices, aluminium business constitutes bulk of it. My question to you, Sanjay, is the street underestimating the value of the aluminium business? The reason I ask you is because they have got volume growth. There's going to be a 3 million ton plant. On the cost side, they're talking about it coming down by a couple of $100 per ton. And, also, if you see, they're going to be backward integrated as well. So is the street underestimating the aluminium business? Go ahead.
Yeah, I think absolutely. We've seen past demergers. You'd see Tata Motors combine, and then when they got split, they focus companies, they will attract new investors. And it's an amazingly efficient company.
Right.
Aluminum is going to slowly expand. Alumina integration is going to get through. The integration of power and coal will benefit. And even if we take $3,000, our EBITDA is $30,000. The EBITDA is 30,000 crores. It should ideally be more like in sync with Hindalco. But even if we take 6.5 times, even if it's 2 lakh crore, you take 45,000 crore of debt, yet the value should be around, because 45,000 crore of debt should reside of the total debt in this company. And yet we get a value more like, again, around 390, 400. If it gets valued at 7.5 times, or if I take the current prices, is a significant upside to that.
So you're saying the aluminium business itself should be around 400 rupees per share. So 400 rupees plus you're talking about around 350 rupees of Vedanta Limited.
Yeah, more like 370 for the HZL.
370 plus around 400 rupees. We're already at around 770 rupees for a stock that's today valued at around 720 rupees. And the reason, Sanjay is telling us that is if you just pull up some charts with regard to aluminium, the capacity is going to be moving up on the aluminium side of the business. The cost of production for aluminium itself will be coming down. I think we should get some of that up for our viewers on the screen. The cost as well as the capacity that will come on stream. So, their capacity is going to be around 3 million tons. And Nalco, which is 500,000 ton of aluminium capacity, they are getting a valuation of more than 7 times as of now. And Hindalco as well as more than 7 times. So do you think the street may go ahead and, extend the long rope and instead of 6.5 times, give it 7 times? In that case, if I put the aluminium piece and Vedanta Limited together, it will be close to 800 rupees. Would that be fair?
Very, very likely. So I agree to these numbers when they give a value of 450 to 490. So we are just being conservative. But if market would do that, and does happen, if it moves to 7 to 7.5 times, then this 450, 480 rupees is a very possible scenario.
Okay. So, one is the upside with regard to the aluminium business, the multiple, and the absolute EBITDA number that the street is working with for Balco as well as the core aluminium business is close to 32,000 crores, which there could be an upside because the spot aluminium prices are $3,500 per ton.
while the street is assuming close to around $3,000 per ton.
Yeah.
Let's focus on the smaller parts of the business. Let's get the steel, the oil and gas business as well that should come, and the power business.
Yes.
Put this together, the street is working with close to around 100 rupees.
Yeah.
So effectively, if you buy Vedanta Limited, and there's no big change in terms of prices, and there's no big shocker that comes about, you're basically possibly getting the steel business, the power business, as well as the oil and gas business virtually free.
Yeah, I mean, absolutely right. And I think here also they'll be surprised. In a sense, power, they'll effectively have a 5,000 megawatts.
Yeah.
Today, analysts have broadly taken 2,200 crore of EBITDA.
Yeah.
This, I think, can move up to more like 3,500 crore of EBITDA.
Yeah.
Now, with 3,500 crore EBITDA, today you see the power companies, and these are all thermal capacities.
Right.
Very, very efficient thermal capacities.
Yeah.
If they are valued at more like 10 times, 10 times, then you take a value, there could be an upside to the power, more like 60 rupees or so.
Okay.
Vedanta Oil and Gas, again, there's a profit-sharing contract, so you don't get valuation of 7-8 times. It's more like 4 to 5 times.
Okay.
But that is at a crude which everyone has taken more like 60, 65, 70.
Which is currently $90, $100.
Yeah, so there is an advantageous gains they will get. We can't extrapolate to the entire life of the, of the plant, but there is still an advantageous gains. So I think there also, there could be a little bit of upside.
Okay.
And steel is something which I think you just take a replacement value, keep it with you.
Yeah.
Someday, if there's a expansion or so, it could turn out to be another big one.
Okay.
So I think for now, this is how we look at all the businesses.
All right, Sanjay, it's been a pleasure having you on the show. Thanks a lot for breaking this down for us. So that's the big call with regard to Vedanta. Sanjay says that currently the profit taking that we're seeing on the company is because of, the technical factor that's playing out. He believes there is still value, and effectively you could see that all these 5 companies, when they get listed, in fact, it could possibly be more than what the current market price is. But Sanjay, you've been on it for all this time. So congratulations first on that call from 300, 350 rupees all the way till around the 700 mark.
Oh, thank you very much.
Okay.
This was an absolute masterclass. Thank you, both of you, for taking us through that. Very informative and comprehensive.
So the two best guys who can get on metals and Vedanta were there on the wall. So it was brilliant.
Let's all go for drinks after this.
On you, I guess.
Yeah.
Perfect.
Well, with that, it's curtains down on Editor's Roundtable. I hope you enjoyed. Stay tuned to CNBC TV 18 for more news and updates.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening.
Don't rush me, Jeff. Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years.
President Trump says he is in no rush for a deal with Iran as the stalemate continues, gives orders to shoot and kill any Iranian boats placing sea mines in the Hormuz Strait. Tehran says talks will not resume until Washington lifts the blockade on Iranian ports. Crude oil prices continue to rise as the Strait of Hormuz remains choked. Brent crude breaches $105 a barrel. The 3-week extension of the ceasefire in Lebanon does little to stem the rising prices. Sharp sell-off on Dalal Street. The Nifty drops below 24,000 as all sectoral indices close in the red. The Sensex is down 2% this week. The IT index down 10% after earnings from all major companies disappoint. A day after meeting bankers on the Claude Mythos AI model, Finance Minister Nirmala Sitharaman calls it a new challenge, adds that the IT ministry is actively engaging in preparedness. The new Mythos AI model could be used as a cyber weapon if it falls into the wrong hands. Vodafone Idea CEO is expecting the government to complete the reassessment of AGR dues. This follows a Supreme Court order last year allowing the government to reassess the dues, which currently stand frozen at more than 87,000 crore rupees. The Indian trade delegation returns from Washington after 3 days of negotiations. Sources say the talks touch multiple areas, including non-tariff measures, market access, barriers to trade, among others. Both sides agree to remain engaged. President Trump faces a backlash over a social media post calling India and China hellholes. India's External Affairs Ministry calls the comments uninformed and inappropriate. Indian origin lawmakers in the US termed the comment offensive and racist. Big tech companies continue to prune their workforce and rising investments in artificial intelligence. Facebook's parent company Meta announces a 10% cut in its workforce, which will impact about 8,000 employees. Microsoft offers voluntary buyouts to 7% of its US workforce. Authorities seize 400 kgs of fake ghee in Gujarat and 3,000 kgs of contaminated tea powder from Hyderabad. Counterfeit goods are now a national challenge as adulterated food and spurious medicines are being seized across the country in just the last few months. Well, let's go straight to the top story this evening. President Trump continues to contradict himself on the timeline for a possible deal with Iran. Uncertainty continues on the possibility of talks resuming. Now, let's break up what the latest developments are. The president has insisted that he's in no hurry to make a deal with Iran. When asked by reporters how long he was willing to wait, he told them not to rush him. Trump added that other wars took several years, while this one has lasted just 6 weeks. In a post on social media, Trump said that Iran doesn't have time, but he has all the time in the world to make a deal. He added, and I quote, "I want to make a best deal. I could make a deal right now," end of quote. This comes after weeks of Trump insisting that a great deal is likely soon. Trump continued to assert that Iran's leadership has split into two factions. He said, and I quote, "We've been speaking to Iran, but don't even know who's leading the country," end of quote. Now, in response, various Iranian leaders took to social media to present a unified front. The Speaker of Parliament, the President, the head of the judiciary, and the accounts affiliated with the IRGC all said that the political establishment and the military are united. Iran's president said that there was no official hardliners or moderates in the country. Back in Washington, officials from Lebanon and Israel agreed to extend the ceasefire by 3 weeks. However, there was no consensus on Israel's invasion in southern Lebanon. Trump said that the U.S. would work with Lebanon to help it protect itself from Hezbollah. Israeli Defense Forces and militant group Hezbollah have already accused each other of violating the ceasefire agreement. Just ahead of the talks, Hezbollah said it fired rockets at northern Israel in response to an Israeli violation of the ceasefire. Meanwhile, in southern Lebanon, hundreds of civilians and media professionals gathered to bid farewell to Amal Khalil, the journalist who was killed by an Israeli strike. The strike killed the 43-year-old reporter and wounded a photographer accompanying her. Lebanon has accused Israel of intentionally targeting a marked ambulance as it tried to reach the journalist. The IDF denied that it was preventing rescue teams from reaching the area and said it did not target journalists. In the oil market, Brent crude prices above the $100 mark as maritime traffic in the Strait of Hormuz remains effectively under a U.S. naval blockade. President Trump has said he refuses to open the waterway as it would allow Iran to make money. He added that the U.S. blockade will be removed only once a deal is made. He also said the U.S. didn't need to use nuclear weapons in Iran because, and I quote, they're totally decimated. Listen in.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. We're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you.
Would you use a nuclear weapon against Iran? You posted on Truth Social a few weeks ago.
We don't need it. Why do I need it? Why would a stupid question like that be asked? Why would I use a nuclear weapon when we've totally, in a very conventional way, decimated them without it? No, I wouldn't use it. A nuclear weapon should never be allowed to be used by anybody. We have total control of the strait. And the fact that it slows, they would have opened it up 3 days ago. They came to us and they said, we will agree to open the strait. And all my people were happy. Everybody was happy except me. I said, wait a minute, if we open the strait, that means they're going to make $500 million a day. I don't want them to make $500 million a day until they settle this thing. So I'm the one that kept it closed. We have total control of it. And it'll open when they make a deal or something else happens that's very positive.
So no headway there in the U.S.-Iran impasse, no breakthrough, no talks at this point in time. Let's talk about the day's market action. The markets continue to witness a broad-based sell-off, with the Sensex and the Nifty ending lower for the third straight session. All sectoral indices closing in the red today. The Nifty down 1%. Similar story for the Sensex. The Nifty IT index bearing the brunt of the pain today, down by over 5%. The Nifty Bank, of course, closing just about in the green. Infosys was the top Nifty loser today, and HCLTech extended losses, ending lower for the third straight session. For the week, the markets erased all gains, with the Sensex and the Nifty down 2% each. So that's the picture. And the Nifty IT index down 10%. Remember, IT stocks have really taken it on the chin on the back of disappointing earnings. And the mid-cap index was down by about 1% or so. In fact, this is the largest weekly drop that we have seen for the index since March of 2020. Now, JP Morgan has downgraded its outlook on Indian equities from overweight to neutral, and this follows a slew of downgrades from other brokerages as well. Hormuz is standing by to take us through where the markets are likely to be headed in light of the calls coming in. Hormuz.
Hey, JP Morgan's downgrade is not the first one. In fact, today's downgrade comes just a day after HSBC also downgraded India. But look at JP Morgan first. They have downgraded India to neutral from an overweight. They have cut their base case target on the Nifty to 27,000 from 30,000 earlier. And they have downgraded it based on stretched valuations because they find better entry points among peer countries of India, such as Korea and China, among other countries. Now, this comes just a day after HSBC issued its second downgrade in less than a month of the Indian equities. They downgraded India now to an underweight stance from neutral earlier, and they say that the risk reward is still unattractive compared to what it was or during their previous downgrade. They had downgraded it first to neutral in the month of March, and this was also followed by a slew of other downgrades that had come in at the start of this month and late last month. Nomura was the first one. They downgraded India to neutral from an overweight rating. They cut their Nifty target to 24,900 from 29,300, and they say that the key reason behind the downgrade was the elevated oil prices due to the Iran war. Goldman Sachs did the same in March. They downgraded India to a market weight from an overweight stance. They cut the Nifty target to 25,300 from 29,500, and they say that the risks over the next 3 to 6 months are tilted to the downside because the market may not be pricing in the full extent of the earnings cuts. This also follows a downgrade by UBS last month. month, where they say that they have downgraded India due to high geopolitical risks and energy price pressures, although they remain constructive on India's medium-term story. But an interesting letter was written by Bernstein to Prime Minister Narendra Modi. One they wrote once back in 2019, and then this one, they highlight possible solutions to recharge the India story, and they say that there is a need to move India away from the low-end labor arbitrage model to a higher productive track. And they have highlighted some key recommendations as well. To phase out subsidies on power and input subsidies as well. To protect farmer incomes via predictable procurement prices is one such recommendation that they have made. And to invest in agri-infra to reduce the reliance on rain and the storage loss as well. They have also recommended phasing out of ICE vehicles gradually and shift their incentives from cash-rich incumbent companies towards the demand side to support new entrants within the automobile space and shift the focus towards electric vehicles. On AI, they say that you should follow a protectionist route for new tech areas, and India must identify emerging sectors early within the manufacturing space before global supply chains are fully formed. They also say that their funds should be redirected from employment guarantee programs in order to build denser metros and bus networks in cities and focus more on public transport, and to remove exemptions from untaxed entities such as certain political and religious bodies, and that could improve equity and allow for lower overall tax rates. Some recommendations made by Bernstein, but a slew of downgrades coming in from a lot of these foreign brokerage houses for the Indian markets.
Hormuz, many thanks for piecing all of that together for us. Now, Finance Minister Nirmala Sitharaman has called the Claude Mythos AI model a new challenge for banking. This comes a day after she met bankers to assess recent concerns that the model could identify vulnerabilities in operating systems and web browsers. Sitharaman has asked banks to take all necessary preemptive measures to secure their IT systems and protect monetary resources. She added that the IT ministry is actively engaged in preparedness.
We need something new and something far more versatile to be able to counter the newer threats which are likely to come. In the coming weeks, there will be a lot of interaction within the banks, understanding where more investments will have to be made, what kind of technologies can come in, how AI itself can be used for countering this AI-born challenge.
And speaking of Mythos, the Minister of State for Telecom, Pemasani Chandrasekhar, has said that Anthropic Claude's Mythos should not fall into the wrong hands, and the government is considering all options.
We've seen Anthropic release Mythos, which is very good adept at finding inefficiencies and vulnerabilities. Is that a conversation that you're beginning to have?
No, absolutely. These are all the things that we have to do, but at the same time, that Mythos or all that stuff should not also go into the wrong hands as well. So absolutely, we will be taking into all these things into picture.
And shares of SBI Life Insurance down after the Finance Minister raised the possibility of changes in insurance distribution norms. Speaking at an event in Mumbai, the Finance Minister said a government-appointed banking committee will examine whether an open architecture model should be adopted for distributing insurance and other financial products, adding that the panel will assess the pros and cons before taking any regulatory decision.
These are things which the committee will be sitting and working under the IBA chairman, which is being formed, which is part of IBA. There's no new committee. Don't ask me, oh, what's happened to that committee? There's no new committee. The IBA chairman with the IBA will be talking to banks to understand how best to go about it. What are the vulnerabilities? By keeping one, by keeping several, by having different vendors but not having some. So all these are going to be worked out.
And on to CNBC TV 18 exclusive, Vodafone Idea CEO tells us that the company expects the government to complete the reassessment of AGR dues soon. Now, this follows a Supreme Court order last year that allowed the government to reassess dues worth nearly 1 lakh crore rupees. So that's the word coming in from Vodafone Idea.
No, I think first of all, I think we are very thankful to the Honourable Supreme Court and the Government of India for taking the holistic view about and a conclusive long-term view about the AGR reassessment. As we speak, the AGR reassessment is on, and I think once that is concluded, then we'll come back to you. The work is in full swing. We can't really comment anything beyond that as we speak.
Any indication from the government as to how long the process will take, how much longer?
The work is on. I think it's on a very fast pace. Let's wait and see when the results come out.
That's Vodafone Idea. And staying with telecom, the telecom department says the telecom companies need to step up and tackle spam calls. Speaking to CNBC TV 18's Ashwin Kumar, the Minister of State for Telecom, said these companies need to strengthen KYC and deploy caller name display on a larger scale.
eKYC, information sharing, if there is one TSP that does an effective invention, it should translate quickly to other TSPs. And then, whether can we block at the international gateway level. So like that, there are multiple ways, they have mechanisms to identify how we are doing Sanchar Sati. I mean, they should be able to do the same things and then share with them.
Now, tech giant Microsoft will offer voluntary retirement buyouts to some U.S. employees, marking the first time for the software company. As per CNBC, around 7% of Microsoft's American employees are eligible. The one-time retirement program will be available to workers at the senior director level. It's also available to those whose years of employment and age add up to 70 or higher. The company has been ramping up its AI expenditure and spending heavily on data centers. And more layoffs in the U.S. Facebook's parent Meta has announced it will be cutting 10% of its global workforce on the 20th of May. This amounts to roughly 8,000 employees across all its departments. And this comes as the company continues to make heavy investments in AI. It's also closing about 6,000 open roles. That's the latest from Meta. After Microsoft and Meta, Nike has also announced it will lay off 1,400 employees across its global operations team. Majority of the reductions will be done in its technology division. The sports company plans to streamline its operations and position the brand for long-term profitable growth. This is the second round of layoffs for the company this year. The Indian trade delegation, which travelled to Washington, D.C., has now returned after 3 days of negotiations. Sources say that talks touched upon multiple areas, including non-tariff measures, market access, and Abhimanyu standing by to help us understand what transpired and where we go from here. Abhimanyu.
The Indian trade delegation had visited the United States from 20th to the 23rd of April for trade talks with their American counterparts. Several issues were discussed apart from trade and market access. Now, several issues included digital trade, investment promotion, economic security alignment, technical barriers to trade, non-tariff measures, and customs and trade facilitation. The Commerce Ministry has said that the meetings were conducted in a constructive and positive spirit with meaningful and forward-looking discussions which took place, and both the sides agreed to remain engaged to maintain this momentum as they move forward. Now, India and the United States had earlier issued a joint statement on the 7th of February this year in which they had agreed for the framework of a reciprocal and mutually beneficial trade. It remains to be seen how early both the sides are going to resolve all pending issues pertaining to the investigations which have been initiated by the US Trade Representative against several countries, including India, as well as the larger issue of how much is going to be the percentage of tariff to which Indian goods are going to be subjected towards. The Indian government had earlier indicated that India is looking for a beneficial access as far as the American market is concerned compared to its several competitors in labor-intensive sectors and labor-intensive goods which continue to be exported from India to the United States. The Indian government is looking at a preferential access at possibly at a lower tariff than its competitors.
Abhimanyu, many thanks. The Navi Mumbai International Airport is expecting flight movements to more than double in the coming months. But even as traffic picks up, there are some fault lines emerging among airlines over the increase in cost, the lack of connectivity and the delays in launching international operations. So is Navi Mumbai ready to take the pressure off of Mumbai's main airport? Are structural challenges slowing down its takeoff plans? Madhiya joins us now with the details. Madhiya, it's been a few months now since Navi Mumbai Airport saw flights taking off, but structural challenges remain. Take us through where things currently stand.
While the airport is expecting strong domestic growth, there are clear challenges emerging on costs and international expansion, like you mentioned. Let me break it down. First, on traffic, sources from the airport tell CNBC TV 18 that daily flight movements currently around 150 flights a day are expected to rise to about 380 by December. That's a strong scale-up expectation. Passenger numbers are also expected to grow from around 20,000 a day now to nearly 50,000 by year end. 50%. That is the expectation from the airport. And demand remains steady. Sources say that load factors above 70%, even in a lean travel season, is a strong indicator. Now, a big driver of this growth is Indigo, because Indigo is the only airline that accounts for about 70% of operations at Navi Mumbai Airport, and that share could rise to as much as 80% in the coming months. This is what sources are telling us. So Navi Mumbai's near-term growth is closely tied to Indigo's expansion plans. But not all airlines are aligned. Air India, for example, has raised concerns with the airport tariff regulator, AERA, saying a shift to Navi Mumbai may not be viable yet. The airline has flagged higher tariffs at the new airport, connectivity gaps, especially lack of metro access, and the cost of split operations between two airports, Mumbai and Navi Mumbai, all of which could push up costs and impact efficiency. This is what Air India has told AERA. There's also a regulatory angle here. Sources say that AERA, the tariff regulator, has received stakeholder comments on Navi Mumbai Airport's tariff proposal. The airport has now a time till April 27 to submit counter comments. The airport's tariff proposal is still under examination. Current rates that we see at the airport are on an ad hoc basis, and a final order is expected by AERA in about a month. Now, finally, on international operations, there's a delay. The airport was targeting March 29 launch, but that has been pushed back due to West Asia tensions. Airlines are holding back because Gulf routes are critical to launching international services with traffic volume very high on Gulf routes. So for now, there's no clear timeline, with focus shifting to the winter schedule. So bottom line, Navi Mumbai Airport is seeing strong domestic traction led by Indigo, but Air India's concerns, tariff uncertainty and connectivity gaps highlight the hurdles, and with international operations delayed, the airport's full scale-up could take more time. Back to you.
All right, Madhya, many thanks for joining us. Now, authorities have seized 400 kilograms of fake ghee in Gujarat, 3,000 kilograms of contaminated tea powder from Hyderabad. Counterfeit goods are now a national challenge as adulterated food, spurious medicines, fake cosmetics and many other categories of products are being seized across the country in just the last few months. Timsy joins us now with the latest. Timsy.
Latest in the ongoing pan-India drive to curb fake and unsafe products from flooding markets meant for mass consumption. Reports have emerged today from 3 major states exposing the scale and spread of the problem. Starting in Gujarat, authorities seized nearly 400 kgs of fake desi ghee being sold under the brand name Mangal Murti in Nicole. Officials say the product was being falsely marketed as pure, raising serious concerns over what consumers are actually putting on their plates. In the national capital next, a major crackdown in Najafgarh has exposed an illegal supply chain of banned performance-enhancing substances and expired health supplements. The raid, led by food safety officers along with local police, targeted a facility operating without mandatory licenses under food and drug safety laws. The operation was triggered by a high-priority alert from the National Anti-Doping Agency, pointing to the growing circulation of prohibited substances in the fitness and wellness market. Further south, in Hyderabad, enforcement teams uncovered a large-scale adulteration racket in tea supplies. Over 3,000 kgs of adulterated tea powder and another 1,500 kgs of expired stocks were seized during multiple raids. Investigators say the compromised products were being supplied to roadside vendors as well as established restaurants, indicating a deep and worrying penetration into the food supply chain. From fake dairy products to illegal supplements and adulterated beverages, these cases highlight a disturbing pattern emerging across states where counterfeit and substandard goods are being pushed into everyday consumption channels. Authorities maintain that intensified surveillance and coordinated enforcement drives will continue, and today's cases underscore just how widespread and entrenched the fake product network has become across the country.
Timsy, many thanks for joining us. This is a serious challenge. It is a national challenge, and as I pointed out, across product categories. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned. The news will continue right here on CNBC TV 18. We're back in a moment.
Hello and welcome to our special broadcast on the Monetary Policy Minutes. I'm Lata Venkatesh. The minutes of the Monetary Policy Committee are clearly more cautious than the RBI statement appeared on April 8th. Most of the members, including the governor, are clearly acknowledging the downside risk to growth and the upside risk to inflation. More importantly, this is the first time that members, including external members like Nagesh Kumar and Dr. Ram Singh, are acknowledging the falling rupee and how it queers the pitch for monetary policy. So, should we even start thinking of raising interest rates or using interest rates to not just control inflation but to defend the rupee is a question that rises in many minds. Joining me now to discuss these and other issues is Mr. Nagesh Kumar, the external member of the RBI MPC. He's also a professor and the director in the Institute of Studies and Industrial Development, the ISID. Dr. Kumar, thank you very much for joining us. Actually, that is the first question. This is the first time that people are talking about, experts are talking about the rupee and the current account deficit in the minutes of the policy. So can you just tell me whether that was a big discussion in the MPC meetings itself, whether we should use whether we should not use a dovish policy because it might endanger the rupee?
I think, first of all, the economic outlook since the last meeting has deteriorated completely. At that time, in February, when we met, one was talking about, the Goldilocks kind of a zone for Indian economy with growth going up and inflation remaining in a very benign situation. And suddenly we found ourselves in a very difficult policy environment, external policy environment with, a lot of concerns about, the rising oil prices, which is an important barometer or parameter or variable for India's economic outlook. The prices going through the roof, but supplies are also disrupted, and including of natural gas and fertilizer, which also have impact on all different sectors of the economy. So this was a concern, and then also because of the short-term capital outflows, FPIs going out because of the uncertainties, global uncertainty, the rupee getting into pressure, but also because of the dollar strengthening in these times, which is bringing pressure on rupee. So all of these discussions were there, and clearly everybody is concerned about the fallout on Indian economy. And it was very clear that sustaining the kind of growth rate of last year, the outgoing year of 7.6% would be very challenging. And we brought down the projections to 6.9, which also, as you said, rightly, downside risk. If this conflict prolongs longer than what one is expecting, one is hoping that it will be concluded soon with the ceasefire negotiations going on and all that. If it continues for a long time, then the situation would demand further, look at the numbers that we had this time around. And similarly for the inflation numbers, previous year we had very benign kind of situation with respect to inflation, which allowed some policy space for Monetary Policy Committee to act on. And as you know, we had 125 basis points of cut in the interest rates. But now the projections, keeping in mind the crude prices going up and scarcities and all that, how long we can contain the effect of the crude prices going up, or to contain the domestic prices of hydrocarbon, how long we can, keep it at the existing prices. So this obviously depends upon how long the conflicts goes on, and we need to be very cautious and watchful. And so all of these issues and pressures on balance of payments because of very high dependence of India on imported crude was a matter of concern.
So, Dr. Kumar, that point is taken. But, will you, in the coming policies, will you watch out for the second round impact of higher prices? I mean, as you said, it is possible that the government passes on some 5 rupee increase in petrol and diesel. I mean, how much can the fisc take after all? Since the prices of crude are close to $100. So if that were to happen, at what point do you think the interest rate instrument needs to be used on inflation? What will you watch out for, sir?
No, certainly, we need to be very watchful and cautious at this point of time. And next meeting is going to be very critical, very important. But every one of us also looked at the inflation numbers, and while there is a clear hardening of the prices, and there could be more hardening if the hydrocarbon prices are allowed to, be rising, then there would be second-order effects on prices. But all of this is supply shock kind of impact on inflation, not demand-driven, pressures on prices, which can be contained or addressed through monetary policy action. So that was also an issue before us. But one has to go with an open mind, driven by data in the next meeting, and see what is the action that is needed at that juncture.
Okay. No, fair enough. But Mr. Kumar, where do you think the reality might lean? Will it lean on having to cut rates to help growth, or will the reality look like you may have to raise rates to rein in inflation, or are you still seeing a very long pause because the shocks are beyond our control?
I said, you see, monetary policy is a very important tool for containing prices when it is a demand-driven, demand shock, creating push for the prices, or, there is a overheating of the economy. But currently, that is not the situation. That all of this inflation which we are seeing or expecting is because of the supply side challenges. And you can hardly address this by the interest rate kind of mechanisms, and it is to be contained through managing supply side better and diversification of the hydrocarbon supplies, for instance, and of course in the medium term to reduce dependence on imports of hydrocarbons through importing, through producing more, digging more in the country, and also renewable energy transition.
Yeah, of course. Those are, of course, fiscal and governmental responsibilities. The Reserve Bank's domain doesn't extend there. But how much did the rupee impinge on your discussions on 6th, 7th and 8th of April, sir? Is there a likelihood that at some point in time we have to raise rates or use interest rate instrument to ensure that the rupee is not damaged? Do you see that happening?
Not at this moment, but who knows about the future? And in these uncertain times, everything is really determined by the forces at play at that moment. So we can't.
Was that even discussed, sir, during those days? Was currency and interest rates the relation between interest rates and currency discussed at the meeting? Sorry, sir, I lost you.
Not really. Okay. Not really at this last meeting. Okay. But future, of course, if it comes to that, we will see.
Okay, okay. Point taken, Mr. Kumar. Thank you very much for joining us. So, looks like extremely data-driven. That's the message from Mr. Kumar. We have to take a break on that note. Thereafter, we are going to be joined by another external member of the MPC, Dr. Ram Singh. Welcome back to this monetary policy discussion. The minutes of the Reserve Bank MPC, like we have been saying, clearly indicate that all members have become cautious. But the overall mood is that let us watch for more data. One standout difference in these minutes is that all the external members are referring to the rupee, the current account deficit, etc. But RBI members are completely silent on rupee and the external front. Well, another point is that the most dovish stance in the minutes came from external member Professor Ram Singh, who has called for a dovish pause. But he too has changed his stance from earlier accommodative to neutral, which indicates that he also has taken a slightly hawkish tilt. Well, Professor Ram Singh is our guest right now, and he joins me to discuss the minutes and the state of the economy. Professor Singh, good morning, and thank you very much indeed for your time. Well, for starters, isn't it a bit bold to say dovish pause when you can see that, you know, there are upside risks to inflation and downside risks to the currency?
As you have stated yourself that I have argued for a dovish pause. At the same time, I have also changed my position, my stand on the stance. So I have also become more cautious. Everything considered, I agree with your assessment that my tone and my views are dovish. These views are justified, in my view, given the data that we have today. It is true that there is an upward pressure on inflation, and also there is a downward pressure, downside risk on growth have materialized to a limited extent. But the economy on inflationary front and also growth front remain in a comfortable zone at the moment. Inflation remains well within the tolerance limit of the mandate for MPC. Growth has taken a hit with respect to past performance. Growth even today does not look bad, but the growth, when I say that growth has taken a hit, it is more with respect to the potential growth rather than the numbers that are being forecast and the numbers that I go with.
Okay. So, you know, I'll come back to the dovish pause sentence of yours, but I just wanted to ask this. You have a sentence saying, as per my assessment, growth forecast is lower by 50 to 60 basis as of now due to the West Asia conflict. So are you saying that even the 6.9 is difficult?
No. 6.9 is after factoring in the...
So from 7.6, okay, from 7.6, the bringing down to 6.9 is your 50 to 60 basis point worry. Is that right?
Absent West Asia crisis, conflict, I would have expected 7.5 or upward growth rate.
Fair enough.
This number is also justified if you look at new series data on growth. Last 4 years. Okay. Out of last 4 years, for 2 years, we have grown upward of 7.45. Okay. And in all 5 years, all 4 years for which we have data, we have grown more than 7%. And also, please note that we have achieved this growth rate at a very benign inflation rate. Okay. So this suggests that at the growth rate that we have experienced during last 2, 3, 4 years, was a growth rate without much of hitting of the economy. So that indicates that there's a potential to grow faster. Without hitting the economy.
Got it. So,
the crisis has changed things a little bit, yes.
Okay. Now, let me come to another statement which really stood out. You said that I am going for a dovish pause, while it is true that this dovish pause is not going to help on the external front, given the falling rupee. Now, was this discussed in the MPC also? The same doubt that occurs to you, that if I look very dovish, am I endangering the currency? Was that a point of discussion?
So in MPC, we discuss all issues that are relevant for the economy, from unemployment to exchange rates to everything. Our mandate is to make our arguments and be guided by inflation data and growth data. Okay. But by way of discussion, we discuss each and every issue that is relevant for Indian economy.
Okay. So
the views that are there in my statement are my views.
Of course. But do you worry that, if the Reserve Bank pours so much liquidity, even now, the repo rate, the call rate is at the lower end of the corridor, closer to 5% and not at 5.25%. Is there a fear that this dovishness signified or reflected by the liquidity and the dovishness in your tone can be negative for the currency? Is that a thought?
So, So let me elaborate on what I mean.
Okay.
As far as the liquidity position is concerned, Honorable Governor RBI has made it amply clear that RBI will take good care to ensure that ample liquidity is available in the system all the time. My dovish pause is also in the same spirit. It is more of a signal that as of today, given by whatever information data we have, as of today, there is no reason for us to think of increasing interest rates. It should be seen in that spirit. When I say that a dovish pause will not help, is unlikely to help on the external front, on exchange rate, it is a statement that is true in ceteris paribus sense. If we have a dovish pause when the inflationary outlooks are becoming somewhat cautious or alarming for some parts of the world, not for us but for other countries, in that situation we can expect that perhaps that many central banks would be thinking of either a pause or maybe an increase in interest rates. So the interest rate differential advantage we will not have, and we will not be signaling that we will have interest rate differential advantages. So you should look at my statement from that point of view. At the same time, I would like to say that we have several other advantages even on the external front, even on the capital account, current account, capital account fronts. And everything considered today, there's no sense. I am not alarmed at all.
Okay. So, now we have 20 days from the day you wrote your minutes on April 8th. Well, not quite 20 days, but 2 weeks. The war has persisted. Crude prices remain in 3 digits, $102. Are you getting a sense that things have worsened? You are making a statement that our Goldilocks scenario has now pushed to the opposite extreme. That's your first sentence of your minutes. Has it just gotten even worse? Because the war is not as yet showing any sign of ending. At least the Strait of Hormuz is not showing any sign of opening up. So do you think we are worse off in growth and we need to lower growth forecasts and increase inflation forecasts in due course?
So with every passing day, this conflict persists. It is going to be making things worse for the entire world. For us also, it's not going to be of any help. At the same time, the alarming signals are not there for Indian economy. Government has done a very good job of controlling prices, retail prices of petrol, diesel, LPG. It also has done a great deal of restoring supply to commercial sector of gas and fuel products. So as a result, because first order effects have been moderated, mitigated, we are not seeing any second order effects. Unless we see there are second order effects, I will not be alarmed for Indian economy. I would also like to add that it is also a crisis that we are turning into an opportunity. This is happening at the government level and also at the household level. At household level, now we see greater use of induction. So substitution of energy mix is already happening.
Yes.
This is something we need very much. Our energy mix at household is suboptimum, whether we compare it to US, we compare it to China. We need to consume more of electricity. Our energy consumption need to be more in the form of electricity. And this gives us a good nudge. Let me also add, Lata, that we have a capacity to accommodate this nudge coming from commercial and household sectors. Because our total installed capacity, especially in renewables, is more than what we are consuming today. So we can afford to produce more power with a healthy mix. So together it will be...
No, I take your point. I take your point that India has not been hit on mobility or on power as much as some other countries which are based on gas-based power have been hit. We are, to that extent...
And let me also add, Lata, here one more crucial point. it is not in interest of anybody, including parties involved in this conflict, to prolong this conflict. Because it is hurting every single player who is involved or not involved. Every single country is being adversely affected. So it is therefore my hope that this conflict will be resolved sooner rather than later. Once that happens, you see, with respect to petrol, with respect to West Asia crisis, we have been focusing primarily on crude, but not on other products that are downstream products. Here we have advantage. We have advantage, twofold advantage. One is our refining capacity. It's significant proportion. We are net exporters there.
That's right.
And other is that the Gulf refining capacity has taken a hit. So this will help us mitigate second-order effects also.
No, I take your point, sir. Unfortunately, out of time, we can't continue the conversation. Thank you very much for joining us in this Monetary Policy Special.
Hello and welcome to News Center. I am Ashmit Kumar. Now, US President Donald Trump sparked a row after he reposted remarks by an American commentator who referred to India as a hellhole. The radio host had called for an end to the birthright citizenship law in the US and described India and China in derogatory language. The Indian government denounced the post as inappropriate and in poor taste. Now, the Ministry of External Affairs spokesperson Randhir Jaiswal said in a statement, and I quote, "They certainly do not reflect the reality of the India-US relationship, which has long been based on mutual respect and shared interests," end of quote. Now, Washington also moved to contain the fallout. US Embassy spokesperson quoted President Trump as saying that India is a great country with a very good friend of mine at the top. However, the statement did not specify when Trump made the remark. China and Iran publicly criticized the US-Chinese embassy spokesperson, meanwhile, wrote on social media that bilateral ties are built on respect and not rhetoric. The Iranian Consulate General in Mumbai posted a video showcasing the cultural and geographical diversity of Maharashtra and wrote, maybe someone should book a one-way cultural detox for Mr. Trump. It might just reduce the random bakwas. Now, even Democrats in the U.S. House Foreign Affairs Committee hit out at Trump. The row over the U.S. president's social media post comes at a time when India and the U.S. continue their engagements on trade issues. Indian negotiators wrapped up three-day trade talks with U.S. counterparts in Washington on Thursday. U.S. Trade Representative Jameson Greer said that India is a tough nut to crack and pointed to safeguards for sensitive sectors like agriculture. Now, Greer also added that there is scope for mutual agreement on some issues. And well, joining us now to discuss this is with us Ambassador Arun Kumar Singh, former Indian ambassador to the US. Ambassador Singh, thank you so much for joining us. First question, I just want to get a thought on this comment by Donald Trump, this post. He's infamous for some of the content that he puts out on his social media handle, this no less, inviting fury here from a lot of Indian users. In fact, very interestingly, also inviting comments from the Chinese spokesperson saying that relationships are built on strong foundations and not on rhetoric. Again, that's a message being sent by none other than China itself. What I want to ask is that at a time when India is negotiating a trade deal, does this put the Indian leadership in a bind, the Indian leadership under pressure to be seen reacting, but not at the expense of angering Donald Trump himself?
Ashmit, this is not the first provocative post that President Trump has put out. And here also, it is not his own comments. He has just repeated a post that has been put out by someone else. But, that doesn't excuse what he has done, because by putting it out again, you're sort of endorsing what was said there. But that having been said, clearly the objective was not to hit out at India, China per se. It was part of the internal debate going on in the US related to birthright citizenship. And the whole objective has been to put pressure on the US Supreme Court, because the sense is that the Supreme Court is likely to rule to retain the right, the birthright for citizenship, and rule against what the administration is trying to do. So the MAGA base of Trump and Trump himself are trying to generate some pressure on the US Supreme Court. So that's what they're trying to do. But that having been said, clearly from India's point of view, we cannot accept our being sort of a collateral damage in this process. And one would expect that from leaders and leaders of countries that say that they are good partners of India should show sensitivity to opinion here. And they should realize that if they continue doing what President Trump has done on occasion, there will be a negative fallout in India, which will have a negative fallout on India-US relationship and on the US itself. But again, if you remember last year, at the time when the trade deal was going through a rough patch, President Trump himself, has spoken about India being a dead economy.
And then he's a lawyer.
And then some of his others who work with him have also spoken very, very negatively about India. But then they walked back to say, India is a very valued relationship. President Trump has a great relationship with the Indian Prime Minister. And the reality is that despite whatever has been going on in terms of the rhetoric, in terms of the substance of the relationship, both countries have made a determined effort to keep all other areas of cooperation going. If you remember, in October last year, the Indian Defence Minister and his counterpart signed a 10-year defence cooperation framework agreement, even while the trade issue had not been resolved. And right now, they worked out a trade agreement, which was sort of disrupted because of the US Supreme Court decision, which ruled the Trump tariffs overall illegal under the particular act that they had used. So the whole thing has been redone. And that's why, as you mentioned, an Indian trade team has been in the US trying to figure out that when the basis on which the earlier trade deal was done has been undone, how do you find a way forward?
Before we dive into the specifics of the trade deal and what perhaps was possibly negotiated, Ambassador, I also want to ask that at a time when the US appears to be locked in a downward spiral in a war engaging Iran in West Asia, does it have the bandwidth to make a commitment of a deal this size, especially at a time when its energies, I'm assuming, are focused towards Iran at this stage?
No, sure, it can make a commitment. I think that's not an issue because overall for US, the India trade is a very small part of their overall trade. So there's nothing that prevents them from moving ahead. I think the challenge for them is that once the US Supreme Court ruled that what President Trump had done under the International Emergency Powers Act was illegal, and then it took it back to MFN levels of tariffs, then he has to find new mechanisms. And so he's trying to use other provisions of US law to put higher levels of tariffs on countries. And therefore, I think what the Indian negotiators are trying to do, that is before he randomly uses other provisions to put higher tariffs on Indian products, can you work out an arrangement so that there is a better understanding on what the level of tariff could be so that our importers and exporters can plan properly rather than be living in a phase of uncertainty. So if they want, clearly they are in a position to do a trade deal.
Sure. Speaking of the trade deal, I just want to get a sense. I'm not sure if you've managed to catch a glimpse of the clip that's going viral of BJP leader Ram Madhav going viral on social media, where he's saying, he's talking in a panel where he's basically saying that, look, India agreed to stop buying Iranian oil. India has agreed to stop purchasing Russian oil. That was, of course, pre-West Asia war. Also going on to say that even with the 50% tariffs that India was looking at, it didn't bring the situation down to some kind of a trade war between the two countries, but rather chose to negotiate. And therefore, the question that is being posed in that clip by Ram Madhav is, what more can India do to take this forward?
So I think, always when you take a decision, it's done on the basis of a cost-benefit analysis. And the oil purchases from Iran had been stopped much earlier. And the reason for that was that for Indian companies that were buying oil and other energy supplies from Iran, if they continued to do that, they would come under US sanctions. Now, the same companies were also buying equipment from the US, raising resources in the US. So when they did a cost-benefit analysis, it didn't make sense for them to continue with the Iranian oil purchases, which had come down to zero. Now, on Russia, if you remember, the Biden administration had in fact said that India should buy more oil from Russia as long as it is buying within the price cap that the US had set. And that was because they wanted to keep the global energy prices stabilized. Now, the Trump administration, it came in with the different requirement that India should now start reducing the purchases of oil from Russia. And the reason for that was more to do with US domestic politics. Because after becoming president, Trump had taken no action against Russia for whatever reason, either because he wanted to reach out to Russia to try and work out some deal in the context of the Russia-Ukraine conflict. He had a meeting with President Putin. So he was taking no action against Russia. And he was being criticized in the US for not taking any action against Russia. So then he decided to add an additional 25% tariffs on India. And when a journalist asked him that, why is it that you have taken no action against Russia? He said, I have imposed tariffs on India. So India was used as sort of a collateral damage to meet the political criticism that he was coming under. And if you see from all the reports, for a long time, India had continued with the purchases, but when they were doing the trade agreement and to get the tariffs to be reduced, India also reduced somewhat the purchases from Russia, but didn't stop it altogether. So I think you have to do a cost-benefit analysis and see what works for you.
Ambassador, again, you made a earlier reference to Section 301 investigations. There are two such investigations that have been instituted against India. These investigations are set to conclude in the month of June. Now, at the time, the US Supreme Court had given its judgment, striking down the Trump tariff that was conceived to be lending Indian negotiators a slight upper hand. Now, with a June deadline in place, with the Section 301 investigations in place, does it now turn the clock against us in terms of when we're trying to close the deal? Do you see that happening before June, before the 301 investigations give their results?
So, Section 301 investigations against India are not something new. They have also happened in the past. And using those investigations certain times on certain specific Indian products, the US has imposed higher tariffs, and India has taken a call about how to respond to that. So at this moment, using the Section 301 investigation is clearly a pressure point. But with that in the background, if the US and Indian trade negotiators are able to work out a deal, then there will be no reason for the US to impose the 301 tariffs. So I think Indian negotiators will have to take a call that what is US demanding or expecting in the bilateral trade agreement that they're trying to work out, and what may emerge from the 301. And based on an assessment of what works better for India, there may be a desire to do things before 301 comes into effect, or wait it out and see what happens there while continuing the discussion. So I think it's an overall cost-benefit analysis that the Indian negotiators will have to work out.
Ambassador, we'd like to thank you for joining us for these insights on what this journey ahead on the India-US trade talks may look like. Let's now go across to our fellow panelist, Mr. Pramit Pal Chaudhary, who's joining us. Mr. Chaudhary, coming to you, we were just discussing with Ambassador saying on the road ahead, given that the Section 301 investigations are likely to complete in June, is that the realistic deadline that India will be aiming for? And if that is, do you see a deal being cracked by the end of next month?
Hard to say when exactly, but it's probably going to be sooner than we expect. The point is not so much, I would argue, about the FTA. To some degree, that has already been largely negotiated. There's some finer points obviously still being worked out. The problem was that for the Americans, the legal basis of their tariffs had basically disappeared with the Supreme Court judgment. So they need to recreate it, if you wish, under using the Section 301. Whether the Section 301 makes sense or not is almost irrelevant. I think that's really about just trying to you have to have a basis for the tariff. You can't just say it exists on the basis of a whim. The real issue, it seems, is that they're trying to merge all of that into a larger package, which incorporates both defense, but particularly importantly, energy deals. That's, I think, arguably the biggest attraction for President Trump. If all of those getting those all together is going to be the bigger challenge. But I would say June is a very good chance of it coming together from what I'm hearing. May be a bit of a challenge, if only because President Trump has other things on his mind.
Sure. Mr. Harsh Pant from the ORF is also joining us. Mr. Pant, welcome to the show. Again, as Mr. Chaudhary was pointing out, that energy, of course, is at the heart of this bilateral trade agreement. Tell us, going forward with the West Asia conflict that we're looking at, in the short to near term, there is no turning away for India from Russian oil. That will continue to happen. Pentagon itself estimates that clearing up of the Strait of Hormuz could well easily take up 6 months or even more. With our continued dependence and reliance on Russian oil, is that likely to play some kind of a stumbling block as far as finalizing this deal is concerned?
I don't think so. I think that is something that India and the US have really factored in already in the negotiations. And as we have seen, we are seeing because of the West Asia crisis, India has been, or America has relented on giving waivers for Russian imports. So I think broadly the Russian energy question seems to be for the moment not really the center ground, but clearly the challenge for India will remain as this crisis drags on, and if it's not resolved quickly, then the challenge of the energy would remain, and I think that would also in some ways should act as a spur for the larger deal with the US, because ultimately, as Pramit was saying, this is a package arrangement that India and the US are looking for, and energy, defense, and trade will have to come together to ensure a larger basket, which aligns in some ways with the priorities of both countries. So I think as this crisis drags on, India's dependence on Russia certainly will continue for the time being, which is something that has been factored into negotiations and factored in the kind of negotiation approach that India is taking forward. But also, I think it should spur or it should accelerate the process of India and the US trying to look at energy as also as a variable, perhaps a positive one in their relationship going forward.
Mr. Pant, again, we ended the latest round of negotiations with no conclusive findings as to what the road ahead may look like. There are no statements being issued as such about the road ahead or about the next possible meeting. What can you tell us are the key pain points that are being, again, fine-tuned, finalized in these final moments of this deal?
Points remain the issue. broadly in terms of restructuring the negotiations from where they were before the Supreme Court ruling to after. And I think that is something that America has to resolve, and India has to see how both the newer structure of tariffs aligns with the sort of priorities that India had set for its negotiating strategy. And that is, I think, that has taken time, and that will continue to take time as it evolves, because that's an evolving position. And the other, of course, has been, in terms of energy, has been an issue, because the kind of energy requirement, or the kind of energy structure, the structure of energy negotiations that was happening before, the West Asian crisis is no longer applicable. So I think there also new thinking will be required, and is certainly what seems to be on the agenda. But finally, I would say that ultimately the pressure points on agriculture will remain, and has continued to remain, although the first tranche, as we have been told, is something that will not really tackle the most contentious issues at this particular point. So I think more than anything else, it's the evolving trajectory of American domestic situation, as well as American foreign policy, that is now shaping the trajectory of these negotiations.
Well, speaking of American foreign policy, Mr. Chaudhary, let me come to you. Let's bring in the dynamic of the West Asia war here as far as the U.S. trade deal is concerned. What I want to ask is, clearly U.S. energies, and especially the energies of the U.S. president, is geared more towards what's happening out of Iran. Will there be a bandwidth inside the American administration, inside White House, to sign off on a deal this size while they are locked in what looks like a downward spiral in West Asia?
Well, it's harder to get the top level to focus on this, but what we're seeing, of course, is that the lower level is still, the lower levels of bureaucracy are still functioning, and they very clearly have a mandate from above to get this done at some point or another. I think the issue is, I think that the game will be that at some point you need to get some sort of a senior level sign off on a final deal, especially when it comes to a package deal like this. That tends to be a little bit more difficult if you're obviously involved in a war, and in which case this becomes priority number 9 or 10 on your list. And that's obviously going to be an issue with the Trump administration. On the other hand, especially if the war starts to wind down, and this war could end quite suddenly for all we know, you have a President Trump who wants to line up some victories, because so far it looks like this war is not going to go very well for him.
Mr. Pant, same question as far as the motivations behind White House, behind Donald Trump in closing this deal. What will be the impulses, motivations guiding Donald Trump as he looks to lock down on this deal, or will he be more geared towards what's happening at the Strait of Hormuz, what's happening out of Tehran?
I think at this point, certainly, he doesn't have the bandwidth to deal with this, but I think the bureaucracies have continued to engage with each other, so that engagement continues, and that is good news in some ways, because first of all, the basis has to be prepared for the two leaders, particularly the U.S. president, to sign off on it, and I think that can be done despite what is happening in West Asia. Certainly, for Mr. Trump, it is going to be a case of trying to gain some victories, as Pramit was saying. And given the last few months, how terrible they have been for him, for his, he's sliding down the opinion polls. There is a challenge of how do you define victory in this conflict that he has unleashed in West Asia. And I don't think that he has any good answers, because his base is also divided. If you see the response in the MAGA base, that is divided on this issue, which is not really going well for him. So I think in that context, we can expect him to certainly push some big ticket items, and therefore, if the war winds down or de-escalates in some way, there can be some potential to really Trump coming into the picture and signing off on this agreement, if the two bureaucracies do manage to conclude and clear some of the final challenges that still exist on the ground.
Right. Right, Mr. Pant, Mr. Chaudhary, thank you so much for joining us again. A key date to watch for will be, of course, the Section 301 investigations. They're due to be completed by the month of June. So that, in a way, is a timer, again, on these talks as far as India is concerned. Let's move ahead. We're slipping into a very short break, but coming up next, the Aam Aadmi Party's Rajya Sabha MP Raghav Chadha, who had recently been removed as the party's deputy leader in the upper house has said that 7 MPs, including him, will join the BJP. We discuss that on the other side. Welcome back to the news center. Now to the big national story that we're tracking. The Aam Aadmi Party's Rajya Sabha MP Raghav Chadha, who had recently been removed as the party's deputy leader in the upper house, has said that 7 MPs, including him, will join the BJP. Chadha was flanked by 2 Rajya Sabha MPs, Sandeep Pathak as well as Ashok Mittal, at the press conference where he made the announcement. Now, Chadha has said that 4 other MPs, Swati Maliwal, Rajinder Gupta, Vikram Sani and former cricketer Harbhajan Singh, will be resigning from the Aam Aadmi Party and joining the BJP as well. Now, AAP currently has 10 lawmakers in the Rajya Sabha. Explaining his decision, Chadha said that the party he had nurtured with blood and sweat had strayed from its founding principles. Once a close aide of Kejriwal, the 37-year-old Chadha had been associated with the Aam Aadmi Party since its inception. One of the prominent spokespersons of the party, he was also appointed the party's national treasurer at the age of 26. Now, Kejriwal responded to the news, tweeting that the BJP had betrayed the people of Punjab. Party leader Sanjay Singh, also a Rajya Sabha MP, said that Punjab would never forget the traitors who stabbed the people in the back. Now, Chadha has said that he and the other 6 MPs have exercised the provisions of the Constitution to merge with the BJP.
और बहुत शर्म के साथ ये कह रहा हूं कि जो पार्टी करप्शन खत्म करने की कसम खाकर बनी थी, वो पार्टी आज करप्ट और कॉम्प्रोमाइज्ड लोगों के हाथ में बुरी तरीके से फंस चुकी है. We, the 2/3 members of parliament of the belonging to the Aam Aadmi Party in Rajya Sabha, exercise the provisions of the Constitution of India and merge ourselves with the BJP. हम BJP में विलय करते हैं.
भारतीय जनता पार्टी नरेंद्र मोदी और अमित शाह का ऑपरेशन लोटस, घटिया राजनीति का खेल और पंजाब के भगवंत मान सरकार के अच्छे कामों को रोकने का षड्यंत्र बड़े पैमाने पर शुरू हो गया है.
Sinha, Supreme Court advocate. Mr. Sinha, thank you for joining us. First question, again, divorcing this discussion from the politics of it, but rather concentrating on the law. Raghav Chadha says, I'm acting as per the anti-defection law. I can move with 2/3 of the MPs in Rajya Sabha. I can merge with the BJP. Is that constitutionally tenable?
See, as per the 10th schedule, legally he has a point because they have 10 members in the Rajya Sabha, out of which a 2/3 majority of those people need to officially merge with the party. It's not a simple case of resignation and joining a party. It's a case of merger. Merger comes with certain procedures. He has to file documents with the chairperson of the Rajya Sabha, and the 2/3 is crossed if he has 7 members, as he claims to. Now, on this, at this stage, if he's claiming that he has filed the papers, then the chairman needs to take a decision. And once he takes the decision, then the merger into BJP is complete. So effectively, he changes, rather that portion of 2/3 of the members become members of the BJP from that date when the merger is announced, and the anti-defection law then does not apply to them. So legally, it seems to be correct. Officially, till the time it actually becomes official, we don't know what's going to happen. It's just a declaration at this time.
Mr. Sinha, just a follow-up question that as far as the 10th schedule is concerned, it seems to suggest 2/3 of the legislative party. Now, what constitutes a legislative party? Is it only the 10 MPs sitting in one house of the parliament, or does it also include all the MPs inside the whole of the parliament, all the MLAs elected by the people in state assemblies as well?
See, that's a question which is debatable because the language of the schedule says that members of a house, then it may be the upper house or the lower house. As it stands, the schedule only mentions house. It is debatable, and obviously it will be subject to challenge. I'm sure AAP is not going to sit idle once this is happening, and this will be questioned, and then that interpretation will come whether it takes into account all of LS and RS or is just the RS. If it is just the RS, then that anti-defection law would not apply because that 2/3 majority seems to have crossed.
Sure. Also, as we speak, we're given to understand that Raghav Chadha may also be making a representation before the Election Commission. If he were to make a claim that the Aam Aadmi Party that he represents is the original Aam Aadmi Party, again, the question I want to ask is, will he need more than just the 7 out of 10 MPs in Rajya Sabha, or will he need a 2/3 majority across all the MPs and MLAs that represent the Aam Aadmi Party?
As far as if you consider the entire legislature, consider both the houses, and he'll definitely need more than those 7. And the issue here is right now that he's claiming a merger. A merger would effectively mean that he is claiming to go to the BJP. The existence of AAP in the legislature is not ending at this time. So if he is claiming that the entire legislature party, including Lok Sabha and Rajya Sabha, are merging with AAP, or 2/3 of those are merging with AAP, that's not his claim right now. He's only claiming Rajya Sabha. So with that, his claim of filing anything with the EC at this time does not seem to be legally tenable as far as I see it.
Also, Mr. Sinha, we're running out of time, so a quick question that any decision that is arrived at by the Rajya Sabha chairperson on whether or not Raghav Chadha as well as the 6 other MPs are to be disqualified or not, is that understanding, is that ruling by a Rajya Sabha chairperson, can that be challenged in court?
Yes, only after he reaches a decision, not before that. At this time, AAP cannot approach the court to seek any sort of injunction. Only after the chairperson reaches a final decision on the merger based on the procedural applications filed by these 7 MPs, only then it becomes amenable to judicial review. Like in the cases of Maharashtra and other states, then it becomes amenable to judicial review, not at this stage.
Right, Mr. Sinha, thank you so much for joining us for that valuable insight. Clearly, this issue is as legal as it is political. We'll, of course, see that play out in the days to come, contingent on, of course, the action that Rajya Sabha MP Raghav Chadha chooses to take and how the response is curated by the Aam Aadmi Party as well. Mr. Sinha, thank you once again for joining us. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
In recognition of her service, she was awarded the Padma Shri in 2020. Please welcome Padma Shri Air Marshal Padma Bandyopadhyay, PVSM, ADSM, BSM with a huge round of applause. Ladies and gentlemen, definitely a standing ovation for her.
Ashu Bandyopadhyay. What an absolutely fabulous moment it is to have you join us here this evening. Thank you for being a future female forward icon. Ladies and gentlemen, what a fabulous story. And I want to understand from you the path that you chose to take, you know, some of the biggest learnings and lessons that you would like to leave us all with.
Good evening. It's a great honor to be amongst you all. My mother sent me a tailoring school because I was short of age. I passed with arts group. In those days, it was called arts group. So, अम्मा ने बोला कि शादी करने के लिए टेलरिंग सीखना चाहिए बहुत जरूरी होता है ये सब चीज़ें ना तो हम गए थे luckily for me I don't know Hindi I studied in the Tamil school here so I don't know Hindi वो टीचर बोलती थी कुड़ी कहती है कि फर्स्ट डिविजन में पास की है ना तुरपाई जानती है ना बॉबिन जानती है हम क्या जाने माय मदर वाज इन हॉस्पिटल फॉर 10 years at Safdarjung I studied in a Tamil school I don't know Hindi I can write English but I can't speak English because our teacher all taught us in Tamil so that's the end of it anyway luckily I was underage so I couldn't join that IAS dream of all South Indians we have, no? Venkatramans, Vishwanathan, they all become IAS officers, no? I also thought so, but luckily I was not so. And I chose pre-medical, which was very, very tough for me. I was the first one to change from arts to science in Delhi University. And I won't take much of your time, but a Fauji never finishes just like that. We say, Jai Hind!
Jai Hind! Jai Bharat! Air Marshal Bandyopadhyay, thank you so much, ma'am, for joining us here this evening. It is an absolute pleasure. Thank you very, very much. Ladies and gentlemen, a big round of applause for our first future female forward icon this evening.
Thank you so much, ma'am, for joining us here. We're extremely honored. Moving on to our next icon, we now recognize a voice of remarkable courage and clarity. After a spinal cord injury at the age of 13 reshaped her life, she refused to let it define her limits and instead rebuilt her path with quiet determination. She went on to study at Lady Shri Ram College, University of Delhi, later at the University of Oxford, where she became India's first wheelchair user to graduate from Oxford. Today, she's an international speaker and disability rights advocate, working across India and global platforms to push institutions to rethink accessibility, equity, and inclusion, not as add-ons, but as design principles. Ladies and gentlemen, please give it up for Pratishta Deveshwar. So much for being here with us today. And you've got everyone's attention. They're listening to you very intently, not just here in this room, but those who are watching us on television and online as well. Again, going back to the resounding message coming in from this room that no matter what the challenges, no matter what the stumbling blocks, you just have to get on with it. What was it that drove you, that motivated you, that inspired you to get on with it?
At the age of 13, I woke up in a hospital bed with a body half paralyzed and a heart completely broken. And when that happens to you at the age of 13, when you are a vivacious, ambitious young girl, it seems like it's the end of life. And it did seem like that to me. I always thought that, कोई बात नहीं, अगर हाफ बॉडी काम नहीं भी कर रही है, मेरा दिमाग काम कर रहा है, मेरा दिल काम कर रहा है, and I am going to focus on what I have.
Thank you, Pratishta, for joining us here this evening and for sharing your story with us. I hope that life brings you all the new adventures that take you on a journey, take you on a ride, and you achieve everything that you've hoped for.
This next honor is for someone who redefined what a second innings can look like. She completed her master's at 44, began her PhD at 47, and earned her doctorate at 53, proving that ambition doesn't follow a timeline. At 54, she stepped into fitness, transforming herself from a homemaker to an endurance athlete. By 57, she had entered reality television through Roadies, and today, at 58, she competes as a hybrid athlete, taking on races and challenges with the same grit she brought to every reinvention. Her journey is a powerful reminder that it's never too late to restart, rebuild, or rise stronger. Please welcome Ashu Jain with a huge round of applause.
We've got all of these pictures of you up on the screen and people actually can see what you do, but what made you want to do this?
So it all started when my elder daughter, she was going to college, and I started in the ranting again, you know, mere bhi bahut khwab the, I wanted to do masters, and she turned around and said, ab to hum pal liye na, now go ahead with that. So that is how it all began.
Can we see a little bit of what you do now that you're not just a grandmom?
Whoa.
There you go, ladies and gentlemen. That is what it looks like when you believe in yourself and nothing gets in your way.
Our next icon is a young athlete whose story already carries extraordinary courage. She lost all 4 of her limbs in an electrocution accident at 8. An Indian para-archer, she has risen rapidly in the sport despite unimaginable odds and now appears on the official world archery circuit. In December 2025, she became the world's first quadruple amputee archer to compete internationally in Dubai. And 4 days before this event in Bangkok, she won gold at the World Para Archery Series final. Please welcome Payal Nag with the loudest applause of the evening.
अभी आपको अपने आप को देख के कैसा लग रहा है?
बहुत अच्छा लग रहा है मुझे अपने आप को स्क्रीन में देख के।
बहुत अच्छा लग रहा है स्क्रीन पे देख के। पर आपने जब शुरुआत की, जब आपने अपने कोच के साथ शुरू किया, तो आपको लग रहा था कि आप ये कर पाएंगी?
जब मैं छोटी थी तो मेरे साथ ये एक्सीडेंट हुआ था, तो तब लोगों ने कह दिए थे कि पायल कुछ नहीं कर सकती, इसे मार दो करके। जब मैं हॉस्पिटल में थी तो लोगों ने कह दिए थे कि पायल अब कुछ नहीं कर सकती, हाथ पैर तो नहीं है, सब गवा चुकी है, अब इसको जहर दे के मार दो करके मम्मी पापा को बहुत लोग बोले थे। बट मेरे मम्मी पापा मुझे मतलब कि कभी ऐसे नहीं सोचे कि कभी पायल कुछ नहीं कर सकती है करके। मेरे मम्मी पापा के वजह से मैं आज जिंदा हूँ और मेरे कोचिस के वजह से आज मैं इंटरनेशनल मेडल, नेशनल मेडल ले पाई हूँ।
आप ओलंपिक में भारत के लिए मेडल लेके आई है पायल, बहुत बहुत धन्यवाद आज हमारे साथ बात करने के लिए, फ्यूचर फीमेल फॉरवर्ड में आने के लिए। और हम चाहते हैं कि आपकी जितनी भी आकांक्षाएं हैं, जितने भी आपके सपने हैं, वो सारे सपने साकार हो, वो सारे सपने पूरे हो। लेडीज एंड जेंटलमैन, अ बिग राउंड ऑफ अप्लॉज फॉर पायल नाग।
Thank you so much, Payal, for coming here. Ladies and gentlemen, our next honoree reminds us that change doesn't always come from systems. It often begins with one person choosing to act. Delhi Police Head Constable Than Singh started by teaching just 5 children in a temple near the Red Fort, and today that effort has grown into Than Singh Ki Pathshala, reaching 230 plus children across 4 centers in Delhi. The initiative provides free education, learning support and nutrition while also working to steer children away from child labor, begging and substance abuse. With community support and volunteers like NSS, MSCW, the impact is already visible, with 30 plus students topping their classes this year.
And that's why I said, ladies and gentlemen, Future Female Forward isn't just about women. It's equally about men who want to drive change, want to be part of the change that we want to see. Than Singh ji, बहुत-बहुत धन्यवाद आज यहाँ पे आने के लिए. मैं सबसे पहले आपसे जानना चाहूँगी, आप दिल्ली पुलिस में हैं. आपने कैसे सोचा कि मैं बच्चियों को पढ़ाऊँगा?
बस एक सपना था, उसको पूरा करना था. पिता का सपना था बेटा दिल्ली पुलिस में जाए, क्योंकि पापा ने देखा अपना सपना, पापा रह गए, तो पापा ने कहा कि मेरा बेटा जाए दिल्ली पुलिस में. उन्होंने मेरा नाम ही थान सिंह रख दिया और लोग मुझे थान सिंह नहीं थाना बोलने लगे. बड़ी जगह बेइज्जती महसूस करी इस नाम से. लगा यार ये क्या नाम रख दिया, क्या नाम रख दिया. स्कूल में देखूं तो ये नाम थाना 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 सुन सुन के परेशान हो गया. बस पापा का एक ही सपना था कि मेरे बेटा पुलिस की वर्दी पहने या किसी भी एक वर्दी पहने ज़रूर. बस उसी ड्रीम को पूरा करने के लिए 2010 में जब दिल्ली पुलिस ज्वाइन करी, तो फिर जब लाल किले पे पोस्टिंग मिली तो देखा वो बच्चे, कोई कूड़ा बिन रहा है, कोई जो टूरिस्ट आ रहे हैं उनसे पैसे मांग रहे हैं, कोई बच्चियां गुटखे खा रही है. तो जब उनसे पूछा बेटा कि आप ये क्या कर रहे हो, क्योंकि वही समय मुझे अपना पुराना समय याद आ गया, क्योंकि मैं भी ऐसे माहौल से निकल कर आया था. उनको बुलाया, उन बच्चों को, बच्चों से पूछा कि बेटा ये क्या कर रहे हो, तुम स्कूल नहीं जाते हो? तो उन्होंने कहा नहीं अंकल जी मैं स्कूल नहीं जाते हूँ. मैंने कहा बेटा ये तो गलत बात है, कहाँ रहते हो? तो उन्होंने कहा अंकल लाल किले के पीछे रहते हैं, मेरे माँ बाप लाल किले में ही काम कर रहे हैं. तो मैंने कहा चलो बेटा मैं आपके मम्मी पापा से शाम को मिलने आता हूँ. उनके माँ बाप से मिलने गया, उनके माँ बाप को समझाया.
धन्यवाद, बहुत बहुत धन्यवाद आज आने के लिए. Ladies and gentlemen, a big round of applause for the head constable of the Delhi Police who is running a school. 250 students have gone through Than Singh's Pathshala.
Thank you so much, Mr. Munjal, for doing this. We now move on to our second set of felicitations, and to present these honors, I'd like to invite on stage Rajesh Warrior, President Global Operations and Chairman and Managing Director, Cognizant India, and Soma Mandal, Member Public Enterprise Selection Board and former Chairman, Steel Authority of India, to kindly join Shireen on stage. Icon has turned endurance into identity. What began as a 3-kilometer jog in 2017 evolved into one of India's most extraordinary ultra-running journeys, earning her multiple Guinness World Records along the way. From high-altitude Himalayan terrain to extreme cross-country runs, she has consistently pushed the limits of human stamina and mental resilience. In one of her most defining feats, she completed the Manali-Leh high-altitude run in 98 hours and 27 minutes, setting a record for the fastest woman on that route. Her story is not just about running distances, it is about redefining what endurance looks like. Please welcome ultra-distance runner Sufia Sufi with a huge round of applause.
98 hours. I can't even imagine what running for 98 hours must feel like. Sufia, what made you want to do this?
मैं ये कहना चाहती हूँ कि कभी-कभी ऐसा होता है कि आपको अपनी लाइफ का जो मकसद है काफ़ी देर में समझ में आता है. आपको ये लगता है कि नहीं, ये वो लाइफ नहीं थी जो हम आपके लिए चाहते थे. I work with the aviation industry for almost 10 years. I work with different airlines. एंड मुझे स्टार्टिंग में ये समझ में आ गया था कि मैं ये नहीं चाहती थी अपने साथ में. बिकॉज लाइफ में होता है ना कि जो चीज़ आपको सुकून ना दे तो वो चीज़ नहीं करनी चाहिए, और मैं वही करती जा रही थी क्योंकि मेरे पास कोई चॉइस नहीं थी. तो मैं वो डेली रूटीन से बाहर आने के लिए कुछ करना चाहती थी. रनिंग ये ऐसा स्पोर्ट है जिसमें ज़्यादा कुछ तामझाम नहीं करना पड़ता है आपको. मैंने पास के ही पार्क में रन शुरू किया 3 किलोमीटर से, एंड इट बिकेम पैशन. अल्ट्रा रनिंग में आई, एंड नाउ आई एम होल्डिंग 5 Guinness World Records.
We wish you the very best of luck. Thank you so much for joining us. Ladies and gentlemen, give her a big round of applause and wish her all the best.
Moving on, this next recognition is for a woman who has turned lived experience into leadership and changed what opportunity can look like. She came to Mumbai after being forced into marriage, rebuilt her life through frontline work in anti-trafficking, and went on to become part of Kranti's founding team, where she anchors its finance operations. She represents a different kind of strength, not inherited but earned through survival, courage, and the refusal to be defined by circumstance. Please welcome Bani Das with a huge round of applause.
Thank you, Bani. Thank you very much for being here with us. We've given a very short introduction to what you do, but it doesn't capture the essence of what you've been able to achieve, what you've been able to accomplish. Take us through that. Yes. But accept the award before that.
थैंक यू. मुझे बहुत अच्छा लगा, बट मैं थोड़ा सा नर्वस भी हो रही हूँ. मुझे थोड़ा सा माइक से नर्वस होता है.
मैं पकड़ लूँ माइक?
नहीं ठीक है. ये जो अवार्ड है ये मेरे लिए बहुत सम्मान की चीज़ है, लेकिन मेरे से ज़्यादा जिन बच्चे के लिए मैं काम करती हूँ उनको ये जाता है क्योंकि उनकी वजह से हम यहाँ पे हैं. मैं 16 ईयर्स से क्रांति में काम कर रही हूँ. मैं को फाउंडर हूँ, एंड 16 ईयर्स में मैंने ऑलमोस्ट 60 से 70 बच्चे के लिए काम किया है. पहले हम मुंबई बेस्ड थे, अभी हम हिमाचल धर्मशाला में शिफ्ट हो गए हैं.
थैंक यू सो मच. थैंक यू वेरी वेरी मच. एंड आपको और आपकी टीम को, क्रांति को बहुत बहुत शुभकामनाएं. मे यू इम्पैक्ट many more lives.
Moving on, the next honor is for someone who has built over 800 learning centers across India's most underserved communities and transformed more than 150,000 homes in Mumbai slums through her Misal India initiative. In 2026, she became the first Indian woman to receive the $1 million GEMS Global Teacher Prize. Ladies and gentlemen, please put your hands together for Rubal Nagi.
Great to see you back here. You've been on Young Turks many years ago, and congratulations on the global recognition that you've just been given. What's the ambition now from everything that you've been able to achieve so far, Rubal? What does the road ahead look like?
Namaskar. Good evening, everyone. Thank you for this. Well, I always say that every award, every praise, every medal that we get comes with a very, very high responsibility and, a lot of weight on your shoulders because everybody is looking at what you're going to do next. And I always say when you educate, you elevate. I've always had only one motto in life, and which is education, education, and education.
Thank you so much, Rubal. Congratulations, and thank you very, very much for joining us here.
We now recognize a woman who, after 3 decades in Indian financial services, chose to tell a different kind of economic story. She left for the mountains, traveled to 30 cities, interviewed 300 women, and wrote Busy Women, published by Penguin in 2026, one of the most important economic documents of this year. Please welcome Shinjini Kumar with a huge round of applause.
From you, so I'm just going to ask you what next now. I know there's another book in the making.
I just want to share one small thing with you. So you have to read Busy Women to know what Busy Women is about. There's no way that I can do justice to it because I did travel through 30 cities. And the point that I continuously keep trying to make is that we are a country that has now been, we've gone through a major economic liberalization 3 decades ago. And we are now into 3rd generation of people who have benefited from this massive growth. So we have to also start looking at women who are coming out of that growth. So while we are doing a reasonably good job with the women at the grassroots, we also need to start paying attention to their daughters who are now air hosts. When I started looking at the demographics of women, I was quite stunned to see how many women were first-time earners for their families, both in rural India and in middle India and in the upper echelons of the country. And these women, their story needed to be written, which is why I wrote that as my first book. And I will tell you about the second book in the second interview. Thank you so much.
Thank you, Shinjini. We look forward to the next book and to our next conversation as well. Appreciate you joining us here this evening.
Moving on, it's time to celebrate an officer from Jammu and Kashmir who secured an all-India rank of 82 in the UPSC CAPF examination and joined the CRPF and quickly distinguished herself during training with multiple top honors, including Best Women Athlete. With 2 years of service, including a posting in Bastar, she has already demonstrated both grit and leadership in the field. Most recently, she led the CRPF's all-men marching contingent at the Republic Day Parade 2026, earning the Popular Choice Award for Best Marching Contingent. Please welcome Simran Bala with a great round of applause.
Simran, what was it like to lead that contingent of men at the Republic Day Parade?
Well, it definitely was a moment because throughout my childhood, I'd always seen Republic Day Parade. We used to get up early in the morning to see the parade live on television. And then finally getting an opportunity to actually be there, present there, to be a part of it. And on top of that, to actually get an opportunity to lead the world's largest paramilitary, that is CRPF's marching contingent. It was a great honor for me.
Absolutely. As they say, there is great strength in gentleness. Simran Bala, many, many thanks. And thank you so much for joining us here this evening. Ladies and gentlemen, a big round of applause.
This next icon has already lit up the stage for us this evening, and now we welcome her back in another capacity. She's a former software engineer, former radio jockey, and the recipient of the National Creators Award for Most Creative Creator Female, presented by the Prime Minister at the inaugural National Creators Award ceremony in 2024. With a style that is multilingual, sharply observed, and unmistakably her own, she has built one of the most distinctive voices in contemporary Indian comedy. From digital storytelling to a 101 show international comedy run, she has made humor out of the everyday and made it unforgettable. Please welcome Ayo Shraddha with a big round of applause.
Shraddha, we've heard of busy women, we've country has been used to. In fact, world over, you know, funny women have been sort of put away. What was it like for you to finally come to terms with the fact that you wanted to own your voice, you wanted to claim your space in the world through comedy, satire, and you know, what you did on stage?
Right. I think I went back to the time when I did not ask for the bat. इस बार तो bat मांगूंगी मैं. So I think I knew what I was going to do, had its challenges. In fact, when you step into the digital world, I think there are just so many things that can break your confidence. You know, just the comment section alone kafi hai.
Do you look at the comment section?
I do, and I have to say my comment section has been rather kind to me. But here I think I would like to say to all the girls, to all the women who are stepping into the digital world to make a career here, I think बहुत ज़रूरी है ये समझना कि कोई कीबोर्ड टेररिस्ट कहीं बैठ के आपकी हिम्मत ना तोड़े. एंड आई थिंक लड़कियों को बहुत फिक्र इस बात की होती है कि अगर ये कमेंट मेरे पिताजी पढ़ लें, मेरी मम्मी पढ़ लें, मेरे घर वाले पढ़ लें. So I think here it's very important that the family says, we know what you're doing and we are proud of you. And, you know, comment section should only encourage you and drive you forward. It should not break your spirit.
Shraddha, we wish you the very best of luck. Thank you so much for joining us. Ladies and gentlemen, Shraddha, thank you for joining us here on the Future Female Forward stage.
Ladies and gentlemen, we now celebrate the youngest achiever of the evening. She started swimming at 9 months. She swam 100 meters in 10 minutes and 8 seconds, becoming India and Asia's youngest swimmer to do so. In March 2026, she set a backstroke record in the International Book of Records. Please welcome Veda Tarfare with a special round of applause. Ladies and gentlemen, now we turn to a performer who defined an era and still carries its memory with her. She represented India at Miss World 1978 at the Royal Albert Hall in London before going on to become one of the most recognizable faces of 80s Hindi cinema. With over 100 films to her credit, she defined an era of dance-led, music-heavy storytelling on screen. She performed in iconic numbers and shared screen space with legends like Kishore Kumar, Manna Dey, and R.D. Burman. Built without a blueprint or backing, her journey stands on pure talent, instinct, and staying power. Please welcome Kalpana Ayar with a huge round of applause. For being here this evening. I don't know how many of you have seen the very, very viral clip of Kalpana ji on stage. I'm going to request Suman Sridhar. Suman, can you join us on stage? Because we are going to have to recreate the magic. Suman, thank you so much for being here with us today. This is a little surprise for you, Kalpana ji, but we are going to recreate a little bit of magic. Should we do it?
Yeah.
Okay. All right.
Ramba ho 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 ho. Samba ho 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 ho. Ramba ho 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 ho. Samba ho 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 ho. मैं नाचूं, तुम नाचो. जितनी तुम प्यार से जी लोगे उतनी ही जिंदगी. रंबा हो 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 हो. संबा हो 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 हो. हो कम कम कम. संबा हो 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 हो.
Ladies and gentlemen, once again a big round of applause for Kalpana Ayar and a huge round of Thank you so much, Mr. Batra and Ms. Arora, for doing the honors. Thank you, Shireen. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening.
Don't rush me, Jeff. Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years.
President Trump says he is in no rush for a deal with Iran as the stalemate continues, gives orders to shoot and kill any Iranian boats placing sea mines in the Hormuz Strait. Tehran says talks will not resume until Washington lifts the blockade on Iranian ports. Sharp sell-off on Dalal Street. The Nifty drops below 24,000 as all sectoral indices close in the red. The Sensex is down 2% this week. The IT index down 10% after earnings from all major companies disappoint. A day after meeting bankers on the Claude Mythos AI model, Finance Minister Nirmala Sitharaman calls it a new challenge, adds that the IT ministry is actively engaging in preparedness. The new Mythos AI model could be used as a cyber weapon if it falls into the wrong hands. Vodafone Idea CEO is expecting the government to complete the reassessment of AGR dues. This follows a Supreme Court order last year allowing the government to reassess the dues, which currently stand frozen at more than 87,000 crore rupees. The Indian trade delegation returns from Washington after 3 days of negotiations. Sources say the talks touch multiple areas, including non-tariff measures, market access, barriers to trade. Among others, both sides agree to remain engaged. President Trump faces a backlash over a social media post calling India and China hellholes. India's External Affairs Ministry calls the comments uninformed and inappropriate. Indian origin lawmakers in the U.S. termed the comment offensive and racist. Big tech companies continue to prune their workforce and rising investments in artificial intelligence. Facebook's parent company Meta announces a 10% cut in its workforce, which will impact about 8,000 employees. Microsoft offers voluntary buyouts to 7% of its U.S. workforce. Authorities seize 400 kgs of fake ghee in Gujarat and 3,000 kgs of contaminated tea powder from Hyderabad. Counterfeit goods are now a national challenge as adulterated food and spurious medicines are being seized across the country in just the last few months. Well, let's go straight to the top story this evening. President Trump continues to contradict himself on the timeline for a possible deal with Iran. Uncertainty continues on the possibility of talks resuming. Now, let's break up what the latest developments are. The president has insisted that he's in no hurry to make a deal with Iran. When asked by reporters how long he was willing to wait, he told them not to rush him. Trump added that other wars took several years, while this one has lasted just 6 weeks. In a post on social media, Trump said that Iran doesn't have time, but he has all the time in the world to make a deal. He added, and I quote, "I want to make a best deal. I could make a deal right now," end of quote. This comes after weeks of Trump insisting that a great deal is likely soon. Trump continued to assert that Iran's leadership has split into two factions. He said, and I quote, "We've been speaking to Iran, but don't even know who's leading the country, end of quote. Now, in response, various Iranian leaders took to social media to present a unified front. The Speaker of Parliament, the President, the head of the judiciary and the accounts affiliated with the IRGC all said that the political establishment and the military are united. Iran's president said that there was no official hardliners or moderates in the country. Back in Washington, officials from Lebanon and Israel agreed to extend the ceasefire by 3 weeks. However, there was no consensus on Israel's invasion in southern Lebanon. Trump said that the U.S. would work with Lebanon to help it protect itself from Hezbollah. Israeli Defense Forces and militant group Hezbollah have already accused each other of violating the ceasefire agreement. Just ahead of the talks, Hezbollah said it fired rockets at northern Israel in response to an Israeli violation of the ceasefire. Meanwhile, in southern Lebanon, hundreds of civilians and media professionals gathered to bid farewell to Amal Khalil, the journalist who was killed by an Israeli strike. The strike killed the 43-year-old reporter and wounded a photographer accompanying her. Lebanon has accused Israel of intentionally targeting a marked ambulance as it tried to reach the journalist. The IDF denied that it was preventing rescue teams from reaching the area and said it did not target journalists. In the oil market, Brent crude prices above the $100 mark as maritime traffic in the Strait of Hormuz remains effectively under a U.S. naval blockade. President Trump has said he refuses to open the waterway as it would allow Iran to make money. He added that the U.S. blockade will be removed only once a deal is made. He also said the U.S. didn't need to use nuclear weapons in Iran because, and I quote, they're totally decimated. Listen in.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. We're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you.
Would you use a nuclear weapon against Iran? You posted on Truth Social a few weeks ago.
We don't need it. Why do I need it? Why would a stupid question like that be asked? Why would I use a nuclear weapon when we've totally, in a very conventional way, decimated them without it? No, I wouldn't use it. A nuclear weapon should never be allowed to be used by anybody. We have total control of the strait. And the fact that it's closed, they would have opened it up 3 days ago. They came to us and they said, we will agree to open the strait. And all my people were happy. Everybody was happy except me. I said, wait a minute, if we open the strait, that means they're going to make $500 million a day. I don't want them to make $500 million a day until they settle this thing. So I'm the one that kept it closed. We have total control of it. And it'll open when they make a deal or something else happens that's very positive.
So no headway there in the U.S.-Iran impasse, no breakthrough, no talks at this point in time. Let's talk about the day's market action. The markets continue to witness a broad-based sell-off with the Sensex and the Nifty ending lower for the third straight session. All sectoral indices closing in the red today. The Nifty down 1%. Similar story for the Sensex. The Nifty IT index bearing the brunt of the pain today, down by over 5%. The Nifty Bank, of course, closing just about in the green. Infosys was the top Nifty loser today, and HCLTech extended losses ending lower for the third straight session. For the week, the markets erased all gains with the Sensex and the Nifty down 2% each. So that's the picture. And the Nifty IT index down 10%. Remember, IT stocks have really taken it on the chin on the back of disappointing earnings. And the mid-cap index was down by about 1% or so. In fact, this is the largest weekly drop that we have seen for the index since March of 2020. Now, JP Morgan has downgraded its outlook on Indian equities from overweight to neutral, and this follows a slew of downgrades from other brokerages as well. Hormuz is standing by to take us through where the markets are likely to be headed in light of the calls coming in. Hormuz.
Hey, JP Morgan's downgrade is not the first one. In fact, today's downgrade comes just a day after HSBC also downgraded India. But look at JP Morgan first. They have downgraded India to neutral from an overweight. They have cut their base case target on the Nifty to 27,000 from 30,000 earlier. And they have downgraded it based on stretched valuations because they find better entry points among peer countries of India, such as Korea and China, among other countries. Now, this comes comes just a day after HSBC issued its second downgrade in less than a month of the Indian equities. They downgraded India now to an underweight stance from neutral earlier, and they say that the risk reward is still unattractive compared to what it was or during their previous downgrade. They had downgraded it first to neutral in the month of March, and this was also followed by a slew of other downgrades that had come in at the start of this month and late last month. Nomura was the first one. They downgraded India to neutral from an overweight rating. They cut their Nifty target to 24,900 from 29,300, and they say that the key reason behind the downgrade was the elevated oil prices due to the Iran war. Goldman Sachs did the same in March. They downgraded India to a market weight from an overweight stance. They cut the Nifty target to 25,300 from 29,500, and they say that the risks over the next 3 to 6 months are tilted to the downside because the market may not be pricing in the full extent of the earnings cuts. This also follows a downgrade by UBS last month, where they say that they have downgraded India due to high geopolitical risks and energy price pressures, although they remain constructive on India's medium-term story. But an interesting letter was written by Bernstein to Prime Minister Narendra Modi. One they wrote once back in 2019, and then this one they highlight possible solutions to recharge the India story, and they say that there is a need to move India away from the low-end labor arbitrage model to a higher productive track, and they have highlighted some key recommendations as well. To phase out subsidies on power and input subsidies as well, to protect farmer incomes via predictable procurement prices is one such recommendation that they have made, and to invest in agri-infra to reduce the reliance on rain and the storage loss as well. They have also recommended phasing out of ICE vehicles gradually and shift their incentives from cash-rich incumbent companies towards the demand side to support new entrants within the automobile space and shift the focus towards electric vehicles. On AI, they say that you should follow a protectionist route for new tech areas, and India must identify emerging sectors early within the manufacturing space before global supply chains are fully formed. They also say that their funds should be redirected from employment guarantee programs in order to build denser metros and bus networks in cities and focus more on public transport, and to remove exemptions from untaxed entities such as certain political and religious bodies, and that could improve the equity and allow for lower overall tax rates. So some recommendations made by Bernstein, but a slew of downgrades coming in from a lot of these foreign brokerage houses for the Indian markets.
Hormuz, many thanks for piecing all of that together for us. Now, Finance Minister Nirmala Sitharaman has called the Claude Mythos AI model a new challenge for banking. This comes a day after she met bankers to assess recent concerns that the model could identify vulnerabilities in operating systems and web browsers. Sitharaman has asked banks to take all necessary preemptive measures to secure their IT systems and protect monetary resources. She added that the IT ministry is actively engaged in preparedness.
We need something new and something far more versatile to be able to counter the newer threats which are likely to come. In the coming weeks, there will be a lot of interaction within the banks, understanding where more investments will have to be made, what kind of technologies can come in, how AI itself can be used for countering this AI-born challenge.
And speaking of Mythos, the Minister of State for Telecom, Pemasani Chandrasekhar, has said that Anthropic Claude's Mythos should not fall into the wrong hands, and the government is considering all options.
We've seen Anthropic release Mythos, which is very good adept at finding inefficiencies and vulnerabilities. Is that a conversation that you're beginning to have?
No, absolutely. These are all the things that we have to do, but at the same time, that Mythos or all that stuff should not also go into the wrong hands as well. So absolutely, we will be taking into all these things into picture.
And shares of SBI Life Insurance down after the Finance Minister raised the possibility of changes in insurance distribution norms. Speaking at an event in Mumbai, the Finance Minister said a government-appointed banking committee will examine whether an open architecture model should be adopted for distributing insurance and other financial products, adding that the panel will assess the pros and cons before taking any regulatory decision.
These are things which the committee will be sitting and working under the IBA chairman, which is being formed, which is part of IBA itself. There's no new committee. Don't ask me, oh, what's happened to that committee? There's no new committee. The IBA chairman with the IBA will be talking to banks to understand how best to go about it. What are the vulnerabilities? By keeping one, by keeping several, by having different vendors but not having some. So all these are going to be worked out.
And on to CNBC TV 18 exclusive, Vodafone Idea CEO tells us that the company expects the government to complete the reassessment of AGR dues soon. Now, this follows a Supreme Court order last year that allowed the government to reassess dues worth nearly 1 lakh crore rupees. So that's the word coming in from Vodafone Idea.
No, I think first of all, I think we are very thankful to the Honorable Supreme Court and the Government of India for taking the holistic view about and a conclusive long-term view about the AGR reassessment. As we speak, the AGR reassessment is on, and I think once that is concluded, then we'll come back to you. The work is in full swing. We can't really comment anything beyond that as we speak.
Any indication from the government as to how long the process will take, how much longer?
The work is on. I think it's on a very fast pace. Let's wait and see when the results come out.
That's Vodafone Idea. And staying with telecom, the telecom department says the telecom companies need to step up and tackle spam calls. Speaking to CNBC TV 18's Ashwat Kumar, the Minister of State for Telecom, said these companies need to strengthen KYC and deploy caller name display on a larger scale.
EKYC, information sharing, if there is one TSP that does an effective invention, it should translate quickly to other TSPs. And then, whether can we block at the international gateway level. So like that, there are multiple ways, they have mechanisms to identify, how we are doing Sanchar Sathi. I mean, they should be able to do the same things and then share with them.
Now, tech giant Microsoft will offer voluntary retirement buyouts to some U.S. employees, marking the first time for the software company. As per CNBC, around 7% of Microsoft's American employees are eligible. The one-time retirement program will be available to workers at the senior director level. It's also available to those whose years of employment and age add up to 70 or higher. The company has been ramping up its AI expenditure and spending heavily on data centers. And more layoffs in the U.S. Facebook's parent Meta has announced it will be cutting 10% of its global workforce on the 20th of May. This amounts to roughly 8,000 employees across all its departments. And this comes as the company continues to make heavy investments in AI. It's also closing about 6,000 open roles. That's the latest from Meta. After Microsoft and Meta, Nike has also announced it will lay off 1,400 employees across its global operations team. Majority of the reductions will be done in its technology division. The sports company plans to streamline its operations and position the brand for long-term profitable growth. This is the second round of layoffs for the company this year. The Indian trade delegation which travelled to Washington, D.C., has now returned after 3 days of negotiations. Sources say that talks touched upon multiple areas, including non-tariff measures, market access, and Abhimanyu standing by to help us understand what transpired and where we go from here. Abhimanyu.
The Indian trade delegation had visited the United States from 20th to the 23rd of April for trade talks with their American counterparts. Several issues were discussed apart from trade and market access. Now, several issues included digital trade, investment promotion, economic security alignment, technical barriers to trade, non-tariff measures, and customs and trade facilitation. The Commerce Ministry has said that the meetings were conducted in a constructive and positive spirit with meaningful and forward-looking discussions which took place, and both the sides agreed to remain engaged to maintain this momentum as they move forward. Now, India and the United States had earlier issued a joint statement on the 7th of February this year in which they had agreed for the framework of a reciprocal and mutually beneficial trade. It remains to be seen how early both the sides are going to resolve all pending issues pertaining to the investigations which have been initiated by the US Trade Representative against several countries, including India, as well as the issue, the larger issue of how much is going to be the percentage of tariff to which Indian goods are going to be subjected towards. The Indian government had earlier indicated that India is looking for a beneficial access as far as the American market is concerned compared to its several competitors in labor-intensive sectors and labor-intensive goods which continue to be exported from India to the United States. The Indian government is looking at a preferential access at possibly at a lower tariff than its competitors.
Abhimanyu, many thanks. The Navi Mumbai International Airport is expecting flight movements to more than double in the coming months. But even as traffic picks up, there are some fault lines emerging among airlines over the increase in cost, the lack of connectivity and the delays in launching international operations. So is Navi Mumbai ready to take the pressure off of Mumbai's main airport? Are structural challenges slowing down its takeoff plans? Madhiya joins us now with the details. Madhiya, it's been a few months now since Navi Mumbai Airport saw flights taking off, but structural challenges remain. Take us through where things currently stand.
While the airport is expecting strong domestic growth, there are clear challenges emerging on costs and international expansion, like you mentioned. Let me break it down. First, on traffic, sources from the airport tell CNBC TV18 that daily flight movements currently around 150 flights a day are expected to rise to about 380 by December. That's a strong scale-up expectation. Passenger numbers are also expected to grow from around 20,000 a day now to nearly 50,000 by year end. That is the expectation from the airport. And demand remains steady. Sources say that load factors above 70%, even in a lean travel season, is a strong indicator. Now, a big driver of this growth is Indigo, because Indigo is the only airline that accounts for about 70% of operations at Navi Mumbai Airport, and that share could rise to as much as 80% in the coming months. This is what sources are telling us. So, Navi Mumbai's near-term growth is closely tied to Indigo's expansion plans. But not all airlines are aligned. Air India, for example, has raised concerns with the airport tariff regulator, AERA, saying a shift to Navi Mumbai may not be viable yet. The airline has flagged higher tariffs at the new airport, connectivity gaps, especially lack of metro access, and the cost of split operations between two airports, Mumbai and Navi Mumbai, all of which could push up costs and impact efficiency. This is what Air India has told AERA. There's also a regulatory angle here. Sources say that AERA, the tariff regulator, has received stakeholder comments on Navi Mumbai Airport's tariff proposal. The airport has now a time till April 27 to submit counter comments. The airport's tariff proposal is still under examination. Current rates that we see at the airport are on an ad hoc basis, and a final order is expected by AERA in about a month. Now, finally, on international operations, there's a delay. The airport was targeting March 29 launch, but that has been pushed back due to West Asia tensions. Airlines are holding back because Gulf routes are critical to launching international services with traffic volume very high on Gulf routes. So for now, there's no clear timeline, with focus shifting to the winter schedule. So bottom line, Navi Mumbai Airport is seeing strong domestic traction led by Indigo, but Air India's concerns, tariff uncertainty and connectivity gaps highlight the hurdles, and with international operations delayed, the airport's full scale-up could take more time. Back to you.
All right, Madhya, many thanks for joining us. Now, authorities have seized 400 kilograms of fake ghee in Gujarat, 3,000 kilograms of contaminated tea powder from Hyderabad. Counterfeit goods are now a national challenge as adulterated food, spurious medicines, fake cosmetics and many other categories of products are being seized across the country in just the last few months. Timsy joins us now with the latest. Timsy.
Latest in the ongoing pan-India drive to curb fake and unsafe products from flooding markets meant for mass consumption. Reports have emerged today from 3 major states exposing the scale and spread of the problem. Starting in Gujarat, authorities seized nearly 400 kgs of fake desi ghee being sold under the brand name Mangal Murti in Nicole. Officials say the product was being falsely marketed as pure, raising serious concerns over what consumers are actually putting on their plates. In the national capital next, a major crackdown in Najafgarh has exposed an illegal supply chain of banned performance-enhancing substances and expired health supplements. The raid, led by food safety officers along with local police, targeted a facility operating without mandatory licenses under food and drug safety laws. The operation was triggered by a high priority alert from the National Anti-Doping Agency, pointing to the growing circulation of prohibited substances in the fitness and wellness market. Further south, in Hyderabad, enforcement teams uncovered a large-scale adulteration racket in tea supplies. Over 3,000 kgs of adulterated tea powder and another 1,500 kgs of expired stocks were seized during multiple raids. Investigators say the compromised products were being supplied to roadside vendors as well as established restaurants, indicating a deep and worrying penetration into the food supply chain. From fake dairy products to illegal supplements and adulterated beverages, these cases highlight a disturbing pattern emerging across states where counterfeit and substandard goods are being pushed into everyday consumption channels. Authorities maintain that intensified surveillance and coordinated enforcement drives will continue, and today's cases underscore just how widespread and entrenched the fake product network has become across the country.
Timsy, many thanks for joining us. This is a serious challenge. It is a national challenge, and as I pointed out, across product categories. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned. The news will continue right here on CNBC TV 18. We're back in a moment.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra, and these are the top headlines from the startup world. AI-based brand analytics platform GobbleCube raises $15 million in a Series A round. This marks the startup's second funding round in a year. The round was led by Saskina Venture Capital with participation from existing investors Infoveg Ventures and K Capital, and the founders dilute 70% stake.
Fintech startup Ulka secures 130 crore rupees in a Series A funding round led by Axel India with participation from existing investors. This marks its second round of funding following a $7 million seed round.
Big tech continues to prune workforce amid rising investment in artificial intelligence. Facebook's parent company Meta announces a 10% cut in workforce, which will impact around 8,000 employees. Microsoft offers voluntary buyouts to 7% of its US workforce.
China's DeepSeek has unveiled the latest versions of its signature artificial intelligence-powered chatbot. This comes a year after its flagship model sent shockwaves through the global tech scene. The preview versions of V4 Pro and V4 Flash are being touted as capable of going toe-to-toe with US rivals OpenAI and Google.
The customer service agent startup Sierra acquires the YC-backed French startup Fragment, which helps businesses integrate AI into workflows. This marks Sierra's third acquisition.
Well, those were the headlines we've been tracking for you this evening on What's Brewing. From a COVID-19 lockdown insight to a fast-growing D2C brand, InVogue is tapping into a category that's quietly evolving from functional innerwear to fashion-led essentials. Bootstrapped and profitable, the shapewear startup is betting on products tailored for Indian consumers, balancing compression, comfort and everyday wearability, even as competition heats up with well-funded entrants. With a strong direct-to-consumer engine and early signs of category tailwinds, the company is now preparing for its next phase of growth, expanding categories and preparing for external capital. Joining me now is Madhav Saxena, the co-founder of InVogue. Madhav, welcome to Startup Street. You've built InVogue as a bootstrapped D2C shapewear brand in a category that was almost invisible a few years ago. What was broken, Madhav, in the Indian shapewear market when you entered, and how are you solving for it differently?
First of all, thank you so much for that lovely introduction. Honestly, when we started a few years ago, everything around shapewear in India was broken. Rather than making someone feel good about their bodies, rather than making look good in shapewear, it was the complete opposite. People used to hate shapewear. They used to feel that, the bodies had flaws when they wore shapewear. And rather than being something that sort of gave them confidence, it just acted like complete opposite way. So that's what we figured, that, shapewear should be confidence enhancing and should not make you feel bad about your body. That's what we sort of found out, and that's how we essentially started InVogue, to ensure that people were confident in the shapewear that they wear.
All right, Madhav, your core pitch is high compression with comfort. These are two things that don't usually go together. How did you crack that product challenge? Also, you're competing with well-funded players and global benchmarks. Where do you win? What is your edge?
Honestly, comfort and compression do go hand in hand. It's just that other brands have not been able to figure that out. You just have to figure out where you have to give compression and where you have to give comfort. It cannot be all around comfort. It cannot be all around compression. You just have to find the perfect mix of comfort and compression, and trust me, it does wonders. We have worked across several iterations over the past 3 years to figure this perfect mix of comfort and compression, and our customers love it completely. And yeah, that's majorly why we are also able to succeed in this category, because honestly, our co-founder Ragni, she herself has lived the problem firsthand. So that's our unfair advantage and the edge over all other global companies, because they have not lived the problem of bad shapewear themselves.
All right, Madhav, you've scaled while staying profitable, even with significant spends on marketing. In a D2C landscape where many are still burning cash, what discipline have you enforced internally to make that work? And also, if you could share with us your revenue targets for the near term.
So it is like, unlike other brands, we often sort of aim to be profitable from the very first sale itself. We do not rely on customer coming back and, then us turning profitable. We always ensure profitability from the very first sale itself. And at the end of this financial year, we're aiming at a monthly revenue of 3 crores. So yeah, that's what we are aiming at.
Okay. All right, Madhav, you've said shapewear is moving from something hidden to something people openly talk about and even flaunt. How big is this behavioral shift, especially among Gen Z? Are we seeing shapewear evolve from occasion wear to everyday wear?
Absolutely. The behavioral shift is insane. Few years ago, when we sort of, went to an influencer or the celebrity or even a normal person to talk about shapewear, they would simply brush off the idea because they associated shapewear with shame. And they were never really ready to talk about it openly in terms of cultural context or whatsoever. However, we have built this whole cultural shift over the past few years, and now people are more than happy to talk about shapewear, flaunt it as an outerwear. We have Gen Z audience wearing it to concerts, parties, everywhere. So it's just beautifully, it has changed.
Okay. Madhav, 96% of your sales come from your own website. Why double down on own channels instead of marketplaces? And in a fashion-led business, how have you managed inventory so tightly while still keeping up with demand? You claim to have zero dead stock across 200 SKUs.
That's correct. So why we double down on our own channel is because we obviously get consumer behavior and the data of the consumer that's worth a lot, honestly. And while we are now also expanding aggressively on marketplaces, so we would be sort of seeing a different shift in terms of the overall channel split. And secondly, ensuring that we have no dead stock, that's because we are working in functional fashion and not just fashion. So when it comes to functional fashion, we are able to predict the demand and, forecast our inventory requirements accordingly, ensuring that we are able to meet the demands of consumers and not sit on any product.
All right, you're now at an inflection point. I believe you're preparing for external funding, expanding categories and launching celebrity-led campaigns. How soon do you plan to raise funds and how much? Also, are you actively in talks with investors right now?
Yes, that's absolutely correct. We are already in the middle of raising a round. So we are raising a round worth 4 crores and we have already secured a significant portion of it. We recently launched a collaboration with Malaika Road and that has been very good as well.
Sure. And I believe there is a swimsuit shapewear in the works. How soon will we see this hit the market and what is the kind of demand you hope to see?
So swimsuit shapewear is something that I'm super excited about because as a category, essentially, we are the ones building it from ground up. No mainstream products currently exist for swimsuit shapewear. So we are sort of planning to launch it in the next couple of weeks. And we are very, very excited because a lot of our shapewear users have demanded a swimsuit shapewear. So we're super excited about this category.
All right. And finally, before I let you go, what's the one misconception about shapewear in India that still needs to be broken?
The biggest misconception that we have come across is that shapewear is just for curvy women. But that's not true. Shapewear is just like makeup for your body. So anyone who wants to accentuate their body, ensure that they look good in their clothes, can opt for shapewear.
All right, Madhav. We wish you the very best for all your aggressive growth targets. Thank you so much for joining us on Startup Street today.
Thank you so much.
And moving on the hot seat, as the AI boom accelerates, the real bottleneck is no longer in modules, it's compute. And across Asia, the gap is only widening. Nava, formerly Crude, is looking to tap into that opportunity. The company has raised $22 million in a Series A round led by Green Oaks as it sets out to build a full-stack AI cloud platform tailored for next-generation workloads. From GPU compute to AI-optimized data centers and orchestration layers, Nava is betting big on a vertically integrated model to power enterprise AI adoption across the region. Now, with Singapore as its new headquarters and expansion plans across APAC, the company is positioning itself as a foundational infrastructure player in the AI stack. Joining us now to talk about the road ahead is Abhinav Sinha, the co-founder and CEO of Nava. Abhinav, thank you so much for joining us on the show today. You're sort of building this in one of the most capital-intensive spaces, right? AI cloud infrastructure. What was the gap that you sort of saw in Asia that convinced you there was room for a new neo-cloud player?
Thank you for having me on Startup Street. You raised the most important question. I think there is a very important context around this. Of course, AI infrastructure is becoming foundational to sovereignty. Geography-wise, every geography needs to look at how much compute software, compute plus software do they have. Compute gap is the most significant at this point of time. Start looking at overall compute. In the US, you are looking at about 100 megawatt per million population. You come to India, you are looking more like 1 megawatt per million population. So US itself is on an aggressive spree of adding compute capacity, especially GPU compute capacity. And if you look at that, they may end up in 5 years from 100 megawatt per million population to about 150. So if India has to match or even come close, we have a large gap to bridge. And this is not just true for India, this is true for many countries in APAC outside China.
Sure, and you've also rebranded, right? You've undergone a rebranding exercise, and you've gone from Crude to Nava, and that was alongside this fundraise. What sort of drove that change, and does it signal a broader shift in positioning as you move from an AI-native cloud product to a full-stack infrastructure player?
Yeah, so we started building on the software side first. We were building AI-native orchestration. We were looking at inferencing software. And now we have expanded our vision significantly to actually build on the GPU compute layer. So we are now building AI native data centers. We are setting up and building GPU compute clusters as well. Nava, as you know, in Sanskrit means new. So Nava now denotes our grown ambition and the intent and the speed with which we want to move. So that's why, one of the core reasons we moved from Crude to Nava.
All right. And now that you're positioning yourself as this full stack, vertically integrated AI cloud from data centers to orchestration, how does this differ from existing hyperscalers, and where's your edge?
See, compute capacity, the need for compute capacity is moving already from training workloads to inferencing workloads. Inferencing workloads have an edge if you are closer to the customer. So this needs to be built across the world and not just in the US or in Europe now. So there is an ample opportunity for everyone to actually build closer to the customer. We believe our software first DNA provides an edge for us to think about the entire stack and integrate and build it fast. So speed will be another differentiation that we will bring to the table. But yes, it is more about learning from the ecosystem and adding on top of it. And we believe the ecosystem has a lot to offer in terms of where you can differentiate today.
All right, and you've got this $22 million coming in, right? Where will you deploy capital most aggressively? Capacity build out, GPU infrastructure, or your go-to-market across the APAC region?
We will start, of course, we've already started building out the team. We are looking at building the team in Bangalore, also setting up our team in Singapore. We are looking at hiring across GPU orchestration, across AI data center architecture and design, roles related to power, liquid cooling. So a bunch of these, infrastructure and software related roles. We are also looking at expanding operations beyond India to different countries in APAC, as you mentioned rightly so. And finally, most critically, we are setting up our first couple of GPU compute clusters. And, this capital is all going in these areas.
All right. And we're sort of seeing this massive surge in AI demand. How big is the infrastructure gap in Asia today? And how urgent is this need for enterprises? And if you could sort of tell us, where does India fit into your growth plans?
As I was alluding to, the infrastructure gap is pretty significant. You can look at, this geography. If you have to match where the US would be in 5 years, you could be talking about a gap which is maybe 100x from where we should be in 5 years' time. I don't think it's possible to reach everything in 5 years. But I think India, as well as other countries in APAC, should be looking at maybe a 10 to 15-year period and getting to maybe 75 to 80% of the capacity per person that the US has or US will have in the future. So this is going to be significant, not just to fuel the requirement and fuel the growth of the growth that you are seeing and the demand that you are seeing from the customers here, but actually to also build the most relevant software layer on top, the most relevant orchestration layer on top, whether cloud or end application layer. You have an edge if you own significant compute capacity at this point of time. So there will not just be a sovereign angle in really being self-sufficient in terms of compute capacity, but also in terms of what edge your cloud or applications have that will be driven by how much underlying compute capacity you have.
Absolutely. But one of the biggest barriers remains the cost of compute, right? Especially for startups in India. How are you sort of thinking about pricing to make AI infrastructure more accessible while still sort of maintaining your margins?
There are a lot of dimensions around which you can innovate. I think the cost of GPUs, of course, remains 65-70% of the underlying cost, and that pretty much remains consistent across. When you start looking at underlying cost of land, power, and then the talent that sets up everything, that's where you can bring differentiation. But you can also bring a lot of differentiation in terms of how your software uses your underlying hardware, how the power, liquid cooling, and all the services basically drive efficiency in the underlying GPU infrastructure. So there's a lot that you can do to not just be the best in terms of, what you can offer, let's say from an inferencing cloud perspective, but also do that at the cheapest cost, right? So there are both these dimensions around which, a lot of innovation is possible, but that does need investment on infrastructure. I'm very excited to see the government being very open and very forward-looking in making these forward-looking bets. So yeah, I think next 5 years are going to be critical for India and also other countries in Southeast Asia in this journey.
Absolutely. And finally, before I let you go, what's your monetization strategy at this point? Are you looking at a pure compute as a service model, enterprise contracts, or a more sort of platform-led pricing structure?
We are different here because we are a software-led player. So we'll be looking at our own inferencing cloud, also looking at providing GPU cluster as a service to wherever large cluster demands are needed. So it will be a combination of both, and it will depend upon the type of opportunities we see in specific geographies around specific clusters.
All right, sure. All right, thank you so much for taking time out and being here with us on Startup Street. And Abhinav, we wish you all the best on this journey going forward.
Thank you so much.
Well, with that, it's time for us to head into a short break. But coming up, India is becoming central to AWS's global cloud and AI strategy. A special conversation on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. India is becoming increasingly central to AWS's global infrastructure play as the company steps up investments in capacity, talent, and AI capabilities in the country. Speaking to CNBC TV 18's Meghna Sen, Prasad Kalyan Raman, Vice President at AWS Infra Services, explains why India is among a select group of markets with multiple AWS regions and why the company is committing billions of dollars to scale its footprint.
We've actually had a long history in India, right, for over a decade now. We started off with our Mumbai region, and then we actually built the second region as well in India. And India is actually one among the very few countries. It's one of literally 6 countries where we have more than a single region. Now, these regions are full-fledged regions. They're regions with 3 availability zones, fully featured set of services. For regulated customers, they wanted the second region as a disaster recovery region, and so it satisfies those needs. But for all the other customers, they're actually able to launch their applications both in Mumbai as well as in Hyderabad, depending on their latency requirements and so on. But the same invariants about high levels of security, availability, and performance are actually universally there across all those regions.
So as you mentioned, we have seen AWS's investments in Mumbai and then in Hyderabad. So are you planning to expand the data center footprints in India with new regions or clusters, especially as other conglomerates, they are also scaling up their infrastructure investment?
Yeah. Well, look, as I said, India is a huge location for us from a growth perspective. We've been very, very fortunate with how customers have relied on us. Like you look at customers across, I talked about in the keynote, I talked about Swiggy and talked about Wipro, Zomato, who's actually released that Nugget app, and now it's expanding it across many other customers as well, or Apollo Tires and so on. So lots of customers across pretty much every single vertical has been using us in India. Like any other region, we're constantly listening to customers, and we have some pretty aggressive growth plans in India, and we will continue to do so. And if you look at our investments, we actually said that we're going to be investing about $12.7 billion by 2030. It's a pretty significant amount of investment.
Also, what do you make of the AI scene in India? Are you seeing those kind of energy levels that you usually see in the US?
Absolutely. I think India is one of the things that is great about India is it boasts a really good, robust energy infrastructure and a transmission infrastructure. So, you have companies across the board who are ready to actually lean in forward with us. I actually think that India is a pretty strong advantage in terms of its energy infrastructure, both in form of like renewable energy as well as access to network, access to land, access to a strong labor force that can build infrastructure at scale that we want. And I think India is very privileged in that sense. And I think overall the general public plus the governments are leaning forward. And noting that AI infrastructure is going to be key for the next generation as well. You look at Sarvam and you look at what the public sector is actually investing in. It's quite encouraging to hear.
Can you also guide us through the CAPEX plan in AI infrastructure investment at AWS? And if yes, what would be the primary source of funding? Well,
this is in Amazon's DNA. When we actually find that there are areas that we think that it is worth us investing, and when our customers tell us that they want us to be investing in this area, we actually lean forward, right? And so Andy talked about his investments close to hundreds of billions of dollars. You see our investment in India as well, like $12.7 billion. All of Amazon is going to be investing about $35 billion by 2030. And that's in addition to the $40 billion that we've already invested. I think when you actually have a huge opportunity like GenAI, which is in front of us, we lean forward on those kinds of investments. We've never been shy about investing that badly. If you look at many years back at our investments in Amazon.com, people used to ask us the same questions, like, how much are you guys investing in it? And look where we are. It's a household name on what Amazon.com is. And same thing with AWS. Like there is literally virtually no industry that is not actually onboarded onto AWS. And if you look at our earnings as well, it's actually quite staggering. We've actually grown in the last quarter 24% year over year with a $142 billion run rate. And that's, literally in the last 13 quarters, that's the highest growth rate we've seen. So we're accelerating growth.
It is Friday and it's time to take stock of the startup deals this week. As per Venture Intelligence, 20 startups raised nearly $80 million. Some of the notable deals include credit management platform Ulka raising $14 million from Axel India, Lightspeed, Z47 and others, while gaming startup Light Fury Games secured $11 million from Bloom Ventures, Mixi and V3 Ventures. Meanwhile, M Home Automation is set to secure $11 million from Bloom Ventures and Peak 15 Partners.
And some of the other deals include ice cream chain Hoko raising close to $11 million from Sauce VC, while textile tech startup Stitch AI raised $7 million from K Capital and Omnivo Partners. Year-to-date, 2026 has seen a total of 314 deals worth $2.93 billion. And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates coming up on the other side. Stay tuned.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The big stories that we're tracking for you this evening.
Don't rush me, Jeff. Guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years.
President Trump says he's in no rush for a deal with Iran. Reports suggest Iran's Foreign Minister Araghchi is likely to visit Pakistan for consultations. U.S. Secretary of War Pete Hegseth says a second aircraft carrier will join the Hormuz blockade. Crude oil prices continue to rise as the Strait of Hormuz remains choked. Brent crude breaches $105 a barrel. The 3-week extension of the ceasefire in Lebanon does little to stem the rising prices. Nifty IT index is down 10% this week after earnings from all major companies disappoint. This is the biggest weekly decline in 6 years. The Sensex and the Nifty down 2% this week. Big tech continues to prune workforce amidst rising investment in artificial intelligence. Facebook's parent company Meta announces a 10% cut in its workforce, which will impact 8,000 employees. Microsoft offers a voluntary buyout to 7% of its US workforce. A day after meeting bankers on the Claude Mythos AI model, Finance Minister Nirmala Sitharaman calls it a new challenge. Adds the IT ministry is actively engaging in preparedness. The new Mythos AI model could be used as a cyber weapon if it falls into the wrong hands. Adani run Navi Mumbai Airport expects to more than double daily flights and passengers by the end of the year, but airlines are divided. Indigo is currently driving 70% of the traffic as Air India expresses concerns over higher tariffs and connectivity gaps at the new airport. Aam Aadmi Party's Rajya Sabha MP Raghav Chadha joins the BJP along with 6 other Rajya Sabha MPs. Says 2/3 of AAP's Rajya Sabha MPs have now merged themselves with the BJP. Arvind Kejriwal calls it a betrayal of the people of Punjab, where BJP has only 2 MLAs. US President Trump faces a backlash over a social media post calling India and China hellholes. India's External Affairs Ministry calls the comments unfortunate and inappropriate. Indian origin lawmakers in the US termed the comment offensive and racist. Authorities seized 400 kgs of fake ghee in Gujarat and 3,000 kgs of contaminated tea powder from Hyderabad. Counterfeit goods are now a national challenge as adulterated food and spurious medicines are being seized across the country in just the last few months. Well, the top story that we continue to track this evening, President Trump continues to contradict himself on a timeline for a possible deal with Iran. This as uncertainty around talks persist. Now, let's take a look at the latest developments in this case. Iranian state media has said that Iran's Foreign Minister Sayed Abbas Araghchi will begin a round of visits to Islamabad, Muscat and Moscow starting this evening. Araghchi is reportedly expected to engage in bilateral consultations and discussions about the war. Now, this comes as President Trump insists that he is in no quote-unquote hurry to make a deal with Iran. When asked by reporters how long he was willing to wait, he told them not to, and I quote-unquote, rush him. Trump added that other wars have taken several years, while this one has lasted only 6 weeks. Now, in a post on social media, Trump has also said that Iran doesn't have time, but the U.S. has all the time in the world to make a deal. He added, and I quote, I want to make the best deal, a deal I could make right now. That's President Trump. Now, this comes after weeks of Trump insisting that a great deal is likely and perhaps even on the anvil. Now, Trump continued to assert that Iran's leadership has split into 2 factions. He said, and I quote, we have been speaking to Iran but don't know who's leading the country, end of quote. Now, in response, various Iranian leaders taking to social media to present a unified front. The Speaker of Parliament, the President, the head of the judiciary and all of the accounts affiliated with the IRGC insist that the political establishment and the military remain united. Iran's president has said that there were no official hardliners or moderates in the country. They are all speaking in one voice. Now, in the oil market, Brent crude prices have remained above the $100 mark as maritime traffic on the Strait of Hormuz remains effectively under a U.S. naval blockade. President Trump has said that he refuses to open the waterway as it would allow Iran to make money, adding that the U.S. blockade will be removed only once a deal is made. Now, this comes a day after Trump said he has ordered the Navy to shoot any boat putting mines in the strait. U.S. Secretary of War Pete Hegseth reiterating that no ship can pass through the waterway without U.S. permission. Hegseth said the U.S. seized 2 Iranian ships in the Indo-Pacific region this week while threatening to seize more, adding that 34 have been turned around in total. Hegseth also criticized the EU and Asian countries for depending on the U.S. to reopen the strait. Now, it's important to note that the strait has now been blockaded by the U.S. itself.
How long are you willing to wait until you get a unified response?
Don't rush me, Jeff. You know, guys like you want to say, oh, so we were in Vietnam like for 18 years. We were in Iraq for many, many years. We're in for all the, I don't like to say World War II because that was a biggie, but we were 4.5, almost 5 years in World War II. We were in the Korean War for 7 years. I've been doing this for 6 weeks, to be honest with you.
This should not be America's fight alone. We barely use the Strait of Hormuz as a country. Our energy doesn't flow through there. Europe and Asia have benefited from our protection for decades, but the time for free riding is over. America and the free world deserve allies who are capable, who are loyal, and who understand that being an ally is not a one-way street. We are not counting on Europe, but they need the Strait of Hormuz much more than we do, and might want to start doing less talking and having less fancy conferences in Europe and get in a boat. This is much more their fight than ours.
And officials from Lebanon and Israel have agreed to extend the ceasefire by 3 weeks in Washington. However, there was no consensus on Israel's invasion in southern Lebanon. Trump said that the U.S. will work with Lebanon, and I quote, to help it protect itself from the Hezbollah. Israeli Defense Forces and militant group Hezbollah have already accused each other of violating the ceasefire agreement. Now, just ahead of the talks, Hezbollah said it fired rockets at northern Israel in response to an Israeli violation of the ceasefire. Meanwhile, in southern Lebanon, hundreds of civilians and media professionals gathered to bid farewell to Amal Khalil, the journalist who was killed by an Israeli strike. The strike killed the 43-year-old reporter and wounded a photographer who was accompanying her. Lebanon has accused Israel of intentionally targeting a marked ambulance as it tried to reach the journalist. The IDF denies that it was preventing rescue teams from reaching the area and said it did not target journalists. Meanwhile, Israeli Prime Minister Benjamin Netanyahu has announced that he underwent a treatment for early-stage prostate cancer. In a post on X, Netanyahu said that the treatment was successful and that he is in excellent physical condition now. Further, the Prime Minister of Israel also said that he delayed the release of the medical report by 2 months so that it wouldn't be used as propaganda by Iran. On to the day's market action. Markets have continued to witness a broad-based fall, with the Sensex and the Nifty ending lower for the third straight session. All sectoral indices closing in the red, with the Nifty IT index being the biggest underperformer, down 5% this week. Pressure clearly being seen there. Infosys emerging as the top Nifty loser. HCLTech extending losses, ending lower for the third straight day. The markets didn't like results from the IT pack this week. For the week, the markets have erased all the gains. The Sensex and the Nifty down a little over 2%. Look at the Nifty IT index down 10%. That is telling you the kind of pain that the IT index has seen. A bad week, most certainly on the back of weak earnings, leading to the biggest weekly drop for the index since March of 2020. Now, JP Morgan has downgraded its outlook on Indian equities from overweight to neutral. This follows a slew of downgrades from other brokerages. Hormuz is standing by with more. Hormuz, what do they have to say?
JP Morgan's downgrade is not the first one. In fact, today's downgrade comes just a day after HSBC also downgraded India. But look at JP Morgan first. They have downgraded India to neutral from an overweight. They have cut their base case target on the Nifty to 27,000 from 30,000 earlier. And they have downgraded it based on stretched valuations because they find better entry points among peer countries of India, such as Korea and China, among other countries. Now, this comes just a day after HSBC issued its second downgrade in less than a month of the Indian equities. They downgraded India now to an underweight stance from neutral earlier, and they say that the risk reward is still unattractive compared to what it was or during their previous downgrade. They had downgraded it first to neutral in the month of March, and this was also followed by a slew of other downgrades that had come in at the start of this month and late last month. Nomura was the first one. They downgraded India to neutral from an overweight rating. They cut their Nifty target to 24,900 from 29,300, and they say that the key reason behind the downgrade was the elevated oil prices due to the Iran war. Goldman Sachs did the same in March. They downgraded India to a market weight from an overweight stance. They cut the Nifty target to 25,300 from 29,500, and they say that the risks over the next 3 to 6 months are tilted to the downside because the market may not be pricing in the full extent of the earnings cuts. This also follows a downgrade by UBS last month, where they say that they have downgraded India due to high geopolitical risks and energy price pressures, although they remain constructive on India's medium-term story. But an interesting letter was written by Bernstein to Prime Minister Narendra Modi. One they wrote once back in 2019, and then this one, they highlight possible solutions to recharge the India story, and they say that there is a need to move India away from the low-end labor arbitrage model to a higher productive track. And they have highlighted some key recommendations as well. To phase out subsidies on power and input subsidies as well. To protect farmer incomes via predictable procurement prices is one such recommendation that they have made. And to invest in agri-infra to reduce the reliance on rain and the storage loss as well. They have also recommended phasing out of ICE vehicles gradually and shift their incentives from cash-rich incumbent companies towards the demand side to support new entrants within the automobile space and shift the focus towards electric vehicles. On AI, they say that you should follow a protectionist route for new tech areas, and India must identify emerging sectors early within the manufacturing space before global supply chains are fully formed. They also say that their funds should be redirected from employment guarantee programs in order to build denser metros and bus networks in cities and focus more on public transport, and to remove exemptions from untaxed entities such as certain political and religious bodies, and that could improve the equity and allow for lower overall tax rates. So some recommendations made by Bernstein, but a slew of downgrades coming in from a lot of these foreign brokerage houses for the Indian markets.
And a Friday surprise, or rather shock, for Paytm coming in from the Reserve Bank of India. The Reserve Bank of India has cancelled the banking license of Paytm Payment Bank. Remember, it's a banking license of Paytm Payment Bank. The entity will be prohibited from conducting any business related to banking. RBI says affairs of the bank were conducted in a manner that was detrimental to the interest of banks and depositors. This, as I said, is the latest that's come in from the Reserve Bank of India. Remember, Paytm has been the crosshairs with the regulator for several years. Now, Prashant joins us with more. Prashant, a surprise as well as a shock coming in from the Reserve Bank Friday evening for Paytm Payment Bank.
Absolutely, Shireen. And, the thing is, if anything, there was relief which was expected for Paytm. So this is actually exactly the opposite of what has come through. And as you said, Shireen, one, of course, is the fact that they've very clearly pulled the plug on the bank, Paytm Payments Bank. But, what's surprising to me is it's really, if you look at the text of it, it's a very sharply worded order, prohibiting from undertaking any banking business. So basically, it's effectively ending its operations as a regulated deposit-taking entity. Saying, and it's the exact text of it, that the bank's affairs were conducted, and I quote, in a manner detrimental to the interests of the bank and its depositors. Another sentence which I think really stands out: no useful purpose or public interest would be served by allowing the entity to continue operations, and of course, failing to comply with licensing conditions, etc. So I think it's a pretty, the one thing, of course, is the action, and the other is the really sharply worded order itself, which kind of tells you that the RBI is really serious about, in a way, reinforcing differentiated banking licenses, especially payment banks, which come with strict compliance expectations. And of course, in no mood to give any regulatory forbearance, especially in this case. So we just have to see. Of course, we'll try and get in touch with the Paytm management as well to see what went wrong here. But this is a pretty it's of course extremely hugely detrimental to Paytm and its brand, etc. But it's of course also the fact that I think this is one of the more sharply worded orders that I remember reading, at least in the recent past. So absolutely, I think a bolt out of the blue, as I said, the market and the analyst community was expecting some relief. The share price, for example, had done very well. By the way, through the course of the market correction in starting late February, the Paytm share price did correct, but not all that much, because there was always this inherent expectation that there will perhaps be some relief which will come. But this, of course, has gone exactly the opposite way.
Absolutely. In fact, as you pointed out, it has been a turnaround story as far as the stock is concerned from the lows that we saw on the back of the previous regulatory action that the RBI had imposed on Paytm. And it looked like perhaps that things were moving towards an even keel. But this, as I pointed out, is a surprise as well as a shocker that's coming from the Reserve Bank of India this evening. Paytm, of course, at this point in time has not issued any comment on the order that's come in from the Reserve Bank of India. And remember, this is effective the 24th of April, so it's immediately come into play. It is effective immediately. There is no window that has been granted by the Reserve Bank of India. The order imposes the closure, the license cancellation immediately. Prashant, the final word?
No, Shireen, just to go back
on Monday.
I think you will see some. We'll have to see the exact contribution from the bank and whether this was, and we'll do that in just a bit. But this is a license which was granted back in I think 2015-16 under the differentiated banking license framework. The bank started operations a couple of years after that. It was allowed to accept deposits with caps, of course, in terms of per customer caps. And it could offer savings and current accounts and wallets and payments and remittances, etc. All those services. It wasn't allowed to lend, so there isn't a credit book in that sense. So it was not a universal bank, but it was a licensed banking entity within the payments bank category. So I think, as I said, we'll have to look at some of the parts for Paytm in terms of what this means and how big a blow this is financially, and that we will do. But certainly, the way the order has come through, it's a complete surprise. Yeah. And just the tone, tenor of the order, of course, the RBI are very, very displeased with what has gone on.
Yeah. Prashant, hang in there. Ritu also joining us. Ritu, this is a Reserve Bank of India's order coming in effective immediately. The license for Paytm Payments Bank stands cancelled. And we're trying to piece together what the impact is likely to be, but also what has led to the Reserve Bank taking this action, because it seemed like things were moving forward, that there was an attempt to stabilize things. In fact, they got that payment aggregator license that the RBI granted them, recently as well, Ritu. So any ideas on what has led to this decision by the Reserve Bank?
Shireen, as far as my understanding goes, and this is from a conversation with various stakeholders, including the regulator that we've had over the course of the last 2 years, the intent at the time that the license was, put on hold when, they were barred from doing any business, and I'm talking January of 2024, the intent very much was to ensure that a banking license may not be granted to Paytm anymore. Remember, this is a payment banking license, not a universal banking license in the sense that it didn't function as a bank, but it was a payment bank license. So there was no lending, but there was a wallet business that was very much thriving, part of the bank. That eventually got moved out of Paytm Payment Bank. And subsequently, like you were mentioning, Paytm did have licenses to operate as a payment aggregator as well, which it recently received. The idea, it took some time for, the businesses to be wound down because there were balances in these wallets that had to be drawn down to the last penny. as per our last conversation with stakeholders, including regulators, that was the intent. Once the business is completely bound down, a cancellation was in the offing. However, the market expectations were to the contrary, simply because, there were a couple of regulatory licenses that Paytm has received over the course of the last year. So perhaps in one corner there was an expectation that the payment bank business may also revive. But like I said, the expectation always was to allow sufficient time for all the customers to withdraw every last penny and thereafter take this action. And, it's not a huge surprise then, because it was operating very much as a shell company. The wallet business, which was a key part of the business, has already been moved out of it. So now the Paytm banking license getting cancelled, visibly, there was no real impact in terms of financials for Paytm now. It is not completely unexpected from what the regulator had told us as well. But sentimentally, yes, this is a negative. But it is just a carry forward of the action that was first taken in 2024.
Yeah, thanks very much, Ritu, for putting that in context. It is a carry forward of the action, as we were discussing with Prashant as well. And at the end of the day, perhaps it will have limited impact because, as you pointed out, this was essentially non-functional on the back of the measures that the RBI had already imposed. We also got Abizar Divanji of Neostrat Advisors joining us. Abizar, many thanks for joining us. The RBI cancelling the license of Paytm Payment Bank effective today, that is the 24th of April. The bank is prohibited from conducting the business of banking, and the bank, it says, according to the RBI, failed to comply with conditions stipulated in the Payments Bank license. So essentially a carry forward of the action that was already taken by the Reserve Bank of India. What do you believe the impact is likely to be, Abizar, and the message that this sends out?
So the message that it sends out, Shireen, is more important. One is that the bank is a fiduciary for basically money laundering in the system. Now, I'm not saying that Paytm was doing money laundering, but one of the clear responsibilities of the bank is to make sure that the right kind of money flows through the legal system. Now, the issues that were happening earlier, just to recap for everybody else, was that they had commingled the wallet and the savings bank account. And what had happened as a result of that is, in wallets, the KYC or the acceptance norms are easier than that for a savings account. And commingling them really meant that inadequate KYC was done for opening of savings bank account. And once funds come into the banking system, they can freely move around. So that fiduciary responsibility is where RBI imposes very high standards on governance, and which is why the license was not accepted at one stage.
Yes, Abizar, given that this decision has now been taken, what will the path forward look like as far as Paytm in itself is concerned? Because we have seen through 2025 a significant recovery, specifically as far as the stock price is concerned. So investors will be curious to understand what this means now as far as Paytm itself is concerned.
So I think Paytm has evolved over years more than the payments bank, because the payment bank wasn't functioning any which way for the last 2 years. But really, what Paytm has done is actually created a very good payments ecosystem which stays intact, especially its merchant distribution is very, very strong. Its ability to now do machine learning has been significantly improved. I get most of my prompts on payments from Paytm, even today. So the wallet functioning, the credit mechanism and the underlying data which will enable it to do a loan service provider business is going to be significantly large. So I think the fact that they have got financial data, their ability to data mine them, their ability to service merchants and enabling financing for merchants is going to be a very strong business model.
Yes, it certainly will be. Abizar, many thanks for joining us. Abizar Divanji there. Ritu, coming back to you now, and as we've been pointing out for the benefit of our viewers, explaining the context of this action, limited impact, because this was something that the Reserve Bank had already put in motion. In a way, its finality, its closure as far as this particular issue is concerned, Ritu.
That's right. It should be seen as a continuation of the action that was taken in January of 2024, whereby, because of various reasons we've been highlighting, there were concerns when it came to the payment bank account about the creation of new accounts, about not adequate safety measures being in place, on the back of which RBI decided to act and it stopped all the payment banking business. Keep in mind, a significant portion of that business was things like FASTag, wallet, remittances, etc. Now, over the course of this period, RBI first wanted to ensure that there was sufficient period for any customer that had even a single penny left in Paytm wallets to be able to withdraw. So it wanted to give enough time for the business to then also be wound up. And that has happened over the course of a year or so. If you remember, it took just 6 months, for things to get set in motion. And then the deadline was extended a couple of times by RBI for deposit top-ups, FASTag withdrawals, all of that to happen. Like I was saying earlier, financially, there is zero impact of the banking license getting cancelled on Paytm at this point of time because the company was virtually, non-functional ever since the business was stopped. It was just a matter of winding up. It's been a long time. It's been 2 years. But now, as a continuation of that action, the license has been cancelled. Keep in mind, Paytm has already got the payment aggregator license. So some part of the business moves there. Sentimentally negative, yes. Financially, this does not have an impact really on Paytm.
Right. All right, Ritu, many thanks for joining us. Well, the big breaking story at this hour, we've got the Reliance numbers out flashing on our screens, and we will get our team to take us through the quarter gone by as far as Reliance Industries is concerned. Of course, this has to be seen in the context of what has been happening in the global scenario as well. Let's go across now to Sonal for the Reliance First Cut. Sonal.
Thank you so much for that. Well, yes, consolidated net profit has come in at 16,971 crore rupees for Reliance Industries. As Shireen pointed out, this has to be considered with the fact that March was a difficult month across the board for all industries. The oil and gas business, the energy business did see a lot of shock because of the Strait of Hormuz being shut, a lot of supply disruptions that was difficult for the global energy market as well. So if we look at the numbers on a quarter-on-quarter and on a YY basis, the decline is expected, and this is something that we are seeing across the industry. So 16,971 crore rupees, that is your profit number, which is the decline. Of course, the segmental breakup is something we'll be watching out for very closely. In the O2C business, the oil and gas business, while retail and Jio are expected to do really well, the EBITDA growth is something that the street is expecting in the Jio and the retail business as well. The consolidated revenues higher on a quarter-on-quarter and on a YY basis because a lot of pricing increases that came by in some of these petrochemicals, and that is something which leads to higher revenues also, both on a YY and on a quarter-on-quarter basis. So 2.94 lakh crore rupees, almost at the 3 lakh crore mark on a quarterly basis as far as their revenues are concerned. Now, do remember, because of these supply shocks that we saw, refining margins were higher. However, some of these petrochemical spreads were lower, and that is something that could have impacted the profits this time around. The EBITDA margin is something which is very important to track. 44,141 crore rupees, absolutely in line with the poll, and this is something that the street was expecting. Margins at 15% in line with estimates, and again, as I said, the segmental breakup is very important to watch out for. So let me do one thing. I'll just take a look at the auto chemicals and the oil and gas business. Let me go across to my colleague Mangalam, who's looking at the retail numbers, and tell us what did he make of them.
Well, these are very good numbers coming in from the retail business, Sonal, because it's an 11% growth. Remember, most on the street were working with anywhere between 6 to 9% growth. So far in the fourth quarter, all the retail updates that have come in, say something from Trent, something from D-Mart, something from V-Mart as well, all of them have indicated sequential improvement and increased numbers as compared to analyst expectations, and that's something that is visible on Reliance as well. And the reason why it stands out in Reliance a lot more than others is because the base of Reliance is fairly high as well. And this also includes the impact of the demerger of the consumer business. The street was on a demerged entity, expecting a number anywhere between 85 to 86,000 crores. The company's actually gone ahead and reported 98,457 crores in the consolidated retail revenue. The EBITDA has grown about 3%, which tells you that the margins also fairly stable between the 7.5% mark as well. So far, from the numbers that have been revealed in the retail business, one can give it a big thumbs up for the very reason that it's a double-digit growth as against street expectations of mid to high single-digit growth, and the number being just shy of that magical 1 lakh crore mark in a quarter.
points. That's about the retail business. Very strong numbers coming in from the retail business, as Mangalam just pointed out. Taking a look at the auto chemicals business as well, the EBITDA here has come in at 14,520 crore rupees. So the auto chemicals business, of course, consists of two segments. One is the refining segment that did really well. Singapore GRMs were higher on a quarter-on-quarter basis as well. However, it's the petchem side of things. Remember, a lot of these big players announcing force majeure, be it for naphtha, be it for gas supplies. And that is an important feedstock that goes into petrochemicals as well. And Reliance, being one of the biggest ones in terms of production, did see some impact there. And that's something that we've seen across the petrochemical chain. So here is where EBITDA margins are lower on a quarter-on-quarter basis. The oil and gas business, absolutely in line with estimates. The EBITDA has come in at 4,195 crore rupees, which compares with a number of 4,857 crore rupees on a quarter-on-quarter basis. So strong numbers coming in from retail. We are waiting some more internals with respect to Jio. But let's go across to Deven Choksi, Managing Director of DR Choksi FinServ, joining us now. Deven, thank you so much for joining us this evening. What did you make of the numbers? Of course, March was a difficult month across the board. India Inc. has been talking about it, and the energy shock is something that would impact some companies, but quite steady if we talk about it on a quarter-on-quarter basis.
Yes, Sonal, good evening. Of course, I think the numbers are definitely, I think, steady numbers for the month of March, and not very surprising though, because the full impact of whatever has happened in the month of March and continuing to happen in the month of April is going to be transferred to April to June quarter, and March quarter is in a way safe quarter, if one wants to call it is. Primarily, I think on the face of the immediate numbers reaction, I find that I think they are more or less in line with expectations. We were expecting fall in the EBITDA in the exploration business. I think that also we are observing it here. Around 700 crore worth of less EBITDA has come from the oil exploration business. But overall, the crack seems to have delivered. And that could be the reason for which I think you are seeing more or less expected lines numbers that we are seeing. Of course, the detailed breakup I need to also see. But overall, I think it appears a little steady number.
Right. Deven, I'm looking at the retail numbers. They weren't particularly impacted by, the Middle East crisis. In fact, consumer sentiment across the board has improved. And as we've heard from managements of other companies as well, it's likely to improve further as well. So that's something that we'll monitor. An 11% growth in light of, the GST price cuts that we've seen from the last quarter to now. It happened in September. How would you read that? And secondly, also, if you look at the other internals, their quick commerce business has done very well, and we're expecting a bigger outperformance from these hyper-local deliveries too. So to that extent, how would you read Reliance Retail's numbers so far?
I guess I think they're probably one of the best numbers that one can even ask for. I think they are steadily maintaining their margins, and they are at the same time, I think, registering higher amount of top lines. So probably industry best, as you want to call it as. And one of the reasons for their being the best, they have been systematically acquiring some of the brands, and the contribution of their own brands is basically now giving higher amount of contribution into the business of the company. That is one of the reasons for which I think you are seeing a satisfactory margin performance in this retail business. In my viewpoint, I think once we see little better breakup, I think available on various aspects of retail formats, we will probably have much more clarity. But on the face of it, the numbers are absolutely on dotted lines, I would like to say.
Take that point, Deven. Wanted to understand your take on the auto chemicals business. What do you think of the outcome going forward? Because there is a lot of volatility that we continue to see. Refining continues to do really well. Cracks are higher. Singapore GRMs were up 8% on a sequential basis. Do you think that is a strength which will continue to help the business, where on the petchem side, spreads overall in the industry have gone down?
Yes, you are right, Sonal. I think the refining side of the business, you are likely to see the continued number, at least in the month of April, though we don't have the certainty about further road map in this particular quarter. But as of now, whatever the refining cracks that we have seen, I think they are going to make some super profit in this particular business, which I think is going to be a blessing in disguise for them. though some part of the profit might be taken over by the windfall on the export business. So that is where probably I think you might see some impact. But overall, the refining business likely to contribute well in this quarter. At the same time, petrochemical, and the observation is correct. I believe that I think their amount of challenge is going to be because domestically, some of the petrochemical products, I think because the price is fluctuating so wild, are going to have some serious situation in form of the user industry not lifting immediately the same product. That could be, I think, a little challenge. But again, as I say, it is little early. We are in still, I think, early part of April as far as I think the current financial year and this quarter is concerned. So we'll reserve the comment or analysis, I think, for later date once I think we see more numbers emerging in the system.
Right. You speak about more numbers, Deven. We have the press release as well. And in the retail business, there are some heartening data points that have come in from the press release too. The business registered gross revenue of around 11%, but the area operated increased by just 1.2%, which tells you that the operations per store has actually increased by revenue per square foot has increased as well. Then I was speaking about the hyperlocal and quick commerce business, right? Hyperlocal commerce orders in the fourth quarter were up 29% quarter on quarter. And remember, this is a high base. Q3 typically has a lot of festive orders as well. So growing 29% on that tells you that the company is scaling up with the hyperlocal business. And on a favorable base, this business has actually seen a 300% rise year on year, establishing India's widest hyperlocal delivery network. They've opened 333 new stores with a total count of 20,160 stores. The registered customer base grew as well, and total transactions were up 60% year on year. Reliance Smart, their grocery business, actually crossed 1,000 stores. JioMart as well continued to do extremely well. Fashion and lifestyle too saw a big growth. AGO Lux saw 24% growth year on year. So basically what we understand so far from the internals as well is that they're fairly resilient, fairly strong, and the management outlook as well. Isha Ambani says, as we enter FY27, our focus is on converting the unmatched reach into deeper customer value due to AI, through AI-embedded merchandising, sharper pricing architecture, and disciplined execution. So it looks like now it's all about execution after the expansion that has been underway.
Yes, that's right, Mangalam. And that's why the retail business stands out. By the way, we do have some commentary coming in from the management on the auto chemicals business. They say that the business navigated a complex global environment during the year. The war in West Asia has led to unprecedented dislocation in global supply chains. But they have again demonstrated its commitment to ensure availability of critical energy and materials to India. Reliance is one of the biggest producers of petrochemicals in the country, and despite the supply shocks, the volumes have not been impacted. They also add that I'm happy that Reliance is making rapid progress in operationalizing its new energy gigafactories, and this business will emerge as a powerful growth engine for Reliance and a transformative contributor to India's energy future. The new energy business that is starting to get commercialized, it's closer to that. The gigafactory would be the next trigger for the company as well. It is the next step in the energy business. Let's get in Naveen Kulkarni, who is the Chief Investment Officer at Axis Securities, to get a comment on that as well. Naveen, there's a lot spoken about this new energy business. This is going to be the next trigger for Reliance Industries as well. Have you ascribed any value here? A lot of that capex would see a commencement as well, be it batteries, be it the solar value chain. There's a lot happening here.
Yeah, so as of now, the value of the new businesses for Reliance Industries, I don't think so, is ascribed at more than 5% of the total company value, right? So again, there is a lot of investment which is going on here, but still the business dynamics and the business metrics are not yet known in terms of what kind of ROE this business can make. So broadly, in terms of the value being ascribed is roughly at the capital which is being employed in this business. So roughly at around 5 to 6% of the company's values is being ascribed at this point in time. However, going ahead, if this business starts making higher than cost of equity, obviously it will start getting a multiple.
Okay, we've got Reliance Jio ARPUs and the subscriber numbers. The average revenue per user for the company is flat on a quarter-on-quarter basis, 214 rupees, which compares with 213.7, so flat. On a year-on-year basis, it's an increase of 3.8%. Remember, broadly, Q4 was a very uneventful quarter for the telecom companies. There was no tariff increase, so therefore ARPUs were moving very slowly, and plus there are 2 fewer working days, so that also impacts the ARPUs, because generally the cycle is for 28 days. So if you've got 31 days, you've got 30 days, relatively, it affects the number of days matters for the ARPU. So this quarter had 2 fewer working days. So ARPUs are on the flatter side on a year-on-year basis, an increase of 3.8%, but the subscriber growth is very strong. The company's subscriber number stands at 524.4 million subscribers. That's an increase of 9 million on a quarter-on-quarter basis and 36 million on a year-on-year basis. And 36 million is the highest that we've seen in the last 7 quarters. In the press release, Mukesh Ambani also goes on to say, I am happy to note that we're advancing steadily towards the listing of Jio platform. This will mark a defining milestone in our journey as it continues to scale new heights and contribute to the digital future. Robust full-year EBITDA growth of 19% was driven by continuing traction in mobility, home broadband, and enterprise services. As we work to democratize access to AI tools and next-generation technology platforms, Jio is well-placed to shape how India communicates, computes, and consumes content in the years ahead. So also making a reference to Reliance Jio IPO, the Jio Platforms IPO, advancing steadily towards the listing of Jio Platform. That is going to be the big trigger for Reliance Jio. The street was hopeful of tariff hikes, but tariff hikes have not come through. And now maybe it's a little difficult given we've got elections, and plus there is a possibility that energy prices have spiked up. So the ability for the telecom companies to pass through a price hike in such an environment, inflationary environment, looks tough. But the big trigger is going to be a IPO. The street is talking about a 40,000 to 50,000 crore IPO, making it the largest IPO so far that we've seen. And the DRHP, perhaps, according to some reports, could be filed as early before the end of June. Naveen, Gurmeet Chadha is also now joining in. Gurmeet, any thoughts on Jio's numbers, and what can the IPO do for the company and the sector?
So mixed in terms of